Hello, all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are going to start with our most awaited video, that is the revision of 9 RTPs, 9 past papers and 8 MTPs, total 26 paper compilation we are going to start today. Now before we start with the compilation, I would like to say a few things before we start with our first paper. That is, the very first thing that I would like to say is, whenever I will revise this particular 26 papers, if you find any particular concept important at your end, just make sure that you put a timestamp below the comment box, so that when you want to recap the things, you can directly click on the timestamp and then you will directly jump to that particular section of the video. For example, if something is important at 53 minutes, just put 53:00 in the comment box, and that point, if you click, next time you will directly come to that particular section, so that you don't have to search that concept again and again. This has been very helpful for the students. There has been more than 1300 comments on the video which we have uploaded in the last year. Most of the comments were about the timestamps only. This is the first thing. Second thing that I would like to say you all is regarding this PDF. This PDF I will share once I will upload the second part. Today I am uploading the first part covering 5 RTPs. And next day I will be uploading another part. Day after tomorrow, after that I will share the PDF. Later on I will upload the compiled video of 26 papers together. Okay, at that time I will give you the compiled PDF also of 26 papers at one PDF file only. Third thing, the most important thing that I would like to say before we start with our revision. Whatever we are going to do in this 26 papers, obviously we have done all these things in class. And in class, we have done all these things in our regular batch, exam-oriented batch, and even in our practical question batch in great detail. Here we are going to complete this particular thing as a revision in 8 to 9 hours, so that on the day of examination, you are able to revise. But in the class, I have explained you each and everything in detail. So we have done all these things in detail, except the latest MTPs and RTPs, which were not there available at the time of doing the classes. Except the latest MTPs and RTPs of May 26, rest all we have done in the class. So be careful that there should not be any confusion that you should not ask me such questions. Sir, if we do this, is it sufficient without doing the class videos? We are skipping the class. Don't do that. If you have a class video, then you do the class video first, complete that. That is in great detail. There I have explained everything in great detail. Suppose a question is completed over here in 10 minutes. There it is completed in half an hour. So just imagine the content that I have delivered over there. Obviously, for obvious reasons, that is class, there we have sufficient time. This is for revision purpose. We are doing this video only from the perspective of, so that on the day of examination you should be able to recap it very fast. Last but not least, one more thing, that there are few more RTPs and MTPs and past papers which are covered in our textbook. Apart from all these are covered in our textbook. Apart from this, we also have, suppose here it is November 22. So in our class book you will also get May 22. You may also get December 21. So like that, there are few more RTPs which are covered, which will give you more exhaustive coverage. Here we are covering 9 RTPs, 9 past papers, and then you are doing 8 MTPs. Okay, so these are the few things that I had to say before we start our session. Now I will not say anything till our last paper. I will only talk about the content. That's it. Now let us start with our first RTP November 2022. The very first question over here is on partnership form, and in this question, the partnership form, the examiner has asked us to compute total income and tax payable of the firm. Now, no remuneration is given in this question. Therefore, because remuneration is not given in the question, therefore there is no need to compute any book profit. Otherwise, in partnership firm question, you have to first compute book profit, then you have to compute remuneration, and then you have to compute total income. In this question, no remuneration, therefore no book profit. Directly compute total income. Let's compute the total income. The partnership firm is commenced. They have started with 3-star hotel. 3-star hotel is eligible for 3580, and this associate is claiming also 3580. Okay. Now this entity was set up in 2025. The firm has 2 partners, 2 working partners, and the net profit of the firm is 26 lakhs. Now let's start computing the total income. 26 lakhs is the net profit. The very first item over here is depreciation as per books of accounts, so add back. Second is interest on capital, 15%. 15% not allowed. Only 12% allowed as per 40B. Therefore, 3% add back. 3% will amount to 10 lakh, because 15% amounts to 50 lakhs. Therefore, 3% amounts to how much? 10 lakhs. Add back 10 lakhs. Third one is you have taken some loan from Mr. Rajveer, a resident, and you are paying him some interest on which TDS is not deducted. So if you don't deduct TDS of residents, 30% of your expenditure will be disallowed as per 40A1A. Therefore, add back 30%. After doing all these things, the next point is you are purchasing some fixed asset. You are purchasing one motor car for 7 lakh rupees and you have capitalized the same in the books of accounts. So for this 7 lakhs, you can claim 3580 deduction because you are using this motor car for what? For 3-star hotel. Second, you are also incurring some 2 crore rupees capital expenditure, but out of that 1.5 lakh crore is land. So land is not allowed as deduction under 3580. Therefore, you can claim deduction for only building. Land will not be allowed. Third, you are also purchasing some air condition on 15th of May for 3,20,000 rupees. So that also you can claim as a deduction under 3580. If you do all these things, you will be under loss. Your 3-star hotel will be under losses. So now the question is, you have another hotel, which is a 4-star hotel, which has started 15 years back. In that there is a profit. So the question is, can I set off the loss of 3-star hotel with a 4-star hotel profit? The answer is yes. Because a 3580 business loss can set off only against 3580 income. 3580 income means it should be set off only against the eligible business. 4-star hotel is also eligible business. Don't raise the question that it was open 15 years back. Even if it is open 50 years back, 100 years back, then also you can set off the loss of the 3-star hotel against that 100 years old hotel also. Therefore, you can set off the loss. One more item is given over here that all the expenses were paid by account paycheck. Yes, it is necessary to pay the expense by account paycheck, account pay draft, ECF and such other electronic mode. Otherwise, 3580 deduction is not allowed. After doing all these things, you will get your total income. Okay. After that, you compute the tax. 30% tax surcharge if applicable. If the income crosses 1 crore, apply surcharge also and 4% cess. Now, the question is not completed. They have asked tax payable. Now, you also have to compute AMT. Oh, don't forget this. In case a partnership firm other than company, if other than company associate claims any profit link deduction or 10AA or 3580 except ATP, you have to compute AMT also. How will we compute AMT? Nothing. Total income as per the normal provision and add back all the 3580 deductions. Add back this 7 lakhs, add back this 50 lakhs, add back this 3.2 lakhs. And then claim depreciation on this 7 lakhs, claim depreciation on this 50 lakhs and claim depreciation on this 3.2 lakhs. This 7 lakh is what? Is a motor car. Therefore, claim 15% depreciation on this. This 50 lakh is a building. Claim 10% depreciation on this. This 3.2 lakhs is a new air condition. Claim 15% depreciation on it. After that, whatever amount will come, that will be adjusted total income. On that, apply 18.5% AMT. Then surcharge if applicable if the adjusted total income crosses 1 crore rupees. Then 4% cess. Then compare whichever is higher and then find out if the AMT is more, you will get AMT credit also. I hope it is clear to all of you. So this is what this question is all about. Beautiful question it is. Coming to question number 2. Question number 2. What is question number 2, sir? Question number 2 is a classic total income question. Whenever a total income question will come in the exam, always remember you have to check the last line first. What is the last line over here? Check the last line. They have asked to compute total income. They have asked to compute tax liability and also check as per which regime they are asking. They are asking as per new regime 115BAA. Accordingly, answer the question. First, always read the last question, last line, that which regime they are asking. Sometimes they put the regime in the additional information also, so be careful with that. Okay. In the additional information also, you should check which regime is asked. So let us start with the new regime 115BAA. Asasi is an Indian company engaged in manufacturing of automobiles. 9 crore 50 lakh is the profit. The very first adjustment is depreciation as per accounts, therefore add back. Okay. Second adjustment, donation to political party paid by account paycheck, not allowed in 115BAA. ATG, ATGGA, GGB, GGC, all these things are not allowed under what? Under the new regime 115BAA. Next one, you are paying 50 lakh rupees to a scientific research association. So generally scientific research association is allowed as deduction under section 35, but in new regime 115BAA that is also not allowed. New regime, donation to scientific research association, statistical research association, social science association, not allowed as deduction. Next one, you are receiving dividend from foreign company of 15 lakh rupees. So what should I do? Reduce from here and show under IFOs. Do not gross up. Even the word received is written. Whenever the dividend is received from foreign company, ICI never grosses up. ICI never grosses up dividend received from foreign company, always remember. What about dividend received from domestic company? That we will see later whenever such adjustment will come. Next one, long-term capital gains of 4 lakh on which equity share, on which STT is paid. It means it is a 112A capital gains. Because STT is paid, therefore it is a 112A capital gains. Therefore reduce from here and show under capital gains. 12.5% tax in excess of 1,25,000 rupees. Therefore, reduce 4 lakh from here and show 4 lakh in capital gains. And while computing the tax, 12.5% tax on 2,75,000, 1,25,000 exemption. Next is a very intelligent adjustment. You have taken a loan of 4 crore 20 lakh rupees from State Bank of India at the rate of 10%, but on 1st of June 2025. Now, this loan is taken for the purpose of purchasing some machinery. Okay. And the interest on the loan is outstanding on 31st March, which was paid on 1st of December 2026. Now, very important. First of all, you have taken a loan of 4 crore 20 lakhs. The rate of interest is 10% and the interest is payable for 10 months because the loan is taken on 1st of June. Therefore, the 10-month interest comes to 35 lakhs. First of all, do that. What do you do? You disallow this 35 lakhs completely because this interest is not an expense. It is taken for the purpose of asset. It is taken for the purpose of plant and machinery. So, whatever is the interest of 10 months, that is 35 lakhs, you add back that interest. 35 lakhs, you add back. Once you add back that 35 lakhs, now you check the treatment. When is the machinery purchased and when is the machinery put to use? The machinery is purchased and put to use on 1st of January 2026. It means from June to December, that is 7 months, the interest should be capitalized. Now find out the interest of 7 months. 35 into 7 divided by 10, that comes to 24.5. Add this to plant and machinery. Sir, this will be added to plant and machinery and claim depreciation? Yes. But sir, it is not paid, doesn't matter. For claiming depreciation, it is not necessary to pay. Only to claim it as a revenue expense, it is necessary to pay. Sir, balance will not be allowed as a revenue expense because it is not paid. It is paid after the due date of filing of return. Always remember, for capitalizing the interest and claiming depreciation, it is not necessary to pay. Only to claim that as a revenue expense, it is necessary to pay. I hope it is clear to all of you. Therefore, ultimately, what is the treatment? Again, I am saying this 35 lakhs will be added back, and then this 35 lakhs into 7 divided by 10, that will be added to the plant and machinery, and the remaining portion will be remaining disallowed forever. Okay. Forever means whenever you will pay in the next year you can claim the deduction. Next one, there is a profit on sale of land of 8 lakh rupees to PQR Limited. Who is a PQR Limited? This is a transfer of land between 100% holding subsidiary. If an 100% holding subsidiary transfers any capital asset within themselves, then it is exempt provided the recipient should be Indian company. If the recipient is an Indian company, it is exempt. In this case, it is exactly happening like that only. So reduce 8 lakh from PGBP and show under capital gains, write a note that it is exempt. Okay. Next one. You have paid a salary of 1 crore rupees to foreign technician for installation of machinery. So this is related to machinery, you cannot debit to P&L. Therefore add back to PGBP and capitalize to plant and machinery. Next one. You have sold some goods of 22 lakh rupees to a customer. So I am crediting 22 lakh rupees to P&L account. Then out of that 12 lakh rupees has become bad debts. So I am writing off bad debts of 12 lakh rupees. Now how much is receivable from the debtor? 10 lakh rupees is receivable. Now the debtor has expired. Debtor died. Debtor is dead. After that we tried to recover and we recover unfortunately 11 lakh rupees. We were supposed to recover only 10 lakh, but we have recovered fortunately 11 lakh rupees. And unfortunately we credited entire 11 lakh rupees to P&L account, which is wrong. You should have credited only the excess 1 lakh rupees to P&L account because 10 lakh is already credited to P&L account when you sold the goods. Therefore, you cannot credit entire 11 lakh rupees once again to the P&L account. Whatever is excess recovered, how much is receivable? 10 lakh. You have recovered how much? 11 lakh. Therefore, excess 1 lakh should be credited to P&L because unfortunately, you have credited entire 11 lakh to P&L. Therefore, reduce 10 lakhs from P&L. That is the ultimate effect of this particular adjustment. Next one, depreciation as per income tax, 1 crore 50 lakhs reduced. Then some additions have been made to fixed asset. Building, which is purchased on 15th of December. Therefore, half depreciation because it is used for less than 180 days, 5% will be allowed. Computer, purchase and put to use on 11th May, full depreciation 40%. Plant and machinery. What is the total cost of plant and machinery? See, it is installed and put to use on 1st of January 2026. 500 lakhs is the basic cost, plus 100 lakhs is the foreign technician salary, plus 24.5 lakhs is the interest which will be capitalized. Therefore, the total cost of machinery is 624.5. On that, you will claim half depreciation because the machinery is put to use for less than 180 days. Therefore, you will claim 7.5% depreciation. And additional depreciation not allowed because you are following 115 BAA. Additional depreciation will not be allowed to you. Last but not least, you are declaring some dividend to your shareholder on 31st of May 2026, which is 1 month before the due date of filing of return. Therefore, as per ATM, you will be eligible to claim deduction. How much? Dividend received or dividend distributed, whichever is lower. How much is dividend received? You can see about the dividend received is 15 lakhs and dividend distributed is 12 lakhs. Therefore, you will be eligible to claim deduction of 12 lakh rupees here. After that, you compute the tax. How many taxes are there? On 112A income, you will compute 12.5% tax in excess of 12.5 lakhs. and rest of the income you will directly compute 22% flat tax, 10% surcharge always in 115 BAA and 4% cess always in 115 BAA. This is what this beautiful question is all about. Let's go ahead with the third question. This is also very beautiful question. Mr. Rajesh is a resident. Mr. Rajesh is a resident and he is holding some units in PQR and Shipra. Now we need to understand who is PQR and who is Shipra. Shipra is a business trust and PQR is AIF. Always remember, in case I have an investment in business trust, the income is taxable in my hand when the business trust will actually distribute the amount. It means in case of business trust, the investor will be liable on receipt basis. But in case of AIF, the investor will be liable on accrual basis. If the investor, if I am investing in AIF and if the AIF is earning 100 and they are distributing 90, still 100 will be taxable in my hand. Be very careful. Okay. Now let's talk about Shipra first. First of all, let's try to understand the holding structure. Mr. Rajesh is holding in Shipra also. He is holding in PQR also. He is holding in business trust also. He is holding in AIF also. Now, Mr. Rajesh is holding how much? Only 10% units. Okay. And the entity is distributing how much? 90% of their profits to the investor. Be very careful. And Mr. Rajesh is earning the following income. Let's talk about business trust first. First, Mr. Rajesh is earning, the business trust is earning. First, let's talk about business trust. Then we will talk about AIF. Business trust is earning 2 crore rupees dividend from GPL. Who is GPL now? GPL is a SPV of business trust. Now, if the business trust receive any dividend from SPV, that dividend is always exempt in the hands of business trust. But what is the treatment of dividend in the hands of the investor? In the hands of investor, it depends. If the SPV has opted for 115 BAA, then it is taxable. If the SPV has not opted for 115 BAA, then it is exempt. In this question, see, check below. It is written that the SPV has not opted for 115 BAA. Therefore, this dividend income is exempt in the hands of what? In the hands of Mr. Rajesh. I hope it is clear to all of you. What about interest from SPV? Interest from SPV is exempt in the hands of business trust, but in the hands of investor, it is taxable. Investor will be liable to pay tax on this. On what basis? On receipt basis. In case of business trust, the income is taxable on receipt basis. So out of 3 crore, how much is distributed? 90%. 90% amounts to how much? 2.7 crore. Out of which Mr. Rajesh holds how much? 10%. Therefore, 2.7 crore into 10% comes to how much? 27 lakh. Therefore, 27 lakh interest will be taxable in the hands of Mr. Rajesh. I hope it is clear to all of you. Third, short-term capital gain on sale of development property. On this, the business trust will pay tax. Investor is liable for exemption. Okay. I hope it is clear to all of you. Now come to PQR AIF. In case of AIF, it is taxable in the hands of Mr. Rajesh on accrual basis. Okay. Now, the very first thing that the AIF is earning is business income. Always remember, on business income, always AIF pay tax, not the investor. Therefore, on this 35 lakhs, Mr. Rajesh will not pay tax. Next, long-term capital losses. That can be given to Mr. Rajesh because Mr. Rajesh is older than 12 months. If the unit holder is more than or equal to 12 months old, then the losses can be given to the losses other than PGBP losses can be given to the investor. So this 20 lakhs, 7 lakhs into 10%, that is 2.7 lakhs. Will be attributed to Rajesh, but Rajesh cannot do anything. Rajesh does not have any other capital gains against which he can set off this loss. If Rajesh would have some other capital gains, he would have set off this losses against it. Therefore, Rajesh will carry for this loss and set off this loss against his subsequent year capital gains income. Last but not least, Rajesh is also earning 52 lakh rupees interest income from AIF. That is IFOs. On this, Rajesh will pay tax. On how much amount? Entire 100%. That is 52 lakhs into 10% share. Now not 90%. In case of AIF, accrual basis taxable is there. Taxation is there in the hands of the investor. Therefore, here Rajesh will pay tax on 52 lakhs into 10%. So 5.2 lakhs will be directly taxable in the hands of Mr. Rajesh. Now, you have to compute tax after that. Tax as per which regime? As per the new regime. What is the new regime slab rate now? So only two incomes are taxable in the hands of Mr. Rajesh. One is 27 lakhs from business trust and one is 5.2 lakhs from interest income from AIF. After that, you have to compute tax as per new regime. What is new regime? New regime slab rates are up to 4 lakh no tax, then 4 to 8, 4%, 5%, then 10%, then 20, 15%, then 20%, then 25%, then 30%. So after 24 lakh, it is 30%. Okay. Now, one more important catch over here in this question is you have to compute tax payable. Tax payable is asked. Always remember, whenever they are asking tax liability, then compute tax and leave it. But when they are asking tax payable, then you have to compute tax. From that, you have to reduce TDS, TCS and advance tax credit also. In this question, Mr. Rajesh TDS has been deducted. Where? At two places. One, on interest income, TDS is deducted at 10% under 194 LBBA, and another on 5.2 lakhs, TDS is deducted under 194 LBB. In both the cases, TDS is deducted at 10%. So on this 10% TDS of 2,70,000 and on this 10% TDS of 5.52,000 would have been deducted in case of Mr. Rajesh. So both this credit should also be given. These small things matter in the examination. Okay. So you have to take credit of these two items, and after that whatever amount is come, that will be called as tax payable. I hope it is clear to all of you. Next question we will go ahead. Question number 4. What is question number 4, sir? Pay attention please, all of you. Question number 4 is on TDS. See what happens generally. Generally, if you go to a tour operator, overseas tour package and program, and if you book any tour, then up to 10 lakh rupees, they will collect 5% TCS, and about 10 lakh rupees, they will collect 20% TCS. But there is some relaxation for non-resident. If a non-resident is coming to India for a visit, and then a non-resident is booking a tour, overseas tour package and program, for that there is a complete exemption, remember. So that is what is happening in this particular question. Mr. Devansh, an Indian citizen, is residing in New York. He came to India for a visit. So a non-resident is coming to India for a visit for few days. When he came to India, he booked a tour of 6 lakh rupees to some Malaysia for 1 week. So he's a non-resident coming to India for a visit. He is booking a tour for Malaysia. In his case, the TCS under 206C1G is completely exempt. Therefore, no TCS in his case. I hope it is clear to all of you. Second case. XYZ is a company which is incorporated in the current year. Whether 194Q will be applicable? Absolutely no. If a company is incorporated in the current year, 194Q is not applicable. Why? Because for 194Q to apply, the last year business turnover has to be more than 50 lakh rupees. More than 10 crore rupees. And the current year purchase should be more than 50 lakh rupees. Now the current year purchase is more than 50 lakhs, no doubt about it. But the last year business turnover is zero in this case because the company is incorporated in the current year. The buyer is incorporated in the current year. Therefore, last year business turnover is zero. Therefore, TDS under 194Q is not applicable in this case. I hope it is clear to all of you. All those things are irrelevant. The very first basic thing is to check the last year turnover. The last year turnover has to be more than 10 crore rupees first of all. Otherwise, this section is not applicable. 194Q is not applicable. I hope it is clear to all of you. Next one, question number 5. Very good question. Mr. Ravi Prakash is aged 52 years. He gifted 30 lakhs to his wife on her 50th birthday. So husband is giving 30 lakh rupees to wife on birthday. What does wife does with that money? Wife purchases a car of 29 lakh 52,000, which includes RTO of 2 lakh 15,000, insurance of 51,000, warranty of 25,000 and accessory charges of 35,000. Now obviously, wife does not have any other great income. She only has 25,000 rupees rental income. 25,000 rental income is how much? It is around 3 lakh rupees income. On that 30% deduction will be available of standard deduction. Therefore, the net income will be 2,10,000, which is lower than basic exemption limit. The question is wife liable to file the return? The answer is yes. Why, sir? Because wife's TCS is collected by the car dealer. How, sir? Wife has purchased a car of 29 lakh 52,000. So 206C1F will be applicable if you purchase a motor car of more than 10 lakh rupees. Of ex-showroom price. Ex-showroom price will not include all these expenses. Ex-showroom price will not include RTO, insurance, accessory and warranty. Therefore, after reducing all these things, ex-showroom price is coming to 26 lakh 24,710. Therefore, on that, the dealer would have collected 1% TCS, which is around to 26,247. Now, wife is not a senior citizen. It is less than 60 years and it is resident. Therefore, remember, in section 139, subsection 1, it is written, if your TDS or TCS is greater than or equal to 25,000 rupees of a previous year, then you are liable to file the return. And for resident senior citizen, it is 50,000. So for resident senior citizen, TDS, TCS amount collected and deducted if 50,000 is more, then liable for filing return. For others, if it is 25,000 rupees or more, they are liable to deduct TDS. So in this question, the TCS of Miss Sudha is more than 25,000, more than equal to 25,000 rupees. Therefore, Ms. Sudha is liable for what? Filing the income tax return. I hope it is clear to all of you. Next question, Mr. Vijay. Total income is 28 lakhs. AO has passed an assessment order enhancing the income by 5 lakh rupees. Now he wants to file an application to dispute resolution committee for reducing the penalty or waiving the penalty or reducing the prosecution for immunity of penalty and prosecution. There is no order of detention against him. There is no prosecution against him. There is a penalty in the 271D which is initiated against him. So he has a lot of question now. Can he file an application to DRC? The answer is yes. What is the condition to filing application to DRC? Your total income as per your return of income should not exceed 50 lakh rupees, which is not exceeding 50 lakh. and the AO should not increase more than 10 lakh. The AO is not increasing more than 10 lakh. There should not be an order of detention against you. There is no order of detention against me. There should not be any prosecution against you. There is no prosecution against me. There can be a penalty against you. Penalty is there or not, it doesn't matter. All other conditions are fulfilled, therefore he can file an application. Second question, what is the time limit? The time limit is 1 month from the date of receipt of order. The order is received on 26th of November 2026. So 1 month from 26th November 2026 comes to 25th December 2026. This is the last date for giving the application to DRC. Third, if I am not happy with this application, if I am agreed with this application, can I file an appeal? No. No appeal is possible against the order of DRC. No appeal or revision is possible against the order of DRC. Order of DRC is non-appealable. And last but not least, would your answer be different if the AO's assessment order is based on the information received under a DTAA with country X? Yes, answer will differ. It is written in the provisions of 245 MA that if the information is received from foreign authority under DTAA, then the doors of DRC are closed. You cannot come to DRC in that case. I hope it is clear to all of you. Next question is a simple DTAA question. Compute total income, net tax payable, follow the old regime. Miss Rajni, 63 years, therefore she is a what? She is a resident as well as she is what? She is a senior citizen. Be careful. She earns income from multiple places. First, she is earning income from country M 10,120, so multiply that by 69 rupees. Then she has some house property rental income $25,000. Minus $200 is a municipal tax, so minus that and then claim 30% standard deduction. Then 15 lakh rupees from performance in India, take that as PGBP income, 4.2 lakhs from bank FD and 15,000 rupees from saving bank. So from this bank FD and saving bank, she will claim deduction under 80 TTB because she is resident senior citizen. Then she has paid 29,000 for insurance of her health and 32,000 for insurance of her husband health. Husband is also resident, so both of them, herself and husband, will get aggregate limit of 50,000 rupees deduction under 80D. Then she has invested some 1.5 lakhs in PPF. She can claim ATC for 1.5 lakhs. Then she has invested 4 lakh rupees in 5-year fixed deposit in the name of her son, not allowed. In the name of her son, not allowed. In the name of self, it is allowed. 5-year fixed deposit in the name of self, allowed under ATC. In the name of son, not allowed. Anyways, ATC limit is already exhausted by what? PPF, so it doesn't make sense. Even if it is allowed, you cannot claim because already 1.5 lakhs is exhausted in PPF. After that, it's very simple. Compute tax as per old regime. Find out the average rate in India and then apply that average rate. Compare that average rate with 20% foreign rate and apply that on doubly tax income. Very simple. The doubly tax income will be what? The doubly tax income will be 11,97,000 is doubly tax. 6,98,000 is doubly tax. These two incomes are doubly tax. Apply the Indian average rate. What is Indian average rate? Indian average rate is this and foreign average rate is 20%. Apply that on doubly tax income. Whichever is lower will be allowed as relief. I hope it is clear to all of you. I hope it is clear to all of you. Question number 8 is a very good question, theory question. What is happening in this question? Pay attention, please, all of you. There are two countries, one country X and one country Y. With country X, we are entering into DTAA. At that time, we are discussing that whatever country X companies will invest in India, we will charge them 15% dividend on dividend tax. So, for example, if country X company invests in Indian companies, we will charge 15% dividend on in their hand. And there is a DTAA between both of us. Then we entered into DTAA with country X and country X is an OECD member. Then we entered into DTAA with country Y. There we made a promise that we will charge 10% tax. Country Y is also OECD member. Now country X people are very angry. Why? They are saying that you have entered with us DTAA first, but you are charging more what? You are charging more tax to our people. And you are entering into DTAA with country Y people later and you are charging less dividend tax to them. Why are you doing so? And we both are OECD member. So the CBDT said that don't worry, we will extend this 10% benefit to you also, provided you are OECD member. If you are OECD member, then we will extend. If you are not an OECD member, then we will not extend. So those CBDT has put some condition. The second treaty is entered into after the entry into force of the first treaty. Yes, the second treaty is entered into after first treaty. The second treaty is entered between India and a state which is an OECD member. Yes, the second treaty is also an OECD member. The first treaty is also an OECD member. India limits its rights of taxation. In second treaty in relation to the rate, yes, India will not completely exempt. India will limit its rights to 10%. And the central government will issue a separate notification for the same. Yes, central government has issued a notification for the same in 2022. Therefore, the entity is eligible for 10% tax rate. I hope it is clear to all of you. So this is what this first RTP is all about. So let's go ahead with the next RTP. RTP May 2023. Question number 1 is a very simple question. There is a partnership firm in which there are 5 partners. Now one of the partner has given a loan of 50 lakh rupees to the firm. Now if I am a firm, you are a partner. Just take an example. I am a firm, you are a partner. You are Mr. Raghav, you are a partner. I am a firm, you are giving me a loan of 50 lakh rupees. Now the firm is questioned by the assessing officer. The assessing officer is questioning firm that from where you have got this particular 50 lakh rupees. So I said that I received from the partner. So now the assessing officer is asking the partner from where you have got the money. The partner is not able to explain the source. So now if the partner is not able to explain the source, can that 50 lakh rupees be chargeable as deemed income in the hands of the firm? The answer is yes. You remember it is written in section 68 that if you take a loan from someone and if you are not able to explain the source in the hands of the person who is giving that loan, then that also is deemed income in the hands of the receiver. And it will be deemed income under section 68 unexplained cash credit, and that will be subject to 78% tax. I hope it is clear to all of you. So the person who is giving the loan, you have to explain the source in the hands of the giver also. Okay. So this is what this question is all about. Second one, you have taken some loan from a public financial institution on which there is an outstanding interest of 3.5 crore. Now you are converting that outstanding interest into a debenture. Can that be allowed as a reduction? The answer is no. If you convert an outstanding interest into a new loan or into a debenture or into a bond where the liability to pay is deferred to future date, it is not allowed as a deduction under 43B. Yes, but there is a recent judgment which I have told you in the class also. If you convert an outstanding interest into an equity share, that is allowed as a deduction. Please keep this thing in your mind. Okay. So if you convert an outstanding interest into a loan, debenture or bond, it is not allowed as a deduction. But if you convert that into an equity share, it will be allowed as a deduction. So this is what this small question is all about. Question number 3 is also very simple. There are 4 to 5 cases in which you are supposed to answer whether they are liable to file the income tax return or not, considering the situation. First assessee, Mr. Albert, whose turnover of business is more than 70 lakhs. Yes. Any person whose business turnover is more than 60 lakh rupees, you are liable to file the return. Therefore, Mr. Albert is liable to file the return. Second, Mr. Aarish is earning lot of income. First, he is earning 2.5 lakhs from profession. Then he is earning 4 lakh from interest on fixed deposit. Then he is earning another 50,000 from saving bank. Therefore, definitely his total income exceeds basic exemption limit. Therefore, Aarish is liable to file the income tax return. Third, ABC company, a law firm. I will not read ahead. A firm and company is always liable to file the income tax return, irrespective of any condition. If you are a partnership firm, LLP or a company, you are always liable to file the return. Don't read ahead. Similarly, next one, XYZ Private Limited, which has incurred an expenditure of 95,000 rupees towards electricity. It doesn't matter. A company is always liable to file the income tax return. That electricity condition is not applicable for company and firm. That is applicable for individual HUF, that electricity charges exceeds 1 lakh rupees. That is for other than company and firm. Company and firm are always liable to file the income tax return. Last but not least, Mr. Valish. Mr. Valish is depositing 50 lakh rupees in his saving bank. Is he liable to file the income tax return? Yes. If an individual HUF, etc., other than company and firm, deposit 50 lakh or more in a saving bank account, they are liable to file the income tax return. Exact 50 lakh is also covered for saving bank. For business, it is more than 60 lakh. But for investing, for depositing in saving bank, it is 50 lakh or more. Go and check the provision carefully. Very dangerous. Let's come to question number 4 now. This is a very dangerous question. Very beautiful question it is. There are multiple parts in this question. There are many small items in this question. I am trying to say all of them one by one. First of all, let me read the question. There is a cooperative society who is engaged in marketing of agricultural produce grown by its members. So if your cooperative society is engaged in this, they are eligible for 80P deduction. 100% profits are deductible. How much profit they are earning? They are earning 60 lakh profit. Apart from that, they have hired 10 employees. 10 new employees have been hired at a salary of 20,000 rupees on 1st May. Then the company, the cooperative society is getting audited under 44AB. The salary is paid by account paycheck. All these conditions are necessary. Then it also earns interest on FD of 32 lakh rupees. Now, these are the basic information which is given. Now, you are supposed to compute total income and tax liability. Don't read ahead. Now, when you are computing total income, you are supposed to compute total income as per 2 points now. First, as per the normal provision, then compute tax as per normal provision, and then compute AMT. AMT also. And always remember, in case of AMT for cooperative society, the tax rate is not 18.5%, it is 15%. So let's compute the total income as per normal provision. What will come in normal provision? First 60 lakhs will come, PGBP. Then 32 lakhs IFOS will come, interest on fixed deposit. Then 60 lakhs will be allowed as deduction fully under 80P. Then 80 JJAA will also be allowed. Why? Because you are hiring 10 employees, 20,000 emoluments, less than 25,000 rupees for 11 months. So 20,000 into 10 employees into 11 months into 30%, 80 JJAA you will claim. So you will claim two deductions. One ATP, directly ATP of that marketing from agricultural produce grown by its members. That entire amount will be deductible under ATP, and 6,60,000 will be allowed under ATJJAA. Then you will compute the tax. Normal tax for cooperative society. What is the normal tax for cooperative society? Up to 10,000, 10%. About 10,000 up to 20,000, 20%. About 20,000, 30%. Then surcharge if applicable. In this case, surcharge is not applicable because the income is less than 1 crore. This is your normal tax. Now you will compute your AMT. While computing the AMT, always remember how AMT is computed. It is nothing but total income plus profit link deduction except ATP. While computing AMT, don't add ATP. AMT is not applicable on ATP incomes. ATP deductions are not subject to AMT. Be very careful. You will not add back this 60 lakh rupees while computing AMT. Yes, you will add back this 6,60,000 while computing AMT. So while computing AMT, add back 6,60,000. Don't add 60 lakhs. You will get your adjusted total income. On that, apply 15% tax, 4% cess, and no surcharge because the adjusted total income is less than what? Is less than 1 crore. This is your first part. Second part, then check whichever is higher. Whichever is higher, that will be your tax. Now the second part of the question, advise whether it should opt for 115 BAD. Now what will happen if they opt for 115 BAD? Let's try to understand. If they opt for 115 BAD, the very first thing which will be removed is AMT. AMT not applicable for 115 BAD SSE. So 115 BAD SSE will compute how? First you will write 60 lakhs. Now I am making the changes in this solution only. First I will write 60 lakhs. Then I will write 32 lakhs. 92 lakhs is your gross total income. For 115 BAD SSE, this is allowed but this is not allowed. For 115 BAD SSE, ATP is not allowed. Only ATJJAA is allowed. So 115 BAD SSE, very straightforward. This is there. ATJJAA is allowed in 115. BAD ATP is not allowed in 115 BAD. Whatever is your total income, on that you will directly apply 22% tax because in 115 BAD the tax rate is directly 25.17. 22% tax, 10% surcharge, 4% cess, and that will come to 21,49,350 rupees. Now there is another part in this question, dangerous part. Would your answer be different if it is not a cooperative society but a cooperative bank? Yes, the answer will completely change. If it is not a cooperative society but a cooperative bank, how the answer will change? Now we will assume this to be cooperative bank. This will be 60 lakhs income, this will be 32 lakhs income. Gross total income 92 lakhs. Now for cooperative bank, this will be allowed, this will not be allowed. Cooperative bank will not be allowed this. So for cooperative bank, what is the deduction? The deduction only ATJJAA will be allowed. ATP will not be allowed to cooperative bank. So therefore 85,40,000 will be the total income of cooperative bank as per normal provision. All three calculations you have to do once again. Then apply up to 10,000 10%, about 10,000 20%, about 20,000 30%. Then apply cess, etc. Surcharge not applicable. Now again AMT. While computing the AMT, again you will add back ATJJAA. ATP is not there only. So what you will add? ATP is not there. So you will add back ATJJAA and compute AMT. So add ATJJAA, compute AMT of 15% AMT, 4% cess. Then again 115 BAD. While computing 115 BAD, how the things will go? Assuming it is a cooperative bank, 60 lakhs will come, 32 lakhs will come. Then this is allowed in ATJJAA. So in ATJJAA, this is allowed. Therefore, the income will remain same in ATJJAA. So 85,40,000 will be the income in in 115 BAD also. Same income because ATP is not there only. Now you will compute 22% tax, 10% surcharge, 4% cess and compare the answer whichever is more beneficial. Okay. So this is what this beautiful question of what? Beautiful question of cooperative society is there. I have given you a chart of cooperative society in the class. Go and check. Okay. Next question is a total income question. Again, whenever a total income question comes, you have to check what? You have to check the last line first. What is asked? They have asked to compute total income. They have asked to compute tax liability as per 115 BAA. Okay, 115 BAA is coming again and again. Be very careful with that. 115 BAB is not very important. BAA is very important for us in the examination. SF Limited is a company engaged in manufacturing and sale of pharmaceutical products. So very first thing is they are engaged in pharma company. Their profit is 930 lakhs after debiting and crediting the following item. Now the very first item over here is the opening stock is overvalued. The opening stock is overvalued by 10%. Now the opening stock is 66 lakhs. It is overvalued. It means it is standing at 110%. Therefore, how much it is overvalued? So 10% is how much? 6 lakh. It is overvalued. So if the opening stock is overvalued, means the debit side of the P&L is overvalued. If the debit side of the P&L is overvalued, it means you have claimed more expense, so add back. You have claimed more expense, na? So add back this 6 lakh. This 6 lakhs will be added back. Similarly, the closing stock is undervalued. Now your closing stock is 63 lakhs. It is undervalued by 10%. It means it is standing at 90%. Therefore, 10% is how much? Cross multiply. It comes to 7 lakhs. So if the credit side of the P&L is undervalued, it means the profit is less. So add back the 7 lakhs. So the opening stock will also be added back. The closing stock will also be added back. I hope it is clear to all of you. Next one, you are purchasing some know-how from foreign company. Now know-how is nothing but an intangible asset, but you are debiting that to P&L, which is wrong. Add that to P&L and claim what? 12.5% depreciation, because you are putting to use for less than 180 days. Therefore, you will not get full 25% depreciation. You can claim depreciation of 12.5%. Next one is a grandfathering clause. Grandfathering clause, you are selling some shares of a listed company, 2,97,000 is the profit. First, reduce this 2,97,000 from PGBP, and then under capital gains compute separately. But always remember, whenever 31st Jan 2018 will come in the examination, it means there is a grandfathering clause. Whenever this date only has one relevance, that is grandfathering clause for the purpose of capital gains under 112A. So how will you compute the capital gains? First step, actual cost. Actual cost means the price at which you have acquired the shares, 85 rupees. Then compare with lower of FMV on 31st January 2018, that is 195, and selling price. Lower of the two is 195. Then lower of the two will be compared with actual price. Then whichever is higher, that will become your ultimate cost. Therefore, in this case, your ultimate cost will be 195 and your sale price will be 220. The difference between them will be called as capital gains. On that will show you that you will show under capital gains, under the head capital gains. On that, 1,25,000 rupees flat exemption will be available. On the remaining amount, 12.5% tax will be available. Okay. Electricity charges of 8 lakh is unpaid. So what? Electricity charges are allowed on payment basis? No. Electricity charges are not covered in 43B. Electricity charges are on accrual basis. Therefore, this will be allowed. Even if it is unpaid, it will be allowed as a deduction. Don't worry about it. Okay. Next one. You are incurring some loss of 2.2 lakh rupees due to hedging contract in respect of import of raw material. So, you are importing some raw material. On that, you are incurring some loss. How much loss you are incurring? You are incurring loss of 2.2 lakh rupees on foreign currency fluctuation due to hedging contract. So that loss is nothing but a revenue loss, because that loss is on raw material. Therefore, that will be allowed as a deduction. It is allowed as a business loss. Next, depreciation as per books of accounts, add back. Next, dividend from foreign company. Dividend from foreign company, I have already told you, reduce from here and show under what? Income from other source. Show under income from other source. Next, 32 lakh rupees you have received from some company for entering into a non-compete contract. So whatever amount you receive in cash or in kind under an agreement for not carrying out any activity in relation to business and profession, that is for non-compete contract, that is considered to be a PGBP income. So let it be part of PGBP. There is nothing wrong in that. Next, you are receiving some advance of 22 lakh rupees. For what? You are about to sell some land, but the negotiation did not go, so you forfeited that 22 lakh rupees. So what is the treatment of this 22 lakh rupees? First of all, reduce from here and show under IFRS. Why? Because the forfeiture is happening after 1st April 2014. If the forfeiture is happening before 1st April 2014, then you will reduce from the cost of acquisition whenever you will sell it. But if the forfeiture is happening on or after 1st April 2014, then it is treated as an income from other source. Directly treated as income from other source. Next, you are having some profit on sale of unlisted shares of 18 lakh rupees. First of all, reduce from here and show under capital gains. How capital gains, sir? Because you have purchased for 80 lakhs and you are having an excess of 18 lakh rupees. So under 18 lakh rupees will be shown as a long-term capital gains, because you purchased in 2018 and sold in 2026. Therefore, it is sold after 24 months. Therefore, it is long-term capital gains. On that, you will apply what? You will apply 12.5% tax. Next, loss of 2 lakh rupees is there on hedging contract for foreign currency payment on imported machinery from Japan. So you are importing some machinery from Japan on which you have done some hedging contract, on which there is a loss on payment. So section 43A will apply. Whatever loss is there, first of all, add back that loss to PGBP. That is not allowed. Then add that loss to what? Add that loss to machinery. Therefore, the machinery cost will become 72 lakhs. On that, claim normal depreciation of 7.5%, because the asset is used for less than 180 days. Additional depreciation not allowed, because the assessee is following 115BAA. I hope it is clear to all of you. Next, normal depreciation 35 lakhs you will claim. Then they have said that imported machinery and know-how depreciation has not been considered. Therefore, we are computing the imported machinery depreciation and know-how depreciation separately. Okay. Now, last but not least, you are hiring some 59 additional employees. 80 JJAA question. All of them are contributing in recognized provident fund. Great. It is necessary to contribute in recognized provident fund to claim 80 JJAA. But out of that, only 36 employees joined on 1st of June. On an emolument of 15,000. From that 36 employees also it is written 10 employees salary settled by bearer check. So those will not be eligible for deduction under 80 JJAA. If you pay by bearer check, if you pay by other than 4 modes, you are not eligible for 80 JJAA. So therefore only 26 employees will be eligible for 80 JJAA. 26 employees into how many months? 1st June, 10 months into 15,000. Emolument is less than 25,000 into 30%. But be careful with one more thing. The 10 employees whose salary is settled by bearer check, their salary should be disallowed in PGBP also as per 48.3. So disallow their salary in PGBP. because in PGBP also that expense will not be allowed. I hope it is clear to all of you. Then another 18 employees joined on 1st July, but their salary is 35,200, therefore they are not eligible for 80JJAA. Then another 5 employees joined on 1st November, their salary is 22,000, but they are not eligible for 80JJAA because they are employed for less than 240 days. In 80JJAA, the employees have to be employed for at least 240 days. After that, you are supposed to compute tax. Now, there are three taxes over here. 1112A on that 12.5% in excess of 1.25 lakhs. 1112 on 12.5% tax directly. And rest of the general income will be subject to 22% tax, 10% surcharge always, and 4% cess. I hope it is clear to all of you. So, this is what this beautiful question is all about. Next question is also a very good question, which is on non-resident taxation. So there is a foreign company over here by the name called as Gamma Inc. That foreign company is providing some technical services, fees for technical services to an Indian company, and there is an agreement between both of them which is approved by central government. So this is a classic case of 115A because there is no permanent establishment also in India. So if a foreign company providing what technical services to an Indian concern, there is an agreement between both of them. Agreement is approved. The services provided are FTS and there is no P115A is applicable. Flat 20% tax. 2% surcharge because the income is more than 1 crore and 4% cess. Expenses will not be allowed of 22 lakh rupees under 115A, and while filing the return they need to be careful. If they earn only this income, and their TDS is deducted as per 115A rate, not lower than 115A rate, not as per the DTAA lower rates. If the TDS is deducted as per 115A, then they are not liable to file the income tax return. I hope it is clear to all of you. Part 2. Will your answer change? If that foreign company has a permanent establishment in India, yes, the answer will drastically change. If that company has a permanent establishment in India, then 44DA will apply. In 44DA, you will take income, you will reduce expenses. 3 crore minus 22 lakhs. Again, you will take 5 crore minus 35 lakhs. But any expense which is not wholly and exclusively for Indian branch will not be allowed. Therefore, this point number 5 will not be allowed. Because this is not only and exclusively for Indian branch, therefore that will not be allowed to as a reduction. Similarly, if Indian branch is making some payment to HO other than reimbursement, then it is not allowed. If it is giving reimbursement, then it is allowed. Other than reimbursement, not allowed. Other than reimbursement, not allowed. What are the other requirements? Other requirements are this associate has to maintain books of account, they have to conduct audit, they have to file ITR, they have to pay tax as per the normal rate. 35% tax, 2% surcharge because the income is more than 1 crore and 4% cess. I hope it is clear to all of you. This question number 7. This question number 7 is a very famous question. A lot of time they have asked this question. Question number 8 is on transfer pricing. PN company is a company which is in India and Zeta Inc. is in foreign country. Now, one entity guarantees 12% of the total loans of another entity. Therefore, both of them are deemed to be associate enterprise. Why? Because as per 92A, if one enterprise guarantees at least 10% of the total loans of the other entity, then both of them are deemed to be associated. Here it is 12%. Therefore, both of them are deemed to be associated. Therefore, the transaction between both of them are international transaction. And therefore, transfer pricing is applicable. Point number 2, without prejudice to point number 1. Assume that whether point number 1 happens or not, ignore that. And then answer, if AO makes a primary adjustment of 3.1 crore rupees on 1st April and the same is accepted by the assessee, what are the conditions and the money is not repatriated to India up to 31st March and the transaction is denominated in INR. So, if the AO makes the primary adjustment of more than 1 crore rupees, then secondary adjustment is applicable if the money is not repatriated to India within 90 days from the date of order. So the AO has passed the order on 1st April 2025 and if the money is not repatriated to India within 90 days from 1st April 2025, then the AO will charge secondary adjustment because the primary adjustment is more than 1 crore rupees, it is 3.1 crore. So how the primary adjustment will be charged? 3.1 crore will be considered as deemed loan multiplied by SBI's MCLR on 1st April 2025 plus 3.25%. So 12.25% will be the rate of interest. Multiplied by 365 divided by 365. Because the loan is denominated in INR, therefore you will take SBI MCLR. If the loan is denominated in foreign currency, then we will take LIBOR. LIBOR plus 3%. 6 months LIBOR plus 3%. One more option is there. You pay one-time additional tax on 3.1 crore. How much one-time additional tax on 3.1 crore? Then secondary adjustment will stop. How much is that one-time additional tax? 18% tax, 12% surcharge, 4% cess, pay that much tax and you will be relieved from what? You will be relieved from this particular secondary adjustment after that. I hope it is clear to all of you. So this is what this paper is all about. So let's go ahead with the next RTP, that is RTP November 2023. Very first question again over here is on total income only. Associates engaged in manufacturing. Let's read the last line first of all. You are supposed to compute total income and tax liability of Mr. Manav and Mr. Manav Limited has opted for 115 BAA. So accordingly, you need to answer. The profit of the Manav Limited is 180 lakhs. Again, here there is some outstanding interest of 24 lakhs. Now they are trying to discharge that outstanding interest by issuing 8% debenture, not allowed. Conversion of outstanding interest into a new loan or into a debenture or into a bond is not allowed. But if you convert that into equity share, it is allowed as a reduction, which I have told you earlier. Then there is some income tax demand of 5,80,000 that will be disallowed. Even surcharge is disallowed. Even cess is disallowed under section 40A1. Okay, 48.2, sorry, not 48.1A. 48.2, income tax including surcharge and cess is disallowed. Then there is some provision of gratuity as per actually that is disallowed under 40A7, and whatever gratuity is actually paid, which is given in the last point, that is 105 lakhs, that will be allowed as a reduction, which you can reduce from your PGPP income. Next one is very important and controversial adjustment. Lot of students have lot of doubts in that. You are incurring some expense on foreign travel of directors. They are going to open some branch in foreign country to market their product. Always remember, it will be allowed as deduction. Why? Because if you are incurring some expense on travel of directors, foreign travel of directors, and if that expense is related to existing business, then it is allowed as deduction. But if that expense is related to new business, then it will not be allowed as deduction. In this case, it is related to existing business, therefore it is allowed as deduction. I hope it is clear to all of you. Then you are purchasing some raw material of 82,000 rupees. And you are making the payment in cash, not allowed. More than 10,000 rupees in cash, not allowed. Therefore, this 82,000 will be disallowed under 40A3. Next one, you are making a payment of 11 lakh rupees to a Japanese company whose income is chargeable to tax in India. So, if a foreign non-resident or foreign company's income is chargeable to tax in India, you need to deduct TDS. Now, you have not deducted the TDS, therefore 100% expenditure will be disallowed in that case. Next, you are incurring some 4.6 lakh rupees on corporate social responsibility expense. Corporate social responsibility expenses are not allowed as per explanation 2 to 37.1. It is not allowed. Next one is a routine adjustment, 100% holding subsidiary, selling something to each other. Capital gains is exempt only if the recipient, that is the receiver, is an Indian company. Therefore, reduce from your PGPP and show as exempt under 47. Always remember, if the recipient is a foreign company, then it is taxable. It is exempt only if the recipient is what? Is an Indian company. Next one, you are giving some donation to what? Donation to a scientific research association, not allowed in 115 BAA. Now they are giving us 1.2 lakh is paid in net banking and balance is paid in cash. It doesn't matter. In 115 BAA it is not allowed only. So if it is not allowed, then it doesn't matter how it is paid. Okay. Next one, interim dividend is paid of 65 lakh rupees. So interim dividend will be claimed as a deduction under ATM, but the dividend will be subject to what? Dividend received. Dividend received or dividend paid, whichever is lower, will be allowed as deduction under ATM. See, always remember, in 115 BAA, you cannot claim any chapter 6A except ATM, ATLA and ATJJAA. These three deductions you can claim in what? 115 BAA. Next one is you are contributing. The employer is contributing to some pension scheme of employees, which is 15% of the salary and dearness allowance. How much is allowed? Only 14% of basic salary plus DA in terms is allowed. But you are contributing how much? 15%. Therefore, 1% you have to disallow as per section 36 subsection 1 clause 4A. Next, you are receiving some dividend from a foreign company. How much? 36 lakhs. So reduce this from PGPP and show that 36 lakhs in what? In IFOs. And compare that 36 lakhs with dividend received 36 lakhs, dividend paid 65 lakhs. Therefore, whichever is lower will be allowed as deduction under ATM. Next, you are giving some donation to a political party, not allowed under AT, not allowed under 115 BAA. Next, normal depreciation allowed, additional depreciation not allowed under 115 BAA. Next, brought forward UAD allowed because it is out of normal depreciation. If this brought forward UAD would have been from additional depreciation, even this would have not been allowed. Okay. And last one, I have already told you. There is no special income in this case. Therefore, only 22% tax, 10% surcharge and 4% cess will be imposed. No special income, no long-term capital gains, no short-term capital gains, nothing is there. So this is what this question is all about. Let's go to the next question. Next question is on TDS and TCS. There is a buyer, Delta Limited, which is the buyer, and there is a seller by the name called as Free Limited. What are we buying? We are incorporated just this year on 1st April 2025 and we are buying coal from them. Always remember, if the seller is selling coal, then generally the seller is liable to collect TCS on coal at the rate of 1%. Coal is covered under 206C subsection 1. So the seller should collect TCS. But there is a relaxation from collecting TCS if the buyer is a resident and the buyer gives a declaration that he will use this coal for manufacturing or power generation and not for trading. In this case, the buyer is giving a declaration that he will use this coal for manufacturing and not for trading. Therefore, the seller will not collect TCS. But in that case, the buyer is liable to deduct TDS under 194Q. But in this case, even the buyer will not be liable to deduct TDS under 194Q, because for 194Q, your last year turnover should be more than 10 crore, business turnover should be more than 10 crore, and the buyer is incorporated in the current year. Now, because the buyer is incorporated in the current year, the last year business turnover is zero. Therefore, the buyer is not liable to deduct TDS also in 194Q. So again, I am saying one more part is there in this question. Again, I am saying the seller is not liable to collect TCS on coal because the buyer is giving declaration. The buyer is not liable to deduct TDS because the last year business turnover is zero. Now, the last line of this question they are saying, will your answer change if the buyer is incorporated in last year? The buyer is incorporated not in the current year but in the last year, and the last year turnover is 10 crore. Still the answer will not change, because the last year, for TDS to apply under 194Q, the last year business turnover should be more than 10 crore. Even if it is exactly 10 crore in the last year, TDS under 194Q will not apply. I hope it is clear to all of you. See how they are exactly asking the questions on margin. Exact 10 crore, if it is last year business turnover, 194Q is not applicable. Even in that case, 194Q is not applicable. Next one, let's go ahead with the next question. Sigma is a manufacturer of car and they are selling some car to car dealers. Always remember, if a manufacturer sell car to car dealer, then provisions of 2061F is not applicable. Very clearly written in the law that if a manufacturer is selling to dealer, the 2061F provisions of collection of TCS not applicable. But in that case, the buyer will be liable to deduct TDS under 194Q if the buyer's last year business turnover is more than 10 crore and the buyer purchases car of more than 50 lakh rupees. So in this case, who is the buyer? The buyer is Epsilon and Omega. Now, Epsilon's last year turnover is 14 crore. Therefore, Epsilon will be liable to deduct TDS of what? Epsilon's last year turnover is 14 crore and Epsilon is buying cars of how much? 120 lakh. Therefore, on 70 lakh rupees, Epsilon will deduct TDS at the rate of 0.1%. But Omega's last year turnover is only 9 crore. Therefore, Omega will not be liable to deduct TDS also. So, in case of Omega, neither TCS nor TDS will apply. But in case of Epsilon, TDS will be applicable on Epsilon. TCS will not be applicable because the cars are sold by manufacturer to dealers. I hope it is clear to all of you. Third question is a very simple question which I have told you in the class of British Airways Supreme Court judgment is there, Royal Dutch Airlines Supreme Court judgment is there, Singapore Airlines Supreme Court judgment which we have done in section 194H. See, the agents, air travel agents gets two type of commission. One is called a standard commission, which is a percentage, which is percentage of the price, which is this. Sorry, percentage. Sorry, just a second. So there are two types of commission which are earned by the air travel agents. One is a standard commission, one is a supplementary commission. Sir, what is a standard commission? Standard commission is a commission which is a percentage of the price which is decided by ITA. International Air Transport Association, they will decide. Some percentage of that will be considered as a commission. Second is the difference between the price which is decided by the airline company and the price at which the tickets are sold. Suppose the airline company said that you should sell at 60,000. Now the air travel agent is selling for 70,000. So the 10,000 is the commission, supplementary commission. So the question over here is whether TDS under 194H will be applicable on both supplementary commission as well as the normal commission. Supplementary commission as well as the standard commission, and the answer is yes. The Supreme Court in the case of Singapore Airlines, KLM, Royal Dutch Airlines and British Airways PLC has held that the TDS under 194H will be applicable on standard commission as well as on the supplementary commission. So this is what this case law is all about. Next one, very simple question. Sir, what is there in the next question? For AY 22-23, you are filing your original return on 28th December and for declaring total income of 12 lakhs. And for AY 23-24, you are declaring a loss of 5 lakhs. They are filing the return on 30th October 2023. Now, for this second year, you want to file updated return. You already have a loss. Now you want to file an updated return by declaring income of 7 lakh. Can you file an updated return on 30th November? The answer is yes. If you have a loss of 5 lakh rupees, now you want to convert that loss into income of 7 lakh rupees, updated return can be filed. Now, by when it can be filed? If it is filed within 12 months from the end of relevant year, you have to pay 25% additional tax. After 12 months up to 24 months, 50% additional tax. After 24 months up to 36 months, 60% additional tax, Finance Act 2025 amendment. And after 24 months, after 36 months but up to 48 months, 70% additional tax, again Finance Act 2025 amendment. Therefore, in this case, because your loss is converting to income, you can file updated return. Secondly, You can file updated return when? Up to 30th November if you are filing, it means you are filing within 12 months from the end of relevant device. Therefore, you are liable for 25% additional tax. 25% additional tax you have to pay. Now, second question in this, what is the time limit for completing assessment? See, in first case, normal return is filed. In second case, updated return is filed. So, when a normal return is filed, the time limit to complete assessment is 12 months from the end of relevant device. The relevant device 22-23, 12 months from the end of 22-23 is 31st March 2024. But when an updated return is filed, it is not 12 months from the end of relevant device. Then it is 12 months from the end of the financial year in which the updated return is furnished. So the updated return is furnished on 31st of October 2023. 12 months from the end of 23-24. 12 months from the end of 23-24 will come to 31st March 2000. 12 months from the end of 30th November 2024, 12 months from the end of 24-25 will come to 31st March 2026. So in this case, the updated return will be filed till 31st March 2026. I hope it is clear to all of you. Let's go to question number 5 now. There is a search in the premise of Mr. Ajay and 160 lakhs undisclosed income is found in the search. Now, Mr. Ajay wants to set off some losses of earlier years of 90 lakhs and UAD of 30 lakhs against this income of search. Can he set off? The answer is no. Against the income which is found in search and seizure, no losses or UAD can be set off against that income. Therefore, this loss is not allowed to Mr. What? Mr. Ajay. I hope it is clear to all of you. Next question is a very simple question on DTAA. Let's try to understand this. There is an assessee aged 45 years, resident of India. Which regime we are following? We are following the old regime. First, he is earning some basic salary of 62,000 rupees per month multiplied by 12. On that 50,000 standard deduction will be allowed. Then dearness allowance 10%. Then royalty income is there from country M in literary book. For literary book, therefore they are eligible for 80 QQB also. Royalty you can show under PGBP or IFRS. ICI has shown under IFRS. You can show under PGBP also. It's okay. 9,80,000 is the gross royalty. 98,000 is the expense, and 3 lakh rupees will be allowed as deduction under 80 QQB. Be careful. Then you are earning some rental income from country N. Then you can claim 30% standard deduction on that. Then you are earning some dividend of 2,20,000 rupees. You can show that under IFRS. Then you are purchasing some residential house property in Bhopal of 23 lakh rupees. On that 1% stamp duty you have paid. Always remember, whatever stamp duty you pay, 1% will come to 23,000 over here. That can be claimed as deduction under 80C. 80C will allow that as a deduction. I hope it is clear to all of you. Then 26,000 rupees you have paid health premium for yourself, and 50,000 you have paid health premium for your non-resident what? Non-resident father. So therefore 26,000 you will get for 25,000 you will get for yourself, because you are not a senior citizen, you are just 45-year-old. Therefore you will get 25,000 for yourself, and for your father also you will get only 25,000 only, even though your father is senior citizen but your father is non-resident. Therefore inflated limit of 50,000 will not be available for non-resident. It is only available for resident senior citizen. Therefore for yourself you will get 25,000, and for your father also you will get 25,000 rupees. After that you compute the tax. You compute the tax as per old regime and then find out the doubly tax income. As simple as that. While computing the doubly tax income, you need to be very careful. For doubly tax income, 1,96,000 is doubly tax income. Then your royalty is 8,82,000 is not doubly tax income. For computing doubly tax income, you have to take 8,82,000 minus 3,80,000 QQB also, and then find out the doubly tax income. That will be your doubly tax income. I hope it is clear to all of you. Question number 7. Very simple question, nothing great, but a good question. There is a foreign company from Germany who has opened a branch in India for sale of LED. Now they are selling some goods from the branch in India, and some goods they are selling directly from outside India. So the officer wants, which has nothing to do with Indian branch. Some goods they are selling from branch in India, some goods they are directly selling from Germany in India, which has nothing to do with Indian branch. The officer wants to charge the goods which are directly sold to India from Germany also. Can he do so? He can do that in UN model, but he cannot do that in OECD model. Why? Because such concepts are called as force of attraction. Do you remember? Rolls-Royce example I have given you in class. If you open a branch of Rolls-Royce in India, and if you sell the Rolls-Royce through India, that is definitely taxable. But in force of attraction, if you directly also sell Rolls-Royce in India, that will also be taxable under UN model. That is called as force of attraction. But unfortunately, force of attraction is only there in UN model. It is not there in OECD model. Therefore, in OECD model, such items will not be charged. In OECD model, only the items which are sold through Indian branch, through Indian PE will be subject to tax, not something which is directly sold. Okay, I hope it is clear to all of you. So this is what this RTP is all about. Please comment below, how is it going? Fast. Let's go ahead with the next RTP, that is RTP May 2024. The very first question again over here is of total income. Assessee is engaged in manufacturing and selling of pharma products. And here we have to compute lot of things. You are supposed to compute total income and tax liability in the most beneficial manner. Therefore, you have to make 3 calculations first. First, you have to compute total income and tax as per normal provision. Then you have to compute total income and tax as per 115 JB, that is book profit, etc. Then compare whichever is higher, that will be answer number 1. And then you compute total income as per 115 BAA, because they have asked us to compute as per most beneficial manner. So first, three calculations you have to make: normal provision, MAT, and then 115 BAA. First, I am computing as per normal provision. The very first thing over here is 900 lakh is your net profit. First thing is, now the things will repeat, adjustments will repeat to some extent. Okay. As and when you go ahead, the adjustments have to repeat. Obviously, after doing all the 26 papers compilation, 90% of the adjustments will be repeated in the examination. Don't worry about it. Okay. Now, in the month of November, you are purchasing some know-how, and this know-how is purchased in November. Therefore, add back this know-how. Know-how will be allowed as a depreciation, and you can claim 50% depreciation, that is 12.5%, because it is put to use in the month of December. It is used for less than 180 days. So you can claim 12.5% as a depreciation. Next, electricity charges are unpaid. Doesn't matter, electricity charges are allowed on accrual basis. Even if it is unpaid, it is allowed as a deduction. No worries. Next, loss of 4 lakh for purchase of raw material on foreign exchange fluctuation price. So you are importing some raw material, you are doing some hedging contract, and on that hedging contract there is some forex loss. So that forex loss is allowed as a deduction. Same adjustment has come earlier also, it is allowed as a business loss. Okay. Next, depreciation as per books of accounts will be added back. Then loss of 2 lakh for purchase of imported machinery. Again there is a forex loss. So now 43A will apply. What will you do? Same adjustment, again repeating. 2 lakh rupees you will add back to PGBP income, and then you will add back this 2 lakh to the cost of asset. You will add back this cost of asset. So therefore the machinery cost will be 65 lakhs plus 2 lakhs, 67 lakhs. On that you will claim 7.5% depreciation, because the machinery is used for less than 180 days, and you will also claim 10% additional depreciation because the assessee is engaged in manufacturing. And now we are computing income as per normal provision. In 115 BAA we will add back this additional depreciation. Okay, so when we will compute the 115 BAA total income, at that time we will add back this depreciation. Then 20 lakhs you are receiving as a non-compete fees for entering into a contract, for not entering into a certain business. So that is considered as a PGBP. Let it be part of PGBP. Write a note for the same. Okay. Then you have received some advance, and you have forfeited that advance in respect of transfer of a capital asset. If that advance is forfeited on or after 1st April 2014, then it is considered as IFOS. Therefore, reduce from here and show under IFOS. Then there is some profit on sale of unlisted shares, 15 lakh rupees, reduce from here, show under capital gains. Those unlisted shares were acquired in 2022. Now you are selling in 2026. Therefore, it is long-term capital gains. On this, you will be liable for 12.5% tax because it is unlisted shares. Normal depreciation, 35 lakhs, you can claim depreciation. That's it. After that, you have to compute your tax. Total income you have computed. After that, you have to compute your tax. What will be the tax rate? The turnover of last year is 282 crore. Therefore, the tax rate will be 25% as per normal provision plus surcharge if applicable and cess. Okay, this will be your normal calculation. Now you will compute your book profit. Book profit will be how much? 1520 directly they have given. Book profit is 1520 lakhs. 1520 lakhs directly book profit they have given. Therefore, book profit is 15 crore 20 lakhs. So how much tax you will apply on this book profit? 15 crore 20 lakh rupees into 15% tax plus 12% surcharge, because the book profit is more than 10 crore plus 4% cess. Okay, I hope it is clear to all of you. Then compare normal provision or book profit, whichever is higher, that will be your answer number 1. Then you compute the tax as per 115 BAA. In 115 BAA, only one thing will be added back, and that is the additional depreciation on plant and machinery. That's it. That's the only thing which will be added back in 115 BAA. You can check it over here. Additional depreciation you will add back. That will give you your total income. In this total income, there are two incomes. One is special income. Long-term capital gains will be chargeable at 12.5%. Other income will be chargeable at normal rate of 22% tax, 10% surcharge, 4% cess. And ultimately, you check which is beneficial. Is the normal provision beneficial, or is the 115 BAA beneficial? That whichever is the most beneficial, you have to give comment on that particular thing, because that is the question which is asked over here. Next is a theory question, small question. The commissioner has a power to revise the order of AO under 263. Okay, so therefore the commissioner has issued some notice to the assessing officer that I want to revise your order under 143. So step number 1, the commissioner has issued notice under 263 that I will revise your order under 143.3. After that, survey has happened in place of assessees. At assessee's place, survey happened. There some new information came. Now the commissioner is issuing second notice after the survey. The content of the second notice is different from the first notice. So there is a 3-step discussion over here. Step number 1, commissioner is starting revisionary proceeding under 263. After that, survey happened at assessee place. Now the commissioner is sending a second notice to the AO. The content of the second notice is different from the first notice. Can the commissioner do so? The court has said that no. The commissioner should stick to the decision which he has taken earlier. The commissioner should stick to the points which he has given in notice number 1. Just because the survey has happened later on, now he wants to withdraw the first notice and send a second notice, and based on that he wants to revise the order under 143.3. That cannot be done by the commissioner. Therefore, the commissioner is incorrect over here. I hope it is clear to all of you. Question number 3 is on black money law. Black money law, always remember, for understanding the black money law, the very important term of black money law is assessee. You should be assessee in black money law. There are 2-3 points which you need to keep it in mind to understand black money law. First of all, the definition of assessee. Who is an assessee? Assessee can be any of the person. A person should be resident in the current year in which you are caught. In our example 25-26, or the person should be resident in the year in which the income was taxed, income was earned, or in which the asset was acquired. You should be resident in either of the 2 years. You should be resident either today when you are caught, or you should be resident in the year in which you have earned the income or in which you have purchased the asset. If you are non-resident in both the years, then you cannot be called an assessee. Then you cannot be subject to black money law. You should be resident either today or in earlier years. Further, one more thing you need to keep it in mind with respect to black money law is that in black money law, 2 things are charged. One is foreign income, one is foreign asset. Foreign income will be charged to the year to which it pertains, but the foreign asset will be charged in the year in which it is found. So if the AO has found foreign income today and foreign asset today, foreign asset will be charged today, but foreign income will be charged in the respective year. So therefore, the black money law came in 2015-16. So if the foreign income is pertaining to earlier than 2015-16, then black money law cannot be charged. But if the foreign asset is pertaining to earlier than 2015-16, still the foreign asset can be charged, because foreign asset is not charged to respective year. Foreign asset is charged in the current year. These are the few basic things that you need to keep it in mind. Now, Mr. Rohit is an Indian citizen. He came to India in March 2014 and then he left India in March 21. Therefore, from 2014-15 to 2020-21, he was resident. Now, in the current year 25-26, he is not resident. But from 14-15 to 2021, he was resident. Now, between this period, he has purchased some shares in December 2013. December 2013 means 13-14. Was he resident in that year? No. In December 13, he was not resident. Even today, he is not resident. Therefore, he cannot be called an assessee. We cannot charge him on this particular asset. Because in 13-14 also he was non-resident, today also he is non-resident. We cannot charge this asset. Second, he has purchased some apartment in London in 2015. So in 2015, that is 15-16, he was resident, and even today he is non-resident, it doesn't matter. But in the year in which he has purchased the apartment, that time he was resident, therefore you can charge this for an asset. Third, in 21-22, he has some manufacturing factory in Malaysia for establishing leather goods. This also cannot be charged because he was not resident in 21-22. He was resident till 2021. He was resident in 2021. He was not resident in 21-22. So in 21-22 also he was not resident. Today also he is not resident. Therefore you cannot charge his income. Next, he has also earned some commission from 2014 to 2021. So commission income is chargeable in the year to which it pertains. But 14-15 you cannot charge because 14-15 black money law was not there only. Yes. Commission income from 15-16 till 21-22 you can charge. From 15-16 to 21-22 you can charge the commission income because the income is chargeable in the year to which it pertains, and if the year pertains is prior to 15-16 then black money law cannot be charged. But if the asset pertains is prior to 15-16, black money law can be charged because asset is charged in the current year. I hope it is clear to all of you. So this is what this question is all about. Now question number 4, a DTAA question. Very good DTAA question. Very good. Lot of small informations are there in this question. Be very careful. First of all, you are supposed to compute total income and tax liability of Mr. Mahesh as per new regime 115 BSc. Let's see what all things are there over here. First of all, Mahesh is 50 years old. New regime you are following. Salary 23 lakhs before standard deduction. So claim standard deduction 75,000. First of all, write salary. Next, self-occupied property. Self-occupied property, interest not allowed in 115 BAA. 115 BSc it is not allowed. In new regime, self-occupied interest is not allowed. Then, fixed deposit interest you can claim under IFRS. Income from business $25,000. How will you convert this $25,000 into rupees? You will convert this as per rule 115. What does rule 115 say? You have to take TTBR on the last day of the financial year. What is the TTBR on the last day of the financial year? It is 71. So you have to convert this as per 71. So multiply this by 71. Similarly, income from house property 4,500 minus 450. That also you will convert as per last day of the financial year TTBR as per rule 115. Then dividend income. For dividend income, rule 115 says something else. For dividend income, you have to convert dividend income into INR as per the TTBR of the last day of the preceding month in which the income is earned. The income is earned in March 26. So you have to take TTBR of 20th Feb. Therefore, on 20th Feb, the TTBR is 70 rupees. You have to multiply by 70. Same for STCG also. You have to take TTBR of the last day of the preceding month. After doing all these things, you will compute your total income and you will compute your tax. Let's see. Salary 22,25,000. House property you will take and convert. Self-occupied house property interest not allowed. Business income you will take. Short-term capital gains you will take. 1,60,000 FD interest you will take and 1,70,000 dividend income you will take. After that you will get a total income of 54,11,290. On that you will apply the slab rates. After applying the slab rates, you will also apply 10% surcharge because the income is more than 50 lakhs. Therefore, apply 10% surcharge and 4% cess. You will get your total income and tax as 13,76,000. On that 13,76,000, you will divide this by what? You will divide this by 54,11,000. Therefore, you will get average rate in India. Now, this average rate in India, you will apply on doubly taxed income in India. What is doubly taxed income in India? The doubly taxed income in India is 2,01,000 is doubly taxed, 17,75,000 is doubly taxed, 3,50,000 is doubly taxed, and 7 lakh is doubly taxed. On this, you will apply this 30,26,285. This is doubly tax. This is the tax paid in India. Now you will compare that with foreign tax. In foreign country, you are paying how much tax? You are paying 20% tax in foreign country. But be careful. In foreign country, you are not getting this municipal tax deduction. Therefore, in foreign country, you are paying 20% tax on 25,000. You are directly paying 20% tax on this 4,500. You are directly paying tax on this 10,000, and you are paying tax on this 5,000. Therefore, in foreign country, you are paying 20% tax on $44,000. If I total all these four, you will get 20% of 44,000 rupees, approximately $44,000. So on that 44,500, you will take 20%. Whatever amount will come will be your foreign tax. On that, you have to convert that into rupees now. How will you convert your foreign tax into rupees? You need to check when it is paid. It was paid by Mahesh on 25th of May. So now you will convert this foreign tax into rupees as per rule 128. See, to convert foreign income into rupees, you have to apply rule 115. But to convert foreign tax into rupees, you have to apply rule 128. And what does rule 128 say? You have to convert as per TTBR on the last day of the preceding month in which the tax is paid. The tax is paid on 25th May. So the last day of the preceding month is 72. So now you will multiply this entire tax. 44,500 is your total income in foreign country. 20% is the total tax in foreign country. Multiply by 72. That will give you your tax paid in foreign country. So the tax paid in India is 769. Tax paid in foreign country is 640. Therefore, whichever is lower will be allowed as a relief. And the balance amount you have to pay from your pocket. I hope it is clear to all of you. Let's move on to the next question. Question number 5. What is this question, sir? This question is on rollback provision. Do you know that you can make an application for APA for future 5 years and rollback for past 4 years? So you have made an application for what? Rollback on 50, application for APA on what? 15th of February 2025. So on 15th of February 2025, you are making an application which was signed on 5th of May 2025. Now you have been asked a question that can you roll back the agreement for the past years? So for first year 2020-21 you cannot roll back because you can roll back only for 4 years and 2020-21 is beyond 4 years. Even for 21-22 you cannot roll back because you can roll back only for 4 years, not beyond 4 years. Yes, for 22-23 you can definitely roll back. There is no dispute and assessment have been completed. Even if the assessment has been completed, you can roll back. There is no condition that if the assessment is completed you cannot roll back. There is no condition like that. Now the next one, in next year 23-24 the TPO has enhanced your income by 500 lakhs. See, one of the conditions that you cannot roll back is if your income falls below what the income declared in the ROI. So whatever is the income declared in ROI, because of rollback your income cannot go below that. So if I have told you in the class also, suppose in your ROI the income is 100 lakhs and if the TPO increases to 120 lakhs and after rollback it becomes 90 lakhs, then you cannot go for rollback. Your rollback cannot reduce your income below ROI. But yes, if you accept that I am ready to declare 100 lakhs as my income, then you can roll back. In this case also, the TPO has increased by 500 lakhs. The income can reduce below 500 lakhs also, but it should not reduce below what? The income which is declared in the ROI for AY 23-24. Similarly, for 24-25, can I go for rollback? Let's check what has happened. The matter has been to tribunal. The matter has been to tribunal for 24-25 and tribunal has set aside the case for fresh consideration by the AO. Yes, you can go. Remember, if the tribunal has already passed an order discharging the matter at its end by confirming the order, by annulling the order or by modifying the order, then you cannot go for rollback. If the tribunal has closed the matter, then you cannot go for rollback. But if the tribunal has remanded back the case to AO, then you can definitely go for rollback in this case also. And for last year, you cannot go for rollback because you have filed the return late. One of the conditions for going rollback is you should file the return on time. If you file the return late for earlier years under 139(4), then you cannot go for rollback. I hope it is clear to all of you. So this is what this question is all about. And this is what this RTP is all about. Let's move on to next RTP, RTP November 2024. Now what is given in this RTP? Again, a total income question has to be computed in the most optimum income tax liability. Again, you have to compute as per normal provision, then as per MAT and then as per 115BAA, just like the previous RTP. Okay. So let's start with the question. The very first item which is given over here, associate is engaging manufacturing of pharma product. This is very important line. The pharma product is very important line. Some adjustments are related to pharma over here, which is given in this question. First thing which you are doing, you are incurring 6 lakh rupees as a public issue expenses that will not be allowed as a deduction. Any expense incurred for issuing shares not allowed, even though the public issue could not be materialized due to non-clearance by SEBI. It doesn't matter. Any expense which is incurred with respect to what public issue, share issue, it's a capital expenditure. Therefore, it is not allowed as a deduction. Be very careful. Okay. The next adjustment is also a new adjustment. You are purchasing some goods of 5 lakh rupees from a micro enterprise Sunny Traders on 25th of February 2026, and you have made a commitment that I will make the payment in 25 days. So if you purchase anything from micro or small enterprise, and if you make a commitment that I will make the payment in 25 days, if you make the payment within time, then the expenditure will be allowed on accrual basis. But if you make the payment beyond time, then the expenditure will be allowed on payment basis. Now, if you make a commitment that I will make the payment in 25 days, now you are making the payment on 29th March 2026, which is beyond 25 days. So you will be allowed the deduction on payment basis, not on accrual basis, because you are not making the payment on time, you are making the payment late. But even though you are making the payment late, still the payment is made in the same financial year. Therefore, no need to worry, you will get the deduction in the current year itself. Yes, if this 29th March would have been 3rd April, then you would have been given the deduction in the next year, 26-27. Now, because this 29th March is also in the same financial year, you can claim the deduction in the current year, no issues. Okay. Third one, you are a pharma company, you are giving freebie to medical practitioners, not allowed. Pharma company giving freebies to doctors, medical practitioners, medical associations, not allowed as deduction. Next one, it is disallowed under explanation to section 37(1). Depreciation as per books of accounts disallowed. One-time license fee you are paying for obtaining a franchise, then that is disallowed, and on that you can claim 25% additional depreciation later on. Okay. Next one, you are setting up some warehouse in rural area for storage of agriculture produce. Now this is eligible for 3580 deduction. Now on that there is a profit of 17 lakh rupees. So do one thing, show this profit separately. Don't merge this profit with your pharma business. So reduce from here and show under PGBP separately. Next one, you are receiving some power subsidy that is considered as a revenue income. Therefore, let it be part of income. Write a note that power subsidy is an income as per section 2, clause 24, subclause 18. It is deemed to be income under section 224(18). Next one is your again grandfathering clause. I am irritated with this grandfathering clause. Again and again it will come. 4,80,000 is your profit. Whenever 31st Jan 2018 will come, it means it is a grandfathering clause. 4,80,000 is your profit from shares on which STT is paid. So that profit you will reduce from PGBP, and under capital gains you will compute separately whatever capital gains will come. How will you compute? You will compute the cost separately. Cost will be actual cost compared with lower of FMV on 31st Jan 2018 or fair or share or selling price, whichever is lower. Compare that with actual cost and then whichever is higher. That will be your cost. Okay. Now next one is also a very intelligent adjustment. Now one thing you need to remember in point number H, whatever capital gains will come, on that 12.5% tax will be imposed. In excess of what? In excess of 1,25,000 rupees, because it is covered in 112A. Next, you have taken a loan from Punjab National Bank of 8 lakh rupees. Now that loan is taken for working capital requirement, and that loan is waived off by the bank. In that there are two parts. 6 lakh is your what? Is your principal, and 2 lakh rupees is your interest. So whatever principal is waived, now entire 8 lakh rupees you have credited to what? P&L account. Now that on that principal which is waived, that is considered to be your income. Why? Because it is remission and cessation of a trading liability. Therefore, that principal will be subject to tax. What about interest? Interest will not be subject to tax. Why? Because interest as an expense was not allowed as deduction because of 43B. Because as per 43B, if you take a loan from PNB, interest is allowed on payment basis. Because the interest was disallowed earlier, therefore again on waiver of interest, it cannot be subject to tax. Therefore, reduce interest what? From your PGBP income and let principal be part of your income. Principal will be subject to tax. Next one is you are employing 50 employees in the financial year 25-26 on a regular basis. They participate in the recognized provident fund. Then emolument is also less than 25,000 rupees. You are employing them for also more than 240 days. Therefore, you will be eligible for what? You are also making the payment by account paycheck. Therefore, you will be eligible for 80 JJAA year. 50 employees into 23,000 into 9 months, because from July into 30%, 80 JJAA deduction will be available. Next, for warehouse of agriculture, for warehouse of sugar, you have invested 40 lakh rupees. Out of that, 25 lakh is land. Therefore, 15 lakh rupees will be allowed as deduction under 35AD. So, under 35AD, what will be your income? You have already shown 17 lakh as a profit. From that, 15 lakh rupees you will claim as a deduction. Therefore, 2 lakh rupees will be taxable profit under 35AD. Last but not least, your depreciation as per income tax law is how much? 9,20,000. You can claim that as deduction. Your turnover of last year is 395 crores, which is less than 400 crore. Therefore, 25% tax will apply, surcharge if applicable, and cess. Now you will compute tax as per what? Tax as per book profit. 115 JB, 99.5 lakhs is your book profit. Therefore, 15% tax and 4% cess. No surcharge because income does not exceed 1 crore rupees. Now you will compute optimum tax. For that, you will compute 115BAA. What is different in 115BAA and normal provision? Only one thing. Whatever 35AD deduction you have claimed, 15 lakh rupees, you will add back that 15 lakh rupees, and on that 15 lakh rupees, that is a building, on that 15 lakh rupees, you will claim what? Normal depreciation of 10%. That's the only thing which is different under 115BAA and normal provision. So in 115BAA, what are you going to do? Add back the depreciation, add back the 35AD deduction of 15 lakh, and on that you will claim your normal depreciation of building of 10%. Okay. After that, you apply on special income, you apply special rate. On normal income, you apply 22% tax, 10% surcharge, 4% cess, and whichever is more beneficial, go for that. If normal provision is beneficial, go for that. If 115BAA is beneficial, go for that. Whichever you are comfortable, you go for that. Okay. I hope it is clear to all of you. Now, question number 2. Question number 2 is one of the best questions that I have come across till now. I am not saying in the entire 26 paper. There are much better questions which will come later on. But question number 2 is one of the best questions that we have come across so far. It's a question on partnership firm XYZ and company. There are 3 partners, A, B, C, who are working partner, and there is 1 non-working partner. So total there are 4 partners, and their details are given, and you are supposed to compute two answers. First, the firm do not want to get its books of accounts audited. Advise the firm on its total income. Firm does not want to get the books of accounts audited. You want to compute the total income of the firm. How will you compute the total income of the firm? See, audit is not required. They don't want to do audit. Now, the turnover of the firm is 2 crore 80 lakhs. Be careful. Can the firm go for 44AD? Yes, they can go. Generally, if your turnover is more than 2 crore but up to 3 crore, you can go for 44AD only if your cash receipt is up to 5% of your total turnover. So, if your cash receipt is up to 5% of your total turnover, you can go for 44AD. Let's check the cash receipt and the total turnover. If it is within 5% range, they can go for 44AD, and if they can go for 44AD, there is no audit required. So therefore, what is the cash receipt? The cash receipt is 2 lakh over here. 2 lakh is cash receipt, and this 10,50,000 is also cash receipt. This is cash receipt directly, point number 3. And point number 4, receipt by way of a check other than account paycheck. If you receive by other than account paycheck, that is also considered as cash only for the purpose of 44AD. Go and check. It is written in 44AD. Any amount received other than account paycheck will be considered as cash. So total cash receipt is 12.5 lakhs. And what is your total turnover? 280 lakhs. This is 4.46%. Therefore, you are well within the range of 5%. Therefore, you can go for 44AD. Therefore, audit not required. Now, compute income as per 44AD. On cash portion, 8% deemed income, and on other than cash portion, 6% deemed income. From that, you can claim brought forward business losses. In 44AD, you cannot claim any deductions from 28 to 44, but you can definitely claim losses. Therefore, from this amount of 44AD income, you cannot claim remuneration interest paid to partners. That is not allowed. 40B is not allowed from 44AD. But yes, business losses are allowed from 44AD. After that, you have to show one thing extra, that is capital gains. 57 lakh is the sale of land, and 12 lakh is the acquisition of the land, cost of acquisition, which has been purchased 5 years back. Indexation not available after 23rd July 2024. Therefore, 57 lakhs minus 12 lakhs, 45 lakhs will be your capital gains, and this 45 lakhs is your capital gains, and this is your PGBP income. This is your part 1. Check it, please. This is your PGBP income. From that, 75,000 business loss is set off, and 45,000 rupees capital gains. From that, GTI will come. Okay, this is your part 1. Now part 2, very intelligent. Again, compute total income. Assuming that instead of 2 lakh received from firm, 4 lakh is received by check other than account paycheck. Let's assume that this is not 2 lakh, this is 4 lakh. So now if this is not 2 lakh, this is 4 lakh, therefore total cash receipt is 14.4 lakhs. So if the total cash receipt is 14.4 lakh, now if you do 14.4 lakh divided by 280, it is going beyond 5%. Now because it is going beyond 5%, now you cannot claim 4480. 4480 cannot be claimed. Now you have to compute total income as per the normal provision. You have to compute total income as per the normal provision. So start computing total income as per normal provision. The net profit is 8,65,000 after debiting and crediting the following items. The first item that you are going to add back, net profit 8,65,000. Now 4480 not available because your cash receipt is more than 5%. So 8,65,000 is your net profit. Interest 15% not allowed. Add 3% back first. Item number 1 to add back is interest. Then 60,000 remuneration you are paying to all the partners. So there are 4 partners, to all of them you are paying remuneration. Add back entire remuneration. 60,000 into 4 partners into 12 months. Add back the entire remuneration. Then what else to add back, sir? Third item, you have to reduce the profit. Profit you have credited to P&L. Capital gains you have credited to P&L. So reduce that 45 lakhs from P&L account. Then sir, one more item. You are making some payment of 12,000 rupees cash payment to a clerk which is debited to P&L. Rest all does not exceed 10,000, but clerk payment is exceeding 10,000. So 12,000 into 12 will come to 1,44,000. So 4 adjustments you are supposed to make. Which 4 adjustments? The interest you have to add back 3%. Remuneration you have to add back all 4 partners. Clerk salary you have to add back 144, and then you have to reduce your capital gains of 45 lakhs. After that, there is a book loss. There is a book loss. So if there is a book loss, not book profit, then how much remuneration you can claim as a deduction? Maximum 3 lakh rupees, not more than that. So your maximum limit is 3 lakh, but your actual remuneration is 21 lakh 60,000. How, sir? For 3 working partners, 60,000 into 12 into 3 working partner, actual remuneration 21 lakh. But in case of loss, you cannot claim more than 3 lakh. Therefore, 3 lakh you can claim as a loss. Therefore, ultimately your business loss will come to 881. Already 581 is your loss and 3 lakh more loss because of the remuneration. 881 is your loss. Now you can set off this loss against your capital gains income. Yes, you can set off. PGBP loss can set off against capital gains income, but capital gain loss cannot set off against PGBP income. PGBP loss you can definitely set off against capital gains income. Sir, what about last year 75,000 loss? That you cannot set off against capital. That you cannot set off against capital gains income, because last year business loss can set off only against current year business income. But current year business loss can set off against any other loss, any other income except salary. Last year business loss cannot be set off against current year capital gains income. Last year business loss can set off only against current year's PGBP income. And in current year there is no PGBP, there is already a loss. Therefore that 75,000 you have to carry forward. I hope it is clear to all of you. Question number 3 is a very simple case law question. There is a telecom company and you are a distributor. And I am giving you SIM card, I am giving you recharge coupons, and I am selling you SIM card and recharge coupon. There is no principal-agent relationship. There is a principal-principal relationship. So if there is a principal-principal relationship, 194H will not apply. If there is a principal-agent relationship, then 194H will apply. That is what it is mentioned in this particular question. Check it, please. Question number 4. Again, a very simple question. The assessing officer is doing a survey in the night at 9:30 p.m. in a sports complex. The sports complex is open between 5 a.m. to 10 p.m. So the first question is, can he enter in the night? See, there is a provision in the survey section in 133A that the assessing officer can enter for survey provided he has taken an approval from higher authority like Principal Director General, Principal Chief Commissioner and Commissioner. Let's assume that he has taken the approval. The question does not specify about approval. Let's assume that he has taken an approval. And approval is not a concern. Now let's talk about the timing. Can he enter after sunset? There is a provision in survey section that the officer can enter only after sunrise but before sunset. But there is further a provision that if the business hours is in night, then he can enter in the night also. What is the business hours? The business hours is from 5 a.m. to 10 p.m. and he is exactly entering half an hour before the business hours end. Therefore, he can enter. There is nothing wrong in that. Second thing, can he after entering take away books of accounts and cash? Books of accounts and cash. So there are 2 things which he wants to take away. One is cash, one is books of account. Let me talk about cash. Cash he cannot take away. In case of survey, he cannot take away cash under any circumstance. Yes, for books of account, he can take away the books of account for as much time as he wants For as much time as he wants, he can take the books of account. But if he wants to take the books of account for more than 15 days, excluding holidays, then he has to take approval from higher authority. Cash he cannot take. Books of accounts he can take up to 15 days. No worry, beyond 15 days he can take an approval and take beyond 15 days also. Okay. Next question, question number 5. A very simple question. Penalty. There is an investment fund under 9A. Sir, what is investment fund? We have done in the chapter on non-resident taxation. Then hopeless section is there. There is an investment fund outside India. There is a fund manager in India. They have to fulfill 17 conditions. 13 conditions should be fulfilled by the fund. 4 condition has to be fulfilled by the manager. Then the income of the investment fund will be not subject to tax. So who will check whether these conditions are fulfilled or not? For that purpose, investment fund has to file a statement in form 3CK within 90 days from the end of the financial year. So they have to file a statement in form 3CK by 29th of June 2026. If they don't file a statement under form 3CK, then they will be liable for penalty of 5 lakh rupees under 271 FAB. That is what it is mentioned over here. So what is the penalty for not filing the statement within 90 days? It is 5 lakh rupees under 271 FAB. I hope it is clear. Second question over here is also very simple. There is a caterer who is receiving 1 lakh in cash and 9 lakh account pay check, so no issues. Because you are receiving only 1 lakh in cash, if you receive 2 lakh or more in cash, then the provision of 269 ST will apply, 271 D apply. Because here you are receiving only 1 lakh in cash and 9 lakh by account pay check, no penalty will be imposed under 271 DA in your hands and no 269 ST will attract in your case. I hope it is clear to all of you. Question number 6, very dangerous question. Very dangerous question. This is the best question on DTAA across the book. Best. No DTAA question can be better than this. First of all, Mr. Rakesh or Mr. Ram Prakash, whomsoever it is a resident. You need to compute the income as per and tax liability as per new regime 115 BSE. And Mr. Rakesh and Mr. Ram Prakash, whomsoever it is, he is earning income from 3 countries, country X, country Y and India. Let's compute total income in India. When you compute total income in India, you will take house property 2 lakh 50, 2 lakh 50, 5 lakh minus 30% standard deduction. Then all these losses will be set off against all this PGPP income of 2 lakh 80, 3 lakh 40 and 1 lakh 80. 10 lakh 80,000 STCG will go in short-term capital gains. 37 lakh long-term capital gains on sale of house. And to save that long-term capital gains, you have purchased another house within 1 year, that within 2 years in the name of your spouse, joint name with your spouse. Can you purchase a new house in the name of your spouse? Yes, why not? The Delhi High Court in the case of Kamal Wahal has held that you can purchase another house, another residential house in the name of your wife. Your wife is not a stranger. You can purchase. So far as the consideration is invested by the SSC, you can claim. Then 3,40,000 agriculture income will be taxable in India. Foreign agriculture income is not exempt. Indian agriculture income is exempt. 1,80,000 agriculture income from country Y is also taxable. Yes, 5,20,000 agriculture income will not be taxable in India. So everything will come in the total income except this Indian agriculture income. Everything will come in the income. And from gross to from rental income, you will claim 30% standard deduction. I hope it is clear to all of you. After doing all this thing, you will get your total income. Total income 37 lakh. Now you have to compute tax. How will you compute tax? Don't compute tax directly on 37 lakhs. You are gone. There is an agriculture income. You have to apply partial integration. Step number 1, compute tax on 37 lakh plus agriculture income. So compute tax on what? 42.2 lakhs. Step number 1, compute tax on agriculture income and total incomes. Compute tax on 42.2 lakhs. Now while computing the tax on 42.2 lakhs, be very careful. Out of this 42.2 lakhs, 12 lakhs is long-term capital gains. Therefore on long-term capital gains, compute 12.5% and on other income, compute as per slab rates. That is your step number 1. Step number 2, compute tax on agriculture income plus basic exemption limit. Agriculture income is 5.2 lakhs, basic exemption limit is 4 lakhs. Now compute tax on 9.2 lakhs. This is your step number 2. Now step number 1 and 2, difference, take the difference between step number 1 and 2. Step number 1 minus step number 2 will be your ultimate tax. On that apply cess. No surcharge because the total income is less than 50 lakhs. Apply cess and then you will get your tax. And then you will divide this by 37 lakhs and therefore you will get your average rate in India. The average rate in India is 16.98. Now compare this average rate in India with foreign average rate. Now in country Y the average rate is 27%. But in country X the average rate is not given. They have given the slab rate. So for country X we need to first of all find out the average rate. How will we find out the average rate in country X? For country X we need to find out the average rate by taking country X total income in the denominator and then computing tax as per the slab rates and taking that tax in the numerator. So what is country X total income? Let's try to understand what is country X total income. Try to understand please. Pay attention please. Sir, will this 2,50,000 come in country X total income? Yes, 2,50,000 will come in country X total income. In country X you will not get any 30% standard deduction. Sir, will I reduce this 1,20,000? No. In country X this loss is not allowed. Check. not in country X. Loss from cannot be set off in country X, therefore in country X do not set off. Sir, will I take business income? Yes, take business income in country X. Sir, STCG, yes, take STCG in country X. And sir, agriculture income is exempt in country X, so don't take country X agriculture income. In country X, you don't pay tax on agriculture income. Therefore, country X only 3 income will come: 2.5 lakhs, 2.8 lakhs, 10.8 lakhs. This is your denominator. On this denominator, apply this slab rate. You will get the tax. After you get the tax, you will get the average rate. Now that average you will compare with Indian rate. And now you will compare the average rate, whichever is lower, and now you will apply that on doubly taxed income. Sir, what is doubly tax income in case of country X? In case of country X, doubly tax income is not 2,50,000, it is 2,50,000 minus 30%. Then, in case of country X, doubly tax income is this 2,80,000, this 10,80,000, this is not doubly tax income, and this 1,20,000 rupees you have to reduce, because on that 1,20,000 you are not paying tax in India. Similarly, doubly tax income you have compute in the same manner the way you have been computing earlier also. 2,50,000 minus 30% is doubly tax income, then 1,30,000, then this. And in country Y, agriculture income is taxable. Therefore, in country Y, this 1,80,000 is also what? Is doubly tax income. Country X only agriculture income is exempt. In country Y, it is taxable. Therefore, in country Y, this 1,80,000 is also doubly tax income. Very, very great question. No question can be better than this in the entire 26 paper. They cannot ask you such question, such big question in the same manner. They have to reduce the content and then ask. Such a big question, if they start asking in the examination, students will go mad. They cannot ask such big question in the examination. It is very, very, very big. Next question. Question number 7, which is on poem. There is a foreign company which is located in USA. Their global assets are 50 crores and their Indian assets are 25 crores. Now, if they pass ABOI test, then their poem is outside India. But the first condition of ABOI test is what? The second condition of ABOI test is failed. What is the second condition of ABOI test? The Indian asset should be less than 50% of total asset. Now, Indian assets are exactly 50% of total asset. Therefore, ABOI test is failed. Further, one more condition is there, that there are 10 board meetings are held, out of which only 4 are held in India. But major commercial decisions are made in India only. Now, this is sufficient evidence. They are failing the ABOI test and majority of the big decisions are taken in India. Therefore, poem is in India. Therefore, this foreign company is a foreign company, but at the same time, it is resident also. It is a foreign company as well as it is a resident. Now I am making a professional fees payment to this foreign company. I am making, say, 10 lakh rupees professional fees payment to this foreign company, which is a foreign company as well as resident. So now I will deduct TDS as per what? 194J or 195? Because in 194J it is written, if you make the payment to resident, then you should deduct TDS. Yes, this is a resident company. Then 195 it is written. If you make a payment to foreign company, you should deduct TDS. Yes, it is a foreign company also. So if there is a clash between resident and foreign company, for the purpose of TDS, what should I consider? So the CBDT has given a circular that if there is a clash between 194J and 195, if there is a clash between resident and foreign company, for the purpose of TDS, consider this as a foreign company and tell them to fulfill all the related requirements also, like you have to deduct TDS as per 195 and also you have to fill form 15CA, 15CB, all the related formalities also you have to fulfill. I hope it is clear to all of you. Next question. It's a very simple question. There is an Indian company which is located in SEZ, in which a foreign company holds 30% share, therefore both of them are deemed to be associate enterprise. Now you have to compute the arm's length price in 3 different transactions. Now you are selling 90,000 pieces at rupees 10 to your associate enterprise. To third party you are selling at 12 rupees. So to associate enterprise you are selling at lower price. To third party you are selling at higher price. Therefore how much higher? $2 higher. So 90,000 pieces into $2 into 85 rupees. That will be your addition in the arm's length price. Second, you are paying some guarantee fee of 15,000 rupees to associate enterprise. To third party you are paying only 12,000. Therefore 3,000 extra you are paying. So $3,000 into 85 rupees will be your increase in arm's length price. Third one, you are taking some details of potential customers and you are paying 18,000 rupees to your associate enterprise. To third party you are paying only $16,000. So $2,000 extra you are paying to your associate enterprise. Therefore that $2,000 will be added to your arm's length price. $2,000 into 85 rupees will be added back. So these are the adjustments which will be made as per point number 1. Point number 2 says that if such adjustments are made by AO, can you claim deduction under 10AA on the enhanced income? No. If the AO increases the arm's length price, then as per 92C subsection 4 first proviso, the AO increases the arm's length price, then you cannot claim profit link deduction, you cannot claim chapter 6A on that income, and you cannot claim 10AA on that particular income. So this is what this particular paper is all about. So let's go ahead with the next RTP, that is RTP May 2025. Now the very first question over here is on total income question. The assessee is a domestic company. The profit of the assessee is how much? The profit of the assessee is 1 crore 7 lakh rupees. Now, I have already told you that whenever a question on total income comes, you need to always see the last line, what they are exactly asking. So they are asking us to compute the total income and tax liability as per 115BAA. So as per 115BAA, you are supposed to compute the total income as well as the tax liability. So let's start computing the total income and tax liability as per 115BAA. The profit is 1 crore 7 lakh. The very first thing which is given over here is the credit to the PNL, and then they have given the debit to the PNL. Let's talk about the credit to the PNL first. The first item which is credited to the PNL is rent received from vacant land. Always remember, when you receive any rent from a vacant land, that goes under IFOS, it is not income from house property. If you want to classify an income as an income from house property, there has to be a building or land upper tenant to the building. A vacant land will go under income from other source. Therefore, reduce from here and show under what? Show under income from other source. I hope it is clear to all of you. Second one, you are earning some rent from commercial property of 5,30,000. The tenant has deducted 10% TDS. Okay. So now this rent will go under income from house property because this is from building. This is from a commercial property. You will reduce this rent from here and you will show this rent under income from house property. From that you will claim 30% standard deduction. Now the question will come to some of your mind that whether we get deduction of 30% standard deduction in 115BAA. The answer is yes. In 115BAA, 30% standard deduction is allowed. In 115BAB, it is not allowed. In 115BAB, the rent is directly taxable. But in 115BAA, you get the deduction of standard deduction and municipal tax also. I hope it is clear to all of you. Next one, you have got some income tax refund. On that, there is some interest. So what is the treatment of interest on income tax refund? It goes under income from other source. Reduce from here and show under income from other source. Next one, you have sold some plot of land for, and the profit on the sale of land is 8 lakh rupees. So first of all, do one thing, reduce this profit from what? PGBP, and show this profit under capital gain. So how to compute this profit? So for that purpose, they have given some information in the point number 6 in the additional information. You can check it over here. The plot was purchased in Jan 24 and it is sold in March 26. The plot was purchased for 50 lakhs and it is sold for 58 lakhs. Therefore, the capital gains will be considered to be long-term capital gains. So how it will be considered? Long-term, because it is sold for after 24 months. Therefore, this 8 lakh rupees will be long-term capital gains. So what is the ultimate treatment? Reduce from PGBP, show under capital gains. Under capital gains, you have to show 12.5% as your tax. I hope it is clear to all of you. Next, you are receiving some dividend from foreign company of 6 lakh rupees. So the very first thing you will do is reduce from PGBP, show under IFOS. But at the same time, to invest in this foreign company, you have taken a loan. Check here in point number 8. You have taken a loan. On that loan, you have incurred an interest of 1,50,000 rupees. So do remember that against the dividend income, do you get any deduction? Yes. Against dividend income under IFOS, we get only one deduction, that is interest expense. That to up to 20% of the dividend. Now, what is the treatment? You are paying 1,50,000 as interest. Okay, but your dividend is only how much? 6 lakh rupees. What is 20% of 6 lakhs? You will get only 20% of 6 lakh as deduction from IFOS. That is 1,20,000 rupees you can claim. So what is the treatment? Add back 1,50,000 in PGBP and in IFOS claim 1,20,000 as deduction, because only 20% will be allowed as deduction. Again, I am saying this 1,50,000 add back in PGBP and claim 1,20,000 as deduction under IFOS from 6 lakh rupees. Therefore, your net dividend will be how much? The net dividend will be 4.8 lakh rupees. I hope it is clear to all of you. Next one is depreciation. Add back depreciation as per books of accounts. Then next is donation you have given for Swachh Bharat Abhiyan. That is ATG, but ATG is not allowed in 115BAA. Therefore, add back this ATG deduction also. Next is you are contributing some pension for your employees. Now, if an employer contributes pension for employees, is the employer eligible for deduction? The answer is yes. How much? 14% of basic salary plus DA in terms. 14% of basic salary plus dearness allowance in terms. Now, what is the basic salary in dearness allowance in terms? That is given in point number 7 below. It is 10 lakh rupees. The basic salary and dearness allowance is 10 lakh. Therefore, 14% of that is how much? 1,40,000 will be allowed as deduction. But you are contributing how much? You are contributing 1,90,000. Therefore, how much deduction will be allowed to you? Only 1,40,000 will be allowed to you. Therefore, 50,000 expenditure will be disallowed over here. Next, you are making some payment of 60,000 rupees to a road transporter. Now, generally, if you make a payment to a road transporter, you are supposed to deduct TDS under 194C. But there is a relaxation that if the road transporter does not own more than 10 goods carriage at any time during the previous year, and he gives a declaration that he does not own more than 10 goods carriage, and he gives a PAN, then I am not supposed to deduct TDS. All those things are happening here. He is following 44AE. He does not own more than 10 goods carriage. He is giving a PAN. He is giving a declaration. Therefore, there is no need to deduct TDS. And even if you have not deducted the TDS, the expenditure will be fully allowed to you. Don't worry. Next, bonus of 4,48,000 is debited to PN. Now, we all know that bonus to employees are allowed on payment basis. As per 43B, you should pay till the due date of filing of return. Now, when have you paid? You have paid after the due date of filing of return on 18 December. Therefore, this bonus will be disallowed under the income tax law. Next is income tax. Income tax is disallowed. The interest of income tax is also disallowed under section 48(2). Both of them are disallowed. Next is you are giving some donation to a university which is approved under 35(1)(2). That is Scientific Research Association. Therefore, that is not allowed in 115BAA, therefore disallow that. This donation to Scientific Research Association is disallowed under PGBP under 115BAA. Under normal provision it is allowed, under 115BAA it is not allowed. Just comment below and let me know whether the voice is properly coming or not. Please, somebody is saying that voice is not coming. So if there is any issue, let me know. Okay. Next one, depreciation of 18 lakh rupees as per Income Tax Act is there. So you can claim the deduction because this information is given in additional information. You have to separately compute. Now, some mistakes they have done. Let's see whether that is a mistake or not. Now, on printer and scanner and EPBX, they have claimed 40% depreciation. Whether printer and scanner are eligible for 40% depreciation, the answer is yes. Printer and scanner are considered to be peripheral of computer. Computer and its peripherals both are subject to 40% depreciation. Therefore, printer and scanner 40% is okay, but EPBX 40% is not okay. On EPABX, only 15% depreciation is allowed. Therefore, you have to add back 25% depreciation over here and disallow 25% depreciation. Printer and scanner 40% is okay. EPABX 40% is not okay. There 25% you have to add back. Next one, additional depreciation you have not considered. Good enough, you have not considered additional depreciation because in 115BAA additional depreciation is not allowed only. Therefore, it is better that you have not considered what? Additional depreciation. I hope it is clear to all of you. Next one, you have done some provision for audit fee in the last year of 1 lakh rupees without deducting TDS. So in the last year you have made one journal entry and you have not deducted the TDS. So in last year 30% of the audit fees would have been disallowed, but in the current year you have deducted the TDS and you have paid the TDS. Therefore, in the current year you should get the deduction of that payment of TDS. Therefore, in the current year you can claim 30% deduction. Very simple. Last year 1 lakh rupees you have not deducted the TDS. Therefore, last year 30% of 1 lakh would have been disallowed, but in the current year you have paid the TDS. Therefore, 30% of 1 lakh will be allowed to you in the current year. Similarly, last year there was an outstanding expense of 90,000 rupees on which you have claimed the deduction for purchase of raw material. You would have purchased some raw material by passing journal entry. Purchase account debit to creditor's account, 90,000 rupees. Now in the current year you are making the payment by cash. 45,000 you have paid by cash. That is wrong. So if you claim deduction of an expense on accrual basis in 1 year, and in the next year if you make the payment by other than account pay check, account pay draft, ECS and such other electronic mode, in the next year it will be added to your income and it will be called as deemed income. I hope it is clear to all of you. Next adjustment is of no use to us. Earlier it was relevant, now it is not relevant. You are issuing some shares of 1 lakh rupees at rupees 90, whereas the fair market value is 60 rupees. Before 2024, there was a concept of angel taxation. At that time, it was relevant. Now it is not relevant, so ignore that. Okay. Now, apart from this, one last adjustment is there. Point number 8. You are declaring an interim dividend of 5,20,000 rupees in September. So it is good that you are declaring the dividend 1 month prior to the due date of filing of return. Therefore, you can get the deduction under ATM. ATM you can get the deduction, but how much? Dividend received minus dividend paid, whichever is lower. So dividend received is how much? 4.8 lakhs. I have already told 6 lakhs minus 1,20,000 interest expense. 4.8 lakhs is the dividend income. And how much is the dividend expense? The dividend expense is 5.2 lakhs. Therefore, whichever is lower, that is 4.8 lakhs will be allowed as deduction to you in this case. Now, after that, you will compute the tax. There are two types of income. One is LTCG, which will be taxable at 12.5%, and other incomes will be taxable at 22%. And on the total tax, you will impose 10% surcharge and 4% cess. So this is what this beautiful question is all about. Now, coming to the next question. Question number 2. Question number 2. It's a question on partnership firm. There are 3 partners. Vatsal, Vihan and Vayu are equal partners. The firm was formed in 2026, this year only. So it's a 10-year-old firm, 10-month-old firm, just 10-month-old firm. Now, what are you supposed to compute? You are supposed to compute just total income of the firm. No need to compute any tax, no need to compute any AMT, nothing. Only total income. So whenever you compute total income of a firm, you have to compute first of all the book profits as per 40B. Then you will compute remuneration. allowable to the partners, and then you will compute the total income. So let's compute all of them one by one. Net profit is 4,50,000. What is book profit? Book profit is nothing but PGBP only. In that PGBP, just add the remuneration if debited to PNL. So net profit is 4,50,000. The first item is depreciation on generator and computer, which is as per books of accounts, so add back. Second is partner salary, add back. How many partners? 82,000 salary, 3 partners for 10 months salary, add back. This is the actual salary. This is not allowed. This actual will be compared with maximum percentage allowed as per 40B, whichever is lower, that will be allowed. That we will see later on. Then 18% interest you are giving. Therefore, 6% interest disallowed, only 12% is allowed. Then you are giving donation to political party. Now you are giving 2 donations. One you are giving by cash. Cash is fully disallowed. One you are giving 70,000 by electronic mode. This will also be disallowed in PGBP. But later on, this electronic payment donation will be allowed as deduction under 80GGC. Later on, you can claim that as a deduction. Again, I am saying cash donation disallowed now also, and in 80GGC also disallowed. But the electronic donation, online donation which you have given will be disallowed in PGBP, but under 80GGC you can claim that later on. Be careful. Next, you are paying some rent to partner Vatsal. Now, firm and partner are always related party as per 48.2, remember. You cannot make payment in excess of fair market value to your partners. What is the market value of the rent? The market value of the rent is 15,000. How much you are paying? You are paying 36,000 to the partner. How much excess you are paying? You are paying excess of 21,000. For how many months? For 6 months. Add back that as per 48.2. You cannot make excess payment to partners in excess of fair market value. Therefore, the excess portion will be disallowed under 48.2. Next one, you are giving some benefit and perquisite to your customers in the form of gold coins. The gold coins are not exceeding worth rupees 10,000 rupees. So the value of the gold coin is up to 10,000 rupees. And you have not deducted TDS. Is it okay? Yes, it's okay. When you give any benefit and perquisite to any person in business and profession, you should deduct TDS under 194R only if the benefit and perquisite exceeds 20,000 rupees. If the benefit and perquisite does not exceed 20,000 rupees, the TDS under 194R is not applicable. Now, because the TDS under 194R is not applicable, therefore the expenditure should be allowed. Even though you have not deducted the TDS, because the provision of TDS is not applicable only in your case. Next, tangible assets depreciation 243 you can claim. And last but not least, you have purchased some trademark in July, but you have put to use in December. So you should claim 12.5% intangible asset depreciation because the asset is put to use for less than 180 days. You can claim 12.5% depreciation. After that, you compute book profit. And then find out the remuneration maximum allowed. Up to 6 lakh book profit, 90% of book profit. Above 6 lakh, 60% of book profit. Compare that with actual. Actual is how much? 82,000 into 3 into 10. Whichever is lower will be allowed. And then you compute the total income, gross total income. And after that, you reduce the chapter 6. In chapter 6, only one item will come. What is that one item? That's 70,000 rupees electronic donation given to a political party. Cash donation not allowed. That's it. They have not asked tax, so we are not computing tax. They have only asked for total income, so I have computed the total income. I hope it is clear to all of you. Let's go ahead with the third question now. That third question is on charitable trust. There is a charitable trust registered under 12AB. The income of the trust is 500 lakhs. Now the trust is giving donation of 200 lakhs to another charitable trust. Now we need to identify whether this donation given to another charitable trust, which is also registered under 12AB, is it allowed or not in following circumstances. Circumstances number 1. Point number 1. If it is given as a general donation, not as a corpus donation. So if it is given as a voluntary donation to another charitable trust registered under 12AB, not as a corpus donation, is it allowed? The answer is yes, it is allowed. Voluntary donation given to another charitable trust registered under 12AB or 1023C is allowed, provided it is only allowed to the extent of 85% of donation given. You will not get more than 85%. If you are giving donation of how much? 200 lakhs in this case, you will get 85% of 200 lakhs, that is 170 lakhs. Second, in case 2, if this donation is given as a part of a corpus, then it is not allowed. Corpus donation given to another charitable trust not allowed as deduction. Corpus donation given to another charitable trust not allowed as deduction. Be very careful. Third part, will your answer change if the donation is given out of the accumulation of last year's? If this 200 lakhs is not given from current year income, but it is given from the accumulation of last year, it is not allowed. It is not allowed from both the cases. The donation should be given from the current year's income. If it is given from last year accumulation, it will not be allowed, and voluntary donation also not allowed. Corpus donation anyway is not allowed. Next, part 2. The trust has received some corpus donation. Okay. We are supposed to identify what are the conditions subject to which corpus donation will be exempt, and what if they do not fulfill the condition, then what will happen. See, if you receive any corpus donation from any person, as a trust, it will be exempt only if you deposit that corpus donation in the mode specified in 11.5. So if you deposit that corpus donation in the mode specified in 11.5, it will be exempt. And if you deposit that anywhere else other than mode specified in 11.5, it will be taxable, and it will be taxable under 115 BBI at flat 30%. It will be considered as violation of 115 BBI. So the rule is very simple. When you receive corpus donation, deposit in the mode specified in 11.5, and if you do not deposit in the mode 11.5, then it will be taxable at 30% under 115 BBI plus surcharge if applicable plus cess. No deduction of any expense will be allowed under 115 BBI. I hope it is clear to all of you. Let's go to next question. Question number 4. In question number 4, we are supposed to compute Mr. Amit, an Indian resident, his tax payable. Whenever tax payable will come, always remember you have to reduce from the tax liability, advance tax, TDS and TCS. Then only tax payable will come. Mr. Amit is opting for option to shift out of the 115 BAC. It means he is following old regime. So you have to compute tax as per old regime. Let's try to understand what Amit is doing. Amit is purchasing some virtual digital assets like cryptocurrencies and some non-fungible tokens also, NFTs. So Amit is purchasing some cryptocurrencies and NFTs. So what all things he has purchased? He has purchased one Bitcoin for 60 lakh rupees, first thing. Then his friend Sushil has given one NFT whose market value is 5 lakh rupees on his birthday, second thing. Then Amit also bought one NFT for 10 lakh rupees. So Amit has bought one at Bitcoin, then he got one NFT as a gift from his friend, and then he bought another NFT. Now, what is due to financial need? Amit needs some money. Therefore, he has sold half Bitcoin. So, for half Bitcoin, how much capital gains or how much gain will come? See, half Bitcoin is sold for 28 lakhs. What is the cost of the Bitcoin? The cost of one Bitcoin is 60 lakh. Therefore, half Bitcoin will be 30 lakhs. Therefore, there is a loss of 2 lakh. What is the treatment of this loss? Lapse. As per 115 BBD. Whatever loss comes in Bitcoin, whatever loss comes in virtual digital asset, it is not allowed to set off against any other income. It is not allowed to set off against this income also. This is lapse. Loss, there is no treatment for loss. This is gone forever. What is the next income for Amit? The next income from Amit is the gift from friend. If I receive a virtual digital asset whose market value is more than 50,000 rupees, that is taxable as income in my hand. Therefore, this 5 lakh rupees will be income in my hand. Because Mr. Sushil, who is my friend, he is giving me NFT of 5 lakh rupees on my birthday. So this 5 lakh will be income from other source. Apart from that, this NFT which I have received as a gift from my friend that I am selling later on for 6.5 lakhs. Check. So 6.5 lakhs will be the sale consideration of this NFT, and the cost of acquisition will be the FMV taken in 56,210. The FMV taken in 56,210 is 5 lakhs. Therefore, this 1.5 lakhs will be subject to 30% tax. And one more thing, Amit also has some other income of 6.5 lakh. So what is the total income of Amit? 4 calculations Amit has made. First, half Bitcoin, there is a loss. This loss is lapsed. Then 5 lakh rupees IFOS, that will be chargeable at normal slab rates, old regime. 6.5 lakh other income, that will also be chargeable at slab rates, old regime. This 1.5 lakh which is on transfer of NFT, this will be taxable at flat 30% without any exemption. Flat 30%. Even transfer expenses are not allowed for Bitcoins and virtual digital asset. Transfer expenses not allowed. Sorry. This transfer expenses are not allowed for Bitcoins and virtual digital asset. I hope it is clear to all of you. Now, they have asked for tax payable. I need to know tax payable. Is there any TDS deducted in case of Mr. Amit? Yes. When Mr. Amit has sold his Bitcoin for 28 lakh rupees and his NFT for 6.5 lakh rupees, so total 34.5 lakh rupees he has sold virtual digital asset, the buyer would have deducted TDS at the rate of 1%. On how much amount? When he sold 28 lakhs Bitcoin, on that 1% TDS would come to 28,000. When he sold NFT of 6.5 lakh, 1% TDS will come to 65,000, 6,500. Therefore, total 34,500 TDS would have been deducted by the buyer on sale of Bitcoin and virtual digital assets. Therefore, this should be taken as a credit while computing the tax payable. I hope it is clear to all of you. All these small points, you need to be very careful with it. Next question, again very intelligent question. There is a partnership firm by the name called as Paul and Company, in which Mr. Vivek is a non-resident partner, and this Mr. Vivek non-resident partner has put capital of 50 lakh rupees in the firm. Now the firm is giving him interest at the rate of 10%. The firm is also giving him share of profit. So the firm is giving him two things. Rate of interest is giving and share of profit. So I am a firm, you are a partner, you are a non-resident partner. I am giving you interest, I am giving you share of profit. I need to comment whether I should deduct TDS or not. So on interest, I should deduct TDS under section 194T, new section introduced from 1st April 2025. Why? If a firm pays interest, remuneration, commission, bonus, salary to the partner, then the firm should deduct TDS at the rate of 10% if the amount of payment exceeds 20,000 rupees in a financial year. So I should deduct TDS at the rate of 10%. When? At the time of credit to partner account or at the time of payment, whichever is earlier. Threshold is 20,000. So I should deduct TDS at the rate of 10%. What about share of profit? On share of profit, TDS is not deductible because share of profit is exempt in the hands of partners. Therefore, on share of profit, there is no need to deduct any TDS. But on share of profit, you should do related formalities. Like Form 15 CACB, you have to fulfill all these things. Okay. Now, there is another transaction over here. Mr. Vivek's friend is also there, Mr. Vikas. He is also non-resident. Now, he is providing some technical services to Palan company relating to project in India. So, Vikas is doing what? Vikas is doing some technical services he is giving to Palan company for some projects in India. So, this technical services, FTS, fees for technical services, is deemed to accrue or arise in India because the project is in India, the services are utilized in India, therefore, it is deemed to accrue or arise in India. Now, in this case, is this amount taxable in the hands of Mr. Vikas? There is no DTAA between India and country X. Let's assume that. Now, therefore, this particular transaction is taxable definitely. Non-resident providing some FTS services for projects in India, it is deemed to accrue or rise in India as per 917. This is definitely taxable in India. Now, the question is, taxable as per what? 115A will not be applicable. Why 115A will not apply? Because for 115A to apply, there has to be an agreement between both the party and that agreement should be approved by central government. All those things are not there here. Therefore, 115A will not apply. Therefore, normal provision will apply. Normal provision means I have to deduct tax as per rates in force. What is the rates in force? The maximum rate which is applicable to individual is 30%. I will deduct TDS as per what? 31.2%. I hope it is clear to all of you. I will deduct TDS as per 31.2% and give the balance money to Mr. Vikas. Now, in second part, it is given. And where I will deduct TDS? I will deduct TDS under 195. 115A is not applicable as there is no agreement which is approved by central government. Second part is a very intelligent part. If India has a DTAA, let's assume in part 1 we have assumed that India does not have DTAA with country X. But part B we are assuming if India has a DTAA with country X and FTS is taxable at 10% for example, then what is the remedy available to the payer Mrs. Pal and Company if India has Mrs. Pal and Company India has deducted tax at the requisite rate provided under the Income Tax Act? So let's assume that India and foreign country has a DTAA and the tax is taxable at the FTS is taxable at 10%, but still Mrs. Pal and Company has deducted tax as per income tax rate of 30%. Then what is the remedy? In that case, there is a remedy available to Mrs. Pal and Company under section 239A with one assumption. The assumption is if the tax is borne by Mrs. Pal and Company, if the tax is borne by the payer, if the tax is paid by the payer by grossing of the income, then Mrs. Pal and Company will get remedy under 239A. What is that 239A remedy? The remedy is Mrs. Pal and Company has to make an application to the assessing officer within 30 days from the date of payment of tax for refund of remaining 20%. And the officer will grant refund of remaining 20% within 6 months by passing an order. But this remedy is only available to Mrs. Pal and Company. See, very simple. If Mrs. Pal and Company has borne the tax, then Mrs. Pal and Company deserves to get the refund. If the tax is borne by Mr. Vikas, then Mr. Vikas deserves to get the refund. So Mrs. Pal and Company will get remedy only if Mrs. Pal and Company has borne the tax. Otherwise, Mrs. Pal and Company will not get the remedy. I hope it is clear to all of you. This 239A is applicable only if the tax is borne by the payer. Go and check this chapter provision we have done, I think on the last page of the non-resident taxation or second last page, either of the two page in our color book. Next question, question number 6. There is a buyer, Mr. Bhuvan, and there is a seller, Mr. Srinivas. The buyer is purchasing some raw material from Srinivas. Now the seller is insisting that make the payment in cash of 3,20,000 rupees for an invoice. So the buyer made the payment in cash. Now what is the treatment in the hands of Mr. Buyer and in the hands of Mr. Seller? See, very simple. You cannot, for buyer I am saying, for buyer this 3,20,000 paid in cash will be disallowed under 40A3. Buyer cannot make the payment in cash in excess of 10,000 rupees. In excess of 10,000 rupees, if you want to pay to a person in a day, you should pay by 4 modes: account pay check, account pay draft, ECS and such an electronic mode. The buyer cannot make the payment in what? In cash. So for buyer, the expenditure will be disallowed under 40A3. What about seller? Seller also cannot receive 2 lakh or more in cash in one entire day. or in with respect to one invoice in multiple days. Seller also cannot do that. If seller does that, seller will be liable for 269 ST and the penalty will be imposed under what? 271 DA. 269 ST will be attracted and penalty will be imposed under 271 DA. The assessing officer will impose the penalty from 1st April 2025. Earlier joint commissioner used to impose. Now all assessing officers can impose. Now second part of this question. Will your answer change? If purchases are done on two different dates, 1,80,000 separate invoice, 1,40,000 separate invoice. In the hands of buyer, again no effect will be changed. Nothing will change. The buyer will be subject to disallowance of entire amount. Because for buyer, more than 1,000 rupees in more than 10,000 rupees in a day should not be paid by other than 4 modes. So for buyer, 1,80,000 is more than 10,000. 1,40,000 is also more than 10,000. So for buyer, both the expenditure will be disallowed. What about seller? Seller will be escaped from 269 ST and 271 DA. Why? Because the transaction is happening on 2 different days. And on every day, the transaction value is not exceeding 2 lakh rupees or more. Therefore, seller will be escaped from 269 ST and 271 DA. I hope it is clear to all of you. Next question, which is on DTAA. Let's try to understand what is this DTAA question. Mrs. Sudha Sharma is 61 years age. She is a classical singer. She does concerts in India and country M. She visits country M every year for a few days. Therefore, majority of the time she is in India. Therefore, she is resident and ordinary resident, 100%. There is no doubt about it. Now, which regime she is following? Let's try to understand. She is trying to follow. We need to compute total income, net tax liability. If she opted out of default regime, it means she is following old regime. We need to follow old regime for her. Now, let's try to compute the total income of Miss Sudha. Now, which all income Sudha is earning? First of all, she is performing some concerts in India. 10 lakh rupees she is earning. You will put this in PGBP. Then another 12,245 from concert she is earning in country M. So you will convert that into rupees as per TTBR on the last day of the financial year. As per Rule 115. Rule 115 says that for conversion of foreign PGBP income into INR, you have to take TTBR on the last day. What is the TTBR on the last day of country M? For country M, the TTBR on the last day of the financial year is 80 rupees. So you will convert this as per 80 rupees. Then she also earns 10,000 rupees from country N, which is with respect to what? Which is with respect to again copyright. So this will also be converted as per TTBR on the last day of the financial year of country N. So for country N, the last day TTBR is 79. You will multiply this by 79 and you will take in India. Then she is earning some fixed deposit interest, 4 lakh rupees on that and 25,000 rupees interest from saving bank. And from this 4 lakh and this 25,000 rupees, she will get 50,000 rupees deduction under 80 TTB because she is a resident senior citizen and she will get deduction under 80 TTB, not 80 TTA. Then she pays medical insurance of 25,000 for herself and 30,000 for her resident husband. Therefore, herself and husband taking together, she can claim 50,000 rupees limit deduction under 80D for mediclaim because she is following old regime. And she deposits 1.5 lakhs in PPF, so she can claim deduction under PPF 1.5 lakhs under 80C. And then she makes 3 lakh rupees 5-year FD in the name of son. In the name of son, if you make an FD, you are not eligible for deduction. You should make in your own name. So if you make in the name of your son, then it is not allowed. Now, one important thing we need to understand. With country M, we don't have DTAA, but with country N, we have DTAA. Therefore, with country M, we don't have DTAA. Therefore, the income will definitely be taxable in India and country M also, and India will give relief. What about country N? Country N, we have DTAA. Therefore, we need to identify this country N income is there, not this $10,000. It is taxable in India or not. We need to understand Article 12 of DTAA between India and country N. For that, royalty and fees for included services arising in a contracting state. Where it is arising? It is arising in country N. It is accrued in country N. Paid to a resident of other contracting state. Where is the resident located? In India. Paid to a resident of India may be taxed in that other state. It means it may be taxed in India also. Therefore, this royalty will be taxed in country N also, and this royalty will be taxed in country India also. Therefore, we will include in India and we will give relief as per Article 23A, Article 23, elimination of double tax, which is similar to Section 91 unilateral relief only if you read this paragraph. So now we have included all the income. Concerts, Indian concerts 10 lakh. Royalty from country N will be taxable here also, there also. Royalty from country M, concert from country M will be taxable here also and there also. Then fixed deposit from Indian bank, and then bank account, saving bank account interest. From that 80C deduction, 80 deduction, 80 TTB deduction. After that, I will get 29,44,600 as total income. I will apply slab rates as per old regime because the assessee is following old regime. Old regime, Senior citizen, therefore up to 3 lakh rupees, no tax, above 3 lakh 5%, above 5 lakh 20%, and above 10 lakh 30%. Therefore, my tax is coming to 693 plus cess 721 is my tax. Therefore, average rate in India is 24.489. Now I will compare this average rate in India with average rate in foreign country and I will give the FTC. Now I will go by country by country. Now in case of India and country N, what is the doubly tax income? In case of India and country N, the doubly tax income is 7,90,000. Therefore 7,90,000 into India's average rate. This is one tax. Compare with the tax paid in country N. What is the tax paid in country N? Whichever is lower, that will be allowed as deduction. The tax paid in country N, you have paid tax at the rate of 10% of 10,000. 10% of 10,000 is $1,000. Now this $1,000 you have paid on 25th of March. So this you have to convert into rupees as per Rule 128. What does Rule 128 says that? Rule 128 says that you have to convert the foreign tax into Indian tax for the purpose of credit as per TTBR of the last day of the preceding month. So you are paying in March 25. So you have to take 20th Feb TTBR. What is 20th Feb TTBR in country N? The 20th Feb TTBR in country N is 78 rupees. Therefore, you have to convert this into 78 rupees and this 78 rupees will be considered as foreign tax and you will compare your Indian tax with your foreign tax and whichever is lower will be allowed as deduction. So always remember, for converting foreign income you apply Rule 115, but to convert foreign tax you apply Rule 128. Similarly, for country M, what is the doubly tax income? For country M, the doubly tax income is 979,600. So I will write 979,600 over here into what is the average rate tax paid in India. It is 24.489, that is 239,894. And what is the tax paid in foreign country? We need to again check over here. They have given the data of tax paid in foreign country. In country M, you have paid $2,500 in the month of October. So you have to again take the TTBR of 30th September. The TTBR of 30th September in country M is, in country M, the TTBR of 30th September is 80 rupees. So you will convert this $2,500 into 80 rupees. And therefore, as per 80 rupees, it will come to how much? It will come to 2 lakh rupees. Check please. So you will take this as 2 lakh rupees. You will convert this into 80 rupees. And this will come to what? This will come to 2 lakh rupees. Therefore, whichever is lower will be allowed as relief. And ultimately, these two reliefs will be reduced from your tax. And therefore, net tax payable will be 443,120 after rounding off. I hope it is clear to all of you. Very good question. Question number 8. Sir, what is question number 8? Again, you will need to find out the tax liability of Mr. Manan under default regime, under new regime. What is Manan doing? Manan was staying in country X for a long time. Now he came to India permanently on 1st February 2025. That is last year. Just 1 month back, just 2 months back, he has come to India permanently. Therefore, Manan is staying in India in the current year for 365 days and in the last year only for 60 days. Therefore, Manan is definitely resident, but Manan is not ordinary resident, but because Manan will not fulfill the additional conditions of ordinary resident. What is the additional conditions of ordinary resident? He should stay in India for 730 days in last 7 years. That is not going to happen. He was permanently settling outside India. Now he has come to India just 60 days back. Plus, he should be resident in India in at least 2 out of last 10 years. That is also not possible. Therefore, Manan is resident but not ordinary resident. Now we need to understand which incomes of resident and not ordinary residents are taxable in India. Only incomes which are accrued in India or deemed to accrue in India, or only incomes which are received or deemed to receive in India. And in case of PGBP, if the business is done outside India but controlled from India, or if the profession is done outside India but set up in India, only then it is taxable. If an income is accrued outside India, received outside India, then that is not taxable for NOR. That is only taxable for R and OR. Therefore, Manan is earning what? Manan is earning some rental income from country X. See, the rental income from country X will not be taxable in India. Why? Because this is accrued outside India. This is received outside India in the bank account in country X. Therefore, that will not be subject to tax in India. What will be taxable in India for Manan is only the business income in India of 12,50,000. That Manan will pay tax in India. And along with that, Manan has purchased some land in Indore on 18th of March 2023 for 30 lakhs. Now Manan is selling that land on 23rd of December 2025 for 80 lakh rupees. So this land is sold after 24 months and this land is situated in India. Therefore, this capital gains will be chargeable to tax in India. Okay. Now, but on this 50 lakh rupees, Manan has two options. That's the catch in this question. Which two options? Which two options? The two options which is given to the grandfathering assessees. That is, if an assessee is resident and he is purchasing land and building before 23rd July 2024 and he is selling land and building on after 23rd July 2024, then he has two options. He can take 12.5% without indexation or 20% with indexation. Manan has both the options. Check. So on LTCG, you will apply both the option, whichever is beneficial, you will take that. And on business income, you will apply slab rates as per new regime. I hope it is clear to all of you. That is the reason they have given you indexation also. All this TTBR, TTSR is not useful. It is for time pass. It's of no use to us. I hope it is clear to all of you. And one last question over here in this particular RTP. It is a very big RTP. One of the best RTPs out of 9 RTPs is this one. It's very big and all questions are also very good. So there is an Indian company, Triveni Cement Limited, TCL, and which is having a head office at Chennai. Now there is a foreign subsidiary, Drift Inc., which is of Triveni. Therefore, that Drift Inc. and Triveni are what? Associate enterprise. Now Drift is paying some royalty. Drift is paying some royalty of $3 million to Triveni. So Triveni is providing some services. Drift is paying royalty of $3 million to us. Whereas Triveni is receiving royalty from others at $4 million. So I am Triveni from associate enterprise Drift Inc. I am taking $3 million. But from others, I am taking $4 million. From associate enterprise, I am taking $1 million less. $1 million means 10 lakh. $10 lakh less I am taking. Therefore, that much I have to add back. $10 lakh into 82 rupees is the rate of dollar which is given over here in the question. Where it is given? 82, somewhere it is given. Here it is given. So 10 lakh into 82, that will be added back. Again, I am saying, I am Triveni, I am in India. When I am giving services to my associate enterprise Drift, so I am taking $3 million. When I am giving services to third party, I am taking $4 million. Therefore, I am taking $1 million less from associate enterprise. That I have to add back into 82. Therefore, I have to add 820 lakhs over here. Second issue, TCL has borrowed 220 crore from Swift Inc. So whether TCL and Swift are deemed to be associate enterprise? If yes, whether transfer pricing adjustment will be met? Yes, TCL and Swift are deemed to be associated. Why? See, TCL has taken how much loan? 220 crore. And the balance sheet of TCL says that the book value of the asset of TCL is 330 crores. So out of 330 crore asset of TCL, 220 crore they have taken as a loan from Swift, which is 67% approximately. Therefore, if one entity finances 51% of the book value of the asset, market value is not relevant for me, then both of them are deemed to be associate enterprise. Therefore, TCL and Swift are deemed to be associate enterprise. Now, we are paying how much interest? We are paying how much interest to Swift? We are paying 8% interest to Swift, whereas the market rate is 7%. So, we are paying 1% extra. We are paying 17.6 crore. Therefore, 17.6 crore we are paying at 8%, which is 1% extra. Therefore, 1% is how much? Cross multiply. That will be added back to your income statement as a transfer pricing adjustment. So, to our associate enterprise, we are paying 17.6 crore, which is 8%. To others, the normal rate is 7%. Therefore, 1% extra. Therefore, add back. Third transaction. TCL supplies goods to True Words Limited. The paid up capital of True Word is 92 crore and TCL holds 22 crores. So let's check how much percentage it holds. So 22 crore divided by 92 crore comes to approximately 23.91%, approximately 24%. Therefore, they are not associate enterprise. Because they are not associate enterprise, transfer pricing adjustment cannot apply in this case. I hope it is clear to all of you. So out of 3 transactions, 2 transactions are subject to transfer pricing, 1 is not subject to transfer pricing. So this is what this RTP is all about. How did you like the RTP? Please comment below. Let's go ahead with the next RTP, that is RTP September 2025. Again, the first question is on total income. Now we need to read the last line. We need to compute total income. As per the normal provision, do not go for 115 JB or do not go for concessional tax regime. Nothing has to be done. Just total income as per the normal provision. Not even tax computation is asked. Okay. So let's start with the first adjustment. Assassi is a company, Rainbow Limited. The profit of the Assassi is 27,22,000 rupees. The very first adjustment is Assassi has taken some loan for purchasing some land. On that land, they will construct some factory building. They will construct some factory building for which approval is not yet received. So because the approval is not yet received, whatever interest you have incurred on loan, that will be capitalized. Okay. That will not be allowed as deduction. That will be disallowed over here. Whenever the building will be ready, at that time the interest will be capitalized till the time the building is not put to use, till the time the building is put to use. After that, interest will be allowed as deduction. So as of now, because the building is not ready, the approval is not received, you have to disallow this interest. You have to capitalize this interest. Whenever it will be ready in the next year, that time you can claim that as a depreciation. Okay. Next one, you have paid some commission of 1 lakh rupees in the month of February. You have deducted TDS in February and you have paid the TDS in September. Absolutely correct. When you want a deduction of an expense, you should deduct the TDS in the same financial year by 31st of March, and you should pay till the due date of filing of return. Therefore, in this case, the assessee has deducted the TDS before March, but paid and also paid till the due date of filing of return. Therefore, this 1 lakh rupees will be allowed as deduction. But the problem is with this 1,25,000 rupees. On this 1,25,000 rupees, which is paid in the month of March, the TDS is deducted in May. Now here they have made a mistake. The TDS should be deducted by March. If you don't deduct TDS by March, it will be disallowed in the current year. Even if you deduct the TDS of March on 1st of April, still in the current year, the expenditure cannot be allowed as deduction. Therefore, this 1,25,000, 30% will be disallowed under section 40A1A, and in the next year, it will be allowed as deduction. This is disallowed because of late deduction. Okay. Now, you are incurring some travel expenses for foreign tour of director, and directors are going outside India for new line of business. This is disallowed. Now, you need to be very careful. Don't get confused with something which we have done earlier. Whenever you incur some expenses for foreign tour for director, where the director goes outside India for existing business, then it is allowed as a deduction. Earlier one adjustment has come similar. You will find that in that adjustment you have allowed the year where it's allowing, both are different. There the directors were going for existing business. So if the directors are going for existing business, it will be allowed. But if the directors are going for new business, it will be disallowed. Okay. Next one. There are some outstanding interest of 3 lakh rupees. Now the company is converting that outstanding interest into a new loan. Conversion of outstanding interest into a new loan does not amount to actual payment. Therefore, that conversion will be disallowed. However, that new loan, whenever that new loan will be paid, that will be allowed as deduction. So, how much you have paid? You have paid 50,000 out of that. Therefore, the 50,000 rupees will be allowed as deduction. So, 3 lakh rupees will be disallowed and 50,000 will be allowed as what? Deduction. I hope it is clear to all of you. Next one, EPBAX and mobile phones. They are subject to 15% depreciation, but mistakenly you have taken 40% depreciation. Therefore, 25% depreciation on EPBX and mobile phone will be disallowed. So, 25% you have to disallow. Okay. Next one, there is a wholly owned subsidiary over here, S Limited. Now you are giving a contribution, you are giving a donation of 5 lakh rupees to that wholly owned subsidiary. For what? For construction of school. For whom? For the benefits of the employees. So this is allowed as reduction. There are some High Court judgment which says that if you give some donation to your wholly owned subsidiary for the welfare of the employees, for construction of school, ultimately it will help in welfare of the employees, which will help in the business. Therefore, it shall be allowed as what? It shall be allowed as deduction. Next one, dividend you are receiving from a company. So whatever dividend you are receiving, reduce from here and show under PGBP. How much dividend you are receiving? 10,000 the equity shares into 10 rupees each. Therefore, 1 lakh rupees dividend you are receiving, reduce from PGBP, show under IFOS. Okay, do not gross up, do not gross up. See, ICI has been taking a stand that nowadays ICI does not gross up dividend unless and until it is written in the bracket that it is net of TDS. Unless and until it is written net of TDS, don't gross up. Earlier they used to gross up dividend received every time, but now they are not grossing up. Unless and until it is written, it is net of TDS. So please don't gross up. Okay. Then there is a grandfathering clause over here which you can apply. Reduce the profit from PGBP and show under what? Show under capital gains. How much is the profit? The profit on grandfathering clause capital gains is 3 lakhs. Reduce from here and show under capital gains tax at 12.5% in excess of 1.25 lakh. Now, whenever the date 31st Jan 2018 will come, always remember there is a concept of grandfathering clause. Next one, very simple adjustment. There is a provision for gratuity as per actuary. So the provision for gratuity as per actuary of 6 lakh rupees will be disallowed under 40A7, and whatever you have actually paid will be allowed. So actual paid will be allowed and actuary provision will be disallowed over here. Last one or two adjustment, that is bonus of last year bonus 2024-25, which was paid on 15th of November 2025. So last year bonus paid in the current year. Therefore, bonus of last year will be disallowed in the last year because bonus is allowed on payment basis. Now last year it was not on paid on time. Therefore, last year this 98,000 would have been disallowed. But in the current year it should be allowed because it is paid. But in that also you have made a mistake. You have paid 34,000 by bearer check. Therefore, I will not allow you full 98,000. Out of 98,000, 34,000 will not be allowed. Therefore, only 64,000 will be allowed. For 34,000, you can write a note that this will be not allowed because it is paid in bearer check. Okay. Last but not least, you have purchased some commercial vehicle of 8 lakh rupees on 21st of March 2026, and you have claimed full depreciation of 15%, which is wrong. You cannot claim full depreciation. You can claim only half depreciation, and this is also debited to the statement of P&L. If this would have not been debited, then it would have been a different case. But you have debited that to P&L. Now, because you have debited to P&L, You have to add back 50%. So you have wrongfully claimed 15%, you should claim only 7.5%. Therefore, 7.5% will be disallowed in this case. Okay, that's the only thing which is asked. No 115 BAA, no MAT, no tax calculation also. Only total income as per the normal provision. I hope it is clear to all of you. Let's go ahead with the next question. Question number 2, which is on charitable trust. So there is a charitable trust registered under 12AB, engage in preservation of forest. The very first question over here is, they are following mercantile system of accounting. Now they have incurred some electricity expenses of 1,20,000 in 25-26, but it was paid in 26-27 on 15th April 2026. So when they will get the deduction? See, always remember, for charitable trust registered under 12AB or 1023C, their deductions are allowed on payment basis. So even though the expenditure is of 25-26, but the deduction will not be allowed in 25-26, the deduction will be allowed in 26-27 only on payment basis. Trust get deduction on payment basis, not on accrual basis. This is the first point. Second, the charitable trust is earning some agricultural income of 10 lakh rupees, which is exempt under 10(1). Will they be eligible for this exemption? The answer is yes. Generally, if you are registered as a charitable trust under 12AB, then section 11 subsection 7 says that no exemption under section 10 will be allowed to a trust except 10(1). 10(1) a charitable trust can claim. So in this case, charitable trust can claim what? 10(1). They cannot claim other exemptions. So in this case, charitable trust, along with the exemptions of section 11, 12, they can also claim agriculture exemption under 10(1). So this is also correct. They can claim exemption under 10(1). Third one, the charitable trust has earned rental income of 4 lakh rupees. They have earned 4 lakh, out of which 3 lakh is received in the current year, 1 lakh is not received, 1 lakh is received in future. So you might have done one point with me in the class, that if you have not received a particular amount, then how will I apply? So you can make an application, the trust has make an application that whenever I will receive, I will apply at that time. So the trust has exercised for the relevant option. That 1 lakh rupees I have not received, whenever I will receive, I will apply. So the law says that you should apply when you receive, or you should apply the year following the receipt. Otherwise, it will be deemed income of the year following the receipt. So 3 lakh rupees you have received, that's okay. You have applied. 1 lakh rupees you have not received, so you have made an application for deferral. You have made an application for deferral. You said that I will apply this in future. When have you received? You have received on 31st August 2026. Now what is your duty? Your duty is to apply by 31st March 2027 or 1 year extra grace by 31st March 2028. You should apply in the year of receipt or the year following the receipt. The year following the receipt is 27-27. So you should apply till 31st March 2028. If you don't apply till 31st March 2028, it will be deemed income of 31st March 2028. I hope it is clear to all of you. Question number 3. A similar question we have done earlier. Point number 1 we have done earlier, similar. Not exactly similar, but kind of similar. Mr. Raju is a buyer and Mr. Sandeep is a seller. Raju is buying some scrap of 55 lakh rupees. Now generally, if a seller is selling scrap, then he should collect TCS under section 206C subsection 1. Because in 206C subsection 1, scrap is covered for TCS. So Mr. Raju is buying some scrap of 55 lakhs from Sandeep. So Sandeep should collect TCS technically. But Raju is resident. And Raju is saying that no, this scrap I am not buying for my trading purpose. This scrap I am buying for manufacturing purpose. Or if Raju says, for example, I am buying this scrap for power generation, then in that case, Sandeep will not collect TCS as per 206C subsection 1A. That if a buyer gives a declaration that he will use this particular items for power generation or for manufacturing, that the seller should not collect TCS. Then in that case, it is the responsibility to deduct TDS under 194Q by buyer if the other conditions of 194Q are fulfilled. The buyer should deduct TDS in that case. Now let's see whether the buyer is liable for deducting TDS or not. Let's see whether the buyer is fulfilling the conditions or not. The buyer, Mr. Raju's last year turnover is more than 10 crore, check. So the buyer's last year turnover is more than 10 crore and buyer is buying goods of more than 50 lakh rupees. Therefore, buyer will be liable to deduct TDS in excess of 50 lakh rupees. That is on 5 lakh rupees, 0.1% at the time of credit or at the time of payment, whichever is earlier under 194Q. So in this question, seller is exempted from TCS, but the buyer is liable for TDS on 5 lakh rupees, 0.1% on credit or payment, whichever is earlier. I hope it is clear to all of you. Next one. Mr. Rajat has taken a loan of 12 lakh rupees from employer for what? For education outside India of his daughter. Out of that, he has remitted 9,75,000 to the university outside India. Whether TCS will apply or not. See, if you take a loan from employer, that is different if you take a loan from a financial institution in India. If I take a loan from a financial institution in India and then I send outside India for education purpose, then TCS is not applicable, only exempted. But if I take a loan from employer in India and then I send outside India, then TCS is applicable in excess of 10 lakh rupees. Up to 10 lakh rupees exempt, about 10 lakh rupees 5%. So here I am taking loan from employer, therefore I will not get complete exemption. I will get exemption up to 10 lakh, about 10 lakh 5%. So in this case, I have taken a loan of 12 lakhs, but I have remitted only 975. Now because 975 is less than 10 lakh, therefore here no TCS will be applicable in this case. I hope it is clear to all of you. Next one is something which we have done earlier also, but a very important case law of Travel Designer India Private Limited, Supreme Court judgment, recent judgment of 2025. What has happened in this case? The SSC has filed an original return on 15 September 2024. Then the AO said that there is a defect in this original return, so the AO has told to rectify the defect, and the SSC rectified the defect in the next year. So the return is filed on 15 September 2024 and the defect is rectified in the next year on 19 May 2025. Now the question is, what is the time limit to send a scrutiny notice? The time limit to serve scrutiny notice is 3 months from the end of the financial year in which the return is furnished. Which return? Original return or rectified return? Original return or when the defect is cured. So the Supreme Court said that the 3 months from the end of the financial year in which the return is furnished will be counted from the year in which the original return is furnished and not the rectified return. So 3 months from the end of the financial year will be counted from 3 months from the end of the financial year in which the original return is furnished and not when the defective return is furnished. I hope it is clear to all of you. So this is what this question is all about. Next question, very simple question once again. It's a question on penalty computation. Mr. Kabir is following old regime. He opted out of default regime. Now his total income as per return is 35 lakhs. Then return is processed 45 lakhs. Then income is assessed 85 lakhs and income is reassessed at 1.05 lakhs, that is 1.05 crore, sorry, that is 105 lakhs. Now we need to suppose to compute the total income. We are supposed to compute the penalty not on account of misreporting. It means penalty is 50%. Very simple question. First penalty will be imposed under 143.3 and then penalty will be imposed after 147. Under 143.3, how the penalty will be computed? Underreported income will be computed, step number 1. Then tax on underreported income, then penalty. What is underreported income? Income assessed minus process. What is income assessed in 143.3? 85 lakhs. What is income processed? 45 lakhs. This 40 lakhs is underreported income. Now, will I compute tax directly on 40 lakhs? No. Never compute tax on directly 45 lakhs. 40 lakhs. First compute tax on 85 lakhs. When you compute tax on 85 lakhs, you have to apply surcharge of 10%. And then compute tax on 45 lakhs. When you compute tax on 45 lakhs, no surcharge. And then cess, and then you will apply 50% penalty. Similarly, underreported income at the time of 147. Income reassess 105 lakhs. Income previously assessed 85 lakhs. Check please. Reassess 105 lakhs, previously assessed 85 lakhs. Therefore, underreported income is 20 lakhs. Now, how will I compute tax on this? Will I compute tax directly on 20 lakhs? No. That is the catch. First, you will compute tax on 105 lakhs, then tax on 85 lakhs. Tax on 105 lakhs, when you will compute, you will apply surcharge of 15%. Tax on 85 lakhs, when you will compute, you will apply surcharge at 10%. And then you will compute the tax. On that, you will apply surcharge. On that, you will apply cess. I hope it is clear to all of you. And then you will apply 50% penalty. Next question is also a very good question. There is a foreign company which is incorporated in Belgium. This foreign company is doing two things. First, it is selling raw diamond in special notified zone. Where is special notified zone? It is in Mumbai, Bharat Diamond Bourse, and in Surat Diamond Bourse. So, this foreign company is selling raw diamonds in Mumbai and also in Surat. This foreign company is also displaying raw diamond in what? In special notified zone, that is Bharat Diamond Bourse, Mumbai and Surat. So, now the question is, this foreign company is doing two things. Selling raw diamonds in Mumbai, selling raw diamonds in special notified zone, and also displaying raw diamonds in special notified zone. Are they eligible for safe harbor rule? Now let me tell you who is eligible for safe harbor rule and who is not eligible for safe harbor rule. First of all, let me talk about this display point. If a foreign company comes to special notified zone and display the raw diamond and earn income, that is not considered as income accrue or deemed to accrue arise in India. As per section 9, it is not taxable. And because it is not taxable, therefore they will not be liable for safe harbor rule also. Someone who is not taxable, only the question of safe harbor rule will not come only. Second possibility, if a foreign company comes to special notified zone and sell raw diamonds, then safe harbor rule is applicable. And then the safe harbor rule is, whatever is the revenue of that 4% should be shown minimum as a profit. If you show lesser than 4%, safe harbor rule will not apply. If you show more than 4%, safe harbor will apply. Then you will not get deduction of any expenses. I hope it is clear to all of you. Question number 7. Beautiful question. We have done a similar question earlier also, which was bigger than this. But this is also a good question. That is the reason I am discussing once again. Kanika is a resident. She is earning income from India, country X, country Y. Now she is following what? She is following default regime, new regime. We need to find out the net tax liability of Kanika. So let's try to compute the total income of Kanika first. In India, she is earning house property income of 4.3 lakhs. Directly income is given, therefore no need to take 30% standard deduction once again. There is a loss of 1.3 lakhs in 1.3 crores in foreign country. Therefore, the net income is 3 lakhs. Then take 9 lakhs singing profession income, 2 lakhs singing profession income. Then 5.5 lakhs from the owner of cricket team Delhi Super Players. Then other businesses income you should take. Share of profit from country X is taxable. In India, share of profit is from a firm is exempt. From foreign country it is taxable. Agriculture income in India is exempt. Agriculture income in foreign country is taxable. You take a total of all of them, you will get somewhere around 35.6 crores. Now compute tax on this. How? Don't compute directly. Partial integration you have to apply because there is an agriculture income in India which is exempt at the rate, which is exempt to the extent of 1.5 crore. Compute partial integration. How? Step number 1. Step number 1 will be tax on this plus agriculture income. Step number 1. Step number 2 will be tax on agriculture income plus basic exemption limit. Then the difference between both of them will be the tax. On that you will apply 25% surcharge because the income is more than 5 crore. In new regime you will apply 25% surcharge, 4% cess. You will get your tax in India 13 crore 86 lakhs. You will get your average rate in India. Then you have to find out average rate in foreign country. Now average rate in foreign country is not directly given. They have given you tax paid in country X and tax paid in country Y. Now because they have given you tax paid in country X and tax paid in country Y, you can find out average rate. How? Tax in country X divided by income of country X, tax in country Y divided by income of country Y. Sir, how did you find out this income? By reading this paragraph. In country X, this loss is not allowed. See, in country X, it is written over here. Loss from house property is not allowed. Therefore, this loss will not be allowed to set off. In country X, this 7.2 crore is taxable. This 4.8 crore is also taxable. Therefore, in country X, 12 crore is taxable. Similarly, in country Y, this 2 crore is taxable, this 2.9 crore is taxable, and even agriculture income is taxable in country Y. Check. In country Y, agriculture income is taxable. Therefore, the total income of country X is 12 crore and the total income of country Y is 6.1 crore. You will get the average rate when you multiply by this, and then that average rate you will compare with Indian rate. What is the Indian average rate? 38.956. Whichever is lower, that you will apply on doubly tax income. How to compute doubly tax income? That everybody knows. Whatever is the doubly tax income, on that you will apply the lower rate and then you will get the relief. I hope it is clear to all of you. So this is what this RTP is all about. Let's go ahead with next RTP, that is RTP Jan 2026. The very first question over here is, pay attention please. You are supposed to compute total income, tax liability as per normal provision, also as per the concessional regime under 115BAA. And you are also supposed to say which option is beneficial. You are supposed to ignore MAT, no MAT is required. And the turnover of last year is 402 crore. Therefore, the tax rate over here will come to 30%. Okay. Now, let's start the question as per normal provision first, and then we will talk about in 115BAA which all items are not allowed. Okay. Now, the assessee is engaged in manufacturing some automobile items, and then the profit of the assessee is 8 crore 25 lakhs. The very first adjustment is depreciation that you will add back. Okay. The next adjustment is you are giving some donation to a political party by account paycheck. Therefore, in PGBP it will be disallowed, but in chapter 6A in 80 JGB, 80 GGB, you can take that deduction. Because in normal provision it is allowed if you make the payment by online mode, but in 115BAA it will not be allowed. Okay, I am saying side by side 115BAA effect also. Next one, there is some long-term capital gain of 6,18,000 rupees on listed equity share on which STT is paid both at the time of purchase and sale. Therefore, this equity share, this long-term capital gains is covered in 112A. Therefore, reduced from PGBP 6,18,000 show under capital gains, and in capital gains 112A will apply 12.5% tax in excess of 1.25 lakhs. Okay. Next one is a very important adjustment for us. Very important technical adjustment. You have purchased some, you have imported some machinery from Japan for 65 lakh rupees. And you have installed that machinery in December 2024. Be very careful. Very intelligent adjustment. You will say that, no, sir, we have done similar adjustment earlier. No. You have not done similar adjustment earlier. So you have imported some machinery from Japan for 65 lakh rupees in December. Now, you have made some foreign currency payment because you have done some hedging contract and there is a loss on foreign currency payment. So this loss, what happens? You have to add back this loss to PGBP. PGBP it will not be allowed as per section 43A, and you should add back this to the add back to the cost of asset and claim normal depreciation and additional depreciation. Now, but in this question, what you will do, you will just add back this loss of 2 lakh rupees to your what PGBP income. Don't add back to the asset and claim normal and additional depreciation. Why, sir? We have been doing that earlier, sir. No, don't do that, because in the additional information it is given that when you will take this depreciation now 1 crore 18 lakhs, that already includes the depreciation on imported machinery. Additional and normal depreciation both are already included in this 1 crore 18 lakhs. Now when you will reduce 1 crore 18 lakhs, you will by default reduce the normal and additional depreciation on that entire machinery. So why are you doing it once again? So be very careful. What is the treatment of this? The treatment of this is very simple. Whatever loss is there, add back that. That's it in the normal provision. In 115BAA, whatever additional depreciation will come on this amount, that additional depreciation on 67 lakhs you have to add back. Okay. I hope it is clear to all of you. So again, I'm saying, first of all, this loss you have to add back. In PGBP, add back. Then don't claim normal and additional depreciation separately in normal provision, because that is already included in 1 crore 18 lakhs. But when you do 115BAA, just add back the additional depreciation on 67 lakhs, because in 115BAA, additional depreciation is not allowed as a reduction. Very, very, very important adjustment. Next one is also a very important adjustment. The assessee has borrowed some fund from Andhra Pradesh Industrial Development Corporation and some Andhra Pradesh State Financial Corporation. The total accrued interest is 11,56,900. Now the assessee is converting this outstanding interest into equity shares. Is that allowed as a deduction? The answer is yes. If you convert an outstanding interest into a new loan, not allowed as deduction. If you convert an outstanding interest into a bond, debenture or any other security where the liability to pay is deferred to future date, then it is not allowed as deduction. But if you convert that outstanding interest into an equity share, it is allowed as deduction. Very recently, Telangana High Court has given a judgment that conversion of outstanding interest into equity shares will be allowed as deduction, because when you convert an outstanding interest into equity share now, there is no liability. The liability of the company is discharged. Company is not liable to pay anything to anyone now. There is no liability in the balance sheet which the company has to pay. Therefore, it is allowed as a deduction. Always remember. Okay. Next one is also very intelligent adjustment. Be very careful. You have taken a loan of 6 crore 74 lakh for acquiring a machinery. You have taken a loan on 1st of June 2023. Now, the machinery is put to use on 1st of February 2025. Okay. So, you have taken the loan on 1st February 2024, and after 8 months, the machinery is put to use. So, first of all, compute the interest of the machinery. 674 is the total loan, multiplied by 10% is the rate of interest, multiplied by 10 will be number of months from June to March, divided by 12. This is the total interest which is there. Okay. Now, first of all, add back this full interest. Why? Because this interest is not allowed as a reduction. It will not allowed as a reduction now. First of all, add back this full interest. Now, what will happen with this 10-month interest? From 1st June to 31st Jan, that is 8th month interest will be added to the asset, and you will claim depreciation and additional depreciation. Again, don't take separately while computing normal regime, because this also is already included in 1 crore 18 lakh check. Machinery purchase through borrowed from HDFC. This additional and normal depreciation also included. So what is the only treatment that you will give over here? You will add back. Okay. Add back the addition, add back the entire interest to the PGBP, and whatever effect has to be done that the company has already done while computing the depreciation, don't give anything else. Okay. Now, out of this 56 lakh, how much will be added to plant and machinery? 8-month interest will be added to plant and machinery, 44.93, and the 2-month interest will not be allowed as deduction. Why, sir? Because the interest is paid after the due date of filing of return. Therefore, 2-month interest will not be allowed. Don't do all this calculation while computing normal regime. This is relevant for computing 115BAA, because in 115BAA you have to add back the additional depreciation. Therefore, while adding back the additional depreciation, you have to take the cost of asset as 674 plus 44.93. That will be added back, because that is the actual cost of the asset. I hope it is clear to all of you. Again, I am saying, whatever interest is coming, whatever interest is coming, first of all, disallow in PGBP. Okay. Just that's the only thing you have to do under the normal provision. When you go to 115BAA, the 8-month interest you add to the cost of asset, and then you will get the actual cost of the asset. Of that additional depreciation you will add back. Okay. Additional depreciation you will add back 10%. Okay. I hope it is, because the machinery is put to use for less than 180 days. Now, the next adjustment is a very simple adjustment. We have done this lot of time in the examination, in the class earlier also, in the paper also. You are giving some donation to a scientific research institution, so you can claim that deduction under the normal provision. Under 115BAA, it will not be allowed. Okay. Next one is also a routine adjustment we have done earlier. You have sold some goods of 18.5 lakhs. Out of that, 11 lakh has become bad debts. Now later on, therefore, now how much is the debtor in the balance sheet? Out of 18.5 lakhs, 11 lakh has become bad debt. Therefore, debtor is how much? 7.5 lakhs. Now the question is, out of this 7.5 lakhs, while recovering, now the debtor is dead. The debtor expired. The debtor is expired. The debtor passed away. Now you are fortunately recovering more than 7.5 lakhs. So you are recovering 9.8 lakhs rupees. And the entire amount you are crediting to P&L. You should not do that. You should only tax 2.3 lakhs now, because this 7.5 lakhs is already included in the sales earlier and you have already paid tax. Therefore, you should only take what? 2.3 lakhs in the income, but you have unfortunately taken full 9.8 lakhs in the income. Therefore, reduce 7.5 lakhs from your PGBP income. Then you have to reduce what? 1 crore 18 lakh 50,000 rupees from your PGBP income, and then you have done some mistake once again. You have purchased some goods of 12 lakh rupees, which is not debited to the statement of P&L account in last year. Okay, so in the current year, you have purchased some goods of 12 lakh rupees, which is not debited to the P&L account. Okay, now you have purchased this goods from micro enterprise and you have made a commitment that I will make the payment within 30 days. So again I am saying 12 lakh goods you have purchased, not debited to P&L on 13th March from a micro enterprise, and you have made an agreement that I will make the payment within 30 days. Now you made the payment after 30 days, check. From 13th March to 14th April, it is after 30 days. Now, because you have made the payment after 30 days, you will be getting the deduction on payment basis. Now, the payment is happening when? Payment is happening next year, 14th April 2025. Therefore, in the current year, the expenditure will not be allowed. This is not debited to P&L. Therefore, don't take the deduction. If this would have been debited to P&L, I would have added back. This is not debited to P&L, so don't reduce. If this would have been already debited, I would have added back. I hope it is clear to all of you. This is how you have to read the words. Now, one last thing. After that, you have to compute the total income and tax as per normal provision. Tax I have already told you 30%. Now in 115BAA, what will happen? 4 items will be added back. First, donation given to political party will be added back in 115BAA. Then scientific research donation will also be added back. Then additional depreciation on imported machinery. At that time, it would be relevant. Okay, while computing the normal provision, don't take additional depreciation because that is already included in 1 crore 18 lakh 50,000 rupees. Then additional depreciation on local machinery, which you have borrowed from HDFC loan, that should also be disallowed over here. These 4 items you have to disallow. Once you do this, you will get what? You will get your total income as per 115BAA. Then on capital gains income, you have to apply 12.5% tax in excess of 12.5%. In I think so it is 112A capital gains. Yes, 112A capital gains. So you have to take 12.5% tax in excess of 1.25 lakhs, and other income you will apply 22% tax, 10% surcharge and 4% cess. I hope it is clear to all of you. Coming to the next question, which is on trust. There is a charitable trust which is registered under 12AB. What are they doing? There are 3 independent situations. We need to answer all 3 of them one by one. First charitable trust is registered as advancement of any other object of general public utility. Now, do you remember that? If you are a charitable trust which is registered as advancement of any other object of general public utility, then you can claim exemption only if your commercial receipt is up to 20% of total receipts. Now, in this case, the commercial receipt is 45 lakhs and the total receipts of the trust is 190 lakhs. Therefore, the commercial receipts divided by total receipts 45 lakhs divided by 190 lakhs is greater than 20%. Therefore, the trust will not be eligible for exemption. The trust will not be eligible for exemption in this case. I hope it is clear to all of you. So, what is commercial receipt? Commercial receipt means the fees which you charge to your customer. The amount which you charge to the customer deliberately for providing the service, that is called as commercial receipts. So, that should be up to 20% of total receipts. So, it is exceeding 20%. Therefore, you will not get exemption. Sir, will my registration also get cancelled? Registration will not cancel. Only exemption will be denied to your registration. You can continue. I hope it is clear to all of you. Second question. Good question, intelligent question. There is a charitable trust which is engaged in vocational training. They are providing some training. They have a training institute. They are providing some certificate courses for sewing machines, for handloom weaving, for handicraft. At the same time, this charitable trust also has a clothing shop at the entrance of the training institute. The shop derived 40 lakhs from sale of clothes, and whatever money they have derived, they are using for the purpose of training. They are maintaining separate books of accounts also for the separate books of accounts for the shop. So there are 2 things which the trust is doing. One, trust is providing training to the students. Another trust also has a shop from which they are selling clothes and they are earning money. Whatever money they are earning from selling the clothes, they are using for the purpose of training. They are maintaining separate books of accounts also. Can they claim exemption? The answer is yes. A charitable trust can have a business activity which is incidental to the business. A charitable activity which is incidental to the business is allowed, provided the money should be applied for charitable purpose and they should maintain separate books of accounts. So here, whatever money is coming from sale of cloth, they are applying for the purpose of what? Training institute, and they are maintaining separate books of account. Therefore, they are eligible for claiming exemption under section 11 and 12. I hope it is clear to all of you. Next question. There are two charitable trusts. One is engage in clean drinking water. Another is engage in water for all. Now they want to get merged. Both of them are registered under 12AB. Now they want to get merged and they have a question whether if they merge, whether exit tax will apply to them. Now for that purpose, the government has brought a new section in Finance Act 2024 by the name 12AC. 12AC says that if you fulfill three conditions, we will not apply exit tax. Condition number one, both of them should be registered trust. One trust getting merged with another trust, both should be registered under 12AB or 1023C. Second, their object should be similar. Here the objects are similar. Drinking water, clean drinking water, water for all. It is a similar object relating to water. So the object should be similar. And the third condition, they should fulfill some prescribed condition which the government has not yet prescribed. So as of now, only two conditions are there technically. Both of them should be registered trust under 12AB or 1023C and their object should be similar. If these two conditions are fulfilled, you can merge with another trust without worrying about what? Without worrying about the implications of exit tax. No exit tax implication will be applied on you. I hope it is clear to all of you. Next question, which is on TDS now. There are some independent situations in which TDS provisions will be asked. First, there are some amendments which are there, which I will tell you the amended answers. Some of the answers are not amended, but listen to my answer. Don't see the solution in this paper at least. Only this paper is of Jan 26, so therefore this is an old paper. The rest all are amended by me. Now, Mr. Rajesh is a lottery distributor, and Golden Lottery Agency is a very old lottery agency. It has a turnover of 98 lakh rupees in the last year. The last year turnover is 98 lakhs, and they are giving Mr. Ramesh some commission of 18,000 rupees first and then 14,000 rupees later. Is Golden Lottery Agency liable to deduct TDS? The answer is yes. Under 194G, Golden Lottery Agency, which is a distributor, they will deduct TDS of the lottery agent. What is the threshold? The threshold is 20,000 rupees. The annual payment should exceed 20,000 rupees, then they should deduct TDS at the rate of 2%. Sir, the last year turnover is less than 1 crore, not relevant. Last year turnover is less than 1 crore, more than 1 crore. Those things are relevant for individual HUF under 194A, 194C, 194H, 194I, 194J, 194R, 194S, 206C subsection 1 and 206C subsection 1F. That is relevant in these 9 sections. That is not relevant in 194G. In 194G, they have just given us to confuse. In 194G, you are not supposed to see the last year turnover. I hope it is clear to all of you. Second question of TDS. Smart Switch Private Limited. It's a platform. It's a platform which is selling cryptocurrencies like CoinDCX, WazirX. Now, Mr. Aarish has purchased some cryptocurrency for 1 lakh rupees in 2024. November 24, and he has sold that cryptocurrency in December 24 at a profit of 347. Therefore, he has purchased for 1 lakh and sold at a profit of 347. Therefore, he has received 447. Selling price is 447. So, I am buyer, you are seller. I am buying something from you for 447. You are selling something to me at 447, but I am buying through exchange. You are also selling through exchange. Who will deduct TDS? The TDS will be deducted by the exchange. I will not deduct. The buyer will not deduct. The TDS will be deducted by exchange at the time of credit or payment, whichever is earlier, at the rate of 1% under 194S on the sale consideration. What is the sale consideration? The sale consideration is 447, not 347. 347 is profit. When the buyer is buying from Aarish, Aarish is selling, na? Buyer is buying. So the buyer is buying at 447, na? Aarish is selling at 447. Therefore, the cryptocurrency agency, that is the cryptocurrency platform, that is CoinDCX, DCX, and in this case, Smart Switch Private Limited will deduct TDS at the rate of 1% on 447. I hope it is clear to all of you. Next question, question number 16, which is on assessment procedure. There is an assessing officer who has taken an approval from Principal Commissioner and directed that Greenfield Textile has to get their books of accounts audited under 142(2)A. So he has given a direction for special audit under 142(2)A. Okay. Now the Commissioner has appointed the Chartered Accountant. Principal Commissioner has appointed the Chartered Accountant. Now the Chartered Accountant is not doing the audit on time. Deliberately he is delaying the audit. He is not doing the audit. Because of that, there is a delay in the audit, and therefore the assessing officer said that because the Chartered Accountant is not doing the audit, I will apply what? I will apply best judgment assessment on the assessee. Now the question over here, which came in front of Supreme Court in the case of Swadeshi Polytechs Limited, whether 144 can be imposed on the assessee if the Chartered Accountant is not doing the audit. There is no mistake of assessee. Assessee is completely cooperating. But the CA is not doing the audit for any frivolous reason. Frivolous means any hopeless reason. There is no reason. Can the assessing officer impose 144? The Supreme Court said that no. If there is a mistake, if there is a delay, if there is a non-compliance by chartered accountant, then the assessee cannot bear the burden of 144. The AO cannot impose 144 on the assessee. If assessee does not cooperate in audit, then the AO can impose 144. But if the CA is not cooperating, or if the CA is frivolous reason he is not doing the audit, or hopeless reason, unnecessary reason he is not doing the audit, you cannot impose 144 on the assessee. I hope it is clear to all of you. Next question. There is a partnership firm. Very simple question of penalty. The total income of the partnership firm is 40 lakh as per return. Then income processed at 42 lakh. Income assessed at 58 lakhs. It is not on account of misreporting. Therefore, you have to compute penalty at the rate of 50%. Now you are supposed to compute the penalty. How will you compute the penalty? Very simple. Income assessed at 58 lakhs minus income processed at 42 lakhs. 16 lakhs under reported income. Now you will compute tax on 58 lakhs first, then you will compute tax on 42 lakhs, then you will take the difference on, then that you will apply 50% penalty. Now they are asking one more question. Can we waive this penalty? Is there any way we can get immunity from imposition of penalty? If yes, what are the conditions? Yes, you have to fulfill 270AA. First of all, in 270AA, only 50% penalty can be waived. 200% penalty cannot be waived. In this case, the penalty is 50%. Therefore, it can be waived. If this would have been misreporting, 200% penalty, then 270AA would have not been applicable. So, what are the conditions that I have to supposed to fulfill? Listen the condition. Condition number 1. The first condition that I am supposed to fulfill is you have to make an application to the assessing officer within 1 month from the end of the month in which the order is received. Which order? Assessment order is received. Second condition, you have to pay the tax and interest within 30 days from the receipt of notice of demand. These two things you have to do. Third thing, you should not appeal against this order. Against this order, you should not appeal. Appeal is not possible against this assessment order. Then the assessing officer will pass the order. This is an amendment within 3 months from the end of the month in which the application is received. Earlier, this was 1 month. Then the assessing officer will pass an order. In order, he can say two things. One, he is waiving your penalty. If he is waiving on penalty, great. If he is not waiving your penalty, then you can file an appeal against your original assessment order. So these are the things which are given in 270AA. Let's go ahead with the next one. Question number 18. There is a foreign company outside India which has a branch in India. Now there is a foreign company outside India or a non-resident outside India. They have a branch in India. They are allocating some head office expenses of 1 crore 85 lakhs in India. Will they get deduction in India? Yes. As per 44C, they can get. But how much? Amount allocated, that is 1 crore 85 lakhs or 5% of adjusted total income, whichever is lower. What if the adjusted total income is a loss? In this question, adjusted total income a loss. Adjusted total income is a loss in this case. Therefore, you have to take average adjusted total income of last 3 years. So, if the adjusted total income is a loss, you have to take average adjusted total income of last year. Therefore, last 3 years adjusted total income is given. We need to find out the adjusted total income of last 3 years, and then we have to add all 3 of them, then divide by 3. That will be our average adjusted total income. Take 5% of average adjusted total income, compare with actual amount allocated, 1 crore 85 lakhs, whichever is lower will be allowed as deduction. Now, how to find out average adjusted total income? They have already given us total income, which is after all the items. Should I add depreciation? Do not add depreciation. We do not add depreciation to adjusted total income. Should I add addition? Should I add unabsorbed depreciation? Yes. UAD is added back. Should I add chapter 6? Yes. Chapter 6 is also added. You have to do this for all 3 years. And find out 3 adjusted total income. Then take average of all 3 of them and then take 5%. Should I add brought forward short-term capital loss? Yes. Brought forward short-term capital loss should be added back. It is written in the law, brought forward losses. Should I add current year long-term capital loss? No, current year losses are not added back. Only brought forward losses are added back. Should I add brought forward speculative loss? Yes, add back that. Should I add VRS? Do not add VRS. This is already 1/5. If this would have not been 1/5, then we would have added back 4/5. This is already 1/5, so it is correct. If this would have been full amount, then we would have added back 4/5 because only 1/5 is allowed for VRS. Should I add back head office expense? Yes, head office expense definitely add back. After adding all these things, you will get 3 adjusted total income. Take total of all 3, divide by 3, multiply by 5%. Compare that with actual. Whichever is lower will be allowed. I hope it is clear to all of you. Next question is on safe harbor rule. Transfer pricing with safe harbor rule. High chances it can come in the examination. Be very careful. There are 3 transactions. We need to find out whether safe harbor will be applicable or not. First of all, we need to identify whether both the entities are associate enterprise or not. First of all, the services are provided by Tech Mitra Solution, an Indian company, and it is provided to Blue Orbit Solution, and both of them are associated because one entity holds 30% voting power in another. Therefore, both of them are deemed to be associate enterprise. This is the first thing. Second thing, we need to find out the nature of service. The nature of service is provision of software development services, which is nothing but provision of support services, which is nothing but software development services, and software development services is covered in safe harbor rule. Therefore, now we need to find out the transaction limit and the percentage. The transaction limit, if it is up to 100 crore, in this case it is 99 crore, you have to show a margin of 17%. Now let's see how much margin they are showing. How to find out margin? Operating profit upon operating cost. Operating profit is 8 crore, operating cost is 50 crore, therefore this is 16%. No, you have to show minimum margin of 17% because your actual margin is only 16%. Safe harbor is not applicable in your case. Sorry, the doors of safe harbor are closed. Second transaction, this next era system Indian company and this new Neurocore Technology is a foreign subsidiary, therefore both of them are deemed to be associate enterprise. Now we will find out whether the service is covered in safe harbor or not. Provision of data processing services with the use of information technology. Yes, it is IT enabled services. Go and check the definition of IT enabled services, you will get that over here. Now here, if the transaction value is up to between 100 crore to 300 crore, more than 100 crore up to 300 crore, which is our case is 255 crore, 265 crore, sorry, the margin should be 18%. If it is 18% or more, we will accept safe harbor. If it is less than 18%, we will not accept. Minimum 18% you have to show. Now what is the margin? The operating profit is 45 crore, operating cost is 225 crore, the margin is 20%, which is more than 18%, therefore the officer will accept safe harbor. I hope it is clear to all of you. Third one, there is a partnership firm and there is another entity, Pragati and there is another entity, Stratosphere Innovation, which holds 12% in the partnership firm. So if I am a partnership firm and somebody holds 10% or more, if I am a partnership firm and if somebody holds 10% or more in our company, then in our partnership firm, then we both are associate enterprise. Now, what is the service they are giving? They are giving provision of contract research and development services. Is it covered in safe harbor? Yes, it is covered in safe harbor. Now, if your transaction value is up to 300 crore, in this case it is 175 crore, you should show a margin of at least 25%. Now, what is the margin? 50 crore divided by 250 crore, the margin, actual margin is 20%, which is lower than safe harbor margin. Therefore, safe harbor is not applicable. Now, one last question which is asked over here. Will your answer change if the services are provided to an entity which is located in notified jurisdiction area? Yes. I have told you and I have told you this is important also. When you provide services to a person which is located in an NJA, safe harbor rule is not applicable. Safe harbor rule is not applicable in NJA. So if you provide all these three services to a person located in what? To all these three services, if you provide to a person which is located in NJA, then safe harbor rule is not applicable in all these three cases. What is NJ? NJ is notified jurisdictional area which the CBDT may notify. Earlier they have notified Cyprus, then they have removed Cyprus. As of now, there is no country which is officially declared by Government of India as an NJ. But yes, in exam they can ask country X is an NJ, country Y is an NJ. Hypothetical question can be asked in the examination, which they have been asking again and again. Next question is a DTAA question. Ritika is aged 30 years, resident individual. He has a business in India and also abroad in country Z. We are supposed to compute total income of Ritika and tax of Ritika as per DTAA. India, as per 115 BSc subsection 1A, means as per new regime. India does not have DTAA with country Z. Let's compute the tax liability of Ritika here. What all things will come in Ritika's income? First of all, income from selling of phones, skins and covers, 12 crore 45 lakhs minus expense of 10.2 crore. This will be the net income. Similarly, income from countries at 15.5 lakhs minus 9 lakhs, the 6.5 lakhs income from countries. Then commercial property rent 7 lakh 80,000, 65,000 into 12 minus 30% standard deduction, expenses not allowed. Then Ritika also has employed few employees. So she is eligible for 80 JJAA. 18 employees employed on 1st of May, emolument is less than 25,000 rupees. Employees are employed for more than 240 days. Therefore, 80 JJAA eligible. 18 employees into 11 months into 23,300 into 30%. For these 22 employees also eligible because employees are employed for more than 240 days and emolument is also up to 25,000 eligible. Last not eligible because the employees are employed for less than 240 days. All of them participate in recognized provident fund. Yes, it is necessary. If you want to claim 80 JJAA, the employee should participate in recognized provident fund. Yes, the payment should also be made by online mode. After doing all these things, you will get total income of what? Ritika. After that, you compute tax. Now, the catch in this question is, in this question, there is coming marginal relief. Why? Because the total income of Ritika is coming to somewhere around 2 crore 7 lakhs. Now, if I compute tax on 2 crore rupees and surcharge on 2 crore rupees, then I compute tax on 2 crore 7 lakh rupees, the extra tax is coming more than the extra income. The extra tax is coming more than the extra tax is coming somewhere around 9 lakh. The extra income is coming only 7 lakh. Therefore, marginal relief you have to apply here. So, the solution I have made over here, because this is old solution, only this question is old in the entire PDF. Only this question is old. Rest all solutions are updated. So for this solution also I have given updated solution here. So first you will compute tax on 2 crore and surcharge on 2 crore. What is tax on 2 crore and surcharge on 2 crore? Apply slab rates. Then apply 15% surcharge. You will get 64 lakh 17,000. Then extra income is 745. Add extra income. Add extra income and then add cess on that. You will get your tax. And then you will find out the what? Then you will find out the double taxation relief. I hope it is clear to all of you. So marginal relief is the catch in this question. Otherwise your answer will go wrong. You need to be very careful when you are close to the marginal relief income. I hope it is clear to all of you. So this is what this RTP is all about. Now let's go ahead with one last RTP, that is RTP May 2026. After this we will be completed with 9 RTP compilation exhaustively in full English along with our Hindi division also. Okay. So the very first question again over here is on total income. There is a domestic company. We need to compute the total income, etc. Let's see the last line, what exactly they want. They want us to compute total income, tax liability under regular provision. Ignore math. Then also they have asked us to compute the total income as per 115BAA also. The turnover of last year is 350 crore. Therefore, the tax in the current year will be how much? Will be 25% because the turnover is not exceeding 400 crore rupees. Now let's start with the solution as per normal provision first, and then we will compute the solution as per the provisions of 115BAA. The depreciation as per the books of accounts will be added back. Then employer contribution and employee contribution of March. Employer as well as employee contribution of March is paid in the month of July. Is it correct? No. Employer contribution you can pay up to the due date of filing of return, it is allowed. But employee contribution has to be paid up to 15th of the following month. So employer contribution is correct, but employee contribution is wrong. Therefore, employee contribution in this case will be disallowed. I hope it is clear to all of you. Then you are giving some contribution of 1.5 lakh to a scientific laboratory, scientific research association, etc. Therefore, that is allowed under section 35, but in 115BAA it will be disallowed. Be very careful. In 115BAA it is not allowed as a deduction. Next one, you are incurring some advertisement expenses of 55,000 rupees, which is paid by account pay check. Till here it is good. But you are giving this advertisement in a political party brochure. Now that is not allowed in PGBP over here. In PGBP it will not be allowed, but under 80 GGB you can claim as a deduction. Under normal regime in 115BAA this will not be allowed as deduction. So again I am saying advertisement in a brochure of a political party is not allowed as a PGBP expense. But under chapter 6A you can claim as a 80 GGB deduction, but under 115BAA you cannot claim. Next is a very routine adjustment again. Provision for gratuity based on actuary, that will be disallowed under 40A7, and whatever provision is paid that will be allowed under PGBP. So 1.2 lakhs will be disallowed and 5 lakh will be disallowed. Next one, opening stock is overvalued by Now if your opening stock is overvalued, it means you are claiming more expense. If you are claiming more expense, you have to add back. So you cannot claim more expense now. Opening stock is overvalued, but that means debit side of the P&L is overvalued. Debit side of the P&L is overvalued means you have claimed more expense, your profit is less, so increase the profit. Closing stock is overvalued. If closing stock is overvalued, it means your income is overvalued unnecessarily, so reduce. So the opening stock overvalued will be added back and the closing stock overvalued will be reduced. Then dividend from foreign company reduced from here, show under IFRS, very routine adjustment. Then profit on equity oriented fund on which STT is paid. So this will come under 112A. How much profit is there? 7 lakh profit is there. So reduce 7 lakh from here and show under what? Show under capital gains under 112A. It will be taxable at 12.5% in excess of 1.25 lakhs. So what is the consideration of this? The consideration of this will be 11 lakhs. How, sir? See, the profit is 7 lakh and the units were acquired 2 years ago. Before 2 years ago for 4 lakh rupees. Therefore, the full value of consideration is 11 lakh, cost of acquisition is 4 lakh, profit is 11 lakh. Again, I am saying the treatment, reduce 7 lakh from here and show 7 lakh under capital gains, 112A because it is long-term capital gains, 12.5% tax in excess of 1.25 lakhs. Then there is some cash lost due to theft. So it's okay, it's a part of business, it's a revenue expenditure, you can claim that as a revenue loss and therefore it is allowed. Since it is already debited to P&L, you don't have to do anything, just write a note. Next, depreciation on tangible fixed asset, 8,50,000 you can claim as a deduction. Then you have purchased some power generating units on 1st of July for 25 lakhs. Now, you need to be very careful. The payment is made as follows. First, you made the payment, advance payment of 3 lakh rupees in cash, not allowed. It is written in section 43(1), if you make a payment for a fixed asset in excess of 10,000 rupees to a person in a day by other than 4 modes, then that expenditure shall not form part of actual cost. You are making the payment of 3 lakh rupees here in cash, therefore this will not form part of actual cost. So out of 25 lakhs, reduce this 3 lakhs. Then out of this 25 lakhs, 7 lakh is given as a government grant. So government grant should also be reduced from actual cost. As per explanation 10 to 43(1). Any amount which is made by any person should be reduced from actual cost as per explanation 10 to 43(1). Then the remaining payment is made by check through banking channel of 15 lakh rupees. Therefore, this will be part of actual cost. So therefore, eventually what will be the actual cost? 25 lakhs minus 3 lakhs minus 7 lakhs. Therefore, the actual cost is only 15 lakhs. On 15 lakhs, claim 15% normal depreciation, 20% additional depreciation because the asset is put to use for more than 180 days. But in 115BAA, you will not get the deduction of additional depreciation. That time you add back. Okay. Next one. The company paid cash in the current year for purchase of raw material of last year. So last year you purchased some raw material, you claim deduction on accrual basis, and in the current year you paid 85,000 cash. Therefore, this will be deemed income in the current year. So in the last year you claimed 85,000 as a deduction on accrual basis. Now in the current year you should make the payment by 4 modes, but you have not made the payment by 4 modes. You are making the payment by cash. Therefore, it will be deemed income in the current year. Next, you have purchased some raw material of 18 lakhs, but due to poor quality, you are making payment of only 14 lakhs. 4 lakh is remitted and seized by the creditor. So out of 18 lakh purchase, 14 lakh is payable, 4 lakh is remitted by the creditor. Therefore, 4 lakh will be deemed income under section 41(1). Remission or cessation of a trading liability is deemed income. Therefore, this 4 lakh you have to add to your income. Okay. I hope it is clear to all of you. Next, you are distributing dividend of 1.5 lakhs in the current year. Okay. How much dividend you are distributing? 1.5 lakhs on 15th of October. Late. You cannot claim ATM. To claim ATM, you should distribute dividend 1 month prior to the due date of filing of return. What is the due date of filing of return of this assessee? 31st October. Sir, why not 30th November? See, it is written in the question, the assessee has not entered into any international transaction. Therefore, 30th November is not possible. Only 31st October is possible. If 31st October is the due date, you should distribute the dividend by 30th September. You are distributing the dividend on 15th October. Therefore, provision of ATM will not be allowed. After that, you have to compute tax. 2 tax will come, 112A. 12.5% in excess of 1.25 lakhs, and normal income will be taxed at 25% because the turnover of last year is below 400 crore. Now in 115BAB, what will you do? In 115BAA, sorry, 3 items will be added back. First, additional depreciation on this machinery will be added back. Then 80 GGB, that advertisement donation will be added back, and then scientific research donation will also be added back. 22% tax on special income, 12.5% in excess of 1.25 lakhs, then 10% surcharge and 4% sales, and then find out whichever is more beneficial. I hope it is clear to all of you. Next question is on charitable trust. There is a charitable trust. Point number 1. Sahitya Charitable Trust, main object is medical relief. Now they are earning some incomes. First income, they are earning income from tax-free bonds, 1,10,000, which is exempt under tax section 1015, and second is agriculture income, which is exempt under 10.1. So their question is, they are a charitable trust, can they claim both the exemption? The answer is no. I have told you this earlier also in earlier RTP that if you are a charitable trust registered under 12AB, then you cannot claim any exemption under section 10 except 10.1. 10.1 you can claim. Therefore, in this case, you can claim 10.1, 10.15 you cannot claim. Therefore, in this case, the first one you cannot claim, the second one you can claim. I hope it is clear to all of you. The institute has already given, the first one is covered under 10.15, the second one is covered under 10.1. So they have also given the section number, so it's okay. If they would have not given section number, then there would have been some problem. We need to think about it where it is exempt. But anyways, anything apart from agriculture income is not eligible. You have to think like that. You don't have to remember each and every section. Next trust. Jyoti Vidya Jyoti Educational Trust. Registered under 12AB. They own a building. So the trust own a building. Now they are giving this building on rent to a private coaching institute which is owned by the wife of the founder of the trust. Now, the wife of the founder of the trust is considered to be specified person under section 13 subsection 3. Now, you cannot give unreasonable benefit to specified person. So if you are giving that building on rent to the wife of the founder, it is okay. There is nothing wrong, but give at market value. If you give unreasonable benefit, then the trust will be gone. So you are giving at a rent of 20,000 per month, whereas the market rent is 70,000 per month. Now you are making a mistake. You should not give at 20,000, you should give at 70,000. So what will happen to the trust? Multiple implication. First of all, 115 BBI will apply. Specified income, 30% tax. Then penalty will be applied 271 AE. If you pass unreasonable benefit to your specified person, first time the penalty will be 100% of the unreasonable benefit given. Second time it is 200%. Then whatever rent they are earning, how much rent they are earning? They are earning a rent of 20,000 rupees. This part of income is not eligible for exemption. On this 20,000 rupees, they will not get 15% exemption. They cannot apply and claim exemption also. So 3 implications you have to keep it in mind. Similarly, next trust is also doing something similar only. There is an Arogya Welfare Charitable Trust, which is providing free medical facilities to poor people. Now in this case, there is one person by the name called as Mr. Karan who has contributed 75,000 rupees to the trust in the current year, and till last year he has contributed 9,50,000 rupees. So is Mr. Karan a specified person? The answer is yes. There is an amendment in the definition of specified person, if you remember. Who is a specified person as per the amended definition as per Finance Act 2025? If a person is contributing more than 1 lakh rupees in a financial year, he is a specified person. No, Mr. Karan is only contributing 75,000. Therefore, because of this reason, he is not specified person. Second condition, if a person is contributing aggregate amount to the trust till the last day of the financial year of more than 10 lakhs. Is Karan contributing more than 10 lakhs? The answer is yes. Till last year, Karan has contributed 9.5 lakh. In the current year, Karan has contributed 75,000. Therefore, the aggregate contribution by Karan to the trust is 10 lakh 25,000. Therefore, because of this reason, Karan is a specified person, and now you cannot give unreasonable benefit to the Karan. Now you are doing unreasonable things for Karan. Check. First of all, you have to prove that Karan is a specified person, which I have proved because of this 10.25 lakhs. Now, are you giving unreasonable benefit to Karan? The answer is yes. You are selling some old furniture at 1,20,000 rupees, whereas the market value of the furniture is 2,80,000. So you are giving unreasonable benefit to Karan of 1,60,000 rupees. You are selling at a cheaper rate, which is wrong. Again, 115 BBI will apply in the hands of the trust, and 271 AAE will apply in the hands of the trust. And this amount which is trust is receiving by sale of furniture, that cannot be subject to exemption under 11 and 12. I hope it is clear to all of you. Next question. Very good question. We have done that in class. It's a Delhi High Court judgment of UCO Bank. CBDT has also accepted this view of Delhi High Court. So it's a well established principle now. Suppose I have gone to court and there is some case going on me. Now the judge is saying that you have to deposit 10 lakh rupees till the time the case is not completed. So I gave 10 lakh rupees as a security to the judge. Now what will the judge do? The registrar of the court will deposit that money in the bank and will earn some interest. Now the bank is paying some interest to the registrar of the court. Will bank deduct TDS under 194A of the registrar of court? The Delhi High Court in the case of UCO Bank has said that no. This is not our income. This is not the income of the court. We are just doing it on behalf of what? On behalf of the person who is fighting the case. So therefore, whatever interest which is paid by banks to the registrar of the court will not be subject to TDS. Registrar of the court is not payee for the purpose of 194A. The payee is ultimately who? The person who will win the case. And who will win the case? That only time will say. Now I cannot say. Therefore, this amount which is paid as an interest by registrar of court to by bank to the registrar of court will not be subject to TDS. I hope it is clear to all of you. Next question has 4 transactions. You need to say whether TCS will apply or not. First transaction, the assessee is selling some timber under forest lease. So whether TCS is applicable? Yes. 2% TCS is applicable at the time of debit or receipt, whichever is earlier. See here, the assessee is Messrs. Green Resource Limited. It is engaged in extraction of foreign produce and minerals. It is selling some timber under forest lease to Messrs. Buildwell Infrastructure Private Limited. So on this transaction, 2% TCS will be applicable. Then there is some scrap which is sold by assessee to resident. Now scrap is sold by assessee to resident. This will be subject to 1% TCS under 206C subsection 1. This is also covered in 206C subsection 1. This is also covered in 206C subsection 1. Third, the assessee is selling some coal to a resident and the buyer is giving a declaration that he will use this coal for generating power. He will use this coal for generating power. Therefore, you should not deduct. You should not collect TCS. So in the third case, the assessee is supplying coal, but the buyer is saying that I will use this for electricity purpose. I will not use this for trading purpose. So in that case, TCS is not applicable under 206C subsection 1A. Fourth one, you are giving toll plaza on lease. So if you give on toll plaza on lease or parking lot on lease or mines on lease or quarry on lease, you should collect TCS under 206C subsection 1C. But if you give this to public sector undertaking, then TCS is not applicable. Go and check. Such minute things they are asking. If you give this to public sector undertaking, then TCS is not applicable. I hope it is clear to all of you. Next question is on provisional attachment. Let's try to understand what is this question all about. First of all, the regular assessment for AY 23-23 of the SSC, 23-24 of the SSC was completed on 16th of July 2025. Okay, regular assessment completed. Then income escaping assessment notice has come on 18th of January 2026. During the income escaping assessment, the AO wants to attach the house property of Miss Preeti. So the AO wants to do provisional attachment provision under section 281B. Now we need to answer three questions. First, the circumstances under which the AO can make provisional attachment of the property. So 281B says that if there is a pendency of assessment and if the officer has taken approval from Principal Director General, Principal Chief Commissioner, etc., and it is in the interest of the revenue to protect the revenue of the government, then they can do provisional attachment under 281B. So three conditions has to be fulfilled. First of all, there has to be a pendency of assessment. Secondly, they have to take approval from higher authority, and then they should have a opinion that it is in the interest of the revenue. Second, what is the time period for which such attachment can be made? They can provisionally attach your property for a period of 6 months from the date of order. Can that be extended? Yes. The officer has to record the reasons in writing. They have to record the reasons in writing. Then it can be extended for a period of 2 years or 60 days from the end of the completion of assessment, whichever is later. So it can be extended for 2 years, or if the assessment is completing later, then 60 days from the completion of assessment, whichever is later. Can such provisional attachment be revoked by AO once he has attached? Now, can he revoke that? Can he leave that property? Yes, he can leave in writing. He will revoke in writing, provided the assessee has to fulfill some condition. First, assessee has to give a bank guarantee. Second, the bank guarantee should be given from a scheduled bank. Third, the bank guarantee should be equivalent to the FMB of the asset. If these conditions are fulfilled, the AO will revoke the provisional attachment order, and the property will be given back to you. Next question we have already done. You can check it earlier. I'll just give you the synopsis also if you don't remember. We have done in earlier RTP. There is a foreign company which has become resident in India due to poem. So now the foreign company has become resident in India due to poem. Now that foreign company is foreign company also. That foreign company is resident also. Now we are making some payment of professional fees. So should I deduct TDS under 194J or 195? So the law says that you have to deduct TDS under 195 and not under 194J. So that is what this question is all about. So we have done this similar question earlier. Same to same question we have done earlier. Now the next question is a very good question on business trust. Mr. Ricardo, who is a non-resident, is holding 10% units of the business trust, and the business trust has distributed the following income to Mr. Ricardo. Always remember now, in this question, this is not the income of the trust. This is the income of Mr. Ricardo directly. They have directly given us 10% income of Mr. Ricardo. So don't do again 10% of this. Your answers will go wrong. Okay. So they have directly given. See, they have given information that Mr. Non-resident holds 10%, and they have given that these amounts are given to non-resident only. So these are not the total income of the trust. These are the distributed income which is given to Mr. Ricardo. I hope it is clear to all of you. Now we need to answer the following things. One more information is given that Grey Limited does not exercise. Who is Grey Limited? Grey Limited is SPV. SPV does not exercise the option under 115BAA. That is very important for taxing dividend income. First of all, let's try to understand one by one. Rental income from real estate property. What will happen? Rental income from real estate property is exempt in the hands of trust. Business trust taxable in the hands of investor under 194 LBA. The investor, the company will deduct TDS. The trust will deduct TDS. So if a business trust invests in land and building, earns rental, exempt in the hands of business trust, taxable in the hands of investor. Investor is non-resident, therefore deduct TDS under 194 LBA at rates in force. Rates in force is the highest rate applicable to the Mr. Ricardo, that is 30% tax plus 4% cess. Interest income from SPV. Again exempt in the hands of business trust, taxable in the hands of investor. Because investor is non-resident, you should deduct TDS at 5.2%. 5% tax, 4% cess. Dividend income. What is the treatment of dividend income? Dividend income exempt in the hands of business trust, always. In the hands of investor also exempt. Why? Because the company, the SPV is not following 115BAA. If SPV is not following 115BAA, the dividend is exempt in the hands of the investor. But if SPV is following 115BAA, if SPV is following 115BAA, it is given in the last line. Assume that SPV follows 115BAA, then what will happen? Then it will be taxable. And you have to deduct TDS at the rate of 10%. I hope it is clear to all of you, plus cess. Last but not least, apart from rental income, interest income and dividend income, the business trust is also distributing 2 crore rupees to all the unit holders. It means to Mr. Ricardo, they will distribute 20 lakhs to all unit holders. See, somewhere they are writing only Mr. Ricardo's share. Somewhere they are writing to all unit holders. You need to be very careful with the wordings in the question. So the above information is for only Ricardo. The below information, 2 crore is for all. So Mr. Ricardo is getting 20 lakh rupees over and above these 3 items. That is nothing but debt repayment. So there 56(2)(12) will apply. What is 56(2)(12)? Any amount which is given over and above rent, dividend, interest, etc. that will be taxable as IFOS in the hands of the investor. How much IFOS? Whatever is given as debt repayment minus whatever is the price of the units purchased in business trust. What is the price of the unit purchased in business trust? 15 lakhs. And what is the amount given over and above all these items? Over and above all these items, 20 lakhs. And the unit business trust units cost is how much? 15 lakhs. 5 lakhs rupees will be taxable as income from other source in the hands of Mr. Ricardo. No TDS is applicable on that provision. So the government has not put any TDS on that particular part of the income. No TDS provision is applicable on that income. I hope it is clear to all of you. Now the next question is very good question. Just one change I have to make. I have to write down here. What I have to write down here? 6.4 crore. That is not 7.2 crore. That is 6.4 crore. Now, to explain this entire question, I have put this example. Try to understand this example first of all. Trex Inc. Trex Limited is an Indian company. They have taken some loan from Mrs. Refine Inc. last year 90 crore. But last year they have repaid 10 crore. Therefore, effectively the loan is only 80 crore. Okay. Now they are paying interest on 80 crore, 6.4 crore, 8%. Trex, Mrs. Refine Inc. is what? Is a third party. Mrs. Refine Inc. is not our associate enterprise. So we are paying 6.4 crore interest at the rate of 8% on 80 crore, 10 crore is repaid. Therefore, this 6.4 crore interest we are paying to third party. Now there is one company, Prestige Inc., which is giving guarantee to our associate enterprise. Now there is one more company, Bright Inc., which is holding 40% in Trex and 40% in Prestige. Therefore, because Bright Inc. holds 40% in Trex, 40% in Prestige, therefore Trex and Prestige are associate entity. Therefore, Trex and Prestige are associate entity and our associate entity is giving guarantee to third party. Therefore, this interest will be coming under limitation of interest. As simple as that. So again, I am saying Prestige is now eventually our what? Prestige is eventually our associate enterprise. Prestige is our associate enterprise. Why? Because Bright holds 40% in us, 40% in Prestige. Therefore, we and Prestige are associated and associate entity gives guarantee to Mrs. Refine Inc. Therefore, the interest paid to Refine Inc. will be coming under limitation of interest under 94B. Now, the question is that there is some disallowance of last year also. Last year also some disallowance is there of 7.5 crore under 94B. How much we can claim in the current year as a deduction? We can claim up to 30% of EBITDA. For that, we need to find out EBITDA. EBITDA is how much? 18 crore is your net profit. Add interest in that 6.4 crore. Add 4 crore depreciation and add 2.7 crore tax. 31.1 crore is your EBITDA. Up to 30% will be allowed in the current year. What is 30% of EBITDA? In excess of 30% is disallowed as per 94B. It means up to 30% is allowed. Therefore, 30% will be allowed in the current year. Therefore, 9.33 crore will be allowed in the current year. Now, 9.33 crore interest you can claim in the current year, out of which 6.4 crore is current year interest. Therefore, remaining 2.93 crore you can claim for last year. So, out of 7.5 crore, you can claim 2.93 crore in the current year, and balance out of 7.5 crore you can carry forward for the next years. I hope it is clear to all of you. It's a good question. We have done a similar question earlier also. And one last question over here, which is on DTAA. Shrestha, resident individual, 34 years. He is earning some income from the various country. India does not have DTAA with foreign country. He has not opted out of default regime. See, they are playing with language, English. Is this a tax paper or English paper? I don't understand. He is not opted out of default regime means she is following default regime. It means she is following new regime. They could have easily said she is following default regime. No, but she is not opted out of default regime. It means she is not going out of default. It means she is remaining in default. It means she is following new regime. What the hell is this? Is this an English paper or a grammar paper or a tax paper? I don't understand. Anyways, whatever is there, we have to take care of it. Now let's try to compute the income. First of all, she is earning income from business from Jaipur. On that, she is incurring expense of 3.5 lakhs. So the net income is 26 lakhs minus 3.5 lakhs. Then she is earning the rent from country M, 95,000 rupees per month minus 30% standard deduction you will take. Expenses will not be allowed in India. Only 30% standard deduction allowed. Then she is earning agriculture operation income of 18 lakhs. On that, she is incurring expense of 8.5 lakhs. So 9.5 lakhs will be taxable. Then she is earning dividend income from country M, IFOS. Now, agriculture income is exempt in country M. So this is not doubly taxed. This will not be doubly taxed because this is exempt in country M and only taxable in India. Okay. So we have to compute total income. So total income will include what? 26 lakhs minus 3.5 lakhs. Then 95,000 minus 30%. Then 18 lakhs minus 8.5 lakhs. And then 4,20,000. Then you have to compute tax. After you have computed tax, now you need to find out doubly tax income. Now the most important catch over here is doubly tax income. Which incomes are doubly taxed? Is this first income doubly taxed? No, because this is Indian income. This is not doubly taxed. Is this second income doubly taxed? Yes, this is doubly taxed. Is this agriculture income doubly taxed? No, because agriculture income is not taxable in country M, so you cannot say it is doubly taxed. Is this dividend income doubly taxed? Yes, dividend income is also doubly taxed. So two incomes are doubly taxed. I am highlighting with different colors. So this dividend income is doubly taxed and this rent income is doubly taxed. Now dividend income is doubly taxed how much? 4,20,000. And the rate is how much? 20%. Compare with average rate in India, whichever is lower will be allowed as relief. But there is a catch in rent doubly tax income. Rent is doubly taxed in India. In India, rent is taxed at 7,98,000 because 95,000 into 12 minus 30% comes to 798. But in country M, the rent is taxable at 6,15,000 only. Why? Because in country M, the rent is taxable at 95,000 into 12 minus 5,25,000 because in country M, all these expenses are allowed. Therefore, what is doubly taxed in India? In India, rent is taxable at 798 because the deduction is allowed different. In India, it is 30%. In country M, it is 5,25,000. Therefore, in India, the income tax is 7,98,000. In foreign country, the income tax is 6,15,000. Therefore, doubly tax is how much? Doubly tax is only 615. You cannot say 798 is doubly tax. Therefore, on 615, you have to apply whichever is lower rate. I hope it is clear to all of you. And on dividend income, you have to apply on 4.2 lakhs because dividend income is same in both the countries. I hope it is clear to all of you. So this is what this RTP is all about. So here we complete 9 RTPs exhaustively in full English. The next target after this will be to complete 9 past paper including the Jan 2026 paper for your reference exhaustively in the same manner and probably in a better manner if it is possible from my side. I request all of you to do only few things. First, watch this video again and again. Again and again, you try to watch this video as many times as possible. This is the most important video for you. Second thing, you have to make sure that if you want to learn all these things in great detail, I am doing just revision. If you want to learn all these things in great detail, we have covered all these things in great detail in our regular batch, in our exam oriented batch and also in our practical question batch. In this compilation video, we are going to cover around 200-250 videos. But in our regular batch, exam oriented and practical question batch, we have covered more than 550 questions. More than 550 practical questions. And there I have explained each and every point in detail. Here the objective is from the exam day perspective. How will you revise on the day of examination? But if you want to do it in detail, you can enroll for our respective batches in full English, which is available on our website. You can check it over here. Third thing, the PDF of this I have already uploaded on our Telegram channel. You can download the PDF from there. Okay. So today we are starting with our 9 past papers compilation, including the latest paper, that is Jan 2026 CA final direct tax paper in full English for our dearest students of South India mainly. So earlier we have also completed 9 RTPs in full English. I hope you all have enjoyed that. If you have enjoyed, again I would like to say, please comment below on the video and also put timestamp on whatever point you find important, so that when you refer for the next time, it is very important for you to identify it very easily. Okay. So the very first paper over here is May 2022 paper. Let's start with May 2022 paper. The very first question is on total income. I've already told you that whenever you do a total income question, you should always read the last line first. They have asked to compute total income and tax payable, and they have asked us to opt for 115BAA. So as for 115BAA, you have to compute the total income of the assessee and the tax payable of the assessee. Okay. We are not supposed to do the normal provision. Only 115BAA is relevant over here. Now, the very first question over here is, the very first line is, assessee is a manufacturer. The profit of the assessee is 850 lakhs. And then they have given us some adjustments which are debited and credited to P&L account. The very first adjustment is the routine adjustment of depreciation, which you will add back because it is as per Companies Act. The second adjustment says that employer contribution of 18 lakh and employee contribution of 18 lakh of March 26, that is of the last month, is paid on 20th of May 2026. Now we all know that the employer contribution you can pay up to the due date of filing of return as per 43B. But the employee contribution has to be paid by 15th of the following month. So here you are making a mistake. What mistake you are making? Employer contribution is correct, but employee contribution is late. Therefore, employee contribution has to be paid by 15th of the following month. In this case, it has to be paid by 15th of April because the contribution is pertaining to March. But you have paid in May. Therefore, employee contribution will be disallowed. Employer contribution will be allowed as per 43B. I hope it is clear to all of you. Next one is the GST penalty. GST penalty is penal in nature, therefore it is disallowed. It is for breaking a law, therefore it is disallowed. GST interest is considered to be compensatory in nature. Interest on GST late payment is allowed as a deduction. Interest on income tax late payment is not allowed as a deduction. Next one, you are giving some 10 lakh rupees on notified skill development project under 80CCD, not allowed under 115BAA. 115BAA does not allow 80CCD. Next one, you have some old machinery which is destructed due to fire on which there is a loss of 20 lakhs. So very simple, add back this loss to PGBP. This will not be allowed as a PGBP deduction because it's a capital loss. So add back this loss and adjust in the WDV of the asset, but WDV of the asset is not given to us. So ignore that. Okay. Because the WDV of the asset is not given to us. So ignore that. If they would have given the WDV of the asset, we would have adjusted. Similarly, there is a scrap of 5 lakh rupees which you would have credited to PNL, reduced from the PNL account and adjust in the WDV, but WDV of the asset is not given to us, so ignore it, so leave it. So what is your ultimate treatment? Loss you will add back and scrap you will reduce. Then you are receiving some dividend from foreign company of 15 lakh rupees. So reduce from here and show under IFOS. Now, to earn this dividend, you have incurred an expense of 50,000 rupees. Now, we all know that from dividend, you can get deduction of only one expense, that is interest expense. No other deduction is allowed from dividend income. That too up to 20% of the gross dividend. That too only to residents, not to non-residents. Now, this 50,000 incurred by the assessee, I don't know whether this is interest or not. If you assume interest, then you can claim as a deduction. If you assume not as an interest, then you cannot claim as a deduction. So what we are assuming, we are not assuming it to be interest. So what is the ultimate treatment? Add back this 50,000, that's it. So what is the ultimate treatment of this entire adjustment F? For dividend received 15 lakh, reduce from PGBP, show under IFOS. And for this expenditure, add back, do not claim deduction because we are assuming it to be not an interest. If it is not an interest, then it is not allowed as a deduction. Next is a very routine adjustment. 15 lakh profit is generated when an 100% holding subsidiary sells assets to each other and the recipient company is an Indian company, then it is exempt under capital gains under section 47. Provided the relation should be 100% holding subsidiary and the recipient company should be an Indian company. So in this case, this 15 lakh will be reduced from PGBP and it will be exempt under section 47. You can write a note under capital gains, it is exempt. Next, some additional information is there. Additional normal depreciation of 92 lakhs, you can claim as a reduction normal depreciation. Then one more information is there. In last year, 24-25, you have purchased a new machinery on 10th of January for 20 lakhs. Therefore, in the last year, you would have taken 50% additional depreciation because the asset was put to use last year for less than 180 days. Therefore, last year, you would have taken 50% additional depreciation. Can I claim balance additional depreciation of 50% in the current year? Yes, you can. But you will not be able to. Why? Because you are following 115BAA. Because you are following 115BAA, the balance additional depreciation cannot be allowed to you in the current year. I hope it is clear to all of you. Next one is also pertaining to last year. Last year, you have done some repair to your factory building and you have credited an amount of 7 lakh rupees to contractor's account. You should have deducted TDS and paid TDS. But you have deducted the TDS, but you have paid the TDS late. That is on 31st December 2025. You should have paid before the due date of filing of return of last year, but you have been late. So what will happen? In this case, it's very simple. 30% of 7 lakh would have been disallowed last year because it was not paid on time. So in the current year, because you have paid now in the current year, it will be allowed in the current year. 30% of 7 lakh comes to 2.1 lakh. 2.1 lakh you can claim as a deduction in the current year. And last but not least, on 15th of May 2026, the assessee, that is the company, declared dividend of 20 lakhs to its shareholder. Therefore, it can claim deduction under ATM. ATM deduction is allowed how much? Dividend received compared with dividend paid, whichever is earlier. And you have to distribute the dividend 1 month prior to the due date of filing of return. Yes, they are distributing 15th of May 2026, which is well before 1 month prior to the due date of filing of return. Therefore, the company can claim the deduction definitely. There is no doubt about it. I hope it is clear to all of you. So, after this, you have to just compute what? Tax, 22% tax, 10% surcharge, 4% cess. That's it. It's a very simple question, nothing great as such. Let's move on to the next question. Question number 2. There is a foreign company, Black and Brown, which is incorporated in country X. And they have an agent, Mr. Lal, in India. Mr. Lal does what? Mr. Lal does stock of goods in India on behalf of the foreign company. He also delivers goods regularly on behalf of the foreign company. The foreign company does not have a permanent establishment or fixed place of business in India, and also there is no DTAA between India and foreign country. So this is the basic information which is given to us. Now we need to find out the tax implication of the following items. First of all, the foreign company is earning income from delivery of goods by Mr. Lal. So do you remember that in section 911 we have seen that if a non-resident has an agent in India and that agent in India regularly deliver goods on behalf of non-resident, then that income is deemed to accrue or arise in India that amounts to business connection. That is the same thing which is happening over here through Lal Singh. Foreign company is BNB, Lal Singh is agent. Agent is regularly delivering goods in India. Therefore, this 2 crore will be taxable in India on the behalf of foreign company in India, as per 911 business connection. Second point, the foreign company is earning technical services of 55 lakhs net amount after deducting expense of 6 lakh rupees. Now here ICAI has taken 2 views. View number 1, if there is an agreement between the foreign company and the Indian company, and the agreement is approved by central government, then you can take 115A, and if you take 115A, then it will be subject to tax at 61 lakh rupees, because in 115A you do not get deduction of expenses. But if you assume that there is no agreement which is approved by central government, then normal provision will apply, 115A will not apply. In that case, you have to tax at net income. Net income will be taxable, 55 lakhs will be taxable at normal rates. So if you go for 115A, 20% tax, but at gross income, if you go for normal provision, then 55 lakh rupees income at normal rate. This is what this point is all about. And the third one and the last one over here is, there is a long-term capital gains on unlisted debentures of Indian company of 14 lakh rupees. So this will be subject to 12.5% tax because this is sold after 24 months. Therefore, this is long term. This will be subject to 12.5% tax. One last point is given to us here for confusion purpose. BNB has paid a tax of 50 lakh in country X. So what should I do with that? See, BNB is not a resident of India. India will give relief to whom? India will give relief to Indian residents, not to foreign residents. So BNB has paid tax in India, or BNB has paid tax over there. India has nothing to do with that. Whatever tax BNB has paid in India or whatever tax BNB has paid outside India, everything will be considered as a relief in his country only, not in our country. India will not give relief to non-residents. India gives unilateral relief under section 91 to our residents, not to foreign residents. Therefore, this last line you can write a note. This has nothing to do with the question. I hope it is clear to all of you. Now let's move on to the third question. Question number 3, which is on charitable trust. In part 1, there are 2 parts. There is a charitable trust which has received 5 lakh rupees as a corpus donation. Okay. Now they are saying that the trust is making a contention that because they have received a corpus donation, that is fully exempt. It's not like that. Corpus donation is not by default exempt. It is exempt provided you invest in the mode specified in 11.5. So if you invest the corpus donation in the mode specified in 11.5, only then it is exempt. Otherwise it is not exempt. Therefore the contention of the trust is wrong. The second point which is asked in this first question itself, the trust has taken a loan of 20 lakhs from a bank, and out of that 18 lakh is used for construction of building. Now the trust wants to claim 18 lakh as deduction, not allowed. If you take a loan and incur an expense, then that expense is not allowed. That expense is allowed on repayment of loan, that too if you repay within 5 years. So if I take a loan and expense If I take a loan and incur an expense, that expense is not allowed as an application. It will be allowed only if the loan is repaid. That too, now an amendment has been made in Finance Act 2023 that the loan has to be repaid within 5 years if you want to claim that repayment of loan as a deduction. I hope it is clear to all of you. Next question. Smile Foundation is not for profit organization. It runs a secondary school. Okay. Now they are receiving some voluntary contribution and government grant total of 30 lakh rupees, 14 and 16 lakhs breakup. Now they are making an argument that is the trust required to get an approval under 1023C? The answer is no. They are not required to get approval. It is exempt. Why, sir? It is exempt because it is a substantially financed institution by government. Sir, how, sir? See, the total amount received is 30 lakh. Out of that, how much donation is received? How much grant is received from government? 16 lakh rupees. Out of that, 15 lakh rupees is received from government. 16 lakh rupees is received from government. Therefore, out of 30 lakh, if 16 lakh is received from government, then more than 50% is financed by government. Therefore, it is by default exempt. They need not have to take any registration. They need not have to take any registration. A substantially financed institution means what? A substantially financed institution means an institution where the government grant is more than 50% of the total donations. So here the government grant is more than 50% of total donation. Therefore, this trust is not subject to take any approval. They can claim exemption without approval. And last but not least, a trust is registered under 12AB. It is also registered under 1023C. It wants to enjoy both. Both you cannot enjoy. It is written in section 11 subsection 7 that if you are registered as 12AB trust, then you cannot enjoy 1023C also. You have to surrender one of them. And from 1st October 2024, I have told you already that from 1st October 2024, the government is not accepting new application under 1023C. The doors of 1023C are closed. But still, if you have earlier registered under both, you cannot claim both exemption. You have to surrender one of them. You cannot claim both the exemptions simultaneously at the same time. I hope it is clear to all of you. So this is what this small question is all about. Next question, question number 4, which is on TDS question. Question number 1. In TDS, we need to identify whether TDS is applicable or not. So Mr. Rajat is there. The age of Mr. Rajat is 79 years. He is a resident. He has a saving bank account. He has a fixed deposit account in an ABC bank. Now he is earning following incomes from ABC bank. He is earning interest on saving bank 75,100, pension of 55,000 rupees per month, and 1,20,000 rupees interest on fixed deposit. He does not have any other income. He is following old regime. Now what is the ultimate conclusion of this question? The bank will deduct TDS under 194P, a special section. Do you remember 194P? Count conditions with me. 194P, count conditions with me. Condition number 1, if assessee is an individual, he is a resident, he is 75 years or old, and if he earns pension from a specified bank, and also interest on FD, interest on saving bank from the same bank, pension should be earned from the same bank, interest also should be earned from the same bank. FD interest, saving bank interest, both are covered. Even RD interest is covered, recurring deposit. But the pension and the interest should be earned from the same bank. Then the bank will compute the total income of the assessee. The bank will deduct exact TDS based on slab rates, old regime, new regime, as the case may be, is followed by the customer. Here the customer is following old regime, so the bank will deduct TDS as per old regime. And then the senior citizen who is 75 years old, he is not liable to file the income tax return. So this is what this question is all about. Here the TDS will be deducted under 194P by the bank. How the bank will compute the income? Let's see. First of all, salary income, pension 55,000 into 12. Gross salary minus 50,000 standard deduction for old regime. Then 75,100 interest on saving, 1,20,000 interest on FD. From that 80 TTV deduction, whatever is the net income on that, bank will exactly compute the tax and will deduct the TDS. After that, the senior citizen do not have to file the income tax return as per 194. See, I hope it is clear to all of you. Next question, beautiful question. Aryan Limited is a domestic company having last year turnover more than 10 crore rupees. So if the Aryan Limited is a buyer, if the buyer's last year turnover is more than 10 crore rupees, last year business turnover is more than 10 crore rupees, buyer is liable to deduct TDS under 194Q if the purchase of goods exceeds 50 lakh rupees during the financial year. How much TDS? 0.1% on excess amount. Let's see how much they have purchased. They have purchased 85 lakhs. Excluding purchase return from Varun and Company, which is a residence. Yes, the seller should be resident. When should I deduct the TDS? On payment or credit, whichever is earlier. The other person is giving what? The other person is also giving PAN to us. So we will deduct TDS at 0.1% only. Now let's see when we should deduct TDS. First, we are purchasing on 25th of May, 30 lakhs. So no TDS because the amount is not exceeding 50 lakhs. Then on 28th of June, we are purchasing another 25 lakhs. So now 5 lakh is exceeding 50 lakhs. Therefore, on 5 lakhs, 0.1% TDS will be deducted on 28th of June. I hope it is clear to all of you. Third one, on 10th of December, 20 lakh, and again we are purchasing. So again, we will deduct 0.1% TDS on 20 lakh. I hope it is clear to all of you. But out of this 20 lakh, 5 lakh is returned in future and 5 lakh goods are returned by the buyer and money was also refunded. So remember, CBDT has given a circular that if you have already deducted TDS and paid to the government and later on if you have returned the goods and money is refunded, you can adjust that much TDS against future purchase. So TDS of 5 lakh rupees, you can adjust against future purchase. So in future, against same seller only, not against different seller. So against same seller, we are again purchasing 10 lakh rupees in future. So now you have to deduct TDS only on 5 lakh rupees. You can adjust the previous purchase return against this particular purchase. So how much we have returned earlier? 5 lakh rupees goods you have returned earlier, taken the money refunded also. So now that 5 lakh rupees you can adjust here. So now on 20th of February 2026, TDS will be deducted only on 5 lakh. 5 lakh will be adjusted. Therefore 5 lakh into 0.1%. I hope it is clear to all of you. Sir, what if the money would have not been refunded but the goods would have been replaced? Then no effect in future. If the money is refunded, if you have returned the goods and the money is refunded, then adjust in future against same seller. If the money is not refunded, but the goods are replaced by the seller, then no effect in future. Then don't give any effect. Then in future also deduct TDS on 0.1% on 10 lakh rupees only. I hope it is clear to all of you. So this is what this question is all about. Now question number 5 talks about whether it is a tax planning or tax management or tax evasion. Let's see. An individual is investing some money of 10,000 rupees in Sukanya Samriddhi scheme. Yes, Sukanya Samriddhi scheme is nothing but it is allowed under 80C by the government of India. Therefore, it is tax planning. Another is companies obtaining form 60 from the customer from all those customers who is not providing PAN. So if the customer is not providing PAN, you have to take a declaration in form 60. So this is nothing but tax management. Third one, a partnership firm is purchasing a refrigerator and installing that refrigerator at partner's home. You are purchasing a refrigerator and you are installing at partner's home and you are claiming depreciation on that. It is a tax evasion. Clear case of tax evasion. Clear case of tax evasion. And the fourth and the last point, a company pays 4 lakh to Mrs. D, wife of director, who although being a qualified professional but is a housewife. You are giving money to wife of director, who is a housewife. The purpose is to increase the total income. It's a clear case of tax evasion. You are unnecessarily giving money to the wife of director so that the expense of the firm, expense of the company increases and the company can claim tax benefit. And wife is anyways not doing anything, therefore her income will be exempt up to 5 lakh rupees as a rebate. Therefore, it is a clear case of tax evasion. I hope it is clear to all of you. And one last question is a theory question. You can see this later on. It's a very, very straightforward theory question. You can watch it later on. Okay, I'm not going to talk about theory question. So this is what this paper was all about. It was a very simple and small paper. The big papers will come now. Let's move on to the next paper, that is November 2022 paper. The very first question over here is again on total income. We are supposed to compute total income as per the normal provision, not as per 115BAA. Okay, as per the normal provision, you have to compute the total income. Now be very careful. There are some very important points which are given in the first line. That is, the assessee is a pharma company. First of all, assessee is a resident. But the most important line is it is a company in which public are not substantially interested. What do I mean by this line? It means it is a closely held company. Which company? It's a closely held company. What do you mean by this? It means there are two important sections which can be made applicable for this assessee. One is section 68, that is unexplained cash credit, and one is section 79, set off and carry forward of losses in case of closely held company. Either of the two provisions may be applicable. I am not saying it is 100% applicable. It may be applicable. That is the reason they have used such words, that is public are not substantially interested. Okay, we will check which points are applicable, which section is applicable, especially for closely held company, which is covered in this question. The profit of the assessee is 50,75,000 rupees. You are purchasing some one-time license of 12 lakh rupees, which is a franchise fee on 28th of July. Very routine adjustment. Add back this and then reduce 25% later on. But here the ICI has made a very, very, very strange assumption which they have not made earlier. Okay, what strange assumption they have made? You know, they have said that add back 12 lakhs, but don't reduce separately later on. Generally, we reduce now separately. In most of the adjustments, we have done like that only. But here ICI is saying don't reduce separately. Why? They are saying that this income tax depreciation which is given below now of 14,50,000 would have included this 25% depreciation also. Now, what kind of strange assumption suddenly they make? Now, the board of studies member change now over the period of time. So, they make their own assumptions. So, what should we do, sir? You can do either of the things. You can reduce or you can write a note that it is already included. You can reduce separately also, or you can write a note also that it is already included in the depreciation amount. Therefore, we are not reducing. Okay. You just inform the ICI that I know the adjustment. Okay. Now, second, you are incurring some expenses on what? On issue of convertible debentures. So if you incur some expense on issuing convertible debentures, it's not a capital expenditure. It is allowed as an exemption. It is allowed as deduction. Therefore, you can claim, because issuing convertible debentures does not lead to permanent capital in the business. Therefore, because it does not lead to permanent capital in the business, you can claim that as a deduction. Okay. Now, next one is a very intelligent adjustment. When you are making two payments, very intelligent and very dangerous adjustment it is. You are making two payments. 2,25,000 you are making to share broker as a commission, and 1,20,000 you are paying to commodity broker for buying some commodity as a commission. In both the transaction, you have not deducted TDS. To share broker also you have not deducted TDS, and to commodity broker also you have not deducted TDS under 194H. Commission TDS is covered under 194H. Now, what is the treatment of this adjustment? Now, ICI has taken two views. View number one, if you assume that the assessee is not a trader, or assessee is not a trader of share and commodity. So, if it is view number one, if he is not a trader of share and commodity, then both the expenditure will be disallowed. Because if you are not a trader of share and if you are not a trader of commodity, then these are not business expenditures for you. Therefore, it will not be allowed as a deduction. Both of them will be disallowed. But the second assumption, if you are a trader of commodity and if you are a trader of share, then you can claim that as a deduction. In that case, you need to ask whether TDS is deducted or not. So if you are a trader, then on share broking, whether am I liable to deduct TDS? Not liable to deduct TDS under 194H. There is a clear exemption that when you pay commission or brokerage on securities, no TDS is applicable. So if no TDS is applicable, then this expenditure cannot be disallowed. Because TDS is not applicable only, then why should I deduct TDS? Second point, that if you are paying 1,20,000 as a brokerage on commodity, then TDS is applicable under 194S. Go and check. And in that case, if you have not deducted the TDS, then 30% of 1,20,000 will be disallowed. So again, I am saying both the views. View number one, let's assume that it is we are not trader. So if you are not trader, both expenditure disallowed. Let's assume we are trader of both. If you are trader of both on commodity commission, you have to deduct TDS. If you have not deducted, 30% disallowed. And on share broking, no need to deduct TDS. If you have not deducted TDS, still fully allowed. I hope it is clear to all of you. Beautiful question it is. Next adjustment. You are contributing 15% of basic salary to employees pension scheme. How much is allowed as a deduction? It is allowed only 14% of basic plus DA in terms. But you are contributing how much? You are contributing 15% of basic salary. Now let's see how much you are contributing. 6 lakhs is the basic salary. You are contributing 15% of that. 15% of 6 lakhs comes to 90,000 rupees. So the actual salary is 19,000. How much is allowed? How much is allowed is basic plus DA in terms is allowed. Now basic is 6 lakhs. What is DA in terms? Total DA is 30%. Therefore 30% of 6 lakhs comes to 1,80,000. Of that 50% is DA in terms. So out of 1,80,000, 50% is 90,000. 90,000 is DA in terms. Therefore basic is 6 lakhs and DA in terms is 90,000. Therefore 6 lakh 90,000 is basic plus DA in terms. Therefore 14% of that is allowed as reduction. 14% of that is 96,600 is allowed, but you are only giving how much? 90,000. Therefore fully allowed. You are not paying more than 14%. 14% is 96,600. You are actually paying only 90,000. Therefore full 90,000 will be allowed. Nothing to disallow. Write a note and leave it. I hope it is clear to all of you. Next one. You are giving 7 lakh rupees as a freebie to medical practitioner. Disallowed. Pharma company, you are a pharma company. That's the reason it is very important line over here at the beginning of the question. A pharma company giving freebie to whom? Giving freebie to medical practitioners is disallowed. It is not allowed as per explanation 1 to section 37(1). Next, you are incurring some 5,20,000 rupees on feasibility study on examining proposals for technological advancement of existing business. Existing business we are doing, then it is allowed. Even though there is no asset which is created. If asset would have been created, we would have capitalized to the asset, but asset is not created and the expenditure is done for technological advancement of existing business. Therefore, it should be allowed as a reduction. Next, depreciation as per books of accounts will be added back. Next, again a routine adjustment. Employees contribution will be disallowed because employees contribution has to be paid by 15th of the following month. Employer contribution will be allowed because employer contribution can be paid up to the due date of filing of return. Okay. So therefore this will be disallowed. Employee contribution disallowed. Employer contribution will be allowed to you. Next is Swachh Bharat Abhiyan, 2 lakh rupees you are paying. So add back here Swachh Bharat Abhiyan. Add to PGBP, claim under chapter 6A, assume that the payment is made other than cash, because if you make by cash, then the deduction under 80G is not, 80GGB is not allowed. Okay. Next, you are receiving some industrial power tariff concession from the central government. So if you receive any industrial power tariff concession, etc. from government, it is an income under section 2, clause 24, subclause 18. Therefore, let it be part of income and write a note on that. Next, in the opening and the closing stock, you are including some interest expense, which is not allowed. So in the opening stock, you are including 6,85,000 rupees as an interest expense, which is not allowed. Add back 6,85,000. And in the closing stock also, you are including 5,65,000 on the credit side of P&L. So reduce 5,65,000. So opening stock wrong inclusion will be added back. Closing stock wrong inclusion will be reduced. Next one is a profit from setting up of what? Next one is the profit from setting of warehouse in warehouse for storage of sugar. How much profit you are earning? Now this is a 3580 business. You have to reduce this profit from here. Show separately. Show separately. Don't merge with this pharma business. Reduce this 10 lakh from here. Show separately. And how much expenditure you are incurring for the 3580 business? You can check it in the fourth adjustment. 35 lakhs you have incurred. Out of that 20 lakh is land. Therefore only 15 lakh will be allowed. So reduce this 10 lakh from here. Show separately as a 3580 business. So 10 lakh will be the profit. From that 15 lakh will be the expense. 5 lakh will be the loss of 3580 that you have to carry forward. That loss you cannot set off against what? Against pharma business. That is not allowed. 3580 loss can set off only against 3580 income for infinite number of years as per section 73A. I hope it is clear to all of you. Next one. You have collected 14 lakh GST from customer and then remitted to government. So 14 lakh collected, 14 lakh remitted, deduction fully allowed. Nullified. Receive 14 lakh, paid 14 lakhs to government, fully allowed. Then you filed an appeal to the court. The court has told the GST department to grant you refund of 5 lakhs. So now refund of 5 lakh has been received. Out of that 3 lakh you have returned to the customer. Now whatever refund you are receiving, that is ultimately a customer's money only. Because GST is not your money. GST is customer's money. You have taken from customer and given to government. Now government has refunded it. So you should give it back to the customer. So you have got 5 lakh as refund, but you have given only 3 lakh to customer. Therefore 2 lakh will be added to your income. That will be your deemed income. 41 subsection 1. Recovery of an expense. You have claimed deduction of that GST earlier. Now you are recovering. Now that 2 lakh will be income. Whenever you will give that back to the customer, at that time that 2 lakh will be claimed as a deduction once again. I hope it is clear to all of you. Next one. This is a very important adjustment. Because of this adjustment only the institute has given this line at the beginning of the question. The public are not substantially interested. See, it's very simple that if you are a closely held company, then your 51% of the shareholders should be same if you want to carry forward the loss. Now here 51% of the shareholders are changing. Why? There was one person, Mr. X, who was holding 55% shares. Now he sold his entire share in the current year. Now 55% shareholder change. Therefore this loss of 13 lakh rupees of 23-24 cannot be carried forward and set off in the current year. Because 51% shareholders have to be changed and 51% of the shareholders have changed. They have to be same if you want to carry forward and set off. But because they have changed, you cannot carry forward and set off. You can write a note on section 79 over here. And the last adjustment is income tax rules. Depreciation is 14,50,000 rupees. You can claim this as a deduction. I hope it is clear to all of you. We are supposed to just compute total income and we have computed the total income. That's it. Nothing great is asked in this question. Question number 2 is again a very intelligent question. In this question, we are supposed to compute total income, tax payable, AMT also, alternate minimum tax also, AMT credit also, all these things we are supposed to compute. It's a question on LLP. This LLP has a SEZ since 2019. Now, because it has an SEZ unit since 2019, it is eligible for deduction under 10AA, but only 50% because the unit is more than 5 years older. 50% deduction will be available of the profits. Now, because it is a partnership firm question, LLP question, you have to first compute book profit. Then you will compute remuneration as per 40B. Then you will compute total income. Then you will compute tax as per normal provision. Then we will compute AMT and then we will compute AMT credit. It's a long question. So first we will compute book profit. Okay. So what is book profit? Book profit is nothing but PGBP income only. Just add remuneration debited to P&L already. So let's compute book profit. The net profit of the P&L as per the LLP 65 lakhs. Profit on sale of license. Is it a part of book profit? Yes. Book profit is nothing but PGBP income. Profit on sale of license is a part of book profit. Don't do anything. Remuneration to partner, add back. This is actual remuneration. Interest 16% not allowed, only for 12% allowed, add back 4%. Donation to political party, add back now, claim as a deduction later on under chapter 6A. Depreciation as per books of accounts, add back. Then remuneration to partners and interest are authorized. It's very important. If you want to claim deduction of remuneration and interest, it should be authorized by deed. Business loss you cannot reduce while computing book profit because business loss are not covered in section 28 to 44. It is covered in section 72. Yes, unabsorbed depreciation you have to reduce while computing book profit. And then you have to compute the depreciation as per the normal provisions. That is, whatever is your income tax depreciation, that you have to reduce. I hope it is clear to all of you. After doing all these things, you will get what? You will get this. Your book profit. Your book profit is how much? 87 lakhs. Now on this 87 lakhs, you will compute what? You will compute your remuneration. How will you compute remuneration? Up to 6 lakhs, 90% of book profit, and above 6 lakhs, 60% of book profit. It comes to 48 lakh 60,000 rupees plus 5 lakh 40,000, total 54 lakhs. What is your actual remuneration? The actual remuneration is as follows. You can check it over here. The actual remuneration is 58 lakhs. And the maximum remuneration is how much? The maximum remuneration is how much? The maximum remuneration is 54 lakhs. Therefore, the allowed amount will be how much? It will be 54 lakh compared with 58 lakh. Whichever is lower will be allowed as deduction. I hope it is clear to all of you. Is it clear? I hope it is clear. Now the real question comes. Now we have to compute the 10AA deduction. But after this, you will do one thing. You will first reduce the losses. First, you will reduce the losses of 4 lakh rupees is the loss which you have to reduce now from your PGBP income. And now your ultimately gross total income comes to 29 lakh rupees. Now from this 29 lakh rupees, you will compute 10AA deduction, and at the end you will take what? 80 GGB deduction of political party donation which you have given. Now how much 10AA deduction we will compute? For 10AA deduction, we need three things. One is export profit, one is export turnover, one is profit, and one is total turnover. Let's try to understand all three of them one by one. Pay attention please, all of you. What is export turnover? So now we have to compute export profit, export turnover, total turnover, and profit from the SEZ undertaking. Now let's see one by one. First, I will find out export turnover. The total turnover of the SSC is 45 crores, but out of that, only that much turnover will come in export turnover, which is received within 6 months from the end of the financial year. Therefore, I have to take only 38 crore in export turnover. From that also, if there are any charges like insurance, freight, telecommunication charges, I have to reduce that. So therefore, the export turnover eventually will come to 36 crore. Now I have to consider the total turnover. What is the total turnover? The total turnover is 45 crore. And in the total turnover, you don't have to check how much money is received in India, how much money is not received in India. You have to take everything. While computing export turnover, you have to check how much money is received in India within 6 months. But while computing total turnover, you don't have to check how much money is received in India within 6 months. You have to take everything. But only one thing has to be reduced, that extra charges like insurance, freight, telecommunication charges, those have to be removed. Therefore, that is 5 crore in 45 crore. Therefore, total turnover comes to how much? 45 minus 5, that is 40 crore. Therefore, I have got two things. Export turnover 36 crore, total turnover 40 crore. Now I have to find out profit, which I have to multiply. And then I will take 50% of that, because this is the 6th year of business. What is profit? Profit is given here. The profit of the SSC is around, we have already computed the profit. We have computed the profit 33 lakhs. Now the question is whether we should take 33 lakhs or 29 lakhs. ICAI has taken two views. First view, ICAI has taken that you should take 33 lakhs, which is before loss. Second view, ICAI has taken you should take 29 lakhs, which is after loss. Both the answers are correct. But from both the answers, you have to reduce one thing, profit on sale of license. Because profit on sale of license, duty drawback and export incentives are not part of what? Are not part of what? Profit of the SEZ. Therefore, if you are taking 33 lakhs, remove profit on sale of license. How much is the profit on sale of license over here? 9 lakhs. Therefore, in that case, your profit will be 24 lakhs. If you are taking 29 lakhs, then remove 9 lakhs, then in that case, your profit will be 20 lakhs. See, they have taken both. In one case, in the original solution, they have taken 24 lakhs, that is 33 minus 9. But they have also given a note below and they have said that you can also take 24 lakhs. Therefore, that will be 29 minus 9, that will come to 20 lakh rupees. I hope it is clear to all of you. You can solve by either of the way. After doing this, you have to compute your deduction under what? SEZ of 10AA. How much deduction you will claim? Multiplied by export turnover divided by total turnover into profit into 50%. So that your deduction will come to how much? 10,80,000 rupees. Then you will claim one last deduction, 80 GGB, that is political party donation. Then you will apply your 30% tax, 4% cess, that will give your tax liability. I hope it is clear to all of you. Now the answer is not ended. After that you have to compute your adjusted total income. Adjusted total income is nothing but, because you have to compute AMT also, it is total income plus 10AA deduction. That is 15,20,000 plus 10AA deduction. This is your adjusted total income. On that 18.5% tax, 4% cess, that will give you ultimately your AMT liability. And then compare your AMT with your normal, whichever is higher. If AMT is higher, you will get your AMT credit. In this question, AMT is higher. Therefore, you can take AMT credit in this case of 26,000 rupees. I hope it is clear to all of you. Let's move on to question number 3 now. Question number 3 is on trust. Taxation of trust. There is a trust by the name called as Fit Me Foundation. Now they have received 125 lakhs as a corpus donation, and they have invested that corpus donation in private sector company. Not allowed. See, I have told you earlier also, corpus donation, if you receive, it is exempt provided you invest in the mode specified in 11.5. And if you see the 11.5 modes, private sector company shares are not covered in 11.5. If you invest in private sector company shares, it is not 11.5 mode. Therefore, you will not get the exemption. Sorry. Your exemption will be denied in this case. I hope it is clear to all of you. Second, apart from above, they have also received 95 lakhs other donation, which is voluntary donation, not corpus donation. Yes, they can claim exemption for that. And 60 lakh for fees for providing yoga services. Yes, yoga is also covered in charitable purpose. So for other contributions, for voluntary contribution and fees from yoga services, yes, for that they can claim 15% exemption, and on balance amount, they have to apply it for the purpose of claiming exemption. If they want exemption, they have to apply for the purpose of the trust. If they apply for the purpose of the trust, on the balance amount, they can claim exemption. I hope it is clear to all of you. Next one is a similar question which we have done earlier. Nagaraj is a founder of SSVB Trust. Okay. This trust is a hospital. Okay. So Nagaraj is a founder of the trust, and the trust is a hospital. Now, Nagaraj's son is admitted in the hospital. Is there any wrong if Nagaraj's son, that is the trustees or founder's son, is admitted to the hospital? No, there is nothing wrong. First of all, trustee's son or founder's son is a specified person under section 13 subsection 3. There is nothing wrong in admitting a trustee or founder's son in the hospital. There is nothing wrong. You can do it. But the question over here is, you cannot pass unreasonable benefit to them. To others, you are charging 5 lakhs. To Nagaraj son, you are charging 3 lakh rupees. That is wrong. Here, the lot of provisions of income tax law will apply. Like this extra 2 lakh rupees which you are providing, unreasonable benefit. On that, 115 BBI will apply. 30% flat tax. Then 271 AAE penalty will be imposed if you do for the first time 100% of unreasonable benefit passed on to the specified person. Second time, subsequent time, 200% of the unreasonable benefit passed on. And this 2 lakh rupees which you are incurring now, extra 2 lakh rupees, that will not be subject to what? Exemption also. So there are a lot of complications. We have seen a similar, but whether the registration will be cancelled? No, registration will not be cancelled. In such case, you have to bear 115 BBI. In such case, you have to bear 271 AAE. You will not claim, you will not get exemption under 11 and 12, but the registration will not be cancelled in this case. Don't worry about it. I hope it is clear to all of you. Okay. So this is what this question is all about. Now let's move on to the next question. Very, very beautiful question. Next question is also a beautiful question of DTAA. Mr. Ritesh is a resident individual aged 42 years. We have to compute total income and tax payable of Mr. Ritesh and follow old regime. We have to follow old regime for the purpose of calculation of tax. Now, the very first thing which we need to understand over here is, we will compute the total income of Ritesh in India. First, income from business in India, 4,85,000, that I will write here. Income from royalty from country N. Now, for that we need to read one additional information here, because India and country N has a DTAA. As per DTAA between India and country N, the royalty will only be taxable in the source state. Which is the source state? Source state is country N. Because Ritesh is a resident of India, therefore India is a resident state and country N is a source state, and the royalty earned from country N is taxable in country N only. Therefore, you do not take this in India, please. Do not take this in India. This is not taxable in India. Ignore this. I hope it is clear to all of you. What about interest from country Y? What about interest from country Y? For that we need to read, as per DTAA between India and country Y, interest can be taxed in both the states. So interest can be taxed in India also, India interest can be taxed there also. So interest you will take in India, and then in India we will give him a relief. TTAA relief we will give. Okay. Because it is written, the tax credit will be available in respect of tax payable in the resident state. So you will get the relief in India. So country Y you will get relief. Country Y interest you have to include. Now the question is, this is which interest? Because it is given in dollars, you have to convert in rupees as per Rule 115. And in Rule 115, for interest there are two rates. For interest other than security, it is last day of the TTBR, last day of the financial year TTBR. But for interest on security, it is the TTBR of the preceding month in which it is earned. So which interest it is? I don't know the nature of interest. It is not clearly written in the question that which interest it is. Is it written anywhere? Can you see whether it is interest on security or other than security? I am assuming other than interest on security so that I can take 31st March TTBR. You can assume interest on security also, but I am not assuming, even ICI is not assuming. ICI is also assuming interest other than security. So let's see the TTBR of 31st March, it is 80 rupees. So you will multiply 9,500 into 80 rupees. That will be the income which is taxable in India. And the third income, agriculture income in country M. So in country M, it is exempt, check please. But in India, foreign agriculture incomes are not exempt. So you will take this in the income. Okay. So ultimately, how much points, how much income will come in the total income? 3 income will come. Let's see, the total income will include which all things? One is business income from India. Then country N royalty will be taxable only in country N. So you will not take in India. Then country Y interest other than security, you will multiply by 80 rupees, 80 into 9,500. We are assuming to be other than interest on security. And then agricultural income, which is taxable in India, not taxable in country M. After that, you will compute tax on 13,54,000 and you will find out what average rate in India. The tax is 227,448 divided by 1354. The average rate in India is 16.798. Now we need to find out how much is doubly taxed income. Is this business income doubly taxed? No, it is only taxed in India. Is this royalty doubly taxed? No, royalty is taxed in foreign country. It is not doubly taxed. Is this 7,60,000 doubly taxed? Yes, it is taxed here also. It is taxed there also. Is this 1,09,000 doubly taxed? No. Country M agriculture income is exempt. Agriculture income is only taxable in India. Therefore, it is not doubly taxed. Therefore, only doubly taxed amount is 7,60,000. Therefore, on 7,16,000, you will apply India's average rate. India's average rate is 16.798. This is the tax payable in India on 7,60,000. Now, how much is the tax payable in foreign country on this particular income? Let's see. You have paid $950 in country Y. When you have paid on 21st of February. So you will now convert this tax into rupees as per Rule 128 now. So always remember, to convert tax, Rule 128 is there. To convert income, Rule 115 is there. Now we are converting tax. So you will apply Rule 128 on $950 which you have paid in country Y. For $950 at what rate? The Rule 128 says that last month TTBR. The tax is paid in February. Last month is January. January TTBR is 78. So you will multiply 950 into 78. That is the tax paid in foreign country. 950 into 78, 31st January TTBR, 74,100, whichever is lower will be allowed as relief from your total tax. So 74,100 will be allowed as a relief. I hope it is clear to all of you. Beautiful question it is. You can check it once. Now, next question. Next question is on TDS. Okay, you would have understood the pattern in which ICI is asking total income, then some questions on what trust, then some questions on TDS, etc. This is the pattern in which ICI asked the question in most of the attempts, including Jan 26 attempt. The pattern was same only. Now, TDS and TCS we need to answer. The very first question over here is, there is an Indian company, TAM Electronic Limited, which is importing certain computer software from a Japanese company, from a US company, JAM Electronics. So Indian company is importing some what? Computer software. But for what? For reselling it to end users in India. Now remember, there is a Supreme Court judgment on this, Engineering Analysis Excellence, long name is there. That if you purchase computer software, for what purpose? For reselling it to for reselling or for end use. If you are purchasing computer software for reselling or for end use, then the DTAA says that as per the Supreme Court judgment, as per DTAA, such amounts does not amount to royalty. It does not amount to royalty, and if it does not amount to royalty, you do not have to deduct TDS. You do not have to deduct TDS. Do you remember that? It was covered in the chapter of non-resident taxation. We have done that. That if you import computer software for end use or for reselling, it does not amount to royalty. Therefore, no need to deduct TDS. Next question. There is a public sector bank which paid 20 crore to a company that provides ATM network to the bank. as commission for facilitating ATM, debit card, credit card. So I am a bank. There is a company which is providing me some services. I have paid 20 crore to them. They are providing some ATM, debit card, credit card services to me. So I have paid 20 crore as a commission. Should I deduct TDS? No. 194H is not applicable in this case. This is a case law of UCO Bank, I think so. UCO Bank case law. 194H is not applicable. The reason is, I don't know the exact name of the case law, but this is the case law which is covered in our book also. 194H is not applicable because in the case law it was written there is a relationship of principal between bank and that agency. So if there is a principal relationship, 194H is not applicable. 194J is also not applicable because there is no human intervention or no manual intervention. It is totally machine intervention. So if it is a total machine intervention, then 194J is not applicable. To apply 194J, there has to be some professional services. There has to be some manual intervention. Therefore, neither 194H nor 194J will be applicable in this case. Question number 3 and 4 are very simple question. Question number 3 we have done so many times in class also, that I have come to you. You are a contractor. I have come to you and I have told you that you have to stitch shirts for me. You are saying cloth. I said that cloth purchased from me or from my associate entity. So if you purchase cloth from me or from my associate enterprise, and if you stitch shirts for me, then whenever I will make you a payment, I will deduct TDS. Now how much amount I will deduct TDS? If you provide me breakup, then I will deduct TDS on stitching charges on service portion. If you don't provide me breakup, then I will deduct TDS on the entire amount. On the entire amount, I will deduct TDS in that case. So in this case, that is only happening. I am telling the contractor to stitch shirts. The contractor is asking for the material. I am selling, take material from my related party under 48(2). So in that case, I have to deduct TDS. And also the contractor is providing a consolidated invoice. So I have to deduct TDS on the full amount, not on the service portion. I hope it is clear to all of you. Next one, there is a Canadian citizen, foreign citizen, which is a non-resident, which is a sportsman. So 194E will be applicable. So if you are a foreign citizen and if you are a non-resident, then the provisions of 194E are applicable. If you participate in matches in India, 20.8% TDS will be applicable, 20 plus 4%, 20.8. And if you earn some honorarium from writing an article in sports magazine, and even advertisement income will be also subject to 20.8% tax. I hope it is clear to all of you under 194E. But this is only applicable to non-resident sportsmen who are not citizen of India. You should not be citizen of India. Okay. Next question is a transfer pricing question on cost plus method. The ICI is very clearly writing which method to follow. Cost plus you have to follow. In cost plus method, what happens when I am providing some services or when I am selling some goods to my associate enterprise? First, I have to find out the cost with respect to my associate enterprise. Then step number 2, I have to find out the third party margin, arm's length margin. Then I will adjust the margin and I will apply on my cost. I will get my arm's length price. So here MNO Limited is an Indian company and MNO INC is a foreign subsidiary. Therefore, MNO and MNO INC are deemed to be associate enterprise. The transaction between them will be deemed to be international transaction. And HTY Hong Kong is a third party. It's an uncontrolled transaction. It's an uncontrolled transaction. First, we will see some basic information. You are billing MNO $85,000 per month. All data is per month. So we will make calculation on per month basis only. You are billing HTY third party $92,000. The direct cost is $120 per hour and indirect cost is $210 per hour. Now MNO works 9 hours for 18 days and STY works, for STY we work 18 days, 8 hours. So both are 18 days only, but for MNO, INC we are working 9 hours and for STY we are working 8 hours. Apart from that, some other informations are also given. Now we need to find out two things here. What is the margin of HTY? HTY margin, because HTY margin is third party margin, that we will apply on what? That we will apply on MNO cost. And that will give us our arm's length price. Let's try to find out the HTY margin now. What is the margin of HTY over here? First of all, the direct cost of HTY is 120 into 8 hours every day, 18 days. And indirect cost is $210 into 8 hours, 18 days. This is the direct cost of HTY. Okay. 47,520. Is this the only cost which when we provide services to STY? This is the only cost? No. There is one more cost which we have to incur when we provide services to STY. That is, when we provide services to STY, we have to give 1.5% of the direct cost as a warranty cost. That is also a part of cost. So 1.5% of the direct cost. 1.5% of the direct cost is 17,280. That is the total direct cost. Of that 1.5%, that also have to add back. So 47,520 is my direct and indirect cost, and 2.259 259 is my warranty cost. This is my total cost of my third party, and my billing amount for third party is $92,000 as you can see over here. Therefore, the differential amount will be my profit. This is my profit. This is my cost. Therefore, my margin is 92.55%. So this is my arm's length margin. Now I have to apply this arm's length margin on my cost. What is my cost when I provide services to whom? MNO-INC. So when I provide services to MNO-INC, same $120, $210, but I provide services for 9 hours and 9 hours. Days are same, only 18. And in case this is the direct and indirect cost. But when we provide services to MNO-INC, we also have to take a loan. Check over here. MNO-INC has given a loan to us of 1,20,000 to MNO Limited to purchase hardware at 4% per annum. But we are calculating the data for per month, therefore you have to divide by 12. So we have to also add the interest cost over it. $120,000 into 4% into 1 by 12, $400 we have to add additional cost. This is our total cost. Now on this total cost, you will apply the margin which we have computed over here, arm's length margin. After that, you will get your arm's length price and then find out the differential amount. I hope it is clear to all of you. It's a very good question of DTAA, of transfer pricing, which can repeat in the examination. Be careful. Okay. Next question, very simple question, nothing great as such. Question number 5. The first question, question number 5A, is a case law question of Pepsi Foods Limited. I will give you the background, what has happened in this case. I have told you this many times. We have done a lot of question in the class. Also, very important case law it is. Very important. Already a lot of time ICI has asked. Now, do you remember that within how much time ITAT has to pass an order under 254? ITAT generally has to pass an order within 4 years from the end of the financial year in which the appeal is filed. But the law says that if an assessee has asked for a stay from ITAT, then ITAT has to grant a stay, but for maximum 180 days, and in that case the order should also be passed in 180 days. Then the question is that can the stay be extended beyond 180 days? Yet it can be extended beyond 180 days if the delay in the appeal is not attributable to the assessee. The delay is attributable to ITAT. It is not because of assessee. Then you have to extend up to 365 days. Then the question is, can you extend beyond 365 days? The law says that you cannot. But here comes the Supreme Court in the case of Pepsi Foods Limited, which says that if the delay is attributable to ITAT, not to assessee, if the delay is not attributable to assessee but to ITAT, then beyond 365 days also you have to extend the stay. You have to extend the stay beyond 365 days also if the delay is not attributable to the assessee. I hope it is clear to all of you. This is what it was written in this particular case law. Next one is a question on board for advance ruling. There is an assessee by the name called as Ricky, who is a resident. He is agreed by the order of board for advance ruling. Now the question is that if a board for advance ruling passes an order, is it binding? No. It is not binding. You can file an appeal to High Court within 60 days. And if there is a reasonable cause, High Court can also give you extension for another 30 days. Therefore, total 90 days time is there. I hope it is clear to all of you. 60 plus 30. Then there is an Indian public sector company. It wants to go to board for advance ruling, but it has a concern that their case is already pending in front of ITAT. Can they go for a board for advance ruling? See, generally, you cannot go for board for advance ruling if your case is pending in front of Income Tax Authority, ITAT or any court. But for public sector company, there is a relaxation that in case of public sector company, if the case is pending in front of ITAT or if the case is pending in front of Income Tax Authority, still they can go for ITAT. Still they can go for board for advance ruling. For other assessee, this relaxation is not available. This relaxation is only available for public sector undertaking. Yes, for public sector undertaking also, if the case is pending in front of High Court or Supreme Court, they also cannot go. Public sector company can go to BFAR only if the case is pending in front of Income Tax Authority or ITAT. So that by that logic, they can definitely go for this particular thing. Okay. And one last question over here is question number 6. We need to identify whether GAR is applicable or not. In the very first question over here is, there is an Indian company which is making losses, which is doing amalgamation with another company. So that the losses can be transferred to the another company. Whether GAR will apply, GAR will not apply. See, GAR applies when? If there is a tax evasion case, GAR does not apply. If there is a tax planning case, GAR does not apply. If there is a specific anti-avoidance rule, then also GAR does not apply. If there is a no specific anti-avoidance rule and there is a tax avoidance, then GAR applies. Okay. Now it is a tax planning. There is nothing wrong. One entity is into losses, another is into profit. The losses entity is getting merged with profit entity. It is amalgamation. It is allowed as per income tax law. There is nothing wrong in that. Okay. The second question, GAR is applicable. There is one company, A Limited in India. There is another company, C Limited in India. Instead of directly giving the loan to C Limited, what A Limited is doing, it is making one entity in a tax haven, low tax jurisdiction. They are making one entity, B Limited. They are forming one entity entity in tax haven and they are purchasing the equity of that entity and telling that entity to give loan to C Limited. So rather than giving loan directly to C Limited, A is first giving money to B and ultimately B is giving money to C. Therefore, GAR will apply in this case because it is round tripping of finance, you can say, or you can say B Limited does not have any commercial substance, because in the question is also it is written there is no other activity in B Limited. B Limited is not formed for any other purpose. It is only formed for doing this transaction. Therefore, you can use two important sentences. One, this is round tripping of finance, GAR will apply. Second, B Limited does not have any commercial substance. It lacks commercial substance. Therefore, GAR will apply in this case. And last but not least, there is an entity which is making one unit in SEZ. There is nothing wrong in making unit in SEZ. You can claim deductions by making unit in SEZ. It is clearly a tax planning case. Therefore, GAR will not apply in this case. Okay. I hope it is clear to all of you. And one last question is on declaration of a person as an agent under section 163. We need to say whether the following person can be declared as an agent under section 163 or not. The AO of Mr. Albert, a non-resident, wants to treat the following person as his agent. Now, first, Mr. Albert has a house in Goa. Now, during the year, he is selling this house to Mr. D'Souza to another non-resident. Now, AO wants to treat Mr. D'Souza, that is the buyer, as an agent. Can he declare the buyer as an agent? The answer is yes. Why, sir? Because it is written in section 163 that if a non-resident sell house to another non-resident in India, or if a non-resident sells house or any capital asset to another resident in India, then the buyer can be treated as a resident. Then the buyer can be treated as an agent. Here, who is selling the house? The house is sold by Albert. Albert is a non-resident. It is sold to whom? It is sold to D'Souza. D'Souza is also non-resident. Where it is sold? It is transferred in India. If a capital asset is transferred in India by NR to another NR, then the buyer can be treated as an agent, and he will be responsible for filing the return, for declaration of for filing of return, for replying to the notices, for making payment of taxes, for all the proceedings under the income tax law. The buyer, that is the agent, will be responsible. Second case, Mr. Albert employed Mr. Rakesh. Can an employee also be an agent? Yes, employee can be an agent. The very first point in the definition of agent is employee only, provided the employee should be employee in the current year. Albert was employee, Rakesh was employee of Albert in the last year, not in the current year. He left the company, check. He left Albert in the current year. Therefore, now Mr. Rakesh cannot be held as what? Held as an agent. Yes, if he would have continued an employee in the current year, he could have been held as what? Agent. Otherwise, he cannot be held as agent. To call any person as an agent, you should do the activity in the current year, not in the past year. Okay. I hope it is clear to all of you. So this is what this paper is all about. So let's go ahead with the next paper, that is paper number 3, May 2023 paper. Beautiful paper. It is one of the best paper. Very first question, you are supposed to compute total income and not as per 115 BAA, not as per 115 BAB. Let's start. Assessee is a manufacturer. Assessee has a net profit of 1 crore 25 lakhs. The very first expenditure done by the assessee is an advertisement of 1.6 lakh in cash. First of all, mistake number 1. Mistake number 2, it is done to a sister concern. Mistake number 2. So you are violating 48.2 also, 48.3 also. You are making excess payment to related party. You are also making payment in cash. So I've told you in class, if both the mistakes are done at the same time, you have to follow the order of the section. First apply 48.2, then balance amount. If it is more than 10,000, then it is applied, then apply 48.3. So first disallow the excess amount. The 1.6 lakh is the total amount. The market value is 52,000. Therefore, disallow the excess amount. 1,08,000 disallow first, and then balance 52,000 you can disallow under 48.3. So ultimate treatment 1,08,000 will be disallowed under 48.2 and 52,000 will be disallowed under 48.3. I hope it is clear to all of you. Now next adjustment, you are doing some repair to plant and machinery of 1.8 lakh towards replacement of some worn out part and machinery, worn out parts of the machinery. So replacement of worn out part of the machinery is considered to be a revenue repair. It is considered to be a current repair. You can claim that as a deduction under section 31. It's not a very substantial repair where the capacity of the machine is increasing. There is nothing like that is happening. If that is happening, then capital repair not allowed under 31. But it is a revenue repair. It's a current repair. You can claim that as a deduction. Okay. I hope it is clear to all of you. Adjustment number 3, very straightforward adjustment. You used to include interest in the interest cost in the closing stock till last year. So till last year, you used to make a mistake that you used to interest costs in the opening and the closing stock. But in the current year, you have changed the policy. You have done everything correct and you have reduced the profit of the current year also. You have made all the rectification properly. So if you have done everything properly, now no effect. No need to do anything because you have done everything correctly now. So why do you have to give any effect? If they would have not done correctly, then we would have given any effect. Now, otherwise there is no need. Okay. Next adjustment number 4. One of your executive was on business trip. He died there. So one of your employee was on business trip. He died. So as a voluntary gratitude payment, you are making some payment of 2 lakh rupees to his family as a gratitude, out of courtesy, out of concern. So whether that can be claimed as a reduction, why not? The employee is dying on a business trip, not on a personal trip. Therefore, you can claim that as a reduction. There is nothing wrong in that. You can claim under 37(1). Okay. Next one, capital expenditure. You are incurring 1.8 lakh rupees on promoting family planning. So family planning promoting expenses are allowed only to company first of all. Second, if it is a capital expenditure, it will be allowed 1/5. Therefore, you have to add back 4/5. You cannot add back. You cannot claim deduction of full 1.8 lakhs. You have to add back 4/5 of the 1.8 lakhs. Okay. Next one, you are paying some retrenchment compensation of 14 lakh rupees on closure of one of the unit. Now, I have told you the treatment of retrenchment compensation paid to the employees in the class. See, if you close the entire company and you pay retrenchment compensation, it is not allowed. So, if the entire company is closed and now you are paying retrenchment compensation, it is disallowed. But if one of the unit is closed and if you are paying a retrenchment compensation, then that is allowed as a reduction. So this will be allowed as reduction because here one of the unit is closed, entire company is not closed. Next adjustment we have done earlier, you have taken some loan from a cooperative bank for working capital. So you have taken a working capital loan from a cooperative bank. Now the bank is waiving the principal and the interest both. So waiver of principal will be termed as remission and cessation of a trading liability. Therefore it will be taxable. So let it be part of EGBP income. If a working capital loan is taken and if it is waived by bank, it is considered to be remission and cessation of a trading liability. Let it be part of PGBP income. What about waiver of interest? Waiver of interest will not be taxable. Why? Because it was not allowed as a deduction earlier on accrual basis. Interest is allowed on payment basis as per 43B because it was not allowed as deduction earlier. So now you cannot tax that also. I hope it is clear to all of you. Next one. You are contributing to some employees pension scheme. How much you are contributing? 12% of basic plus DA in terms you are contributing. So that's good. You can contribute up to 14% of basic plus DA in terms. You are contributing only 12%. So fully allowed. There is nothing wrong in this. Okay. Next one. There is a mark to market loss. This adjustment is coming for the first time, but it will come again and again from here onwards. There is a mark to market loss of 6 lakh rupees in respect of an unsettled derivative. Now what should I do? So generally mark to market loss is allowed as deduction under section 36 subsection 1 clause 18. But it should be as per ICDS, and ICDS says that only mark to market loss of settled derivatives will be allowed. Mark to mark loss of unsettled derivative will not be allowed. Therefore this 6 lakh will be disallowed. What about this mark to mark margin? Margin is realized in the next year. It is not realized in the current year. Therefore no effect in the current year. Next year we will see. And next year question we are not doing, we are doing question of current year. Okay. Next one, very routine adjustment. Provision for gratuity based on actuarial valuation disallowed as per 48.7. 48.7 does not allow provision for gratuity. But actual payment of 2.75 lakhs will be allowed as deduction. So you can claim 2.75 lakh as deduction and add back 4 lakhs. Next, some additional information is given. The assessee has invested in a private company in which assessee holds 16% shares. So if I hold 10% or more voting power in a private company is nothing but a closely held company, and if that company gives me a loan, that is deemed dividend in my hand under 222E, but the deemed dividend cannot be more than accumulated profits. So how much loan they are giving me? They are giving me loan of 4 lakh rupees, out of which the deemed dividend will be how much? The deemed dividend will be only 1 lakh because the accumulated profits are only 1 lakh. So 1 lakh will be taxable in my hand under income from other source. Next, I am giving some iPhone to my distributors, 5 iPhones of 60,000 rupees each. Total 3 lakh rupees iPhone I have given, but I have not deducted TDS. I should deduct TDS under 194R because I am giving benefit and perquisite in business. And if I give benefit and perquisite in business of more than 20,000 rupees, I should deduct TDS under 194R at the rate of 10% if the payee is a resident. I am not deducting TDS, therefore 30% of the expenditure will be disallowed because it is written in the question that this expense is already debited to the business promotion expense. You are already debiting this to PNL, therefore I will disallow 30% of 3 lakh, which is what? 90,000 rupees. And last but not least, you have contributed 3.5 lakh to approved electoral trust by RTGS. So this can be claimed as a deduction under 80 GGB. Okay. So this is what this question is all about. Nothing great. Yes, some adjustments were new, but it was very easy. Nothing great as such. Question number 2. Part A is very simple, but part A2 is very, very good. Part A, Mr. A, aged 34 years. He is a salaried employee. He is earning the following income. We need to answer what is the total income of this person. We need to compute total income, and he has not opted for 115 BSc, so we have to compute as per old regime. Okay. First, gross salary 23 lakhs. From that old regime, because old regime is following, we will take 50,000 standard deduction. Okay. Then business loss 4.5 lakh. You cannot set off against salary, therefore carry forward. Then short-term capital loss 3 lakh 60. Again, you cannot set off short-term capital loss against salary, therefore carry forward. Then you have purchased some bitcoins at 1000 rupees, which is virtual digital asset, and you have sold for 1300. Transfer expense not allowed. In case of virtual digital asset, transfer expenses are not allowed. So you have purchased for 1000, you have sold for 1300. Therefore 300 is the profit. That profit multiplied by number of bitcoins 1000, that is 3 lakh rupees, will be subject to tax at flat 30% tax plus cess. So the ultimate income will be 23 lakhs minus 50,000. Rest of the two losses carry forward, and this will be considered as taxable at flat 30%. I hope it is clear to all of you. Okay. Now the next question is a beautiful question. It will take time for you all to understand if you have not read this provision properly with me in class. We have done 3 circulars on this. That is the partnership firm provisions of 9B and 45.4. Let's go through the question first. There are 3 partners, L and MM, of a partnership firm since 1997. Now L retires from the firm on 27th of July. The capital account of L shows a balance of 20 lakh rupees. There is no revaluation of asset in the books of accounts after 2005-6. Now, so L is retiring. So if L is retiring from the firm, it will be called as reconstitution of the firm. And if there is a reconstitution of the firm, then 2 sections will apply. First 9B will apply, and then 45.4 will apply. Now what is the firm giving to partner? The firm is giving partner 3 things. One is cash, one is stock, one is land. So now we will apply 9B. 9B is applicable if there is a reconstitution of the firm and the firm gives capital asset or stock in trade to the partner. If stock in trade is given, then the firm will be liable for PGBP, and if capital asset is given, then the firm will be liable for capital gains. Now the firm is giving both. Capital asset is also given, stock in trade is also given. Let's talk about stock in trade. 9B. How will you compute the PGBP income? FMB of the stock in trade minus the cost. The FMB of the stock in trade today is 2 lakh rupees. What is the cost? 1.2 lakhs. Therefore 80,000 will be chargeable under PGBP in the hands of firm, and therefore on that the firm will pay 31.2% tax. Then the firm is also giving to the partner what? Money. Money is not covered in 9B. The firm is also giving capital asset to the partner. Yes, that is covered in 9B. What is the market value of the capital asset? Land. The market value of the land today on the date of transfer is 17 lakh. The land was purchased for 60 lakh, but the FMB of the land was on 1/4/2001 was 1,10,000. Therefore, I will take 1,10,000 as the market value as the cost, because the asset was purchased prior to 2001. Therefore, 15.9 lakhs will be the capital gains in the hands of firm as per 9B. On that, the firm will pay 12.5% plus 4% cess, that is 13% tax. 9B is over. 9B, there are 2 tax they have to pay. Stock in trade, 80,000 into 31.2%. Capital gains, 15.9 lakhs into 13%. Now we will come to what? 45.4. What is 45.4? 45.4 is nothing but A is equal to B plus C minus D. That is 45.4 capital gains. What is A, sir? What is A? A is your answer. What is B? B is your money received. How much money you are receiving? You are receiving 1 lakh money, so I am writing money 1 lakh. What is C? C is the market value of the capital asset received. What is the market value of the capital asset received? 17 lakhs. Minus what is D? D is the capital account balance. What is the capital account balance? It is 20 lakhs. But that is where most of the students will do mistake. Don't write 20 lakhs directly. First, you have to readjust the capital by adjusting the profit, book profit, by adjusting the accounting profit, and by adjusting the taxes. So first, you have to readjust the profit. How? What all things the firm is transferring to the partner as per 9B? The firm is transferring to the partner as per 9B stock, and then as per 9B, it is also transferring capital asset. It is transferring stock at what price? 2 lakhs. What is the cost of the stock? Cost of the stock. Is it revaluing? Yes. Check please. The stock is getting revalued at what? 80,000 rupees. So the book profit, accounting profit will increase by 80,000 rupees. What is the second thing that the firm is giving to the partner as per 9B? The second thing that the firm is giving to the partner as per 9B is land. Is the land getting revalued? No. Land is already valued at 17 lakhs and you are transferring the land at 17 lakhs. So for the land, there is no change in the accounting values. The accounting value is remaining same only. But for stock in trade, the accounting value is changing. The stocks were recorded at 120, but they are transferred at 2 lakh. Therefore, there is an increase of profit of 80,000 rupees in books of account. But for land, there is no increase in the profit. Therefore, there is only an accounting profit increase in case of stock. From this increased profit, they will pay two tax. 24,960, that is 31.2% on 80,000, and 13% on 15.9 lakh, that is 2,06,600. So from 80,000 is the increase in the accounting profit, and there are two taxes they have to pay. So there is a net loss of 1,51,660. That will be shared between all the three partners, assuming that the share of profit is equal. So 1,51,660 divided by 3 will come to 50,553. So that is the loss which will be given to partner who is leaving the firm. That is partner N, whomsoever it is, L. So 20 lakh is the partner capital account minus 50,553 is the loss. So ultimately this difference is negative and this is positive. Therefore positive minus negative will come to negative. Therefore the loss is that if B plus C minus D is negative, then take as 0. So after doing all these things, ultimately we got the answer as 0. I hope it is clear to all of you. We have done 3 circulars based on this. Go and check with our question bank. Okay, I hope it is clear. Beautiful question it was. Question number B. There is a foreign company, XYZ INC, which is in Korea, which is entering into an agreement with an Indian company, XYZ Limited, and they want to provide some services with respect to setting up of a power plant in Gujarat, India. Now, they are providing some offshore services. Are the offshore services taxable? Yes, taxable. They are also providing some onshore services. Onshore services are also taxable. What do I mean by offshore services? Offshore means they are providing from outside India. Onshore means they are coming to India. Both of them are taxable because it is an FTS. It is a fees for technical services, and in case of fees for technical services, in case of royalty, in case of interest, it is not necessary that you should come to in India provide service. The services should be utilized in India. Yes, the services are utilized in Gujarat. That is sufficient. There is no need to come to India and provide services. Both of them are taxable. Therefore, this is taxable. Yes, this for offshore service they are charging 3 crore rupees. This 3 crore will be taxable. For onshore services, they are charging 2 crore. This 2 crore will also be taxable. But this 2 crore they are discharging by what? By way of debenture. This 3 crore they are discharging through bank account. But this 2 crore they are discharging by debenture. So they are providing us what? They are providing us onshore service, and in return we are giving debenture. So that 2 crore is also taxable, and interest on that 2 crore debenture will also be taxable for 7 months because the debentures were issued on 1st September. Therefore 2 crore into 6% into 7 by 12, this will also be taxable. So in all there are 3 incomes which will be taxable in the hands of ABC INC. One is onshore service of 2 crore, offshore service of 3 crore, and interest on debentures. All 3 of them will be taxable in India. They have only asked to discuss the tax implication. They have not asked to compute tax, so I am not computing taxation and all. I am just giving the treatment. What will be the treatment? I hope it is clear to all of you. Let's go to the next question. Question number 3. In question number 3, there is part A. Part A, very simple. There is a charitable trust which is providing some benefits to public. Apart from that, it is also giving interest-free loan to its employees. Now the AO is saying because you are providing interest-free loan to your employees are covered in 13(3) specified person. Therefore, I will withdraw your tax exemption. The answer is wrong. First of all, employees of the trust are not covered in the specified person definition. Employees are not covered. There is a case law of Tata Trust also, which is there in the first page of our textbook of taxation of trust. You can go and check over there also. And I have told you in the class also, I made you write separately that the employees of the trust are not covered in specified person. Therefore, if you pass any benefit to the employees of the trust, it cannot be called as violation of section 13 subsection 3. Therefore, the AO cannot withdraw your tax exemption. He cannot withdraw because of this reason. Therefore, the AO is incorrect. Second question is a beautiful question of DTAA. Here you have to take 2 views. First of all, you are supposed to compute total income and tax liability of Mr. Rizvi, and you have to follow old regime. You have to keep this thing in mind first of all. Now, first of all, we will find out the residential status of Mr. Rizvi. Rizvi is an Indian resident, aged 35 years. He was working in Valley oil fields in country Sasa as a superintendent, and he was earning AED 9,500 per month. Now, his mother was not well. His mother is staying in Mumbai. She was not well. So he left everything and came back to Mumbai. He shifted to Mumbai on 1st of July 2025 permanently. Now definitely he is a resident because he is coming to India on 1st of July. So from 1st of July till 31st of March, obviously he is staying for 182 days or more. He is definitely resident. There is no doubt about it. But is he ordinary or not? There is a doubt about that. We don't have the data of the last 10 years. We don't know how many days he has stayed in the India for the last 10 years. For last 7 years he was staying in India for how many days? I don't have that data. Therefore, we can assume both. First assumption we can take, he is an ordinary resident. The easy assumption we can take is a not ordinary resident. If he is an ordinary resident, then world income will be taxable. And if he is a not ordinary resident, then only income which is accrued in India, which is received in India will be taxable. Let's assume that he is an ordinary resident. Then world income will be taxable. Which all income will come? First of all, 3 months he was working there as a salary and he was earning salary there, that will also be taxable, because for ordinary resident world income is taxable. 9,500 into 3 months into what is the rate, 23, this will come. Then he has come, when he came to India, he has given his property on let out in country, in his country at 3250. So when he came from July to India, from July he has given the property on rent. So 9 months rental income will also be taxable, minus 30% standard deduction. Then business income in India will be taxable, fixed deposit interest will be taxable, saving bank interest will be taxable, dividend income will be taxable. Yes, he can claim 80 TTA also as a deduction under chapter 6A, because he is following old regime. And then you have to apply the tax rate in India, find out the doubly taxed income, find out the average rate in India, and then apply the doubly taxed income or average rate, whichever is lower on that. Okay, the tax rate in foreign country is 23%, find out the tax, then it becomes a routine question. But the easier answer to assume is, let's assume that he is not ordinary. If he is not ordinary, then only income which is accrued in India, income which is received in India will be taxable. Therefore, salary income will not be taxable because it is accrued outside India. House property income will not be taxable because that is also accrued outside India. Business income will be taxable. Fixed deposit will not be taxable because that is also accrued in country. Yes, FD, saving bank interest can be taxable in India. Dividend income can be taxable in India, and then 80 TTA he can claim on saving bank interest. That's it. No double taxation, no double taxation relief, no need to find out average rate in India, nothing to do. Because there is no double taxation only now, only Indian incomes are taxable, the double taxation cannot happen only. Therefore, it is very easy to make this assumption. Therefore, the answer to this question is very long. In first assumption, they have taken everything. They have found average rate in India, which is 21.25. Then they have compared that with foreign rate, whichever is lower. In second assumption, very simple, nothing will get taxed, only business income in India, SBI interest this, and then 80 TTA deduction he can claim, and then 1 or 2 mediclaim deductions are also there that you can claim, you can check. 48,000, 60,000 he has incurred for his father and himself, etc. That you can claim as a 80 deduction. That's it. So whatever assumption you want to make, you can make. Okay, that is your choice. Let's move to the next question, question number 4. Which is on TDS. There are 2 questions on TDS, and then there is a transfer pricing question, question number 4A1. Now what is this particular question all about? Good question. There is a person who is providing me what? Technical consultancy. So if a person is providing me technical consultancy, let's assume that it is fees for technical service. I have to deduct TDS at the rate of 2%. But the other person is going to assessing officer and getting a lower deduction certificate of 1%. And is giving that certificate to me, then I have to deduct TDS at 1% only. Generally, I have to deduct TDS at 2%. If it is a technical service, then 2%. If it is other professional service, then 10%. But if the payee is going to assessing officer and getting a lower deduction certificate, giving it to me, then I have to deduct TDS at 1% only. I hope it is clear to all of you. Second question, very simple. I am purchasing a house of 60 lakh rupees. The stamp duty value of the house is 82 lakhs. So therefore, I will deduct TDS at the rate of 1% on whichever is higher under 190 for IA. So therefore, the consideration is 60 lakh, but the stamp duty value is 82 lakh. Therefore, I will deduct TDS on 82 lakhs, 1% TDS. I hope it is clear to all of you. Next question is a question on transfer pricing. Good question, but simple question. But it's a good question. We are supposed to compute arm's length price in point number A. Now, let's try to understand who are the assessees over here. There is a Shahi Private Limited, which is an Indian entity. And there is a Sumi INC, which is a Japanese entity. And the Indian entity is wholly dependent on the raw material of the Japanese entity. So, if the Shahi Indian entity is wholly dependent on the raw material of Sumi Japan, then both of them are deemed to be a source enterprise. Why? Because if one enterprise is dependent on other enterprise 90% or more for raw material, then both of them are deemed to be a source enterprise. Here it is not 90%, here it is 100%. Therefore, both of them are deemed to be a source enterprise. Now, Shahi is importing goods of 30 crore. Now, we need to find out the arm's length price of this. Now, there is some mathematical game which we need to understand over here. You are purchasing goods of 30 crore from Sumi. So, this is your price which you are paying to Sumi. This is your purchase price. On that, Sumi is charging 20% markup to you. Markup is always on cost. So, if it is 20% on cost, that is 1/5 on cost. But 30 crore is not cost for you, it is sale for you. So, it will be 1/6 on sale. Therefore, the cost will be 1/6 profit I have to remove from here. 30 crore, 1/6 will come to 5 crore. Therefore, the effective cost for Sumi will be 25 crore. So Sumi's cost is 25 crore plus Sumi is charging profit of 1/5 of cost, that will come to 30 crore, and 1/6 of sale, that will come to 30 crore. Therefore, the cost of Sumi is 25 crore. So Sumi is charging us more margin. We don't want this margin, we want arm's length margin. The arm's length margin with respect to unrelated party is 10% on cost. Therefore, now I will apply 10% on the cost. So first I will find out the cost of Sumi. On that I will apply 10% cost, 10% margin. I hope it is clear to all of you. Because 30 crore is the selling price. I will reduce the profit from that. Then I will get the cost. On that I will apply arm's length margin. Arm's length margin is 2.5 crores. So now ultimately the selling price is coming to 27.5 crore. Now, Sumi is providing me one more services. Sumi is providing me to use the brand name of Sumi without any payment. For that, the annual cost of the brand value is approximately 90 lakhs. So that also Sumi will charge me. Obviously, Sumi will not give me to use that brand value without cost. Obviously, they will charge some money. So they are charging 90 lakhs. So I am adding 90 lakhs, 0.9 crore to this. Therefore, ultimately, the final price, the actual arm's length price should have been 28.4. But how much we are paying? We are paying 30 crores. Therefore, differential amount should be added back. That is the amount of arm's length price which will be added back. Now, part 2. If the TPO increases the income, suppose TPO increases the income by 2 crore. TPO further increases the income by 2 crore. Can I claim deduction of 10 AA on 2 crore? No. You remember that? If the officer increases the income, then on increased income, you cannot claim chapter 6 deduction and 10 AA deduction as per 92C subsection for first proviso. As per first proviso to 92C subsection 4, if the AO or TPO increases your income, then you cannot claim what? You cannot claim 10 AA or chapter 6 deduction on that. I hope it is clear to all of you. Third one. Will Shahi Private Limited become liable for penalty for under-reporting of income based on the report of the transfer pricing officer? No. See, 270A penalty is imposable when if you don't report the transaction in Form 3CB and if you don't maintain proper documents as per 92D. Now, it is nowhere mentioned in the question anywhere that the Shahi is not maintaining documents, Shahi is not reporting in the transaction. It is nowhere mentioned anywhere. So, if you don't do this, then directly 200% penalty is imposable on you as a misreporting of income. But if you maintain documents properly, if you report Form 3CB properly, then the penalty under 270A will not be imposed on you. Therefore, unnecessarily, we will not impose penalty on this particular assessee. So, this is what this question is all about. Now, let's go to the next question. Beautiful question. 3 case laws are there. First case law has now become an amendment. What is the first case law? I will tell you the background of the first case law. There was an assessee who has deducted the TDS, but he failed to pay the TDS on time by 7th of the following month. But he has rectified his mistake before the date of filing the TDS returns. So, for example, for the month of April, you have to pay the TDS by 7th of May. So, he did not pay by 7th of May. But before 31st July, before filing the TDS returns, he has paid the TDS. He has paid the interest and he has filed the TDS returns also. Still, the assessing officer has imposed penalty. Assessing officer has imposed prosecution proceedings against the assessee. So, the Supreme Court of India said that you cannot do that. If the assessee has suo motu rectified the mistake, paid the tax, paid the interest, filed the TDS returns on time, then you cannot impose what? Prosecution proceedings. So, the CBDT liked that judgment and CBDT made that as a law. The CBDT passed an amendment in 2024. And the amendment was that if an assessee has failed to pay the TDS on time, but he has paid the TDS before the filing of TDS return, and he has paid the interest also and he has filed the return also, then you cannot impose prosecution against him. Initially in Finance Act 2024, they made this amendment for TDS, but in Finance Act 2025, they made this amendment now for TCS also. So for TCS also, if you fail to pay the TCS on time, but you rectified your mistake before the due date of filing the TCS return, you paid the TCS, you paid the interest, you filed the return, then nobody can impose any prosecution against you. I hope it is clear to all of you. Second question. Second question was, there was an assessee who has initiated some MAP proceedings under DTAA between India and foreign country. What is MAP proceeding? Mutual agreement proceedings. You know that if you are covered under DTAA and there is some wrong thing happened against you, which is not as per DTAA, the taxation of the assessee is not as per DTAA, then you can approach the taxes, you can approach the competent authority of your nation, then the competent authority of India will talk to the competent authority of foreign country, they will try to resolve the matter through MAP proceeding. The tribunal can also come in between, international arbitral tribunal may also come in between to resolve the issue. So there was something like this which was pending in case of assessing. So this is one of the proceeding which was going on. Now at the same time, the assessing officer is imposing interest under section 220, declaring the assessee is assessee in default. Because assessee might have done some violation. Now the assessee is making argument, because my MAP proceeding is already pending, you cannot initiate a proceeding, any other proceeding under the income tax law against me and declare me as an assessee in default. So the matter went to Supreme Court. The issue under consideration is, if MAP proceeding is already pending at international level, can the assessing officer in India can initiate other proceeding? The answer is yes. The Supreme Court said that MAP proceedings and the assessing default proceedings are independent of each other. They have nothing to do with each other. If we make a conclusion like that, if MAP proceeding is pending, the AO cannot do anything else, then everybody will deliberately start with a MAP proceeding, so that the AO cannot touch you. Therefore, MAP proceeding is independent and all other proceedings are independent under the income tax law. I hope it is clear to all of you. Beautiful case law. Now, again a beautiful question on section 911, business connection and significant economic presence. What is a significant economic presence? If a non-resident is doing transaction with a resident for any goods, services, and if the payment is exceeding 2 crore rupees, then that amounts to business connection. The non-resident has to do transaction with resident. Then the transaction will be subject to business connection. It is significant economic presence and it will be taxable in India. It will be deemed to accrue or rise in India. So let's try to understand what is exactly happening in this question. Kiwi Inc. is a company which is engaged in manufacturing and selling of mobile phones globally. So they are selling mobile phones across the world. One mobile phone is sold for $2,000. Alpha Inc. is another company based in USA which is having a website like Amazon. So Alpha Inc. is working like Amazon. It's an e-commerce operator. Gamma LLC is a company incorporated in UK. They are engaged in manufacturing and selling of printer. So there are three entities. One is Kiwi, which is selling mobile phones. One is Alpha, which is running like a e-commerce operator. One is Gamma, which is engaged in manufacturing and selling of printers. Now Kiwi is selling 80,000 mobile phones. How? How and to whom? Both the questions are important. Three questions are how, to whom and how much. It is selling through Alpha, that is through a website. Okay. To whom? To a person resident in India, taxable. Now we need to check if it is crossing 2 crore, then significant economic presence is there. 15,000 mobile phones into $2,000 into what is the rate of dollar over here? It is 80 rupees into 80 rupees. It is definitely crossing 2 crore, therefore it is taxable. Because you are selling to Indian residents through a website, therefore it is taxable. It is deemed to accrue or rise in India. Second, you are not selling to Indian residents, therefore not significant economic presence. Third, again you are selling to residents through your own website. That is also taxable. To your own website, your website is outside India, but you are selling to Indian resident, that is deemed to accrue or rise in India. Again 7,000 into $2,000 into 80 rupees. It is crossing 2 crore. Fourth one, again you are not selling to resident, therefore not taxable. Fifth one, you are selling to resident but through a physical store in US. This will not be subject to tax. This is very common sense here. You are going to UK or you are going to US and doing some shopping over there in a physical store. So whether that physical store will come to India to pay tax in India? Obviously no. Obviously no. This is not applicable to the physical stores which are there. This is only for digital transactions. Significant economic presence. This will not be subject to tax. Now one more transaction is there. Gamma LLC enters into a contract with Alpha for publishing an advertisement on the website for the period. Now the Gamma paid $50,000 for advertisement in India for Indian customer deemed to accrue rise in India. I have told you in the class, remember, if Samsung is telling Facebook that do advertisement for me, now the Facebook is asking Samsung, which is your target customer? If your target customer is India, then that advertisement income is deemed to accrue rise in India. But if your target customer is UK, then that advertisement income will not be deemed to accrue rise in India. So this 50,000 is targeting Indian customer, therefore it is taxable. This 20,000 is targeting advertisement in UK, therefore this will not be subject to deemed to accrue rise in India. I hope it is clear to all of you. And one last question over here, which is on This last question is on SFT reporting. Whether the following transactions will be reported in SFT by the reporting entity or not, we need to answer this. Let's see. First, Mr. A is purchasing 5 bank draft of 3 lakh each from a current account with State Bank of India. No, it will not be reported. If you purchase a bank draft of 10 lakh or more, it will be reported by the bank only if you purchase in cash. Here you are not purchasing it cash, you are purchasing in online mode through your current account, therefore it will not be reported. Second transaction. You are making 2 time deposits, one of 7 lakh, one of 5 lakhs, total 12 lakh. It will not be reported. Why, sir? Time deposit of 10 lakh or more if you make, then it will be reported in SFT. But the renewal is not covered in 10 lakh. Fresh 10 lakh is covered. 7 lakh is fresh. 5 lakh is renewal. This will not be covered in 10 lakh limit. Therefore, only 7 lakh FD is made for the purpose of SFT. Therefore, this will not be reported. Third, credit card. Credit card transaction will be reported when? If the credit card bill is paid in cash of 1 lakh or more, or the total credit card bill of the entire year by any mode is 10 lakh or more. Now, the cash payment is 19,500 each month in cash from April to July for 4 months. Now, this is not exceeding 1 lakh. Wait. But one more cash payment is made. Check from Jan to March. Now, if I take the first and the third transaction, the cash payment is exceeding 1 lakh. It is 1 lakh or more. Therefore, the first transaction will be reported, third will be reported, second will not be reported because second is made through online payment and therefore that will not be reported because for online payment, the limit is what? The limit is 10 lakh and it is not crossing 10 lakhs. The first and the third transaction will be reported, the second one will not be reported. And last but not least, if I am a assessee who is subject to tax audit, and if I sell any goods or provide any services and if I receive more than 2 lakh rupees, in cash, not exactly 2 lakh, more than 2 lakh in cash, then SFT is required. If it is exactly 2 lakh, then SFT is not required. In this case, check, it is exactly 2 lakh, therefore no SFT. I hope it is clear to all of you. Very minute thing they ask in examination. If it is, go and check the SFT limit. For tax audit assessee, if they sell anything and receive more than 2 lakh, then SFT is required. It is exactly 2 lakh, SFT is not required. Whereas, if you receive exactly 2 lakh, SFT is not required. But 269 ST penalty will be imposed on you. Because in the provision of 269 ST and 271 DA penalty, the limit is exact 2 lakh. But for SFT, it is more than 2 lakh. See that inconsistency between the law. I hope it is clear to all of you. Check it, please. So, this is what this beautiful paper is all about. Check it, please. Then we will go ahead with the next paper. Let's move on to the next paper, that is November 2023 paper. The very first question is of a domestic company. We are supposed to compute what? We are supposed to compute the book profit and the minimum alternate tax. Ignore the provisions of normal tax. Okay, just book profit and MAT we have supposed to compute. The net profit of the assessee is 89 lakhs. The first expenditure is expenditure pertaining to 10AA. Now the expenditure pertaining to 10AA are not added back. They are subject to MAT. So let it be like that only. Don't do anything. Next, depreciation as per Companies Act. What happens with depreciation as per Companies Act? You add back depreciation and then you reduce other than revaluation. In this question, there is no revaluation. Therefore, add back 30 lakhs and reduce, add back 34 lakhs and reduce 34 lakhs. There is no revaluation in this question. Therefore, you can do two things, write a note or you can add 34 and less 34. Both the answers are correct. Next, interest to financial institution not paid. It doesn't matter. In a MAT, it does not add back. Penalty for infraction of law. It doesn't matter. In MAT, it is not added back. In normal provision, it is added back. Then proposed dividend add back. Provision for income tax add back, transfer to general reserve add back, and then expenditure pertaining to ATIA do not add back. It is a part of MAT liability. Okay, let it be part of MAT. Okay. Next one is a very intelligent adjustment, which is credit to the statement of penal account. Amount withdrawn from reserve created during 22-23. Generally, if you withdraw an amount from reserve and credit to PNL, you should reduce from book profit. But in this case, I will not reduce, because the book profit of 22-23 was not increased by such reserve. It is very clearly written in the law that you can reduce from the book profit only if the book profit of earlier year was increased by such reserve. Now, if that was not increased by such reserve, you cannot reduce that. I hope it is clear to all of you. Next, profit from 10AA, let it be part of MAT. MAT is applicable on 10AA. Profit from ATIA, let it be part of MAT. MAT is applicable on ATIA. Deferred tax credit, you can reduce. Deferred tax credit is not subject to MAT, so you can reduce that from book profit. Last but not least, you have a business loss as per books of 8.75 lakhs and you have an unabsorbed depreciation as per books of accounts 0, whichever is lower is 0, therefore nothing will be allowed as deduction. Rest of the 3 items are not eligible for MAT, they are not relevant for MAT, they will be helpful in calculating the provisions of tax as per normal provision. And in this question, we are not computing tax as per normal provision, we are computing only as per MAT. After that, apply 15% tax, apply surcharge if applicable, if not applicable, ignore, then 4% cess will apply. As simple as that, a very simple question. Question number B1, what is there in this question? There is an airline company, okay, which is incorporated in USA, foreign airline company, US airline company, which operates flights from India to US, US to India. So now we have to compute the total income as per 44 BBA. Now 44 BBA is applicable to non-resident aircraft business when it is applicable. When the aircraft is leaving India, then it is 100% taxable in India. But when the aircraft is leaving from outside India, then it is taxable only if it is received in India. Okay. Now, they are first of all earning 90 lakh rupees for carriage of passenger from Delhi to New York and vice versa. But out of that 90 lakh, it is from Delhi to New York, New York to Delhi, total 90 lakh. But out of that 90 lakh, 40 lakh is received in New York for passenger from New York to Delhi. So out of 90 lakh, 40 lakh is from New York, therefore it is accrued outside India, and it is also received in New York, therefore it is received outside India. Therefore, out of 90 lakh, 40 lakh will not be subject to tax, only 50 lakh will be subject to tax. Similarly, out of this 70 lakh, 30 lakh is same only. It is received in New York from flight flown from New York. The flight is also leaving New York, received also New York. Therefore, out of 70 lakh, 30 lakh is accrued outside India, received outside India. Therefore, only 40 lakh will be taxable in India. So, 50 plus 40 total revenue is 90 lakhs. Of that, 5% will be deemed income. 5% deemed income will be taxable in India, but from 5% deemed income, you will not get deduction of any expenses of PGBP, because under 44 BBA, PGBP expenses are not allowed as deduction. Therefore, this 170 lakhs will not be allowed as deduction. You should write that as a note in the examination, otherwise you will not get complete marks. Okay. Next question, Mr. Adi. Here you can take two views in this question. Mr. Adi is a non-resident Indian. He is an NRI. He is purchasing some unlisted equity shares of 6 lakh rupees and he is selling that from 9 lakh rupees. Brokerage transfer expenses of 15,000 rupees. Now you are supposed to compute taxable capital gains of Adi. Ignore first provision to 48. Don't consider first provision to 48. Assume that Adi has invested in the specified assets before 31st March. Now you can assume two things. Adi has purchased the shares in foreign currency. See, how Adi has purchased the shares, that is not given. Whether Adi has purchased the shares in foreign currency or Indian currency, I don't know. If he has purchased the shares in foreign currency, then Adi can apply chapter 2LA. What he can apply? Chapter 2LA, and he can claim exemption for what? This 3,50,000 reinvested. But if Adi has not applied for, if Adi has not purchased the shares in foreign currency, but he has purchased the shares in Indian currency, then he cannot apply chapter 2LA and he cannot claim exemption of this 3,50,000. Let's assume both the things. Institute has assumed both the things. Let's assume that Adi has purchased the shares in foreign currency. Therefore, sale consideration 9 lakh, 15,000 transfer expenses, net consideration very important 8 lakh 85 and 6 lakh rupees cost. 2,85,000 is your capital gain. Now, if you want to save this capital gains, you can invest 8,85,000 in specified assets within 6 months. But Adi has invested only 3,50,000. Therefore, he will get proportionate exemption, that is 2,85,000 capital gains multiplied by amount invested divided by net consideration. This much Adi can claim as an exemption. This answer is correct if you assume that Adi has purchased the shares in foreign currency and is going for chapter 2LA. He is opting for chapter 2LA. Then only this exemption is allowed as per 115F. But if Adi has purchased the shares in Indian currency, then the answer is very simple. Adi cannot get this exemption. Therefore, ultimately, Adi's capital gains will be 2,85,000. As simple as that. You don't have to think much. I hope it is clear to all of you. Next question, question number 2 is a very simple question on DTAA. You can do it or you can ignore it. I will say you can ignore it. Don't waste much time. We have done much better questions on DTAA earlier. So, there is no need to do such kind of hopeless question once again of DTAA. Ignore that question completely. There is no use of doing that question once again. Okay. Question number 3 we will come to. If there is some absolute repetition, I will not do that. Even if there is 1% change in the question, I will try to do that with you all. But if it is absolutely same to same, then it doesn't make sense to do it once again. Next question is on TDS and TCS. Mr. Kunal is an employee. Employee of what? Of an engineering company, Vertex Engineering Private Limited. He has taken a loan of 11 lakh from employer for his son's education in Germany. But out of that, he has remitted only 9,15,000 rupees. So, if you take a loan from your employee, then TCS is definitely applicable, but up to 10 lakh rupees, it is exempt. Above 10 lakh rupees, it is taxable. Taxable at what percent? 5%. So if you take a loan from employee, if you take a loan from a financial institution in India and then you send outside India, then TCS is not applicable only. But here you are not taking loan from a financial institution. You are taking loan from your employer. So you are taking a loan from your employer of how much? 11 lakh rupees. You are sending 9 lakh 15. This will not be subject to TCS. Now you are sending, this is for your son's education. Now you are sending another 6 lakh 98,000 rupees for his out of pocket expense, which is also considered as education expense only. Now this will be subject to what? TCS, but only in excess of 10 lakhs. So total how much you have sent? 915 plus 698. Total you have sent 16 lakh 13,000 rupees. So out of 16 lakh 13,000, remove 10 lakh. On 6 lakh 13,000, 5% TCS will be applicable. I hope it is clear to all of you. Is it clear? I hope it is clear. Next question, Mr. Rajat Kapoor, who has a turnover of last year 18 crore rupees turnover. Therefore, he is definitely last year turnover is too high. Therefore, now he is purchasing a residential house of 7.5 crores. First of all, he will deduct TDS under 194 IA at the rate of 1% on selling price or stamp duty value, whichever is higher. Selling price is 7.5 crores, stamp duty value is just 4.5 crores. Therefore, TDS will be applicable on 7.5 crores. 1% TCS will come to 7,50,000 rupees. Mr. Rajat has to deduct and pay. Second, Mr. Rajat is also paying 13% commission on purchase of house. So 13% commission on 7.5 crores comes to around 97.5 lakh. So now last year's turnover of Mr. Rajat is more than 1 crore. Yes. And Mr. Rajat is paying commission of 97.5 lakh. Therefore, Mr. Rajat will be liable to deduct TDS at the rate of 2% under 194H, not under 194M. Sorry, I've wrongly written under 194H. And the answer it is 194H only. Why Rajat will deduct TDS under 194H? Sir, it is personal commission. 194H covers personal commission and business commission, both kind of commission. Go and check. 194C and 194J does not have personal things. But 194H definitely covers personal commissions also. Therefore, Mr. Rajat will deduct TDS under 194H only. I hope it is clear to all of you. Third question we have already done. You can check it later on. I am not repeating and not doing time based on that. Okay. Let's go to the next question, which is on case law. Some good case laws are there. First question. Very long story. I have to tell you the story by reading the question one by one. There is an assessee who has filed e-return with an income of 11,75,000. In the return, he has shown two income exempt, one PPF interest exempt and one long-term capital gain exempt under 1037. He has shown both this in the income tax return as an exempt income. But he failed to claim the business loss of the current year, 4,50,000. He failed to claim that. So two exemption he has claimed, one loss he failed to claim. After a few months, what happened? The return got processed and the return disallowed both this exemption also. The return disallowed the interest on PPF also, the return disallowed long-term capital gains also. Both of them are disallowed. And the intimation was served to the assessee. Then the assessee filed a revised return under 139.5, but again he made a mistake. He did not e-verify the return within 30 days. When you file a revised return or when you file a normal return, whichever return you file, you have to e-verify within 30 days. You have not done e-verification within 30 days. So I will tell you the entire story. First, he has filed the return, he has claimed two exemptions. Third, he has failed to claim the business loss. Now the software has added back two exemption also. Then he filed a revised return but did not e-verify, so there is no use of that revised return. Now he is making a rectification application and telling the assessing officer to rectify both the exemptions also, and he's telling the assessing officer to allow business loss also. So whether the assessing officer will allow or not, the rule is very simple. What does 154 says? If there is a mistake apparent from record in the intimation, I will rectify. See, there is a mistake apparent from intimation as far as what is considered. As far as your two interest and long-term capital gains are considered, the intimation has done a mistake by disallowing that. You have claimed intimation, you have claimed interest, you have claimed LTCG in your ITR, but software has added back. That is a mistake apparent by software. But the business loss you have not claimed only in the return. So how can you tell that business loss to get rectified? That will not be rectified by the assessing officer. So the assessing officer will rectify something which is a part of the return. Assessing officer will not rectify something which was never a part of return. Therefore, the assessing officer will not rectify the business loss, but he will rectify the first two things. I hope it is clear to all of you. Second question is also a case law. What does this case law say, sir? Pay attention, please. Very, very good case law. See, in 269 SS and 269 T, you cannot take a loan of 20,000 or more in cash, and you cannot repay the loan of 20,000 or more in cash. Cash means other than four modes you cannot do. Account pay check, account pay draft, ECS and such other electronic mode. Otherwise, the assessing officer under 271D and the assessing officer under 271E will impose penalty on you and will give you an opportunity of being earned. Will give you an opportunity of being earned and will impose penalty. Now the question is, this assessee has repaid the loan by passing book adjustment, by passing book entry. I have to pay you 3 lakh, you have to pay me 3 lakh, so we have adjusted. I have to repay 3 lakh loans and you have to pay me 3 lakh, so we have adjusted. Now the officer is saying that this book adjustment is other than 4 more, therefore I will not allow. Therefore I will impose penalty under 271E. This is a violation of 269T. So the court said that the power to impose penalty is on assessing officer, and assessing officer has to give reasonable opportunity of being heard before imposing the penalty. And if the assessing officer finds the transaction bona fide and genuine, there is no tax evasion or tax avoidance, then he should allow this mode also other than 4 modes. Otherwise, what is the use of giving opportunity of being heard? Therefore, passing the repayment of loan by book entry is also allowed. No penalty will be imposed if the transaction is genuine and bona fide. I hope it is clear to all of you. It is not necessary that you should make the payment by 4 modes only. You can make the payment by other than 4 modes also. You provided you prove that it is a genuine transaction. There was no intention of evasion of any tax. Third one is also a very good case law. The assessee is engaged in business of leasing. So assessee does what? Assessee purchase capital equipment like cars and other machineries and then give that on lease to the customers. Now, so to give one of the capital equipment on lease to customer, the assessee has taken foreign currency loan. On that foreign currency loan, there is lot of forex loss which is coming on that particular loan. Now that forex loss is claimed as a deduction by the assessee under PGBP. Now the officer is saying no, you cannot claim that as a loss as a loss in PGBP. You have to add that to the asset and claim that as a depreciation. So the matter went to the Supreme Court. The Supreme Court said that no, it will be claimed as a business loss only. Assessee can claim that as a business loss because taking loan is an independent transaction and giving the property, giving the asset on lease is an independent transaction. Don't mix both of them. Both of them are independent of each other. Both of them are not related to each other. Therefore, because both of them are not related to each other, both are independent of each other. Therefore, business loss will be allowed as a separate deduction. Do not add to the cost of asset. This is what it is given in this particular case law. And one last question is a very simple question. Very simple question. Whether the following assessees are liable to file the income tax return or not. See, there is an assessee who is incurring 2.4 lakh rupees on travel to foreign country for his wife. Yes, if you incur more than 2 lakh rupees for a foreign country travel for yourself or any other person, more than 2 lakh rupees if you incur for yourself or any other person for travel to foreign country, you are liable to file the return. Similarly, if your turnover of the business is more than 60 lakh rupees, then you are liable to file the income tax return. So your turnover in this case is 73 lakh. Therefore, you are liable to file the income tax return. And one last question is a theory question. You can go through it once if you want. Okay, just check it once. Then we will go ahead with the next paper. Let's go ahead with the next paper, that is May 2024 paper. Very first question over here is on total income. We are supposed to compute total income as per the normal provision, not as per 115BAA or BAB. Okay, so let's start. There is a pharma company which is having a net profit of 95 lakhs over here. The net profit is 95 lakhs. So first write down that. Depreciation as per books of accounts, you add back 11.9 lakhs. Now adjustment number 2 is a good adjustment which is on a Supreme Court judgment of Sassoon Chemicals Limited, which we have done in 43B in PGBP. Now, what is this judgment? So, what I was saying that assessee was having some dispute with the employees. So, till the time the employees dispute is not settled, so he has put that money of bonus in a separate trust account. Now, the dispute got resolved before the due date of filing of return, and the assessee has removed the money from the trust and paid to the employees. Everything has been sorted before due date of filing return. Now the assessing officer is saying no, you have not directly paid the amount to the employees. You have first given to the trust and then the trust is giving to the employees. Therefore, I will disallow the expenditure. There is nothing wrong in this. The Supreme Court said that so far as the money has reached to the employees before the due date of filing of return, therefore the assessee should be allowed the deduction of this particular expense. I hope it is clear to all of you. Next one, the assessee is paying some regularization fee for violating the medical council law. So if you pay some money for violating a law, then that is disallowed because it is penal in nature. It's a penalty for breaking a law. It's an illegal expense as per explanation 1 to 37.1. It will be disallowed. Next one, you are paying 45,000 rupees as a late fee to the government for not completing the contract on time. Now this 45,000 which you are paying for not completing the contract on time, it's compensatory penalty. Therefore, it is allowed under the income tax law. I hope it is clear to all of you. Next one, again a routine adjustment, 100% holding subsidiary selling each other. Therefore, it is fully exempt. So reduce from here and show exempt under what? Under capital gains. Nothing great as such. Next one is also a very routine adjustment of grandfathering, that whenever 31st Jan 2018 will come, grandfathering is applicable. So here you will remove this profit from of 4.5 lakhs from PGBP and you will compute as per the grandfathering clause the profit as per the grandfathering clause. But the only thing which you need to keep it in mind over here, when you take the FMB as on 31st Jan 2018, you have to take the highest of the market value on 31st Jan 2018. In this question, they have given you two market value, one 175, one 165. Don't take 165. You have to take the highest of the market value. That's the only catch in this question. Otherwise, this is again a very, very simple adjustment. Next, point number 7. You are supposed to pay some tax liabilities to the GST department or other tax departments, but instead of paying the tax, you are giving bank guarantee to the department. Whether giving bank guarantee amounts to actual payment? No. Giving bank guarantee does not amount to actual payment. It will be disallowed. Actual payment, it means it should reach to the authorities. Only giving a bank guarantee does not amount to actual payment. Next, you have taken some loan 3 years ago on which there is an interest of 7.5 lakhs. You have deducted the TDS on time before March, and you have paid also before July, before the due date of filing of return. So nothing will happen. This will be allowed because it is deducted on or before the end of the year, and it is paid before the due date of filing of return. Therefore, it will be allowed as a deduction under the income tax law. Just write a note that this is allowed as a deduction. Next one, the company has contributed 65 lakhs to electoral trust by account pay check. So add to PGBP, and donation given to electoral trust will be allowed as deduction under 80 GGB. I hope it is clear to all of you. Now the next adjustment is a very, very, very intelligent and very good adjustment. Be very careful with this adjustment. Okay. So the company has imported some machinery parts. What they have done, they have imported some machinery part, but by mistake they have included that in the closing stock. How much machinery parts they have imported? 1200 pieces they have imported, but by mistake they have included that in the closing stock. So what should I do? Don't do anything. Why, sir? Because it will get nullified. Sir, how? See, if you have imported the machinery part and by mistake you have shown in the closing stock, so by mistake you would have shown in the purchase also, because you have considered that as a raw material, correct? That's the reason you are showing in the closing stock now. So if you have by mistake considered as a purchase and by mistake considered as a closing stock also, so you would have gone it would get nullified. Therefore, there is no need to give any effect. I hope it is clear to all of you. Yes, but one thing you have to do is no effect in P&L. But you should add that to plant and machinery and claim normal and additional depreciation on that. So yes, that you have to do. 1200 pieces because it's a part of machinery now. So you should claim normal and additional depreciation because you are a manufacturer. So 1200 pieces into $25 per piece into 82.88, because on 15 September when you have purchased, on that date the dollar rate was 82.88. So on that you can claim normal and additional depreciation. I hope it is clear to all of you. Now apart from that, the adjustment number 2 in the additional information. The depreciation charge in the statement of P&L is 11.9 lakhs. So this is your depreciation as per accounts. So add back this and then take depreciation as per tax. The first thing over here is you are purchasing some firefighting equipment of 95,000 rupees. But the question is saying that there was no fire and hence equipment was not used. So what? Firefighting equipments are not necessarily that fire should be there. You are using that as an emergency. Therefore, keeping a firefighting equipment in your factory, in your office, itself is a passive use. Therefore, you can claim depreciation on that. There is nothing wrong in this. You can claim depreciation. There is nothing wrong in this. Second, additional depreciation you cannot claim because it is in office. New machinery which is installed, on this you can claim additional depreciation also, normal depreciation also, because it is new machinery which is installed. You can claim normal depreciation 15%, additional depreciation 20%, and you can also claim what? Normal and additional depreciation on this particular closing stock also, imported machinery spares. Third one is very good adjustment. In 2018, you have sold some machinery whose WDV at that time was 35 lakhs. Now you are purchasing that machinery back for 65 lakhs. So do you remember? If you sell an asset and reacquire, then the actual cost of the asset will be determined as per explanation 4 to 43.1. That is the WDV at the time of original transfer or reacquisition price, whichever is lower. Now the WDV at the time of original transfer was 35 lakhs. and reacquisition price is 65 lakhs, whichever is lower will be considered to be actual cost. So therefore you will get 15% normal depreciation on this. Additional depreciation will not be allowed because it is second hand plant and machinery. I hope it is clear to all of you. On second hand machinery, additional depreciation is not allowed. So this is what this question is all about. One or two adjustments were very good, otherwise it was a very routine adjustment, routine sum. Now coming to question number 2, very simple question. There are three parts in this question. First part, Mrs. Urvashi, who is 56 years old. She is a resident. She is individual. She acquired a residential house at Ayodhya in 1994 for 45 lakhs. The market value of the house on 1/4/2001 is 1 crore 20. Stamp duty value is 1 crore 2 lakhs in 1/4/2001. Now she is selling the house on 15th of October for how much? 15 crore 50 lakh rupees. The stamp duty value is 70 lakhs. So which value I should take as an FVC? You will take 15.5 lakh crore as FVC. Why, sir? Because the difference between the FVC and the stamp duty value is not more than 110%. You can take 110% of 15.5, it is not exceeding that. Because the difference is not more than 110%, therefore you will take full value of consideration as your selling price. Selling price will be 15.5 crores. Sir, what will be the cost of acquisition? See, the cost will be actual cost is 45 lakhs. Compare with lower of stamp duty value and market value is on 1/4/2001, whichever is lower. So the lower is 1 crore 2 lakhs. Ignore this market value. Now we will compare this with what? Compare this with actual cost. Now whichever is higher, therefore 1 crore 2 lakhs will become your cost. So therefore what is your sale consideration? Your sale consideration is 15 crore 50 lakhs and your actual cost is 1 crore 2 lakhs and 14 crore 40 lakhs will be your capital gains. This is long term obviously because it is 24 months old. Now to save this long term capital gains on this Ayodhya house, Ayodhya is also house over here, residential house over here at Ayodhya. You are purchasing another residential plot in Amritsar and you will be constructing a house in the next 1 or 2 years. So you are depositing 3 crores in the capital gain account scheme. So total you are reinvesting 11 crore. But remember, you will get exemption under 54 of only 10 crore now after Finance Act 2024. So after Finance Act 2024, we do not get exemption of more than 10 crore in 54 as well as 54F. Therefore 10 crore you can claim exemption. Remaining 448 crore you can pay 20% tax. Okay, sorry, 12.5% tax. But Urvashi has one more option. You can write down in the examination because Urvashi is a resident. She has purchased land and building before 23rd July and she is selling land and building after 23rd July. So Urvashi also has one more option that don't take indexation and without indexation claim what? Claim 12.5%. Whatever is more claimed, don't take indexation. Sorry, Urvashi has two options. Don't take indexation, take 12.5% or take indexation and take 20%. Whichever is more beneficial, Urvashi can do that. So you can write that note. ICAI has not asked, but you can write a note. Alternatively, Urvashi can do what? Has an option to take indexation by taking tax rate 20%. I hope it is clear to all of you. Next one is a case law question of Pradeep Kumar Malhotra. Very important case law which we have done in the chapter of IFOS under 222E. What is Pradeep Kumar Malhotra is doing over here? The name of the assessee in this question is Manju Menon. Manju Menon has 20% share in a private company. So Manju Menon has 20% share in a closely held company. Now, if that closely held company gives a loan to Manju Menon, that will amount to deemed dividend under 222E because Manju Menon has shares of voting power of how much? 20% or more. Now, Manju Menon has done what? Manju Menon has given his immobile property and on rent to the company. In return, Manju Menon has also allowed the company to do what? To provide that property on collateral to the bank and take loan. So Manju has given what? Property on rent to the company. Now Manju has also allowed the company to give that property on collateral to the bank and take a loan. Now in return, the company is also doing some favor. See, Manju is doing so much favor to the company. So the company is also doing some favor. The company is giving an advance of 20 lakh rupees to Manju by passing a board resolution. So whether this 20 lakh rupees given to Manju will be subject to deemed dividend, and the answer is no, because this loan given by the company to Manju is not a gratuitous loan. Is not out of gratitude. Only gratuitous loans are covered under 222E. Now, it is not one-sided loan given by the company. Company is doing some favor on Manju. Manju is also doing some favor on company. 222E is not applicable. If only one-sided favor is done by the company on the shareholder by giving a loan, only then 222E is applicable. Otherwise, 222E is not applicable. I hope it is clear to all of you. And the third question in this particular question is on non-resident taxation and determination of residential status. Miles Company Inc. is incorporated in US. Their shareholders have met in India 3 times in the current year. 2 times they have come to India for modification of various classes of shares. It means they want to change the paid up capital from 10 rupees to 100 rupees or 100 rupees to 10 rupees or 10 rupees to 1 rupees. To change that, they have come to India, and one time they have come to India to sell some assets of the company. Majority of the board meetings, majority of the commercial and management decisions of the company are done in California, in Chicago, USA only. Therefore, they are coming to India only for two small things. One is for sale of some assets of the company. One is to change the classes of the shares of the company. They are not coming to India for making management and commercial decision. Therefore, the poem of the company is outside India. Therefore, the residential status of the company is non-resident. Therefore, first we have to comment on the residential status. The residential status of the company is non-resident. Now, if it is a non-resident, we need to answer the following question. First, they are earning some dividend of 5,50,000 rupees net of TDS. From what? From GDR. Now GDR dividends are covered in 115 AC. It is taxable at 10% plus 4% surcharge, 4% cess, therefore 10.4%. But this is received. So 5,50,000 is received. Therefore this is net of TDS. Therefore 89.6% is net of TDS. Therefore 100% is how much you have to cross multiply. Because the word received and because the word net of TDS is very clearly written over here. Therefore you have to gross up the dividend income. Second one, ICAI has taken two view. First, very important point. Now, second is one is a very intelligent question. That foreign company, that non-resident foreign company is providing some services to government of India. Which services? Technical services. Now, the government is going to use that service, is going to utilize the service where? The government is going to utilize the service in what? Utilize the service in Nepal. Whether it is deemed to accrue or rise in India? Yes, it is deemed to accrue or rise in India. When a government is paying royalty, FTS and interest now, it doesn't matter whether it is accrued in India or not, whether it is utilized in India or not. When a resident pays now royalty, FTS, etc., then we have to check whether the services are utilized in India or not. But when a government pays, the services can be utilized outside India also. So this is definitely taxable in India. Now second thing, here also 5,55,000 is received. So you have to gross up. You have to gross up. But how much gross up? What should be the tax rate? Should I take this in 115A or should I take this in normal provision? See, that you have to take as a view. Because in the question, it is not written that the agreement is approved by central government. But agreement is not required. Approval is not required in case of central government. Na? In case of central government, approval is not required. That is also another catch. Always remember, when a non-resident provides services to a resident, then there is an agreement and approval. Both are required to come under 115A. But when a non-resident provides services to government, only agreement is required. Approval is not required because government cannot give approval to themselves. Na? Therefore, even though approval is not there, still you can come under 115A. Again, I am saying for government under 115A, approval is not required. Central government cannot give approval to itself. Therefore, without approval also you can come under 115A. So government can come in 115A. 2 points to be kept in mind out of this question. Government can come in 115A. Without approval also, government can come in 115A even if the services are utilized by government outside India. Therefore, this is received amount. Net of TDS will be 20.8% will be TDS, 20% tax, 4% cess. Therefore, this 5,55,000 is nothing but it is 79.2%. 100% is how much? You have to cross multiply and find out the answer. I hope it is clear to all of you. Is it clear? Question number 3. Let's come to question number 3, which is on trust. Very simple question. Part 1. There is a trust, registered charitable trust under 12AB. Now they have applied 4,50,000 for the benefit of trustee. Gone. 115 BBI. You cannot pass unreasonable benefit to trustee specified person. 115 BBI flat 30% tax. Then another 2,50,000 you have provided as a benefit to Mr. Sujan Dave, who has donated 3,75,000 to the trust during the year. Now Mr. Sujan Dave will be called as substantial contributor. He is also covered in specified person. How, sir? Definition has been amended in the current year. If any person is contributing during the financial year more than 1 lakh rupees or total aggregate contribution till date to the trust of more than 10 lakh rupees, both of them are considered to be specified person. So Mr. Sujan Dave is contributing 3,75,000 in the current year, so it is more than 1 lakh in the current year. So because it is more than 1 lakh in the current year, Mr. Sujan Dave is a specified person, substantial contributor. You cannot pass unreasonable benefit. You are giving a benefit of 2,50,000. This will also be subject to 30% tax. Third, you have accumulated some 2,50,000 last year under 11 subsection 2 to be used for specified purpose within 5 years. But in the current year, you are giving donation to another person. Again, it is a violation of 11 subsection 2. Therefore, 115 BBI will apply here also. You cannot accumulate the money and do what? You cannot accumulate the money and apply the money in the next year for donation purpose. That is also subject to what? 115 BBI. Check it, please. Part number 2. A trust was incorporated in 24. Now in 26, they are planning to make for an application for registration. In 24, they have not made an application for registration. Can they directly make an application for final registration, or they have to make a provisional registration? In such case, the trust can directly make an application for final registration. Provisional registration is only applicable if this is your first year of activity. Yes, if the trust would have come in 24 for making application now, in that case, they have to make a provisional application. Otherwise, if you are already an existing trust in 26, because your trust was started in 24, in 26 you are already an existing trust, you can directly make an application for final registration. The commissioner will give you registration within 6 months and you will enjoy the exemption from the next assessment year. You can enjoy it. I hope it is clear to all of you. Next one is a very simple question of DTW. You can check it once. Very, very, very straightforward question. I am not wasting my time on that. Please check that at your end. Next question on TDS. The first question on TDS is on service charge, mandatory service charge which is collected by the hotel. I went to a hotel to eat something. The hotel has collected service charge paid to the employees. Whether the hotel is liable to deduct TDS on that, the answer is no. The Supreme Court in the case of ITC hotel has said that the hotel is not liable to deduct TDS on the tips which are given to the waiters or the employees of the hotel on behalf of the customers. That is not subject to TDS. Check it please. Second, a partnership firm is selling some goods through an e-commerce operator of how much? 4,90,000. Out of which 4,30,000 is paid through e-commerce operator and 60,000 is directly paid by the customer to the seller. So both are subject to TDS under 194O. So there is an Amazon. I am Amazon. There is a seller. There is a buyer. The buyer is purchasing something. The Amazon is liable to deduct TDS of the seller. But if the buyer directly pays to the seller, then also TDS is applicable. It is deemed to be credited by the e-commerce operator only. In both the cases, 0.1% TDS will be applicable. I hope it is clear to all of you. Check it please. On this 4,30,000 also 0.1%. On this 60,000 also directly paid by consumer to the seller, not paying through the e-commerce operator. Generally what happens? The buyer pays to the e-commerce operator pays to the seller. 4,30,000. That is subject to TDS. Second, customer directly paid to the seller. That is also subject to TDS. It is deemed to be credited by the e-commerce operator. But sir, the total sale is 4,90,000. Are they not eligible for exemption up to 5 lakhs? No. Exemption up to 5 lakh is not applicable for firm. It is only applicable to individuals and HUFs. Okay. Only individuals and HUFs are subject to exemption if they provide PAN card or Aadhaar card. Otherwise, they are also not eligible for exemption. I hope it is clear to all of you. Next question is a very simple question on transfer pricing. Yalin Limited is located in country X. And that too they are located in notified jurisdictional area NJA, and Armo Limited is located in India. Now we are providing some goods to Yalin Limited in 11.75 crores. So Armo is in India, Yalin is in NJ, notified jurisdictional area. We are selling some goods to them at 11.75 crore rupees. Therefore Yalin, Armo and Yalin are deemed to be associated first of all as per 94A. The transaction between Armo and Yalin is deemed to be international transaction. Transfer pricing is applicable. So now find out the arm's length price. So to third party you sell the goods at how much? To third party we sell the goods at 13 crores. But in this 13 crore there are two things which are not there in 11.75 crores. Which two things? One is there is some insurance and freight of 25 lakhs. So you have to reduce that in this 13 crore. Insurance and freight is there. In this 11.75 crore, insurance and freight is not there. And there is some warranty of 0.19 lakhs, 0.19 crore, that is 19 lakhs. That also you have to reduce. You will get your arm's length price as 12.75 lakhs. What is your actual price? 11.75 lakhs. Shall I check 3% margin? No. For NJ people, 3% margin should not be checked. 3% margin is there now. If there are less than 6 items, then you have to check the 3% margin between your actual price and arm's length price. For NJ people, that is not there. For NJ people, safe harbor rule is also not applicable. If I am doing transaction with a person located in NJ, I am not allowed to do safe harbor rule also. So the arm's length price in this will be 12.56. Actual price is 11.75 crore. Differential amount should be added back. I hope it is clear to all of you. Next, case law. Case law. Question number 5 is generally case law only. They might ask one case law sometime 2, sometime 3 also. And then they will tell you attempt any 2 out of 3. Okay, most of them are the recent last 1 or 2 case laws, 26, 25, 24 case laws. If you do properly, high chances 1 or 2 questions will come from there only. Now what is the first case law over here? Try to understand this case law please. Very good case law. There is Air India over here. Air India is an assessee. Now Air India has taken an engine on lease from a foreign company, which is from Germany. That foreign company does not have a P in India. That foreign company does not have a PAN also in India, but the DTAA between India and Germany says that the tax will be deducted at 10%. Now the question is, because that DTAA says 10% and the non-resident does not have a PAN, should I deduct TDS at higher rate at 20%? As per 206AA, the court said that no. That higher rate of 20% in non-PAN cases should not be compared with DTAA rates. DTAA rates are final and conclusive from every angle. You cannot deduct more than 10% under any circumstance for DTAA. Yes, if this 10% would have been income tax rate, then you would have compared this with 20% and whichever is higher. But if this person is a 10% is a DTAA rate, you should not compare with 206AA DTAA rate, and therefore in this case the TDS will be deducted at 10% only, even though the non-resident foreign company does not have a PAN card. I hope it is clear to all of you. Second case law, very good case law. In this ICAI has taken two views. Two different case laws are applied over here. One is a Supreme Court judgment of Hindwire Limited and High Court judgment of Tony Electronics, and second is Supreme Court judgment of Elegantron Finance Limited and High Court judgment of ICICI Bank Limited. So this is a fight between two judgments. Both of them ICAI has given. ICAI said that you write whatever you want to write. Now what is this actually, both the judgments? I'll tell you. I've explained all these things in class in great detail obviously. The AOS passed an order on 20th of Jan, and in which assessee has made a mistake of reducing depreciation instead of adding. So instead of adding depreciation of 10 lakh, assessee has claimed depreciation of 10 lakh. It means they have claimed double deduction. They have claimed benefit of 20 lakhs. So who has done this? AO has not done this. Assessee has done this. Now AO did not correct this mistake. AO did not find this in the order. So try to understand the first paragraph. Assessment is done. Assessee has made one mistake of reducing depreciation instead of adding depreciation. AO did not found that. AO did not notice that particular mistake. Now, later on, assessee went to appeal for some other issue, not on depreciation. The appeal was finalized on 28th of Jan. The AO gave the effect to the appeal on 23rd of July. Now the AO wants to rectify the mistake on 26th of June and is trying to rectify that double mistake. Now the question is, what is the time limit to rectify a mistake? It is 4 years from the end of the financial year in which the order sought to be rectified was passed. The entire issue is from where the 4-year time limit will be counted, whether it should be counted from the original order or whether it should be counted from the rectified order or whether it should be counted from this appeal order. So there are two views over here. The Hindwire case law and the Tony Electronic case law says that the 4-year time limit should be counted from this subsequent order, not from the original order. But the ICICI Bank and Elegantron Finance Limited case law said that no, 4-year time limit has to be counted from the original order. So if you follow Hindwire case law, then rectification is possible. But if you follow Elegantron Finance or ICICI Bank, then 4-year time limit has gone. 4-year time limit has gone, and therefore you cannot rectify now in 2025-26 or 2020 order. I hope it is clear to all of you. And one last question in this case law is a very simple question. The assessee has deducted the TDS but failed to pay the TDS. Deduction has been done on time, but payment has not been done on time. Deduction has been done on time by the assessee, but the payment has been late. Now in this case, what will happen? Pay attention please. Whether the AO can impose 271C penalty? The answer is no. See, it is very clearly written in the law that 271C penalty is only for failure to deduct. It is not for failure to payment. Still, the deduction is done on time. Still, the AO is imposing 271C penalty for payment, and therefore the AO is not correct. The Supreme Court has held that. 271C penalty is only for late deduction. It is not for late payment. I hope it is clear to all of you. Next question, question number 6. Now from this question onwards, from this paper onwards, May 2024, because new course have started in May 2024. So from May 2024 onwards, you will also start to see the questions on black money law and tax audit, because black money law has been included in the new course and tax audit has also been shifted from audit paper to your direct tax paper. So very first question is on tax audit. So there is a club, there is a travel company, Club U Travel Company. They have remitted huge amount outside India to Australia. They are saying that this is with respect to some travel. They are travel agency, so they have to send money outside India because the passengers are traveling. Now the income tax department has collected the information from the bank. They have collected form 15CB, which is issued by chartered accountant. They have also collected list of passenger, copy of their passport, date of travel, date of when the invoice has been raised by the foreign party. The income tax department has done their homework. Income tax department has gone one step ahead. They have also verified from the passenger that whether you have traveled from Club U Private Limited. The passenger directly denied. The passenger said that we did not travel. Then income tax department came to know that all these invoices which were remitted outside India were for false reasons. It's a FEMA violation. Total 78 certificates were issued by 15 CB chartered accountant. 35 crores were remitted by chartered accountant by the company outside India, which chartered accountant has certified. Now the question is the chartered accountant guilty? The answer is yes, he is definitely guilty. When we asked question to the chartered accountant, the chartered accountant started giving an argument that he was not a statutory auditor and he has examined the books of accounts. He did not examine the books of accounts. He has just checked the KYC. He has verified the KYC. Because he was not a chartered accountant, he did not examine the books of accounts. What is the responsibility of chartered accountant when a chartered accountant issues form 15 CA 15 CB? First of all, he should examine books of accounts. Even though he is not an auditor, statutory auditor, he should still examine the books of accounts. Second, he should examine whether the TDS has been deducted at proper rate or not. Third, he should verify the agreement between both the parties. All these things are not done. Only KYC has been checked. Therefore, a chartered accountant in this case is deemed to be guilty. See, all these points I am saying, you have to write down all these points in the examination, otherwise you will not get marks. That's the I'm not doing general discussion over here. I'm doing discussions over here which are very specific to exam which you are supposed to write. I should have easily said, nah, a chartered accountant is guilty, let's go ahead. No, I'm not doing that kind of revision over here. I'm trying to say everything minutely which you have to write in the examination. Therefore, you have to write down these 4 points and then you have to write down, if you remember the clause, as per clause 7 and clause 8 of part 1 of second schedule, a chartered accountant is deemed to be guilty in this case. I hope it is clear to all of you. Next one, you need to identify whether the following persons are doing tax planning, tax management or tax evasion. So Mr. D has a fixed deposit receipt with FDI of 50 lakh rupees. Now he gifted this sum of 50 lakh rupees to his son. So he gifted this FD to his son who is 18 years old, so that he can shift his interest income from his income to his son's income, because he is already earning lot of income. So if I am earning already lot of income and if I make a fixed deposit in my name, I have to pay 30% tax on that. So I am shifting that fixed deposit, I am gifting that fixed deposit to my major son. Is it tax planning, tax evasion? It's a tax planning. Most of you will say it's tax evasion, sir. There is nothing like tax evasion in this. Yeah, if I would have given this gift to my minor son, minor daughter, or to my wife, to my spouse, then it would have been clubbed in my hands. But if I give that to a major son, there is nothing wrong. I can give it to my major son, I can give it to my father, I can give it to my neighbor, I can give it to my girlfriend, I can give it to my boyfriend. It is allowed. There is nothing wrong. The law does not stop us. Therefore, it is allowed. There is nothing wrong. You can do that. Yes, if you trust your son, then you can do. If you don't trust your son, then don't do. As simple as that. Second one is very simple. Mr. Ram's annual income is 49.6 lakhs. Now he's about to receive some commission of 6 lakh rupees. So he's telling the company that don't give me commission, give it to my wife. My wife does not having any great income. So give that commission to my wife. This is clear tax evasion. Your commission, how can you shift to in your wife's name? You know that your income is already 49.5 lakhs. If you receive the commission of 5 lakhs or 6 lakhs again, then you will be liable for surcharge on total tax. So you are shifting your commission to your wife's name. That is absolutely tax evasion. This is clear case of tax evasion. And one last question in this paper is, there is a non-resident foreign company which is entering into a contract with several Indian company and they have made an application to BFAR. Now, suppose they are entering into contract with 10 Indian companies. So they want to know the tax planning, how much will be the tax liability. They want to know the tax effect. So for that purpose, they have made an application to BFAR. Now, suppose they have made an application to BFAR with 10 companies. Because they are entering into transaction with 10 companies. Now, one of the companies out of 10 companies has also made an application to AO to understand that same issue. So now the question is whether the application of the non-resident will be rejected because of that. See, one of the provision in BFAR is, if your application is already pending in front of income tax authority, then your BFAR application will be rejected. Now here ICAI has taken two views. That whose application, whether applicant's application should be pending or anybody's application can be pending, then you will reject the application of the applicant. So two views. View number one is correct view according to me. If my application is not pending, somebody else's application is pending, then you cannot reject. View number two. If anybody's application is pending, then also you can reject my application. Second view is very strange, very vague. First view is better. If my application is already pending in front of income tax authority, then you reject my BFAR application. But if somebody else has made an application, then you cannot reject my application. That view is correct according to me. You can write either of them, whatever you want to write. Okay. So this is what this paper is all about. So let's go ahead with the next paper, that is November 2024 paper. The very first question over here is on total income. Assassi is a resident company. It is a manufacturer since 2012. Now, what is this company want us to compute? They want us to compute total income tax liability as per the regular provision. They have not opted for any concessional rate. So, as per the normal provision, you are supposed to compute the total income and tax liability. Then they are also asking us that the turnover of the company of last year is 450 crore. Therefore, the tax rate will be 30%. Now they are asking, would it be beneficial to opt for concessional tax rate? So we can go for 115 BAA later on. Okay. Now let us solve the question first of all as per the normal provision. Then we will solve as per 115 BAA. The very first adjustment is the depreciation as per Companies Act. So you will add back that. Next is you have received some dividend of 5 lakh from a foreign company. So reduce from here and show under IFOS. So reduce 5 lakh from here and show under IFOS. Now you are incurring some interest expense on borrowed fund for investing in the Arnold Limited. So you have taken a loan to invest in Arnold Limited. On that you are paying some interest. So that interest will be disallowed here. But in IFOS you can claim deduction of interest against dividend up to 20%. So 20% of 5 lakhs comes to how much? It comes to 1 lakh. 1 lakh you can claim as a deduction under IFOS. Therefore, in IFOS, the net income of dividend will be how much? The net income of dividend will be only 4 lakh rupees. Okay, I hope it is clear to all of you. Next, you are contributing 5 lakh rupees to the State Housing Board for constructing tenements. Tenements means something which is a temporary house for the workers. So you are giving 5 lakh rupees to the State Housing Board for constructing tenements for the workers. Now, the ownership will remain with the State Housing Board only. Ownership is not your, it is the government's ownership, not your ownership. You are only contributing the money. So that can be claimed as a revenue expenses because that you are not the owner of that. If you would have been the owner of that, you would have claimed depreciation, but you are not the owner. Okay. Now, next one. There was a creditor of 20 lakh rupees which has been settled for 15 lakh rupees. Therefore, 5 lakh rupees is what? Waiver by creditor. It is a remission and cessation of a trading liability. Therefore, it is deemed income. You have not, the amount has been already credited to PNL. So great, you don't have to do anything. Just write a note that it is already a deemed income. Okay. Now, next. There were some debenture holders to whom you have paid some upfront discounted interest. You have paid of 5 lakh rupees. The debenture's life is 5 years. Now, the question is, you have paid some upfront money to the debenture holders of 5 lakh rupees. Should you claim deduction in 5 years? That is over the life of the debenture, or you should claim in one single year. So the code says that you should claim in one single year. There are difference in opinion in that. Some people say that you can claim in 5 years. Some people say that you can claim in one single year also because the liability is already crystallized. The liabilities arise. Therefore, you can claim in one single year itself. So the assessee has taken 1/5. So you can claim full. So if the assessee has taken 1/5, it means you have to take 4/5 more to claim the deduction properly. So take 4/5 more deduction in the current year. I hope it is clear to all of you. Next one. During the previous year 25-26, the assessee started a business of developing and building rental housing projects, which is eligible for deduction under 80 IBA. So you are doing some rental and you are developing and building some housing projects, which is eligible for deduction under 80 IBA. You have earned a profit of 20 lakh rupees. So now this 20 lakh rupees can be claimed as a deduction under 80 IBA because the project is approved during 2021. Yes, it is very important that the project should be approved between 1st June 2016 to 31st March 2022. The project has to be approved between this 6 years if you want to claim deduction under 80 IBA. Assessee's project is completed, is approved between this. Completion can be done within next 5 years from the date of approval. But the project should be approval till 31st March 2022. Therefore, assessee will be eligible for deduction of 20 lakh rupees under 80 IBA. Next, the assessee is also earning 10 lakh rupees from construction of an housing project, but which is executed in the form of a work contract. So they are getting it outsourced through some other person and then they are getting construction done. So this will not be eligible for what? 80 IBA. In 80 IBA, if you want to claim deduction under 80 IBA, you have to do construction yourself. If you do outsourcing in the form of work contract, you are not eligible for doing 80 IBA. So therefore, this 20 lakh rupees you are doing yourself. Therefore, you are eligible for 80 IBA. Just 10 lakh rupees you are doing work contract. You are not eligible for 80 IBA. Okay. I hope it is clear to all of you. Next. The company has purchased the land in 2012 for 5 lakh rupees, which was compulsorily acquired in 2020. Now, the original compensation was 10 lakh, which was awarded, which was given in 2020. So, the original compensation would have been taxed in 2020. Now, you have received 8 lakh rupees additional compensation. So, this will be taxable now. So, now this will be taxable at 8 lakh rupees at 12.5% because enhanced compensation is taxable in the year in which in the year in which it is received. So this 8 lakh will be taxable. Against this, you will not get any deduction of cost of acquisition. Yes, if you would have incurred some legal expenses, you would have deduction of legal expense. You would have got deduction of legal expenses against that. Next, depreciation as per income tax law, you can claim 4.5 lakh deduction. Next, the company has purchased some machinery of 20 lakh rupees in 2022. Now, some fire etc. has taken place in the factory. So the machinery has been broke down. Now, this machinery is the only machinery in the block of asset. Now, the block ceased to exist. Therefore, short-term capital gain will arise. There was only one machinery. There is a fire in the factory. Because of that, machinery got destroyed. And now you are receiving an insurance claim of 22 lakh rupees. So, you need to find out the capital gains of this particular machinery. So, you are selling for how much? You are selling for 22 lakhs. Now, let's find out the WDV of the machinery today. You will take 20 lakh as the cost. Okay. Then you will start taking what? Normal depreciation and additional depreciation in first year. In first year, you have to take normal and additional depreciation. In subsequent year, you will only take normal depreciation. Okay. Then you will get your WDV as 9.3 lakh rupees. Once you get the WDV as 9.3 lakh rupees, on that difference amount, you will apply STCG tax rate 30%. Okay. Last but not least, you are declaring dividend of 6 lakhs to a shareholder. So you can claim deduction under ATM, but be careful. In ATM, the deduction cannot be more than your dividend income. How much is the dividend in your IFOS? Only 4 lakh. How, sir? See the first adjustment, second adjustment. Dividend is 5 lakh minus 1 lakh you are claiming as a deduction. Therefore, net dividend is 4 lakh. Against that, you can claim only, you cannot claim 6 lakh against 4 lakh. You can claim only 4 lakhs against 4 lakh income. Therefore, 4 lakh will be allowed as deduction. That too, it is allowed because you are distributing dividend by 31st of August. You have to distribute the dividend. If you want to claim deduction under ATM, then you should distribute the dividend to the shareholder 1 month prior to the due date of filing of return. Okay, I hope it is clear to all of you. After that, apply tax rate of 30% because the turnover of last year is 450 crore, which is more than 400 crore. Apply 30% tax rate, then surcharge if applicable and cess. Okay. Now we need to talk about 115BAA because the question is asking, would it be beneficial if they opt for concessional tax regime? Let's see. If they go for 115BAA, how the things will change? If they go for 115BAA in the current year, the things will change as follows. The only item which will be added back is ATIBA 20 lakh rupees. The 20 lakh rupees deduction which you are claiming under ATIBA, that is the deduction which will be disallowed. The rest all will be same. What about ATM, sir? ATM is allowed under 115BAA. In 115BAA, ATM is allowed. JJAA is allowed. JJAA is allowed. IBA is not allowed. Therefore, we are adding back this ATIBA. After that, you will apply 22% tax on the entire income, except the long-term and short-term capital gains, whatever it is. On that, you will apply on short-term capital gains also, you will apply 22%. Sorry. Only on long-term capital gains, you will apply 12.5%. Then you will apply 10% surcharge. Then you will apply 4% cess. After that, you will get your tax. Okay. Then you compare whichever is more beneficial. You can go for that. So this is your first question. It was a simple question, nothing great as such. Question number 2. We will talk about this question now. This is a question on slum sale. Salsa Limited has 2 units. One is textile unit, another is chemical unit. You are planning to slum sale your chemical unit. For how much? 242 lakhs. Okay. 242 lakhs is the sale consideration. Now, in slum sale, always remember you have to find out 3 things. First, full value of consideration. What is full value of consideration? FMV1 or FMV2, whichever is higher. First, find out these 2 things. Then you have to find out the cost of acquisition. What is cost of acquisition? Cost of acquisition is the net worth of the undertaking transferred. In this case, it will be net worth of chemical unit. So let's try to find out FMV1 first. FMV1, FMV2, whichever is higher, that will become FVC. Sir, what is FMV1, sir? FMV1 is the FMV of the asset transferred. Whatever chemical unit asset you are transferring, find out the FMV of that. So first you are transferring land. For land, you have to take stamp duty value. As per Rule 11 UAE, for land, you will take what? Stamp duty value. 62 lakhs you will take. Now, second, you are transferring building and machinery. For building and machinery, you will take stamp duty value again. For building, you will take stamp duty value. For machinery, you will take book value. Again, I am saying, for land and building, you will take stamp duty value. So, for land, I am taking what? The stamp duty value. The stamp duty value will be the FMV for land. I am finding out FMV1 first. For building also, you have to find out stamp duty value. Okay. Stamp duty value. Now, stamp duty value is not given. So, we are assuming the book value and stamp duty value is same only. Okay. For machinery, you have to take book value. So, for machinery, we are taking the balance sheet value as your book value. Okay. Because again, book value is not given separately. It is written in the balance sheet that the balance sheet value is itself is a WDV. Now, for legal license and franchise, you will take FMB1 I am finding out. FMB1 you will take book value. Okay. For equity shares, you will take FMB1 market value. For equity shares, you will take FMB1 as market value. Now what is left? Inventory is left. Inventory you will take book value. Creditors is left. For that also you will take book value. Now FMB1 is over. What is FMB2? FMB2 is whatever you have received. What you have received? You have received 242 lakh rupees. That will be your FMB1. Now compare FMB1 and 2, whichever is higher. Let's see FMB1 and 2 here. What is FMB1, sir? For land I have told you stamp duty value. For building I have told you stamp duty value, but stamp duty value is not given, so we are taking book value. For machinery you have to take book value. For listed shares you have to take market value, sorry. As I have already told you. Inventory you have to take book value. License and franchise you have to take book value. For liability you have to take again what? Book value, okay, which is given in the balance sheet. Once you will get that, you will get your FMB1. Now what is FMB2? FMB2 is 242 lakhs. Whichever is higher, therefore 262 will become what? Will become your full value of consideration. Now let's talk about what will be the net worth. That net worth will become the cost of acquisition. In net worth for land, you will take book value. You will not take market value. You will take book value for land. So what is the book value of land? 50 lakhs. For net worth, you will take book value. For FMB1, you take stamp duty value. For building, you will take, for building and machinery. For depreciable asset, you will take income tax WDV. Now, income tax WDV is same as balance sheet value. So you can take from the balance sheet the income tax WDV. For license and franchise, you have to find out the income tax WDV, because license and franchise is again what? Again your depreciable asset. You have purchased the license and franchise last year in June. So you have to reduce 1 year depreciation from here. Take chemical unit license and franchise 23 lakhs. From 23 lakhs, reduce 1 year depreciation. You will get your market. You will get your value. For equity shares, you have to take book value. What is left now? For inventory, you have to take book value. Okay. For trade creditors also, you have to take book value. After that, you will get your net worth. Once your net worth is computed, reduce your net worth, that is cost of acquisition, from your full value of consideration, you will get your what? You will get your capital gains. You need to be very careful what you take in FMB1 and what you take in net worth. Some things are minor, things are same, most of them are different. At some places you are taking stamp duty value, at some places you are taking book value. At some places you are taking stamp duty value, at some places you are taking income tax WDV. At some places you are taking book value, at some places you are taking market value. So the things are slightly different at both the places. You need to be careful with that. Let's go to question number 2. So there is a US based foreign company which is having a branch in India. Okay. So now this question is on 44C. So US based foreign company has a branch in India and they are allocating some head office expenses to Indian branch. So if a non-resident allocates head office expenses to Indian branch, whether the Indian branch is eligible for deduction? Yes, under 44C. For that you need to find out the adjusted total income of the branch. For that, they have given us the data. The loss of 28 lakh is after charge of following items. So first we will find out adjusted total income. Now to find out adjusted total income, first I will add what? Depreciation will I add? No. No, you don't add current year depreciation to find out adjusted total income under 44C. Unabsorbed depreciation, yes, we add back. Short-term capital loss, yes, you can add back. VRS, you cannot claim full VRS, you can claim only 1/5. Therefore, add back 4/5. Speculative business loss, yes, you can add back. Deduction under chapter 6A, yes, you can add back. Head office expenses, actual head office expense, you can add back. Now, after doing all these things, now what is happening? Surprisingly, your adjusted total income is coming positive. It is coming positive. So therefore, because the adjusted total income itself is positive, this data of last 3 years is not relevant. See, when we take average adjusted total income of last 3 years, you know, when the adjusted total income is negative. When the adjusted total income itself is positive, then you cannot take average of last 3 years. Be very careful. The average of last 3 years is only possible when the adjusted total income in the current year is negative. So ICAI has played a game with you all. The adjusted total income itself is coming positive. Therefore, the last 3 years average is need not required. So what is the adjusted total income in this question, sir? Let's see. The adjusted total income is 2 crore 12 lakh 10,000, which is already positive. Take 5% of that. Compare that with actual. 5% of that is 10 lakh 60,500. Actual is 1 crore 65 lakh. Therefore, 10 lakh 60,500 will be allowed as an head office expense. Now the question is not over. We need to find out compute the total income of the assessee. Now we will find out once again the total income. The loss is 28 lakhs. From total income, is depreciation allowed? Yes. So don't add back. Is unabsorbed depreciation allowed? Yes. So don't add back now. Now we are finding out total income. Okay. So unabsorbed depreciation is allowed from your PGBP income. Short-term capital loss. Is short-term capital loss is allowed from PGBP income? No. Add back this. Short-term capital loss now cannot be allowed against PGBP income because now you are computing the total income. VRS 4/5 disallowed, only 1/5 allowed. Speculative losses cannot be set off against your normal business. Add back. Chapter 6 deduction allowed? Yes, chapter 6 deduction allowed. Head office expense allowed, but only 10,65,000. This add back 165, and whatever is allowed, that is 10,60,500, that you can reduce. After doing all these things, you will get your income as 1,54,49,500. I hope it is clear to all of you. So beautiful question it is. Question number 3A, subpart 1, and then we will go to subpart 2. Subpart 1 is on electoral trust. There is an electoral trust which is formed in current year only. So the current year is the first year of the electoral trust. This is very important. Whether the electoral trust is formed in this year or it is formed in last year, it makes a great difference in finding out some data. Now they have received a voluntary contribution of 600 lakhs from various people. What is the job of an electoral trust? The electoral trust, whatever donation they receive, 95% they have to donate along with the surplus of last year to various political parties. That's it. If they donate 95%, then they are eligible for exemption. If they don't donate 95% of the total contribution received, then they are not eligible for exemption. Now, try to understand one by one thing. The trust is incorporated in the current year. It receives 600 lakhs as a voluntary contribution. Now, it spends 5 lakhs as expenses on management of its affairs. Obviously, it has to incur some expenses to manage the affairs of the trust. So, 5 lakh it has incurred. Now, they are asking us, what amount of surplus that can be distributed by the trust? They are asking us this. What amount of surplus that can be distributed by the trust? See, first of all, how much money the trust can incur on management of affairs? They have incurred 5 lakhs. Can they incur 5 lakhs? Let's try to understand. Okay. In the first year, the trust can incur 5% of the total donation or 5 lakh rupees, whichever is lower. That much they can incur. So they can incur 5% of 600 lakhs. 5% of 600 lakhs comes to 30 lakhs. Okay. Or 5 lakhs, whichever is lower. So they can incur up to 5 lakh rupees and they are incurring 5 lakhs only. So they are okay. So they can incur 5 lakhs out of 600 lakhs. Therefore, 595 lakhs will be distributable surplus. Correct? It is as simple as that. So what is the distributable surplus? Total donation. Out of that, whatever is the allowed management expenses as per law is 5 lakhs. Therefore, 595 lakhs will be considered to be a distributable surplus. This is part 1 of the question. Second part. What will be our answer if out of the total voluntary contribution of 600 lakhs, 100 lakhs is received from individuals who are not citizen of India? Then you are violating the provision. Why? Because as per the provisions of electoral trust under rule 17 CA, it is written that electoral trust shall not accept donation from foreign citizens. You are not allowed to take donations from foreign citizen. If you take donation from foreign citizen, then you are not eligible for what? You are not eligible for exemption only. I hope it is clear to all of you. Part 2. There is a trust. There is an institution which is covered under 1023(6). Now, they want to enjoy 1023C also and 1046 also. Can they enjoy the benefits of both of them together? No, they cannot enjoy both of them together. As per section 11 subsection 7, you can go and check. Section 11 subsection 7 says that if a trust wants to enjoy both, they cannot enjoy both of them. They have to enjoy one of them. There are 2 provisos below that. You can go and check. Okay. Next one is a very simple question of DTAA. You can go through that later on. It's a very simple question. We have done that such kind of questions earlier, lot of time. Okay. Now, next question. Question number 4. 4A1. Discuss the provisions of the Income Tax Act 1961 with respect to the collection or deduction of tax in the following situations. First of all, Mr. Bhavan has purchased an urban land in 2016. Now, the government in the current year has compulsorily acquired that land on 10th of April. The compensation was awarded to Bhavan was 4,40,000 on 10th of April, and then later on in the same financial year, they have given enhanced compensation of 1 lakh to Bhuvan or Bhavan, whomsoever it is, in the same financial year. Okay. So he has been given 2 compensation in the same financial year. First, on 10th of April 2025, he has been given 4,40,000 compensation, and then on 10th of December, he has been given 1 lakh compensation. Whether the government will deduct TDS, the answer is yes. Under which section? Under 194 LA. 194 LA says that when the government gives you what? Payment for compulsory acquisition in excess of 5 lakh rupees in a financial year. First of all, in 194 LA, the limit is 5 lakhs. The entire year payment should be more than 5 lakhs. Is it more than 5 lakhs? Yes, it is 5,40,000. then the government will deduct TDS at the rate of 10% on payment. In 194 LA, TDS is deducted on payment basis, not on accrual basis. I hope it is clear to all of you. Therefore, original plus enhanced compensation is more than 5 lakh. Therefore, TDS will be deducted. Next question. Question number 2. This is also a question on TDS, but which is on online gaming. Now, online gaming, practically it is not relevant, but yes. Section is there, therefore we are doing, because I have told you in the class also that the government of India has removed the concept of online gaming by playing money. Without money you can play online games. With money you cannot play online games. Now let's see what is going to happen in this case. There is a Dream 44 online gaming portal. Mr. Z is a gamer in that. He has a credit balance of 10,000 in the account. Further, he deposited 1 lakh rupees. So now the total amount available in his account, Dream 11 account, will be 1,10,000. Now he earned 30 lakh from online games. He has also received some referral bonus. So this referral bonus is not subject to tax. Okay, because it is used for the purpose of playing. So if referral bonus is used for the purpose of playing, then it is not taxable. If it is given and if you can withdraw that, then it is taxable. Okay. Now let's try to understand when the income will be taxable. See, in online gaming in 194BA, the TDS will be taxable at 30%. When you withdraw the winning or at the closing balance. At the time of withdrawal also it is taxable. At the time of closing balance also it is taxable. Now when is he withdrawing? First he is withdrawing on 1st of February 2026, 25 lakhs. Can I deduct TDS on 25 lakhs? No. You will deduct TDS at the rate of 30% on the winning. How to find out the winning? Very simple. Whatever is the withdrawal amount minus whatever is the opening balance and whatever he has deposited during the year. So the opening balance is 10,000. He has deposited 1 lakh. Therefore, withdrawal minus opening balance plus current year deposit will be subject to TDS. Therefore, on 1st February, the TDS amount will be 23.9 lakhs into 30%. Now, on 31st March, the balance in the account is 6,60,000. So now how the TDS will be applicable? Now wait. Now the TDS will be applicable as follows. Whatever he has withdrawn plus whatever is the closing balance minus how much he has deposited 1 lakh plus how much is the opening balance 10,000 minus 23.9 lakhs which is taxed earlier. So whatever is taxed earlier, you have to reduce that because you are adding the aggregate amount here. You are adding the current year entire withdrawal and you are also adding the closing balance. Okay. So now we have already paid tax something earlier on 23.9 lakhs. If you don't reduce that 23.9 lakhs now, then there will be duplication of tax. Therefore, reduce that first and then whatever amount is left on that 30% tax will be applicable. I hope it is clear to all of you. Coming to the next question. Next question is a simple question on transfer pricing. Okay. Surya Limited is here, which is in India. They are importing some raw material from Sun INC and Sun INC guarantees 20% of the total borrowing of Surya. So if one enterprise guarantees 10% or more of the total borrowings of another enterprise, therefore both of them are deemed to be associated. Therefore Surya and Sun are deemed to be associated. Now, we are importing some goods. We are importing some goods from whom? From Sun INC at 60 crore rupees from Sun INC. Now Sun INC, now listen carefully, it's a matter of mathematical calculation. What are you importing? You are importing. Surya is in India, Sun is outside India. Surya and Sun are associate enterprise because Sun guarantees 20% of the total loan. Now, Surya is importing what? Surya is importing 60 crore rupees goods from Sun INC. We need to find out the arm's length price of this. Now, Sun is charging a markup of 20%. Always remember. Sun is charging a markup of 20% for unrelated party, but to Surya it is charging more markup. It is charging 25% markup. Now, markup is always on cost. See, Sun is selling us at a cost plus 25%. Therefore, for us the selling price is 60. Now this is selling price. This 60 is selling price. Always remember, be very careful because this 60 is selling for Surya. So now if Sun is charging 25% markup to us on cost, therefore on sale it will be how much? It will be 20%. Be very careful. 1/4 on cost is 1/5 on sale. Therefore, this is selling price for Sun. For Sun it is selling price. On this, inside this, there is a cost plus there is a 25% margin. So 25% margin on cost is 20% on sale. Therefore, I will reduce what? 20% profit from here. This will give me cost of 48 lakh. Now you can recalculate. 48 lakh is cost for Sun. On that, they are charging 25% margin. That makes 60 lakhs. I hope it is clear to all of you. Apart from that, Sun is also providing some other things to us. Sun is allowing us to use the brand name of Sun. Surya was allowed to use the brand name of Sun. For that, they would have charged 1 crore rupees. So I have to add back that 1 crore rupees. Plus, Sun is also allowing us 1 month extra credit. Check here, please. To others, Sun only allow 1 month. But to us, it allows 2 months extra credit period. Therefore, they will charge 1 month extra cost of credit from us. 57.9 lakhs into 12% into 1 by 12. Okay, I hope it is clear to all of you. So after doing all, sir, how did you get 57.9? 48 plus 1 crore. Okay. Plus our margin. What is our margin? What is our margin? Our margin is 20%. We have to add back our margin also, correct? So therefore, after that, whatever amount will come, that will become your arm's length price. So be careful with the answer. 60 crore is the selling price for Sun, purchasing price for Surya. From that, I am reducing cost. I will get 48. I will add my arm's length margin. Arm's length margin is 20%. That is 9.6. Therefore, my cost is how much? My cost is 57.6. On that, I will add brand value. On that, I will add cost of capital. And then I will compare with my purchase price. Therefore, the differential amount will be added back. Okay, I hope it is clear to all of you. Part 2. What is the due date for Surya for furnishing the audit report under 92E? It is 1 month prior to the due date of filing of return. They are eligible for transfer pricing. Therefore, their due date for filing the tax audit report is 31st October. Okay. What is the amount of penalty if it fails to furnish the report under 92E? If you don't furnish the report under 92E, that is Form 3CB, then you are liable for a penalty of 271 BA, 1 lakh rupees. I hope it is clear to all of you. Next question. Let's go ahead with the next question. Question number 5A1. What is happening in this question? Mr. Balram Kumar is there, who is a jeweler. Now, the police has done some investigation, has found 1 kg gold from Mr. Balram. Now, the income tax department also came and they valued the gold to be around 63.3 lakhs. The assessee did not raise any objection on the gold. He agreed that yes, I have hide this particular gold. Now, during the assessment, the AO not satisfied with the explanation made by the assessee, and the AO added 63.3 lakh rupees as a unexplained jewelry under 69A. On that, the AO applied 115 BBE, that is 78% tax. The tax is 49.3137 lakhs, 78% of 63.3, and 12.35 lakhs he has applied as an interest. The assessee filed an appeal to Commissioner of Appeal. The Commissioner of Appeal allowed the appeal, and the addition of 63 lakhs was deleted by the CIT, and therefore the assessee won the case. So what is the story? The assessee won this case of 49.3 lakhs and 12.35 lakhs interest. Now the department wants to file an appeal to ITAT. Can they file an appeal to ITAT? The answer is no. Why, sir? Because to file an appeal to ITAT, there is a tax effect limit which is given by the law. The tax effect should be more than 60 lakh rupees if the department wants to file an appeal in ITAT. What is the tax effect? Tax effect means tax including surcharge and cess. Tax effect does not include interest, penalty. Therefore, what is the tax including surcharge and cess? It is 49.37 lakhs. Is it less than 60 lakhs? The answer is yes. Therefore, the department cannot appeal. I hope it is clear to all of you. The department cannot file an appeal because the tax is less than, tax including surcharge and cess is less than 60 lakhs. Tax effect does not include interest. Be very careful. Okay. Next one. Due to the nature and the complexity and the volume of the accounts of an assessee, during the assessment proceeding, the AO issued direction for inventory valuation. Can AO issue directions for inventory valuation? The answer is yes. The answer is yes. The AO can definitely issue inventory valuation direction under 142(2)(a). The relevant approval was taken by the AO. Now the AO has started making mistakes. The company was given an opportunity of being till here everything is correct. Now AO wants to appoint chartered accountant. No, inventory valuation is not done by chartered accountant. It is done by cost accountant. First mistake. The AO fixed the fees of inventory valuation as 2,50,000. No, the AO cannot fix the fees. The fees will be fixed by commissioner, principal commissioner, and it will be fixed as per the guidelines set by the government, which is 3,750 per hour to 7,500 per hour. It has to be within this range. Third, the CA was asked to raise the bill on the company. No, third mistake. The bill will not be paid by the company. The bill will not be paid by the assessee. All the expenses will be borne by central government itself. It is not going to be borne by the assessee. Be careful. So a lot of mistakes are there. You need to identify and say all these mistakes in this particular question. Next question, very simple, yaar. There is a telecom company and there are distributors. So telecom companies, they give SIM cards, give recharge coupons to the distributor. So if there is a principal relationship between both of them, then commission is not applicable, TDS is not applicable. If there is a principal agent relationship, then commission is applicable, TDS is applicable. In this case, there is a principal relationship because they are selling that particular thing. They are selling that to whom? They are selling that prepaid connections to the distributors. They are not giving it to the distributor. So if the telecom company is selling the coupons, selling the SIM cards to the distributor and telling them that is your duty, it is your headache to sell, we will not take it back, then it is a principal relationship. Therefore, commission is not applicable, TDS is not applicable. But if there is a principal agent relationship, then TDS will be applicable in this case. I hope it is clear to all of you. Let's go to the next question. Next question is a question of tax audit. Let's talk about this beautiful question. We need to comment whether the CA is guilty or not. There is an assessee by the name called as PQR Waste Management. It is a domestic company. They filed the return of 2324 AY on 30th September claiming deduction under 80IA. So they are claiming deduction under 80IA. Okay. So for claiming deduction under 80IA, you have to take a report from a CA in form 10 CCB. They have taken the report from 10 CCB from CA also. Everything is correct till here. But next year, the chartered accountant came to know that the period, tax holiday period is already expired in 22-23 only. And he has given a report for 23-24. Gross negligence by chartered accountant till here. I am not making any comment, final comment. So the CA gave a report for 23-24 that you can claim deduction under 80 CCB. But later on he came to know that the 10-year period is expired in 22-23. So whatever CA has done a mistake, he has rectified that. Now check. First, he has withdrawn his audit report. Second, he advised the company to file revised return. At that time, revised return was allowed to file till 1 year from the end of the relevant assessment year. Now you cannot revise the return after 31st December. So the assessee filed a revised return, assessee withdrawing the deduction under 80IA. So the assessee filed a revised return, 80IA deductions are withdrawn. The assessments were also completed. Nobody raised any question. The assessments were also done based on revised return only. The assessment done by the assessing officer was also done, disallowing the exemption. Disallowing the deduction under 80 IB, everything is correct. Now the department contended that the chartered accountant has issued form 10 CCB without ensuring the 10-year period has expired or not. The chartered accountant contended that as soon as he came to know, he withdraw the report, he informed the assessee, and then this form 10 CCB was not subject matter of any penalty proceeding or assessment proceeding. CA said that my report was not subject matter of any penalty or assessment proceeding. So is the CA guilty? No. CA will not be guilty. A CA will be guilty if he does not exercise due diligence or is grossly negligent. He has exercised his knowledge and wisdom and he has withdrawn the report. He has informed the company to change the deduction and the company has also done. It was not a part of assessment. The AO has also done the assessment based on revised return also. Therefore, the CA is not guilty in this case. I hope it is clear to all of you. Next question. There is a company, they are planning to acquire 5 JCB. The total depreciation on such JCB is about to be 30 lakhs. So instead of acquiring the JCB, they thought that we will lease the JCB. So they are not ready to purchase, but they are rather leasing it. The lease rentals are 36 lakhs. Whether this will be called as tax planning or tax evasion. It is tax planning. There is nothing wrong. Nobody can tell me what to buy, what to lease. If I don't want to buy and if I want to lease, how can the government stop me? The government cannot stop me to buy or stop me to lease. Whatever is more beneficial to me, I will do that. There is nothing wrong in that. There is nothing wrong in this. I hope it is clear to all of you. Second question is a beautiful question. Mr. Dhaval is 45-year-old. He is making investment in equity shares. Now during the year, he has made lot of capital gains, short-term capital gains of 10 lakh rupees. Now obviously he has to pay what? Tax on it. Now he was holding another portfolio of 1,000 equity shares which was purchased at 200, but now the price has fallen because of some reason. So there is a loss in the portfolio. So what he did, he sold all the shares and purchased all the shares next day. He sold at 200, booked the loss, and again he has purchased at 200 rupees. So now the question is, can you set off this loss against this income? Why not? This is called as tax harvesting. Everybody does this who knows this. There is nothing wrong in this. This is tax planning. Nobody can stop you to do tax harvesting. This is something which is a tax planning. That there is a capital gains on sale of shares. There is another portfolio which is lying in my portfolio and another set of shares which is lying in my portfolio in which there is a loss. I can sell that shares, purchase that immediately after that, and set off that loss against my capital gains. Nobody can stop you. This is called as tax harvesting, which is not allowed in some foreign countries, but in India it is allowed. So it is allowed, so do it. Nobody will stop you. Okay. And last but not least, ABC Limited is an Indian company. They are making an application to board for advance ruling in relation to tax liability of Pinnacle INC. So ABC Limited is entering into a transaction with a non-resident, so they want to make an application. The transaction value is 250 crore. Now, how many copies of application they have to make? First of all, they have to make 4 copies, quadruplicate. What is the fees? The fees is 5 lakh rupees. If the transaction value is more than 100 crore and up to 300 crore, then the fees is 5 lakh rupees. Second, if the board rejects, then what is the remedy? The board rejects, then the only remedy is appeal to High Court within 60 days plus 30 days extra time you will get. If there is a genuine reason, you will get an extension of 30 days. So this is what this paper is all about. Let's go ahead with the next paper, that is May 2025 paper. What is asked in this particular question? You are supposed to compute total income, tax payable. Whenever the word tax payable is there, always remember you need to take the credit of TDS, TCN and advance tax. Whenever they will write the word tax liability, then don't do all those things. But when they are asking tax payable, reduce all these 3 things. Okay. Then they are also asking, would it be beneficial for the company to opt for the concessional regime under 115BAA? Okay. So a lot of things are asking. But before that, one very important thing is, initially the associate was a partnership firm, then they converted into a company. So this entire scenario is that you are converting your partnership firm into company. Today it is a company. Today we are supposed to compute the total income and tax of company. But once upon a time, around 4 or 5 years back, they were a partnership firm. So there were 3 partners, Krishna, Kinara and Komals were partners in a partnership firm Triple K. Okay, now they have converted their partnership firm since 2016 to 2021. They were partnership firm, and after that they have converted that partnership firm into a company. Okay, on 1/4/2021 they have converted that into a company. All the assets are transferred from firm to company. All the partners are also transferred from firm to company. Their capital account, their shareholding is in the ratio of the capital account. They were not given any other consideration. Can you imagine such conditions somewhere? Such conditions were there in section 47(13). Remember, if a partnership firm is converted into a company or it is succeeded by a company in a business, then if all the partners are transferred and all the partners are getting the shares in the company in the same ratio in which their capital account stood, and if all the partners do not get any other consideration, and if all assets and liabilities are transferred and they maintain this particular, all the partners should be at least 50% and they should maintain this for a period of 5 years. If you fulfill all these conditions, then whatever capital assets are transferred from partnership firm to company, all of them will be exempt. Okay. So now there is some use of this later on in the question. Now today the associate is a company. Today it is not a partnership firm. But once upon a time it was a partnership firm. They have transferred their business and they have claimed exemption under capital gains in 2021. Now the company has a net profit of 1,19,25,000 rupees. Now the first thing which they have done is 1,17,000 they have paid to some road transporter. But they have paid in cash. Can you pay in cash to road transporter? Up to 35,000 you can pay as per 40A3. The first one is 26,000, that will be allowed. Second is 37,000, not allowed, disallowed. Third and fourth allowed, 22,000, 32,000 allowed, up to 35,000 it is allowed. Now, there is one more information which is given with respect to this. The company did not deduct TDS. Why? They should have deducted TDS, but they have not deducted TDS correctly because the payee, that is the transporter, has given a no deduction certificate. Check. So if the transporter has given no deduction certificate, I don't have to deduct any TDS from that. I hope it is clear to all of you. So the only disallowance will be this 37,000 rupees. Next, depreciation, add back. Next, out of the debtors that were transferred, one debtor became bad and the company cannot recover. Nothing could be recovered. Therefore, the company debited that 6 lakhs in the P&L. So one of the debtor of the partnership firm, it has become bad in the hands of the company. Can company claim deductions of the predecessor? The answer is yes. If the predecessor has sold some goods and it has become bad in the hands of successor, it is allowed as a deduction as per the Supreme Court judgment of T.V. Bhadra Rao K. Koteshwara Rao. Remember or not? So this 6 lakh rupees correctly claimed as deduction by the company. Because the company has already claimed that as a deduction, we don't have to do anything. Okay. Next one, very important adjustment. Dividend received from listed company, 5,40,000. Sir, should we gross up this? First of all, reduce from IFOs. Reduce from IFRS, show under what? Show under capital. Reduce from PGBP, show under IFRS. Do not gross up. Sir, why are we not grossing up? Because ICI has stopped grossing up the dividend unless and until it is written in the bracket that it is net of TDS. Otherwise, they are not grossing up. So you also don't gross up. In PGBP question, don't gross up dividend unless the ICI mentioned that it is net of TDS. Otherwise, don't gross up, please. Okay. So reduce from here and show under what? Income from other source. Show under income from other source. Okay. Now, next one is a very good adjustment. The company has invested in the shares of listed company through a stockbroker. During the financial year, the company paid 1,25,000 to the resident stockbroker as a commission for the purchase of shares. Whether this will be allowed as deduction? Not allowed, because the associate's business is not of what shares, na? If your business is not of shares, how can you claim the commission on sale of shares as a deduction under PGBP? It will not be allowed. Now they are doing some emotional atyachar. No shares were sold during the year. So what? No TDS was deducted on. TDS is not applicable only on commission on securities. If I purchase any security from a stockbroker and if I pay commission, TDS is not applicable under 194H. Question of TDS does not arise only. This expenditure itself is not a business expense. Therefore, it shall be disallowed under the income tax law. Disallowed means it is not allowed as a deduction. Okay. It is not allowed as a deduction. Next one. Depreciation as per income tax is 15,78,000 that you can claim as a deduction. Okay. Now, there is one important information which is given over here. A machinery HYC that the firm has used earlier was transferred to company at the time of succession. Okay. The machinery was formed part of 15% block. Okay. WDV of the machinery today is 12 lakhs. Now you are discarding that machinery for 15,78,000. So there was some machinery which was there with the firm. That machinery you have got. The WDV of the machinery today is 12 lakhs. Now you are discarding that machinery. Okay. So what? What should I do with that? Nothing can be done. Leave it. Sir, why leave it? Why leave it, sir? Because this is only discarded. This cannot be reduced from the block of asset. Why? I have told you earlier, only those machineries and those assets are reduced from block of asset where there is a money payable. There is no money payable on this. Because there is no money payable, you don't have to reduce this machinery from the block of asset. Okay. So therefore, you will claim full 15,78,000 depreciation on it. I hope it is clear to all of you. Now they have made a problem. Remember that partners which are coming from firm to company, the partners which are coming from firm to company, they should hold at least 50% of the shares in the company and they should hold that for a period of 5 years from the date of succession. Now, the shareholding pattern can be seen as follows. Krishna 30%, Kenara 25%, Komal 20%. These three are holding 75%. Now, others are holding 25%. So, it is correct. But they have made a problem. Krisha sold 95% of her holdings to her daughter-in-law, Kirat. Now, because Krisha has sold 95% of the shareholding to her daughter-in-law. So, 95% of this will come to how much? 28.5%. 28.5% sold. Therefore, Krisha now hold only 1.5%. Kinana hold 20% and Komal holds 20%. Therefore, 25 plus 20, 45 plus 1.5, 46.5%. Now, it is below 50%. Therefore, now because it is below 50%, listen carefully. Okay. Because it is below 50%, be very careful. Now you cannot do one thing. What is that one thing, sir? Now, because it is below 50%, there are two consequences you have to bear. First of all, some old capital gains was there. Some old capital gains was there, which was exempted in 4713. Now that will become deemed capital gains. Why? Because we have violated the condition within 5 years. So that capital gains which got exempted on succession, the capital gains which got exempted on succession now will become taxable. You have to add back this to income and tax on this 12.5% tax. Second, this business loss will also not be allowed to you, because the losses of the firm can be carried forward by the company. The losses of the firm can be carried forward by the company only if you fulfill this condition. You are violating this condition of 50%. Now, because you are violating this condition, this loss also cannot be set off to you. I hope it is clear to all of you. And one last adjustment, very simple. The company holds 65% stake in a private company, which is a closely held company, and therefore that company has given a loan of 15 lakhs to the company. The accumulated profits of the company is 31 lakhs. Therefore, deemed dividend will be taxable in the hands of the company, because the company holds 10% or more voting power in a private company, which is a closely held company. That company is giving 15 lakhs loan, but the accumulated profit is only 31 lakhs. Therefore, deemed dividend will be 15 lakhs. 15 lakhs will be taxable as income from other source under 222E in the hands of company. Now, we need to find out the total income. and tax payable. Now, while computing tax payable, let's compute total income. Total income, whatever it is, after that you will apply tax rate. The turnover of last to last year is 390 crore. Therefore, the tax rate will, the turnover of last to last year is 408 crore. Because the turnover of last to last year is 408 crore, therefore your tax rate will be 30%. This is the first thing. Second thing, be very careful. LTCG will be subject to 12.5%. Other incomes will be subject to 30% tax surcharge if applicable. Now we need to find out tax payable. So I will take TDS credit of 2 dividends. First of all, on this dividend of 5,40,000 rupees, on this dividend of 5,40,000, where is dividend of 5,40,000? This 5,40,000 dividend, the company who have paid me dividend, they would have deducted 10% TDS, correct? So on this 54,000, I will get credit, and on this dividend of 15 lakh rupees deemed dividend, on this also I will get credit of 10%. So this 1.5 lakh TDS credit I will get, and there 5,40,000 TDS credit I will get. 5,40,000, 10% is 54,000, 15 lakh, 10% is 1.5 lakh. So 1.5 plus 54, 2,04,000 I will take as a TDS credit. I hope it is clear. Be very careful. Now last but not least, would it be beneficial for the company? Then you find out under 115BAA whether it is beneficial or not. The income is same only. There is nothing which will be added in this question in 115BAA, nothing. You can check, all the adjustments are same. Just tax rate will change. Long-term capital gains will be chargeable at 12.5% and rest of the incomes will be chargeable at 22% plus 10% surcharge plus 4% cess. Check whichever is more beneficial. I hope it is clear to all of you. Very simple question. Second question. Question number 2. A very simple question once again on what? On partnership firm. There is a partnership firm LLP etc. in which there are 3 partners J, K and L, of which J and K are working partners. Partnership deed authorized 14% interest per annum, 14% cannot be allowed, only 12% allowed, and deed also authorizes remuneration to working partners of 75,000 rupees per month. Now what are we supposed to find out? We are supposed to find out total income and tax payable. Ignore AMT. We are not supposed to find out AMT. Now let's try to find out the total income. First of all, the partnership firm is earning income from 2 places. One, they are earning income from 10AA, another they are earning income from 35AD. Now let's talk about from 10AA, how much they are earning. They are earning from 10AA, their profit from 10AA is 24 lakhs. You can check it over here. So I am writing SEZ profit 24 lakhs. Then their profit from 35AD business, warehousing facility, it is 30 lakhs. So I am writing warehousing facility 30 lakhs. Okay. So 2 profits I have added back. Now I will compute their income. First of all, 14%. Whenever there is a partnership firm question and a remuneration is given, you have to first find out book profit. So first we will find out book profit as per 40B. Interest 14% not allowed, 2% add back. So I will add back 2% interest. Then salary to all partners is also debited to P&L. 9 lakh each you are giving to all partners. So 27 lakh salary you will add back. Then you will claim 35AD deductions. Let's try to claim 35AD deductions. You have incurred a capital expenditure of 60 lakhs. Out of that 35 lakh is land. Therefore only 25 lakhs will be allowed as deduction. Okay. Because 25 lakhs is on building. You can claim building, you cannot claim land under 35AD. Then you will get your book profit. Okay. After book profit, you will compute your remuneration. You will compute your maximum, whatever is your maximum amount, whatever it is. Okay. Then you will compare that with 18 lakhs. Only 2 partners remuneration can be considered. Okay. Only 2 partners remuneration. 75,000 into 2 partners into 12. That will come to 18 lakh rupees. Compare with actual, whichever is lower will be allowed as deduction. Now you will claim 10AA deduction. For 10AA, your profit is, you have started the unit in 2020. Therefore, this is the 6th year of operation. Therefore, you will get 50% deduction. So 24 lakh is your profit of the undertaking. Multiply by export turnover 90 lakhs. Total turnover 120 lakhs. So multiply by export turnover, divide by total turnover 50%. You will claim deduction under 10AA. After that, you will get your profit and then you will compute your tax 31.2%. Very simple. Okay, this is your part 1. Part 2. Assume that the LLP has filed the return late. So if the LLP has filed the return late, will they get deduction of 10AA and 35AD? The answer is yes and no both. See, if you file late return now, then you cannot get 10AA. 10AA is not allowed if you file the return late. But yes, for 35AD, there is no condition that you should file the return on time. There is nothing like that. For 35AD, there is no condition that you should file the return on time. But for 10AA and other profit linked deductions, you have to file the return on time if you want to claim the deductions. I hope it is clear to all of you. So it's a very, very good question. Next question is also a good question. Joseph is a non-resident and he is also a person of Indian origin. Therefore, Chapter 12A will apply here. Chapter 12A NRI special provision. Remember or not? They have asked you to compute the total income of Joseph as per the special provisions of Chapter 12A. You have to find out special provisions of Chapter 12A only. You have to compute as per Chapter 12A only. Plus, you need to also keep in mind Joseph has shifted to opt out of default regime. So, for other incomes which are not covered in Chapter 12A, you will follow old regime. So, for incomes which are covered in Chapter 12A, you will follow Chapter 12A. For incomes which are not covered in Chapter 12A, you will follow old regime. First of all, sale proceeds of listed equity shares in A Limited, 6 lakhs. Is it covered in Chapter 12A? Yes. Equity shares are covered. Equity shares of a public and private companies are covered in Chapter 6A. Plus, you have purchased in foreign currency. Therefore, it is covered in Chapter 12A. Chapter 2, not Chapter 6A. By mistake, I have told you. Chapter 12A, it is covered. So, let's find out this first of all. 6 lakh is the sale consideration minus expense on transfer 50,000 minus 1 lakh 10,000 cost. Therefore, capital gains is 4.4 lakhs. Now, if you want to save this 4.4 lakh capital gains, you should invest in specified assets within 6 months from the date of transfer. When are you transferring? You are transferring on 31st May. You are investing fresh investment in the Indian Public Limited Company. Whether Indian Public Limited Company specified asset, the answer is yes. Are you investing within time? Yes, we are investing within time. 31st May to 11th November, it is within 6 months. June, July, August, September, October, November. We have time till 30th November. You are investing in what? You are investing on 11th November only. Therefore, you are eligible for exemption under 115F. How much exemption? Proportionate exemption. Whatever is the gain, 4.4 lakhs. Multiply by amount invested, 2.2 lakhs. Divided by net consideration, 5.5 lakhs. If I would have invested instead of 2.2 lakhs, full 5.5 lakhs, then full exemption would have been given. But because I am not investing full consideration, I am only investing 2.2 lakhs, therefore I will get proportionate exemption. I hope it is clear to all of you. So first 3 points are done. Next, interest on government security, net of TDS, acquired in foreign currency. Is government security covered in Chapter 12A? Yes, government security is covered in Chapter 12A if you acquired in foreign currency. But this is net of TDS, so you have to gross up. What is the tax rate? 20.8%. You have to gross up. This is 79.2%. So 100 is how much? Cross multiply, find out. Gross up. Next, interest on deposit with public limited company. This is also acquired in foreign exchange. Is deposit of public limited covered in Chapter 12A? Yes, deposit of public limited is covered in Chapter 12A. Deposit of private limited is not covered. Plus, if you purchase in foreign currency, yes, it is a deposit of public limited company. It is purchased in foreign currency, but the expenses will not be allowed. Yet it is already grossed up, so you don't have to gross up. So tax this directly 3,25,000 into 20.8%. Don't reduce expenses. Expenses are not allowed in Chapter 12A. Then interest on deposit with private company. Private company deposits are not covered in Chapter 12A. On this, you have to apply slab rates. On this, you have to apply what? Slab rates as per the old regime. So, on 5,55,000 rupees, you have to apply slab rates as per the old regime. Beautiful question it is. Let's go ahead with the next question. Question number 3. So, there is a charitable trust which is registered under 12AB. They are engaged in providing some facilities to old age home to senior citizens. They are providing some facilities to senior citizens in old age homes. Now, the total receipts of the trust is 145 lakhs. Now, during the year, there is a contribution which is received from Mr. Keshav, a resident individual, amounting to 1,20,000 rupees. So, the trust is receiving a contribution of 1,20,000 from Mr. Keshav. Now, Mr. Keshav will become what? Will become specified person. How, sir? He is a substantial contributor as per section 13 subsection 3. How? Amendment is there in Finance Act 2025. If any person is contributing more than 1 lakh rupees in the entire financial year or aggregate up to the end of financial year 10 lakh rupees over the years up to 10 lakh rupees by the end of the year, then he is a substantial contributor. So Keshav is contributing more than 1 lakh in the current financial year. He is contributing 1,50,000 rupees. 1,20,000, sorry. So Keshav is a substantial contributor. Now you cannot pass benefits to Keshav. If you pass benefits to Keshav, a lot of consequences you have to bear. So now you are giving unsecured loan to Keshav. You cannot do that. You cannot give unsecured loan to your substantial contributor who is a specified person. So now the trust is guilty of this. Therefore, trust will be liable for tax under specified income under 115 BBI on 5 lakh rupees 30%. They will also be liable for a penalty under 271 AE. They will not be liable for exemption under 11 and 12 on that much amount. Whatever amount they have received from what? whatever amount they have received from Keshav, if they apply that money, that 1,20,000, if they apply, they will not be eligible for what? They will not be eligible for exemption. So lot of consequences the trust has to bear for passing on benefits, unreasonable benefits to whom? To the substantial contributor. Sir, what is the penalty under 271 AAE? First time it is 100% of the benefits passed on. Second time onwards it is 200% of the benefits passed on. I hope it is clear to all of you. Next one. There is a trust which is registered under 12AB. They are running a hospital. They receive voluntary contribution of 95 lakhs. That is corpus donation. Now, you know that you have to exempt corpus donation, then you have to invest in the public sector company or in the mode specified in 11.5. So, the company received corpus, the trust received corpus donations. They have invested that in the mode specified in 11.5. They have invested in public sector company. On which date? They have invested in financial year 24-25. Now, next year on 31st March 2026, due to disinvestment by the government, the company ceases to be a public sector company. Is there any mistake of the assessee? No. If you invest in the mode specified in 11.5, which is a public sector company, and the public sector company ceases to be a public sector company, then 3 years from the date of seizure till 3 years from the date of seizure. When is the company ceasing to be a public sector company? 31st March 2026. So till 31st March 2029, you don't have to worry. Till 31st March 2029, no consequences will be there against you. Yes, once 31st March 2029 will be over, then the department will ask, where have you invested the money? So by 31st March 2029, you need to remove the money and put it in the mode specified in 11.5. I hope it is clear to all of you. Next one, there is a trust which is registered under 12AB. They have paid some consultancy charge of 1 lakh rupees to doctor. Should they deduct TDS? The answer is yes. Mutatis mutandis. A trust is also liable to deduct TDS. If they are not deducting TDS, then their expense will also be disallowed under PGBP. The way it is disallowed under PGBP, 30% expenditure will be disallowed for trust also. Mutatis mutandis, remember or not? 30% of the expenditure of the trust will be disallowed under income tax law. Now the trust is making an argument, my last year tax audit was not done. So all those things are not relevant for trust. Those are relevant for individual HUF. Last year tax audit to be checked. Last year turnover is more than 1 crore. Last year gross receipt is more than 50 lakh. All those things have to be checked for whom? For individual HUF, not for trust. I hope it is clear to all of you. Let's go ahead with the next question. Next question is on DTAA. Good question. Small question, easy question, but good question. Meera is 28 years old. She is a resident and she provides management consultancy to small and medium sized operations in corporations in India and abroad. She provides some management consultancy services in India also. She provides some management consultancy services outside India also. Now, we are supposed to compute her total income, tax payable as per the default regime. As per the default regime, that is as per new regime, sorry. India does not have DTAA with foreign country. Okay. Now let's start. First, she is earning 3,75,000 from providing consultancy in India, and in country case she is earning 12 lakhs. Expenses is 9,60,000 and 2,50,000. Then rent from shop, expenses incurred in earning this rent, so on and so forth. That's the only two incomes which she is earning. Now, additional information. Country K provides two options for management consultancy. They are providing two options. Pay 20% tax without deduction, pay 30% tax after deduction, and you have to take whichever is more beneficial. As it is written in the question that you have to opt the best one, lowest possible tax. So which is more beneficial? Let's see. If they want to pay tax directly on 12 lakhs, then pay 20%. Or if they want to reduce the expense, then pay 37%. What do you feel which is more beneficial? Paying 37% is more beneficial. Sorry, paying 20% is more beneficial. Again, I am saying, if they want to directly pay tax, pay 20% on this consultancy income in country K. Or they can pay 12 lakhs minus 2.5 lakhs, 37% tax, which will be more beneficial. Paying 20% tax will be more beneficial for them according to me. So that is better for them. Okay. What about house property? For house property, they are getting a flat deduction of 20% in country K. So now we will compute the income in India. How we will compute? See, what all things I will take in India? 35,70,000 I will take in India. I will reduce 9,60,000 expense. Then I will take 12 lakhs in India, and then I will reduce what? Reduce what? 2,50,000 in India. In India, I will reduce everything, na? In India, I'm not going to leave anything. Correct or not? In India, I will reduce everything. I will take everything in India. Then for rent, I will take 55,000 minus 30% standard deduction. I will do all these things. I will compute tax in India. I will find out average rate in India. Now I will find out average rate in foreign country. Sir, how will you find out average rate in foreign country? For that, I will take tax in foreign country in the numerator and income in foreign country in the denominator. Sir, what is tax in foreign country in the numerator and what is the income in the denominator? Let's see. See, for management consultancy, we are going for 12 lakh option, correct? So we are taking income as 12 lakhs, of that 20% tax. And for rental income, it is what? It is 55,000 into 12. So 55,000 into 12, and we are getting 20% deduction over there. So therefore, for rental income, it is 5,28,000. And what is the tax rate in foreign country? It is 27% for rental income. So I'm taking 27% in the numerator. So I will get the average rate in India. And then I will compare this average rate in foreign country with average rate in India, and whichever is lower, I will apply on the doubly tax income. I hope it is clear to all of you. So to find out the average rate in foreign country, we need to take two taxes. First, tax on management consultancy divided by income of management consultancy, because directly paying 20% on 12 lakhs is more beneficial. Then tax on 5,28,000. How did I get 5,28,000? 55,000 into 12 minus I'm getting 20% standard deduction in foreign country on house property. So this is my income of house property in foreign country. On that 27% tax is 147,560. Then I will get average rate in foreign country. I will apply that on doubly tax. Whichever is lower, that will be beneficial for me in India. I hope it is clear to all of you. Next question is on TDS. Let's see. Question number 4A1. There is a non-resident company which is incorporated in country Y. They have factory across the world. In India also they have a factory. It means in India also they have a permanent establishment. Now, their turnover is too much, 200 crore, 400 crore, too much turnover, and they are purchasing some raw material of 1 crore rupees in the current year from a domestic company. So, are they liable for deducting TDS? The answer is yes. Why, sir? Even non-resident buyers deduct TDS in 194Q? Yes. In 194Q, non-resident buyers are also covered if they have a permanent establishment in India. Now, this non-resident buyer has a factory in India, which is a permanent establishment. So, if a non-resident buyer has a permanent establishment in India, they are also liable for 194Q. Other conditions are fulfilled. Like, last year business turnover is more than 10 crore? Definitely. Like, are they purchasing more than 50 lakh rupees? Yes, they are purchasing 1 crore rupees. They are purchasing how much? 1 crore rupees. So, they are liable to deduct TDS on 50 lakh rupees. How much? 0.5%, 0.1%. 0.1% TDS will be deducted on 50 lakh rupees. Next question. There is a domestic company which is paying lot of commission and other charges for their business promotion. So for the promotion and to boost sales, they are paying a lot of commission. First, they paid commission of 1,75,000 on 13th of July. Therefore, 194H will apply 2% TDS on commission. Then again they are paying commission of 1,60,000. 194H will apply because 194H is applicable if you pay commission of more than 20,000 rupees in the entire financial year. Then other incentive they are giving 1,60,000. What does this other incentive includes? It includes reimbursement of expenses for family members and Prakash. 1 lakh rupees for Prakash and 60,000 for his family members who has accompanied Prakash. 194R will apply here. 194R. What is 194R? If I give any benefit or perquisite in business and profession, and if it is more than 20,000 rupees in the entire financial year, then I am liable to deduct TDS under 194R at the rate of 10%. So that's what the company is doing. The company is giving other incentives to Prakash and his family of 1 lakh rupees and then 60,000 again. 194R. Then again they are giving some laptop to Prakash for achieving sales target. Again 194R will apply at the rate of 10%. I hope it is clear to all of you. 194R is applicable here also. Next question. Antique Master is an online website. It is working like an e-auction services. See, under 194O we have done one provision where it is written that for e-auction services TDS is not applicable, provided they should restrict their activity only to listing and pricing. That's it. They should not go beyond that. So, if you are only restricted to, if the e-auction services are only restricted to price discovery, they are not liable to deduct TDS. But here, in this case, they are taking money from buyer and then they are transferring to seller account. All these things you are not supposed to do. If you do all these things, then you are liable to deduct TDS under 194O. E-auction services are exempted from 194O only if you are restricting yourself to price discovery. If you are going beyond that, you are liable to deduct TDS. In this case, therefore, you are liable to deduct TDS on 11 lakh rupees at the rate of 0.1%. I hope it is clear to all of you. Now, next one is a transfer pricing question, simple question. Indiana Limited is an Indian company. It is engaged in manufacturing and trading of various electronic items, electronic projectors mainly. Indiana has the following stakes in different foreign entities. First of all, you need to say whether they are associated or not. First, Indiana holds 30% voting right in Star GmbH. Whether both of them are associated, the answer is yes. Indiana and Star GmbH are associated because one enterprise holds 26% or more of the voting power of another enterprise. Therefore, both of them are deemed to be associate enterprise. Second point, it appoints 6 directors in Moon Inc. Moon Inc. has 15 directors. No, they are not associated. If you want to become associated, you should appoint more than half of the directors. Therefore, they are not associated. Third, it has given a guarantee for a loan of 12 million euros. The total borrowing is 150 million. Therefore, it is also less than what? 10%. If you want to become associated, you should be having at least 10%. You should at least give guarantee for 10% of the loan of the other entity, or you should at least hold 51. If you should at least finance 51% of the total book value of the other enterprise. So here Indiana is not giving 10% guarantee of the total loan. Neither Indiana is giving what? Indiana is giving 51% of the finance to the other entity of the total book value of asset. Therefore, they are also not associate entity. Only Star GmbH and Indiana are associate entity. The second and the third transactions are not associate entity. So first question is that only. Whether Star, Moon and Asteroid are associated, only Star is associated, Moon and Asteroid are not. Justification you have to write properly. It is not MCQ, please. Now, with Star, whatever transaction you are doing, that is subject to transfer pricing. Indiana bought 1000 units of electronic projects from Star for 15,000 for resale. It sold these projects in India without doing any modification. The gross profit margin earned from such resale was 20%. Star GmbH provide after sale service of 1 year. The cost of warranty is 3% of sale price. Now you need to be very careful with this. You need to be careful. You have to apply resale price method in case of Star GmbH. What is first step of resale price method? The first step of resale price method, the price at which you buy from associate enterprise and resale to your third party. First step of resale price method, identify the price which is purchased from associate enterprise and then resale price, resale to third party. You are purchasing at 15,000 rupees and you are reselling at a margin of 20%. It means on sale price, 20% on sale price. Okay. So therefore, this 15,000 is your cost. This is your sale price. So you need to find out the resale price. So 15,000 is 80%. So 100% is how much? Cross multiply, you will get your 18,750. 18,750 is the selling price of one product. Again, I am saying 15,000 is the price at which you are buying from Star GmbH. And you are reselling at 20% of sale price. But this is your cost. This is not your sale. Okay. So you need to find out what? The price. 20% of this you have to add back. You will get 18,750 rupees. Multiply by 1000 units, you will get your resale price. From that, you will reduce your normal margin. What is your normal margin? Your normal margin you will see from Moon Inc. Moon Inc. charges how much? Moon Inc. charges 30%. So from that, you will reduce 30%. Because Moon Inc. was also purchasing similar electronic project. Asteroid is doing something else only. Don't consider Asteroid as your unrelated party. Take Moon Inc. as your unrelated party. Reduce that normal GP, you will get your cost. Then Star GmbH also gives you warranty for 1 year. So that for that you need to add warranty cost. Warranty cost you have to add back. That is 187.5 into 3% into 3 by 12. Cost of warranty is 3% of the sales. So that you have to add back. After that you will get your selling price, arm's length price. I hope it is clear to all of you. Then you compare that with 15,000 rupees. Whatever is the difference you add back. So this is what this question is all about. Let's go to the next question. Question number 5A1. What is 5A1? Beautiful question. Rajinish is a resident individual. He has made some false entry in the books of account. Therefore, the AO is imposing penalty under 271 AAD for making false entry equivalent to the false entry. If you make any false entry in the books of accounts, AO has the power to make a penalty under 271 AAD. The penalty is likely to be around 3 crores. Now, to recover this penalty, The AO is doing provisional attachment on 31st May. The AO is of the opinion that to protect the revenue, it is important. So he has taken the prior approval from commissioner and has attached provisional attachment. So question number 1 is, can he do the provisional attachment in this case? The answer is yes. Generally, the AO can do provisional attachment under 281B only during the pendency of assessment proceeding, generally, to protect the interest of revenue. He has to take approval from higher authority. But only during one penalty proceeding also he can do. Generally, during assessment proceeding he can do. But during penalty proceeding, he cannot do provisional attachment. There is only one penalty proceeding during which he can do provisional attachment, that is 271 AD. That too, if the penalty amount is more than 2 crore rupees. Check. So, is the action of the AO valid? The answer is yes. Is there any monetary limit? Yes. For 271 AAD, the penalty should be more than 2 crore rupees. Second part, assume all procedures of the provisional attachment have been made. Discuss the validity of such provisional attachment and can it be extended. First of all, validity is, it is 6 months on the date of order. Whenever the AO will pass the provisional attachment order, it will be applicable for 6 months. Can it be extended? Yes, it can be extended. Therefore, when has the order been made? The order is made on 31st May. Therefore, it is valid till 30th November 2025. It will be valid till 30th November 2025. Now, can it be extended? Yes, it can be extended up to 2 years or before completion of 60 days from the end of the completion of assessment, whichever is later. So, it can be extended for further 2 years or after completion of assessment, another 60 days, whichever is later. Third, is there any option available to Mr. Rajneesh where such provision attachment can be avoided? Yes. Your property is getting attached? Yes. You don't want it to be attached? I don't want it to be attached. I want to sell that property. So, whatever is the market value of the property, that much you have to give what? A bank guarantee from a scheduled bank. So, if you give a bank guarantee from a scheduled bank of the value equivalent to the property, market value FMB equivalent to the property, then the department will not do provision attachment. I hope it is clear to all of you. Next question is of Lakshman Das Khandelwal. Lakshman Das Khandelwal, we have done this particular case law earlier, but again I will tell you because it's a very, very, very important case law for us in the examination. So what is this case law? Pay attention please. Generally, if a late scrutiny notice comes under 143.2 or an improper notice comes under 143.2 and if you cooperate, then the provision of 292BB is applicable. That it is deemed to be valid, it is deemed to be proper. But what if the notice has not come only and if you cooperate? Whether in that case, whether 292BB can apply? No, 292BB cannot apply if the notice has not been sent by the department. So 292BB can only cure those defects where the notice has come late and you have cooperated, then it is deemed to be valid, or where the notice has come improper, you have cooperated, you have not raised objection, and then it is deemed to be valid. But if the notice has not come only, then 292BB cannot attract. That's what it is written in the case of Lakshman Das Khandelwal. Next question is also a very good question of BDR Finvest. The assessee, the payer has deducted the TDS, but the payer has not paid the TDS. So if the payer has deducted the TDS, but the payer has not paid the TDS, therefore in Form 26AS of the payee, the tax amount will not be reflected. The TDS credit will not be shown. So the question over here in front of the court was whether the payee will get the credit of TDS which is not reflected in 26AS even though the payer has deducted it. The payer has deducted the TDS, not paid the TDS, whether the payee should get the credit of TDS without reflection in the 26AS. The court said that yes, the assessee can get the TDS. The moment the payer has deducted the TDS, even though it is not reflected in 26AS, the payee can claim the credit. I hope it is clear to all of you. Beautiful question. Question number 6. What is question number 6, sir? Let's see. It's a small question on tax audit. Mr. Ram is engaged in trading of mobiles and is a proprietor of 6 Mrs. Narang Mobile, some company is there. He is a proprietor of that. Now the turnover is 5 crore 12 lakhs. Out of that, 22 lakh is received in cash and remaining online, and he has made a payment of 5 crore 50 lakhs, 28 lakhs in cash remaining online. The first question is he required to make the books of accounts audited? The answer is no. Why, sir? Narang is the answer is yes, he is liable to get the books of accounts audited. Why, sir? Why Narang is supposed to get the books of accounts audited? See, what is the turnover for getting the books of accounts audited? 1 crore. If the turnover of business exceeds 1 crore, you are supposed to get the accounts audited. But sir, for some people it is 10 crore also. Yes. For some people, it is 10 crore, provided your cash receipt is up to 5% of total receipt and your cash payment is also up to 5% of total payment. In this case, let's check whether Narang is fulfilling both the conditions or not. The cash receipt is 22 lakh. Cash receipt is, the total receipt is 502 lakh. Therefore, cash receipt is 4.29%. This condition is fulfilled. The cash payment is 28 lakh. The total payment is 550 lakh. This is crossing 5%. Therefore, Narang is not fulfilling this particular condition. Therefore, because the turnover of Narang is 5 crore 12 lakh, he is supposed to get the accounts audited. He will not get the benefit of 12 lakh, or he will not get the benefit of 10 crore rupees. I hope it is clear to all of you. Second question in the same. Narang has issued an invoice of 3,50,000 to Messrs. XYZ and Company for sale of mobile phones. XYZ and Company made 2,50,000 through account pay check and 1 lakh in cash. Is the tax auditor required to report this? No. The tax auditor is required to report this transaction only if the cash receipt is 2 lakh or more. If the cash receipt is less than 2 lakh, there is no need to report this in Form 3CB or Form 3CD, whatever it is. So because in this case, the cash receipt is only 1 lakh, the auditor is not required to report that in Form 3CD. I hope it is clear to all of you. Next question is a very simple question. 100 times we have done this. There are two units. One is eligible for SEZ deduction 10AA. Another is not eligible for SEZ deduction. Whether they are doing transaction with each other, whether GAR will apply, GAR will not apply. Because in that case, SAR is there. Specific anti-avoidance rule is there. One unit is in SEZ. Another unit is in non-SEZ. If they sell anything to each other, then the provisions of SAR is applicable. GAR is not applicable. Specific anti-avoidance rule is there. There is no need to apply GAR in that case. I hope it is clear to all of you. Why? Because there is domestic transfer pricing in that case. If one unit is eligible for ATIA, ATIB 10AA, another is not eligible. If they sell each other anything, then the domestic transfer pricing is applicable, provided the transaction value for domestic transfer pricing should exceed 20 crore rupees. Otherwise, domestic transfer pricing is not applicable. I hope it is clear to all of you. And last question over here. There is an Indian company. They are entering into an agreement for providing some technical know-how to a foreign company. Now, the agreement is expected to be 500 crore. The tax liability is expected to be 150 crore. Can they make an application to board for advance ruling? Yes. A resident can make an application for board for advance ruling if the transaction value is more than 100 crore. In this case, the transaction value is 500 crore. Therefore, they can apply for advance ruling. Second, can the advance ruling authority, can the board ask for production of books of accounts? Yes. The board has given, the board for advance ruling has been given the same powers which are there under section 131 to issue summon by the income tax authority. 4 powers are given under 131. All 4 are given to board for advance ruling also. That is the power to issue commission, the power to compel production of books of accounts, the power to enforce attendance of a person, and also the power for, last one, the power for compel production of books of accounts, I have said, issued commission, I have said, power for discovery and inspection. All 4 powers are also given for board for advance ruling. So this is what this question and this paper is all about. Just go through it once. Let's go ahead with the next paper, that is September 2025 paper. The very first question again is on what? Is on total income, etc. Compute total income, ignore MAT, ignore 115BAA. Okay, ignore all these things and compute total income. Now, Asasi is a resident company engaged in manufacturing of leather product. Always remember, whenever you are engaged in manufacturing of leather, apparel or footwear, then under 80JJAA, you are eligible to claim the deduction even if you employ the employment for only 150 days. Generally, if you want to claim 80JJAA, you should employ the employee for how many days? 240 days. But if you are engaged in these 3 businesses which I have told you just now, you are eligible for 150 days also. Okay, be very careful. Very small point, but very important point. The profit is 97,38,000. You are doing some foreign travel. Your directors are going outside India for some foreign travel to set up a new project in new project plant in London. Therefore, this will be disallowed because it is not related to existing project. It is related to a new project. Therefore, it will be disallowed under the income tax law. Okay, very, very important point. Next one is a very good point. You are purchasing some goods of 4 lakh rupees from a micro enterprise on 16th of March. Okay. Now, on 16th of March, you are purchasing some goods. There is an agreement between both of them that you will pay the money in 48 days, but 48 days are not considered to be correct. It is maximum 45 days if there is a agreement between both of them. If I agree that with you that I will pay in 48 days, as per MSME Act, 48 days is not sufficient. 45 days maximum is allowed. So I am purchasing on 16th of March. Okay. When am I making payment? I am making the payment on 29th of April. 29th of April, if I am making the payment, I have actually made the payment within 44 days. Check please. 16th March, I am purchasing. Maximum 8 days, 45 days maximum it is allowed, but I am making the payment on 29th of April. So I am making in 44 days because I am making the payment on time, that is within 45 days. I will be getting the deduction on accrual basis, and my accrual basis means in the current financial year itself. I will get the deduction in the current financial year itself, that is in 24-25. I hope it is clear to all of you. Be very careful. Next one is also a very good adjustment. You have taken some premise on rent. For that you have given some security deposit. To the landlord, you have given some security deposit of 6.5 lakh. Now, due to unforeseen situation, the landlord has forfeited that money and is not giving you that money. So, this is a loss. It's a capital loss. It's a capital loss. Therefore, it is not allowed as reduction under the income tax law. I hope it is clear to all of you. It is a capital loss. Therefore, it is not allowed as a deduction under the income tax law. Next, there is some profit on hedging of a loss in foreign currency for importing a printing machinery of 110 lakhs. So first of all, this profit you will reduce from PGBP. Second, this profit you will adjust in the cost of asset as per 43A, because this profit is with respect to a machinery which is imported on which there is a foreign currency loss. So whenever you import a machinery on which there is a foreign currency loss, you have to adjust the loss on profit in the WDV of the block of asset. So you have purchased the machinery for 110 lakhs. So first of all, first effect, reduce 6.25 lakhs from PGBP. Then reduce 6.25 lakhs from 110 lakhs, and then compute your normal depreciation 7.5%. Why normal depreciation 7.5%? Because the machinery is put to use for less than 180 days, and additional depreciation of 10% because the machinery is put to use for less than 180 days. I hope it is clear to all of you. Next, depreciation of 13 lakhs you can claim under PGBP. You can claim depreciation 13 lakhs under PGBP. Next, you have sold one plot of land with a profit of 15 lakhs to a wholly owned subsidiary. Generally, if you sell any capital asset to your subsidiary, it is exempt, but in this case, it is not exempt because here you are selling to a foreign company. Check please, Russian owned company. So this is not exempt, this is taxable. So reduce this from PGBP and show as capital gains under capital gains and pay tax on that. Reduce 15 lakhs from PGBP. Now, the information about this plot of land is given in point number 1. Check please. You are selling for 32 lakhs. You have purchased this land for 32 lakhs. The stamp duty value is 60 lakhs. Okay, so you will take the stamp duty value as your consideration. Okay, cost of acquisition 32 lakhs. 28 lakhs will be capital gains, which will be subject to what? 12.5% tax. Next, very routine adjustment, provision for payment of gratuity is disallowed under 48(7). What is actually paid will be allowed under PGBP. Okay, so the provision will be disallowed under 48(7). Actual payment will be allowed under PGBP. Next one, very important adjustment. 150 days are sufficient. First of all, we will get deduction only for regular employees. For casual employees, we will not take deduction because casual employees do not participate in the provident fund. And if you want to claim deduction under 80JJAA, participation in provident fund is mandatory. Casual employees do not participate. So you cannot get for casual employees. Second, you cannot get for employees whose emolument is more than 25,000 rupees. Therefore, you cannot get for these first 82 employees. Yes, can I claim for this employees? Yes, for this employees I can claim. Here I am fulfilling all the conditions. If the employees are employed on 1st September, they are eligible for what? They are eligible because they are employed for 150 days or more. Assessee is a leather manufacturing assessee. Regular employees participate in emoluments. Emolument does not exceed 25,000. Exact 25,000 is okay. For last category of employees also I cannot claim 80JJAA. Why? Because the employment is less than 150 days here in this case. I hope it is clear to all of you. And last but not least, you are purchasing some 7,500 equity shares at a price of 40. The fair market value of the share is 95. Therefore, there will be a gift taxation for purchasing the shares for inadequate consideration. 7,500 shares into 95 minus 40, that is into 55, will be chargeable as income from other source. You are only supposed to compute what? Total income. And the depreciation on fixed asset is 12,60,000. This is excluding the imported machinery. Therefore, on imported machinery, we are separately computing depreciation. They are talking about this point number 4. We are separately computing depreciation. How? 110 lakhs minus 6.25 lakhs. On that, you are computing 7.5% normal depreciation, additional depreciation 10%. I hope it is clear to all of you. So, this is what this question is all about. Very, very simple question, nothing great. Let's go to question number 2. Very good question. Message PR is an AOP. it is an AOP. And there are two members. PR Associates is an AOP, and there are two members, Mr. P and Mr. R. Mr. P is following old regime and Mr. R is following new regime. Okay, now what are we supposed to do? We are supposed to compute the tax liability of PR Associates and Mr. R. We are not supposed to compute for Mr. P. We are supposed to compute for Mr. R. We are supposed to compute for PR Associates. Now, both of them have a share of 65% and 35% in the AOP. Be very careful now. Again, I am telling you what we are supposed to do. We are supposed to just compute total income of AOP and Mr. R, not for Mr. P. For Mr. P, we are not supposed to compute. Now, what is the total income of AOP? It is 11,80,000. Now, Mr. P is earning 2,40,000, 45,000, and he is following old regime. So his income is less than basic exemption limit. Mr. R is earning 2,97,000. His income is also below basic exemption limit. Okay. He is following new regime. So again I am saying Mr. P is following old regime. So his income is below basic exemption limit. Mr. R income is also below basic exemption limit because he is following new regime. In new regime, the basic exemption limit is 4 lakh now. So therefore all the members are poor. If all the members are poor, the AOP will pay tax at slab rates. So the AOP will pay tax at the slab rates only. So for AOP, 11,80,000 will be subject to slab rates. Up to 4 lakh, no tax. Above 4 lakhs, up to 8 lakhs, 5%, then 10%, etc., etc. Okay, be very careful. Now, for Mr. R, what are we going to do? Mr. R will have two income. One is 2,97,000 as other income, and one is 35% of AOP income. 35% of AOP income will also be added here. So therefore, the total income of Mr. R will be 7,10,000, and Mr. R is following new regime. Now, because Mr. R is following new regime and his total income is up to 7,10,000, therefore close your eyes and up to 12 lakhs, it is full rebate. Up to 12 lakhs, Mr. R is not liable to pay any tax. Therefore, you can claim full rebate under 87A. There is no need to compute rebate under 86 separately. Directly under 87A, you can say that full amount is exempted. I hope it is clear to all of you. It is fully exempt, not subject to a single rupee tax. Now, the second question is a beautiful question. This is a very good question. You need to be careful with this question. Shivansh purchased 11,000 equity shares at 10 each at a premium of 40 per share. It means Shivansh has purchased the shares for 50 rupees. Now, on 7th of October, the company buybacks 1,000 equity shares. What is the company doing? Company is buying back 1,000 equity shares. So, after this, Shivansh holds how much? Only 10,000 shares. Now, on this 1,000 equity shares, if the company is buying back, that will be deemed dividend in the hands of Shivansh. 1,000 into 550, 1,000 into 550 per share will be deemed dividend as per 222F amendment by FA 24. Further, on this 1,000 shares, there will be a capital loss. Under 46A, full value of consideration always 0. Cost of acquisition, 1,000 shares into 50 rupees per share is the cost, 40 plus 10. So, this 50,000 rupees loss. So, keep these two things separately. 5,50,000 deemed dividend and long-term capital loss 50,000. Now, let's go ahead. This ABC Limited has distributed assets to its shareholders on liquidation. Now, the ABC Limited is getting liquidated. How much shares Shivansh has? Shivansh after buyback has 10,000 shares. Before buyback, he had 11,000. Now, he has 10,000 shares. Shivansh received 100 rupees per share in cash. It means 10 lakh he will receive in cash. Correct? Plus, he will also receive one plot. The market value of that plot is how much? The market value of that plot is 60 lakhs. So, Shivansh is total receiving 70 lakhs from company on liquidation. So, whatever company distributes on liquidation, that is deemed dividend in the hands of the shareholder. But to the extent the company possesses accumulated profits. Now, listen carefully. The total equity shares of the company is 1 lakh, out of which Shivansh holds, Assassi holds 10,000. Therefore, Assassi holds only how much? 10% of the shares. Now, Shivansh is getting assets worth rupees 70 lakhs. The accumulated profits of the company is 8 lakh. How much is attributed to Shivansh out of 80 lakhs? Only 8 lakhs. So, Shivansh is getting assets worth 70 lakhs, cash plus asset, and Shivansh accumulated profits is only 8 lakhs. Therefore, deemed dividend will be 8 lakhs. I hope it is clear to all of you. Don't compare 70 lakhs with 80 lakhs. 80 lakhs is for all the shareholders and 70 lakhs is only for Shivansh. Therefore, you have to compare 70 lakhs with 10% of 80 lakhs. Therefore, deemed dividend under 222C will be 8 lakhs. Now, we will compute capital gains of Shivansh. Whatever amount received is FVC 10 plus 60 minus whatever deemed dividend under 222C will be reduced. 62 lakhs will be the net consideration. From that you will reduce cost of acquisition. What is the cost of 10,000 shares? The cost of 10,000 shares you can see in the first paragraph. 40 plus 10, it is 5 lakh rupees. So 57 lakhs is the capital gains long term. So now this 50,000 long term capital loss you can set off against this 57 lakh long term capital gains. Long term capital loss can set off against long term capital gains. I hope it is clear to all of you. Beautiful question it is. Very intelligent question. Next question. Bit to INC is a FII. Whenever FII will come now, always remember 115AD is applicable. Now you are supposed to compute total income and tax liability of bit to INC. Whenever FII will come, 115AD will apply. First short term capital gain is given. So short term capital gains of equity shares on which STT is paid, that will be subject to 20% tax plus 4% says 118 it is. Now normal short term capital gains on which STT is not paid, that will be taxable at 30% under 115AD. Go and check. Long term capital gains, two views are taken by ICI because the question is not clear whether it is 112A STT paid long term capital gains or not STT paid long term capital gains. You can assume anything. If you assume STT paid long term capital gains, then 12.5% subject to 1.25 lakh exemption. If you assume not STT paid, then directly 12.5%. Then interest received from Indian company, 20% tax, but you have to gross up because the word interest is given. For FII, interest and dividend is taxable at 20% under 115AD. So you will take 20% on this, but you have to gross up because receive word is given. Dividend directly income is given, take 20%. Interest on other security directly income is given, directly 20%, no need to gross up here. Okay, then compute the tax liability. I hope it is clear to all of you. Let's move on to next question. Question number 3A. Now this is a very good question on taxation of trust. In this question, we are supposed to compute the total income of the trust. A charitable trust is engaged in relief of poor. It derives an income of 114 lakhs. First of all, 1 crore 10 lakh is derived from property, so add that to the income. Then some accrued interest they have earned on fixed deposit, so add that also to income. Then you will claim 15% what exemption. So there are two incomes that the trust is earning. One they are earning from property, another they are earning from accrued interest. So you will reduce 15% from there. Okay, till here everything is very simple. Now, the trust has applied 86 lakhs towards charitable purpose. Now let's see which all things will be allowed out of this 86 lakhs. First of all, 80,000 electricity bill of last year is paid in the current year. So it will be allowed in the current year. Okay, because for trust application is allowed on payment basis. So this 80,000 will be allowed in the current year. Then 4,72,000 including GST of 72,000 is paid to a company for advertisement. But they have not deducted TDS, they have made the full payment. Therefore 30% of 4 lakh will be disallowed. So 30% of 4 lakh comes to 1.2 lakhs. 1.2 lakhs will not be allowed to you. So out of 472, 1.2 lakhs will be disallowed because you should deduct TDS. Now. You have not deducted, you have remitted the full amount 472. Wrong. You should deduct TDS on the excluding GST amount. On GST amount, we don't deduct TDS. Therefore, 30% of 4 lakh will be disallowed. Therefore, 4 lakh 72 minus 1.2 lakhs, 3.52 lakhs will be allowed to you out of 472. Okay. Then, 5 lakh you have paid to another trust by way of donation other than corpus donation. Other than corpus donation is allowed as deduction, but only 85% is allowed. Okay. So, out of 86 lakhs, total application you have made how much? 86 lakhs. 80,000 will be directly minus. 4.72 is allowed subject to only 3.25 lakhs. You cannot take 4.72. And 5 lakhs also you cannot take 5 lakhs. You can take 85% of 5 lakhs. So rest of the amount will be allowed as application. So how will you claim the deduction? Check. After this 15%, first you will reduce 80,000. Then you will reduce 3.52 lakhs. Then you will reduce 85% of 5 lakhs. And then you will reduce 75.5 lakhs. You cannot reduce these three fully. Out of this 80,000, already you have reduced 80. Out of this 4.72, you have already reduced 3.52. Out of this 5 lakhs, you have already reduced 85%. Therefore, rest of the amount will be allowed as an application. I hope it is clear to all of you. Beautiful question it is. Next question, we have already done a similar question of DDAA. You can check it, please. Let's go ahead with the next question. Question number 4. This is a question on TDS. In part 1, there is one couple, husband and wife, Mr. and Mrs. A. They are fully purchasing some flat in Lucknow. For that they have paid 86 lakh to the builders jointly, half. 4 lakh they have paid for car parking, 250 they have paid for generator costs, swimming pool they have paid 1,50,000. The stamp duty value of the property is 75 lakh, but the consideration, total consideration is 94 lakhs. 47, both of them have paid. Are they supposed to deduct TDS? First of all, in 194 IA, the TDS is deducted if the value of the property is 50 lakh or more, or the stamp duty value is 50 lakh or more, whichever is higher. Here the value of the property is 94 lakhs. Sir, will we take all these things also? Yes, in consideration you have to take everything. Everything is included in consideration. So therefore, the value of the property is 94 lakhs. Now, husband is paying 47 lakh, wife is paying 47 lakh, doesn't matter. You don't have to check who is paying how much. You have to check the value of the property. If husband and wife aggregate is also paying 50 lakh or more, TDS is applicable. Therefore, wife will deduct 1%, husband will deduct 1% on their respective share. I hope it is clear to all of you. Wife will deduct 1% on 47 lakh, husband will deduct 1% on 47 lakh. Both of them have to deduct 1%. Next question is a very simple question. There is an employee who is earning a salary of 37 lakh 50,000. He is following new regime. Therefore, his net salary is 36 lakh 75,000. Is also earning. In new regime, he will not get deduction of house property SOP loss. SOP loss not allowed in new regime. Now, he is also earning interest from a fixed deposit in the State Bank of India. Now, while the employer will deduct TDS, will the employer give the credit of interest TDS and car purchase TCS also? The answer is yes. From 1st October 2024, the employer is supposed to give the credit of TCS also. Collected at any other place. So, whatever tax will come from that, the employer will first give the credit of TDS deducted by bank, then he will give the credit of TCS collected by car dealer, then whatever amount is left, that will be deducted by the company under section 192. I hope it is clear to all of you. Next question. There is a cooperative bank who has made a fixed deposit with Union Bank of India. They are paying 2.5% per annum as an interest. TDS will not be deducted under 194A. In 194A, there is a clear exemption for bank, cooperative bank and post office. If you are making payment, Union Bank will be making payment to a cooperative bank. So, if a Union Bank is making payment to cooperative bank of interest, TDS will not be applicable in 194A. Now, the cooperative bank is withdrawing 4 crore rupees in cash. Even 194N will not apply. In 194N also there is a clear exemption for bank, cooperative bank and post office. If a bank, cooperative bank or post office withdraw amount, then 194N TDS is not applicable in that case. I hope it is clear to all of you. Let's move on to the next question, which is a very simple question. Very simple question of DTAA. Beta Limited is an Indian company in which Robert INC holds 30%. Are both of them associated? Yes, both of them are associated as it is 26% or more voting power. Now, during the financial year, Beta supplied some 700 pieces to Robert at 1100, whereas to other party they supply at 1400. Therefore, 300 will be added back. Okay. First question, would Beta and Robert INC be treated as associate enterprise? The answer is yes. If yes, why? You have to just write that because one enterprise holds 26% or more of the voting power of another enterprise. Therefore, both of them are deemed to be associate enterprise. Second part, what are the options available to Beta Limited if it accepts the enhancement of income? How much income will be enhanced? Income will be enhanced by $300 per pieces into $700 into whatever is the dollar rate you have to identify, and then you have to write down the entire story of the secondary adjustment. That if this much is added back, if $300 is added back per pieces, then they have to bring back the money to India within 90 days from the due date of filing of return. If they don't bring the money back to India within 90 days, then secondary adjustment will be applicable. For that, you have to find out the rate of interest. You need to find out the period. One more option is there. What? You can pay one-time additional tax of 20.9664 and you will be relieved from secondary adjustment after that. You have to write down the entire provision of secondary adjustment in this particular case. Question number 5. Very good question. In case of an assessee, very good question. Try to understand the dates over here. For that, you need to know some dates now, which I will speak again. The AO has passed an order under 143.3 on 15 December. So, 15 December, AO has passed an assessment order. That is in 22-23, the AO has passed an assessment order. Then on 26th of March, the CIT has passed a revisionary order. Can he pass? Yes, he can. The revisionary order can be passed within 2 years from the end of the financial year in which the order sought to be revised was passed. The order sought to be revised was passed in 22-23. Within 2 years from that, the end of that year is 31st March 2025. You can pass. Now, in the order, the CIT said that I will tell the AO to make the fresh assessment. Can the CIT tell the AO to make fresh assessment? Yes, CIT can confirm, CIT can annul, CIT can also what? Tell the AO to make a fresh assessment. Now, that order was dispatched to the assessee. The AO issued notice under 142(1) to the assessee on 6th of May for making fresh assessment. Now the assessee is making an argument that this is a time barred assessment because this is time barred by CIT because assessee got to know about this. Assessee got to know about this after 2 years. What is the last date by which the CIT is supposed to pass the order? 31st March 2025. 2 years from the end of the financial year in which the order sought to be revised was passed. The order sought to be revised was passed in 22-23. The commissioner passed the order on 26th of March, 31st March 2025, before 31st March 2025. Now assessee is making an argument, I came to know on 6th of May. Now when you came to know is not important. What is written in section 263, the CIT should pass an order within 2 years from the end of the financial year in which the order sought to be revised was passed. So has the CIT passed the order within 2 years? The answer is important. That is important. What is important is the order should be made within 2 years. Has the CIT made the order? Made the order means has the CIT passed the order within 2 years? If the CIT has passed the order within 2 years, then it is a valid order. When you have come to know, you can come to know after 2 years also. Assessee can come to know after 2 years. What is important is CIT should pass the order within 2 years. I hope it is clear to all of you. Next question. This is also a very intelligent question. Rama has filed as return of income claiming bad debts. Then return was processed under 143(1). You filed the return got processed under the software. Thereafter, the AO noticed that the assessee has wrongly claimed the amount of bad debts, so AO issued 154 notice. But unfortunately, this notice was after the expiry of time limit under 154(7), that is 4 years. The AO can send notice up to 4 years, but he has sent after 4 years. And then he initiated 154. During 154, he issued notice under 148A also. Now he wants to start 148A also. So first he started 154. During that 154 itself, he wants to start with income escaping assessment also. Can he parallelly start both the proceedings at the same time? The answer is no. The court said that because 154 is already in pendency, you cannot start with the fresh proceedings here. First complete that and then you can start with 148A. I hope it is clear to all of you. The third one is something which we have just done in the previous paper also. There is a charitable trust who is paying a rent of 30 lakh. They have not deducted TDS. They should deduct TDS. Mutatis mutandis. Last year turnover and all is not applicable for charitable trust. Those are applicable for individual HUF for deducting TDS. Therefore, here, if they have not deducted TDS, 30% expenditure will be disallowed in this case. I hope it is clear to all of you. Then there are some theory questions. You can go through it. Next question. Next question we have done earlier. You can go and check. Okay. There is only difference over here is you have to now comment on this based on what tax audit. You remember that in the chapter of transfer pricing, I will explain once. In the chapter of transfer pricing, I have told you one thing, that in 94B, limitation of interest, there is a non-resident associate enterprise. If the non-resident gives me loan, I pay interest, that is covered in 94B first. But there are two deemed debt also. If the third party is giving me loan and if the third party non-resident is giving what, associated entity is giving what guarantee, then that is also covered in 94B. Third thing is there. That is important in the context of this question. Third thing is there. If the non-resident is giving a matching amount and third party is giving me a loan, then that is also covered. Now let's assume if the non-resident associate entity is giving a 5 crore deposit to third party and that third party is giving me 5 crore loan, then that is covered in 94B because it is matching. What if that party is giving 5 crore but the third party is giving me only 2 crore? Then it is not matching. So in that I have told you, you can take two opinions. In that I have told you, you can take two opinions. One, you can say that it is not matching. Second, which is correct opinion, you can say that it is partly matching. Even though it is not fully matching, it is partly matching. So there is a difference in opinion. So if there is a difference in opinion, what will you do as a tax auditor? You will mention that difference in opinion in your form 3CB. And you will also mention that in clause 30B subclause A. that there is a difference in opinion between me and the assessee, or there are two views which can be taken. We are taking one of the views. I hope it is clear to all of you. And the next question we have done earlier, you can go and check. Okay. And the last question over here is, there is a non-resident who has made an application for board for advance ruling. Now they want to withdraw such application. Can they do so? Yes, they can. You can withdraw the application within 30 days from the date of application. If you make an application for advance ruling, you have an option to withdraw that within 30 days. Now, second question, what is the time limit within which the board for advance ruling will pass the ruling? It is 6 months from the date of application. Whenever you will make an application within 6 months from the date of application, they will what? They will give you the ruling. Okay, maximum 6 months time they take. So this is what this paper is all about. Just go through it once, then we'll go ahead. Let's go ahead with the next paper, that is Jan 2026 paper. Question number 1. What are they asking in this question number 1? Let's read the last line. They have asked us to compute total income and tax liability as per the regular provision. Assessee has not applied for 115BAA, but they have asked, would it be beneficial for M Auto to opt for beneficial tax rate? Then we will go for 115BAA at the end. First, we will compute as per the normal provision, as per the regular provision. The turnover of last to last year is 350 crore, that is up to 400 crore. Therefore, the tax rate will be 25%. Let's start with the adjustment. The assessee is a manufacturer. It is in June 2024. They have started a new unit at Patna. For manufacturing of automobile accessories. Separate books of accounts are maintained for both the units. One unit is in Lucknow, and in 2024 they have started with another unit at Patna. So there are two units over here. Now they have given us the statement of profit and loss account of Lucknow unit. The profit is 50 lakh rupees. Now, first of all, they are paying a commission of 2,50,000 rupees to a non-resident who does not have any office in India. So, if the non-resident does not have any PE in India, therefore his income will not be taxable in India. If the non-resident's income is not taxable in India, the question of TDS does not arise. And if the question of TDS does not arise, and if you don't deduct the TDS, the expenditure cannot be disallowed. Therefore, in this case, the expenditure will be allowed because you are making a payment to a non-resident whose income is not taxable only in India. Therefore, if income is not taxable, why will I deduct TDS? Therefore, this expenditure will be allowed to me. Okay. Now, you are providing some standard warranty to your customer as a replacement free of charge. Approximate charges are around 0.5%. Approximate provision you are making is around 0.5% of the sales amount of 5 lakh rupees. So this is the provision of warranty. In every business there is some portion which can be considered as a standard warranty, which is the present obligation, which can be considered as reasonable warranty. So because it is a present obligation, the company knows with past experience that around 0.5% of the sales are going to go under warranty. Therefore, that much provision the company makes. So that is a normal business expense. You can claim that as a deduction. Nothing wrong as such. Okay. Next one, you are contributing 6 lakh as a contribution to what? National pension scheme. Only 14% is allowed. You are contributing 20%. Therefore, only 14% is allowed. Therefore, you have to add back 6% over here. More than 14% will not be allowed as deduction. Okay. Next one. The company has issued 10,000 equity share, 10,000 debentures during the year, out of which 200 debentures were converted into shares. So, if you incur any expenses on conversion of debentures into shares, then that is allowed as a revenue expense. There is nothing wrong in that. Okay. So, because it is not a permanent capital in the company, conversion of capital, conversion of what debentures into shares, which will be converted in future. Now it is not converted. You are incurring expenses for issue of convertible debentures. So, if you incur any expense for issuing convertible debentures, that can be allowed as an expense. Nothing wrong. Next one, very intelligent adjustment. The company's branch office was located in old building, taken on rent. Okay, so the company has taken a building on rent. So I am taking a building on rent. On that, I am doing a capital expenditure. Can I claim depreciation on that? Yes, you can claim. It will be considered as deemed building in your case. You can claim depreciation on that. So I can claim depreciation on that. Yes, you can. So if I have taken a building on rent, on that I am doing capital expenditure. I cannot claim that as a revenue expense under section 30, but you can claim that as a depreciation. So on this 20 lakh rupees, which is a capital expenditure on somebody else's building, I will claim 10% depreciation on that is 2 lakh rupees. Okay. As the building is used for more than 180 days, I am assuming that it is more than 180 days. I don't know the date of incurring the capital expenditure. I don't know. That information is not given in the question. So I am writing in the note that it is assumed that it is used for more than 180 days. And I am claiming what? Depreciation. Next one. You are entering into a non-compete fees with someone. Okay. And you are making a payment for non-compete fees. Okay. How much? 12 lakh rupees without deduction of TDS. Now, whatever non-compete fees you pay now, for that there are two views which are taken by ICAI. In practical life also there are debates. First, people say that claim it as a revenue expense. Second, people say that claim it as a what? As an intangible asset and claim depreciation. Now, if you claim that as a revenue expense, then you should have deduct TDS under 194J, because in 194J non-compete fees is covered. Again, I am saying, if you claim that as a revenue expense, you should have claimed TDS under 194J. You should have deducted. Now, you have not deducted TDS, therefore 30% expenditure will be disallowed. What is the second opinion we can take? We can take second opinion is we can take this 12 lakh rupees as an intangible asset. In that case, if you claim that as an intangible asset, then there is no need to deduct TDS, because then it is not a non-compete fees. It is not, TDS is not required in case of assets. So in that case, you can claim 25% depreciation. I hope it is clear to all of you. So whatever view you want to take, ICAI has taken both the view. While solving the question, ICAI has taken revenue expense, but in the note, ICAI has mentioned intangible asset. Okay. Now, let's talk about the Patna unit now. The Patna unit before depreciation has a net profit of 25 lakhs. Okay. Now, there are some asset information which they have given. There is a plant and machinery of 15% depreciation, opening WDV 14 lakh 75. Okay. Then you have purchased one machinery for 10 lakh rupees. Okay. I will add to the block of asset. Then you have purchased another machinery in August for 6 lakhs. I will add that. And then I will reduce all the machines were sold. That is the opening machines were sold for 15 lakhs. So now the WDV is 15 lakh 75,000. Now I will claim normal depreciation of 15% on the entire WDV, but on this August machinery, which is a new machinery. June machinery is an old machinery, but August machinery is new machinery. So on this August machinery, I will also claim 20% additional depreciation. Be careful, because that is new machinery. June machinery is old machinery. On that, you will only get normal depreciation. The next adjustment is same, which we have done earlier also, but again we will see. You have purchased some plot of land in 2010-11, which is acquired by government compulsorily in 2022, and they have given you what? They have given you original compensation of 10 lakh. Out of which 8 lakh was received in 23 and balance 2 lakh was received in 23 once again. Okay, in April and October. So on that you would have paid tax in 23-24. Now the court has awarded you 7 lakh rupees additional compensation. So that will also be taxable. 4 lakh received in 23. So that 4 lakh you would have paid tax in 23. And on this 3 lakh you are receiving in the current year. So on this 3 lakh you will pay tax in the current year. Okay. I hope it is clear to all of you. So out of this entire transaction, only this 3 lakh is received in the current year. So this 3 lakh will be taxable as long-term capital gain. Sir, why long-term? Because if the original compensation is long-term, then the enhance is also long-term. If the original is short-term, then enhance is also short-term. I hope it is clear to all of you. Next one. You are also receiving interest on additional compensation. Interest on additional compensation is taxable under IFRS with 50% flat deduction. So IFRS you will show 12 lakhs minus 50%, 6 lakhs flat deduction, 6 lakhs is taxable. I hope it is clear to all of you. Now this is the income under the normal provision. After that you compute the tax. Now you will compute income under 115BAA. In 115BAA there is only one item which will be added back. That is additional depreciation on this 6 lakh machinery you have to add back. That's it. That's the only thing which you are going to add back in 115BAA. There is nothing else. Okay. And then you check whichever is more beneficial. So this is what this question is all about. Let's move on to the next question. Next question. Again a beautiful question. This was a dangerous paper. Huh? You all know that Jan 2026 paper was a conceptual paper. Only students who have done the studies conceptually, all 50-hour batch, 60-hour batch, 100-hour concept batch, this batch, all those students have gone. They have cried like anything. Jan 26 was a very, very dangerous paper. Question number 2. A Limited is an Indian company. Be very careful. It is a wholly owned subsidiary of another company, Indian company, E Limited. Both of them are 100% holding subsidiary. Both of them are Indian company. Now, on 1st of October 2020, A Limited sold a plot of land to E. Exempt. Why? If a 100% holding subsidiary A transfers capital asset to another subsidiary, which is also 100% holding subsidiary, the recipient has to be Indian company, it is exempt. So this transaction is exempt. This 15 lakh land which is sold for 35 lakhs is exempt under section 47(4). It is exempt. Now, but this exemption is subject to condition. Two conditions. The recipient, the receiver should not convert this asset into stock in trade for a period of 8 years. and the 100% holding relationship, subsidiary relationship should be there for a period of 8 years. So 100% relationship should be there for a period of 8 years, and the recipient should not convert this into stock in trade, but they have done a mistake. Within 3 years, E Limited converted this into stock in trade. So first, because it is converted within 3 years, now whatever capital gains was exempt earlier, that will be subject to tax. That will be subject to tax. So 35 lakhs will be the full value of consideration. What was the purchase price of the asset? 15 lakhs into, in which year it was transferred? It was transferred in 2020-21. 2021 indexation was 301 divided by 148. 2009-10 indexation. Whatever capital gains, this much capital gains was exempt now. This was capital gains was exempt in 20. That will be taxable now. So you will take the tax rates of earlier year only. Yes, the tax rates of earlier year only will applicable. Everything will be applicable as per earlier year, but will be taxed now. So why are you taking indexation? Because it is not deemed income of the current year. It is written in the law. It will be taxable in the year to which it pertains. So it pertains to 2021. Therefore, it will be taxable as per 2021 today. Now, second tax implication in the hands of E Limited. In the hands of E Limited has to do two things. E Limited is converting a capital asset into stock in trade. So now 45 subsection 2 will be applicable in the hands of E Limited. So for capital gains, what will you do? This is very simple. For capital gains, you will take fair market value on the date of conversion. What is the fair market value on the date of conversion? 65 lakhs, 60 lakhs. And for PGBP, what you will do? You will take 65 lakhs as PGBP. So PGBP will be 65 lakhs minus 60. And for capital gains, you will take what? The fair market value on the date of conversion. Okay. I hope it is clear to all of you. So nothing great as such. Okay. So two implications will be there. One, initially in the hands of A Limited, exempt. Later on, it will be income because E Limited has violated the provision. Then in the hands of E Limited, two taxes. One under capital gains, one under PGBP. Second question. Again a dangerous question. S Limited is a domestic company. Purchased its own shares on 10th November. The consideration was 25 lakhs. The amount received by the company on 1/4/2021 for issue of 10,000 shares was 100 per share was 15 lakhs, including premium. Now, this is the story of S Limited. There is a company who is buying back its own shares. Now, there is a person by the name called as Rohan, who acquired 100 shares of S Limited at 150 per share. At a premium of 50%, he sold these shares to Divyam at 200 per share. Divyam received 250 shares in buyback scheme of S Limited in respect of all 100 shares is purchased from Rohan. Now listen carefully one by one. Very dangerous now. Very dangerous. Part 1 is not relevant today because this is an amendment made by FA 24 that was relevant in last year. As I have told you before, 1st October 2024, what used to happen in case of buyback, the company used to pay additional tax. But after 1st October 2024, it is not the company who paid tax, it is the shareholder who paid tax under deemed dividend and loss under capital gains. Therefore, no additional tax will be applicable in part 1. Discuss the taxability of the amount received on account of buyback of such shares in the hands of Divyam. Yes, for Divyam, it will be deemed dividend. How many shares of Divyam they are buying back? Check. Discuss the tax liability on received on account of such buyback of shares in the hands of Divyam. So for Divyam is getting how much shares? How much rupees? Divyam is getting 250 rupees per shares. Listen carefully. Divyam is getting 250 rupees per shares in respect of 100 shares. Therefore, for Divyam, the buyback amount would be, deemed dividend will be 250 into 100, that is 25,000 will be deemed income in the hands of Divyam. That's it. That's the only tax implication in the hands of Divyam. There is no other thing. Will your answer change? Again, this part is not relevant for me as of now. Why, sir? Because again, this is an old provision. Now, in today's context, in the context of FA 25, all these questions are not relevant. So, this question is only relevant to the extent of point number 2. How much amount will be taxable in the hands of Divyam in case of buyback? Only 25,000 rupees will be taxable. And obviously, some capital losses will also be booked under 46A. Why? Because to the extent the shares are bought back by the company, that much cost of acquisition of the shares will be considered as what? Will be considered as loss under 46A. Question number 3 we will talk about. This is a very dangerous question. What is there in this question? We are supposed to compute total income and tax liability. Assume that he has opted from opted out from the default regime, it means we are supposed to compute as per old regime, step by step. First of all, Manoj is 47-year-old. He left for employment in United States in 2010. Around 15 years back, he left outside India. Since then, he is staying in India. And his wife is staying in Delhi in India. He is staying in USA since then. He has not come to India. That's good. After 10-11, Manoj never stayed for more than 30 days in India. He was outside India only. Therefore, I can definitely say that Manoj is non-resident. Now, if you are a non-resident, which income is taxable? Only income which are accrued in India or which are received in India, only that much will be taxable in India. Other incomes will not be taxable in India. I hope it is clear to all of you. Now, he remitted $40,000 in joint bank account of his wife at Punjab National Bank. His wife invested in Manoj's name 13 lakh rupees, listed shares. So, this will be taxable in India when the Manoj will sell this listed shares. Because this listed shares are invested in domestic company of India. When it is sold, it is accrued in the hands of Manoj. Now, Manoj has purchased shares of 13 lakhs in India. These shares were sold for 15 lakhs. STT was paid both at the time of purchase and sale. Therefore, it is 112A shares. Now, here you have to apply grandfathering clause. Grandfathering clause has to be applied. Why? Because you are purchasing listed shares. STT is paid, you are purchasing before 2018, you are selling after 2018, grandfathering clause will apply. But unfortunately, in this question, the FMV as on 31st Jan 2018 is not given. So I always say that whenever FMV as on 31st Jan 2018 is given, you are just assume, you just close your eyes and say that it is grandfathering clause. But sometimes even if the FMV as on 31st Jan 2018 is not given, then also there can be a grandfathering clause applicable, like this in this case. In this case, grandfathering clause will be applicable. I hope it is clear to all of you. Why? Because you are purchasing listed company shares, you are purchasing Indian company shares, you are purchasing shares on which STT is paid. Therefore, FMBS on 31st Jan is not given. If it is not given, then take your cost as cost. That's it. You cannot do anything. FVC has 15 lakhs, cost as 13 lakhs. You cannot do it. You don't have any other information. You don't have any other information. You have to take 13 lakhs as your cost. That's it. So therefore, here the answer will be 13 lakhs. On 2 lakh rupees, apply what? You have to assume that the 31st Jan FMV is same as the actual cost. You have to assume that, write that assumption. Even ICI has written that assumption. You can make two assumptions. You can make two assumptions. Assumption number one, you can say that your 13 lakh cost is same as 31st Jan FMV, or your 15 lakh FVC is same as 31st Jan FMV. You can assume any of them and answer will slightly change. Next, Manoj has acquired a vacant land from a foundation which is registered under 12AB. For 30 lakhs, the stamp duty value of that foundation is 40 lakhs. Are you purchasing for lower than market stamp duty value? Yes. Whether it is inadequate consideration, the answer is yes. Whether that can be taxable? No. Why? Because if you receive anything from trust which is registered under 12AB, it is exempt under 56(2)(10). 56(2)(10) is not applicable if you purchase anything or if you get a gift from a registered trust. Therefore, even if you are purchasing for inadequate consideration, still it is not taxable. Very, very intelligent question it is. Paper was dangerous. Huh? Comment below and let me know how is the paper. Next, very simple, dividend from Indian company IFOs. Next, interest of 20,000 credited to NRE account, exempt. In case of non-resident, interest credited to NRE account is exempt, not taxable. Next, royalty of 2 lakh rupees received for authoring a book on literature, IFOS. 80 QQB not available for non-resident. 80 QQB is only available for residents, not available for non-residents. And last but not least, you are paying some insurance premium of 2 lakh rupees. 2 lakh rupees for whom? 2 lakh rupees for life insurance policy. But you will get only 1.5 lakhs in ATC. In ATC, you cannot get more than 1.5 lakhs. Therefore, you can claim 1.5 lakhs in ATC. So, this is what this beautiful question is all about. Let's go to next question. Now, this is one of the most dangerous question of trust ever. So, what is happening in the last two attempts, ICAI has been targeting more questions on total income computation of trust. Before that, you would have watched that they have been asking questions on total, questions of small questions of 2 marks on trust. But since last two attempts, that is September 25 and Jan 26, they have been asking total income questions on trust. So, let us compute the total income of the trust. A trust is registered under 12AB. Okay, they are running primary and secondary school. We have been given the information of the trust. Gross receipt, first of all, you will write down the gross receipt in your income. Okay. Then interest from tax-free bond, which is exempt under 1015, taxable for trust. For trust, only 10(1) is exempt. Rest all exemption of section 10 are not available for trust. So trust has to pay tax on this. Next one, very intelligent. Voluntary contribution of 10.5 lakhs you have taken. So out of that, 9 lakh is normal donation, you add back. 1.5 lakh is anonymous donation. Now anonymous donation, 1.5 lakhs. It is exempt to the extent of 5% of total donation or 1 lakh, whichever is higher. So whatever is higher, that will be exempt. Pay attention please. And the balance will be subject to 30% tax. So this 50,000 will be added back at the end and you will tax 30% on that. Okay. Now listen carefully. Sir, what about this 1 lakh? For this 1 lakh, you have two options. I have told you in the class. This 1 lakh you can add to the income statement and claim 15% exemption, or you can add this 1 lakh at the end. Whatever you want to do, I say he has done both. This 1 lakh which is getting exempted, you have two options. Add to the income statement, claim 15%, or add at the end. Whatever you want to do, you can do. It is applicable. Now, grant from government, exempt. Exempt. Assuming that it is invested in the in 11.5. So whatever grant you will receive, because it is a corpus donation, this is a corpus donation. Now this corpus donation, whatever you have received, it is exempt if you invest in the mode specified in 11.5. I am assuming that it is invested in the mode specified in 11.5, so I can take it exempt. If I assume alternatively, it is not invested in the mode specified in 11.5, then you have to add to the income. Next, salary to teachers. This includes salary expense of 5 lakhs which were not paid till 31st March. So only payment basis deduction is allowed. Therefore, out of 40 lakhs, 35 lakhs will be allowed, 5 lakhs will not be allowed. Okay. Other general expenses. This includes 60,000 by uncrossed check. Uncrossed check means which is not crossed. So you have to make the payment in case of trust by 4 modes only. If you make the payment by other than 4 modes, therefore it will not be allowed. So therefore, out of 20 lakhs, only 19.4 lakhs will be allowed. I hope it is clear to all of you. Next. Every adjustment is a very, very dangerous adjustment. A land belonging to trust in a nearby village was sold. It was sold for how much? It was sold for 10.5 lakhs. It was purchased for how much? It was purchased for 5 lakhs. So this 5.5 lakhs you will add to income first. Okay. Now, if you want to save this, what are you supposed to do? If you want to save this, you should purchase another capital asset. Are you purchasing? Yes, we are purchasing another capital asset of 12 lakhs. So full exemption. This full 5.5 lakhs will be claimed as exemption. It can be considered as an application later on. This is fully exempt. Now, whatever you have invested, listen carefully, whatever you have invested over and above the net consideration. How much you have invested over and above the net consideration? 1.5 lakhs. That can be claimed as an application later on. So first of all, add this 5.5 lakhs to the income statement, claim 15%, then reduce this 5.5 lakhs. Because entire consideration is invested, then reduce this 1.5 lakhs again. So this is what this beautiful question is all about. Dangerous question. After that, you will get your total income. Only total income is asked, tax is not asked. Thank you very much. Already the question is very lengthy for 6 marks. It is not worth 6 marks. It is around 8 to 10 marks question. The paper they are asking very lengthy. They are asking lot of things in a small question. It is very difficult. For discussion only it is taking 10 to 12 minutes. For writing it will take how much? Half an hour. People will not be able to complete the paper. You need to be very fast in the examination if you want to complete the paper. Next question we have done already. You can check it please. If you want to do it, you can do it once again. An educational institution having annual receipts of 4.95 lakhs. The assessee has claimed exemption. The assessing officer has denied the exemption on the ground that educational institution and not make application. No need to make any application. Because if your receipts are up to 5 crore rupees, then it is exempt. But it is separately 5 crore for education and hospital. Sorry, it is aggregate of 5 crore for education and hospital. I am sorry. It is not separately 5 crore for education and separately 5 crore for hospital. So this is the question we have done so many times. Next question we have done so many times. It is a simple question on DTAA. Check it please if you want. Let's go ahead with the next question. This is a simple question on what? TDS. Mr. Rohan is selling his urban agricultural land for 49 lakhs. The stamp duty value is 51 lakhs. So are we supposed to deduct TDS? The answer is yes. 1% on 51 lakhs, whichever is higher. So 194 IA, 1% on whichever is higher, you have to deduct TDS. Next. A cooperative bank has provided information of 2 customers. Mr. A is a filer. He regularly files the return. He is withdrawing 1 crore 5 lakhs from the bank. So if a person is regularly filer, then the TDS is applicable above 1 crore. So above 1 crore, it is 5 lakh rupees. Total 1 crore 5 lakh is withdrawing. So on 5 lakh rupees, 2% TDS will be deducted by bank on 10th of November. Now Mr. B is non-filer. He is not filing the return for the last 3 years. So if he is not filing the return for the last 3 years, so up to 20 lakhs, no TDS. After 20 lakhs on this 3 lakh rupees, 2% TDS, and after 20 lakhs, it is directly 5% TDS. Sorry, up to 20 lakhs. Sorry, I said wrong. So totally he is withdrawing how much? First 23, then 75. And he is a non-filer. He is non-filer. He will get an exemption of only 20 lakhs, not 1 crore. So on this 3 lakh rupees, 2%. And on balance, up to 1 crore, 2%. Above 1 crore, 5%. I hope it is clear to all of you. Next one, Mr. Rohit is a resident. This is also a very intelligent question. He has received 9 lakh rupees on 30th June towards maturity of LIC, which was taken on 1st July 2021. For which the sum assured is 8 lakh and the annual premium is 2,50,000. See, if the policy is issued in 2021, then your annual premium should be up to 10% of sum assured. If your annual premium is up to 10% of sum assured, it is exempt, or else it is taxable. Now, in this case, your annual premium is how much? In this case, your annual premium is greater than 10% of sum assured. How? Your annual premium is 2,50,000. Your sum assured is 8 lakh. Therefore, it is more than 10%. Therefore, it is taxable. Now, because it is taxable, the company will deduct TDS under 194DA at the rate of 2% of net income. So, 2% of net income means what? What is net income, sir, in this case? Net income means whatever amount received. How much? 9 lakhs. Minus whatever premium you have paid over the year. So you have received 9 lakhs minus you have paid premium for last 3 years, 2.5 lakh, 2.5 lakh, 2.5 lakh. So total premium you have paid is 7.5 lakh. Therefore, the company will deduct TDS on 1.5 lakhs. How much percent? 2% TDS. I hope it is clear to all of you. Is it clear? Next question, same to same we have done in earlier paper. You can go and check. Same question we have done. I am not wasting time on that. Question number 5 also we have done. Same question we have done. I am not wasting time on that. Go and check. Question number 2 we have not done, so we will talk about it. It's a good question once again. On dispute resolution committee. Mr. Chauhan filed the return of income, declaring income how much? 16 lakhs. Can he go for dispute resolution committee? Yes, up to 50 lakh income as per ITR is allowed. But few more conditions are also there. The AO has passed an order under 154 determining income 19 lakhs. So the AO has increased the income by how much? 3 lakh rupees. Can I go? Yes, the AO should increase the income up to 10 lakhs. So the return income should be up to 50 lakhs. Yes, it is up to 50 lakhs. And the AO should increase the income up to 10 lakhs. Yes, he is only increasing 3 lakhs. Therefore, I can go for dispute resolution committee. Is order under 154 also covered in dispute resolution committee? Yes. Order under 143, 144, 147, 154. All these orders are covered in dispute resolution committee. Don't worry. Is there any monetary limit prescribed? Yes, monetary limit I have already told you. The AO, the ITR income should be up to 50 lakh and the AO should increase the income up to 10 lakh rupees. Then only you can go to dispute resolution committee, otherwise you cannot go. 154 order is also covered. Yes, 154 order is also covered in the specified order in dispute resolution committee. Now, next one is on compounding of offences, which was an amendment which came last year. So for them it is important, for you all it is not that important. Let's see what is happening over here. From 17th of October 2024, the government has changed the entire concept of compounding of offences. Now let's see what is happening. Mr. Roy is an Indian resident. He is liable to collect TCS. So he collected the TCS but failed to pay to the government during the financial year 23-24. So he did not pay the TCS on time. So the AO initiated prosecution proceedings on 24th of July. Mr. Roy applied for compounding of offences of 17th of August, which was rejected due to non-payment of outstanding tax. Now this line is very important. So what is happening so far? The SSC has not paid the TCS. So the AO initiated prosecution. The SSC applied for compounding of offences. The AO rejected because the SSC did not pay the tax. Now, the SSC filed an appeal against the penalty imposed by the officer. Now, on 8th of October, Roy paid all the outstanding demand, including interest and penalty. So later on, he paid the entire amount of tax and penalty, everything. Now he wishes to apply for compounding of offences under the new guideline on 17th of October. Can he do so? Yes, he can. Why, sir? It's a curable defect. It's a curable defect. Non-payment of tax is a curable defect. You can come. Yes, he can apply, and since it was rejected due to non-payment of tax, which is a curable defect. Second, by which date Mr. Roy needs to file the application? At any time after committing the offence, whether it has come to the notice of the department or prosecution is launched, you can come anytime. At any time. There is no time limit given by the law. So you can come at any time, whether you have, whether it has come to the notice of department, then also you can come for compounding of offence. And even if the department has launched the prosecution, then also you can come for compounding of offence. And one last question over here. In the last question, I am changing some limits because these limits are as per the old MSME limits, and now the MSME limits have been increased drastically. So this first one I am changing to 340 crores. Okay. Otherwise my answer will go wrong. The first one I am changing from 34 crore to 340 crores. Now I am reading the answers. First of all, Messrs. P and Associates, it's a partnership firm liable for tax audit under 44AB. Now they have made various payments. Now you need to identify, list out the points to be kept in mind. Whether P Associates is in compliance with the relevant provisions. First of all, they are purchasing some things from Teal Private Limited. Teal Private Limited's turnover is 340 crore. Therefore, it is not a micro and small enterprise. For micro and small enterprise, your turnover should be maximum up to 100 crore. Therefore, this is not a micro or small enterprise. Therefore, for them, 43B clause H is not applicable. You can make the payment late also. It is allowed on accrual basis. So, here 43B is not applicable. Okay. Second, Kind Private Limited, the turnover is up to 10 crore and the investment in plant and machinery is up to 2.5 crore. Therefore, it is micro enterprise. So, now 43B is applicable. Now, you are purchasing on 21st November. Date of payment as per agreement is 1st of December. But you are making the payment what? 20th of February. Are you making the payment late? Yes. Now, because you are making the payment late, it will be reported in MSME. But the deduction will be allowed to you. Why? Because you are making the payment in the same financial year. It will not be allowed on accrual basis, but it will be allowed on payment basis. But the payment is also done in the same year. Therefore, you can claim the deduction. Third case, Russ Private Limited. The turnover is up to 100 crore. Yes. The investment in plant and machinery is up to 25 crore. Yes. Therefore, it's a small enterprise. Now, you are purchasing on 1st of March. As per agreement, you are saying that you will pay on 20th of April. Not allowed. Maximum 45 days time is there. So, 45 days time completes on 14th of April. It is not completing on 20th of April. 20th April will not be accepted. If you pay by 14th of April, you will be allowed deduction in the current year. If you pay after 14th April, you will be allowed the deduction in the next year. You are paying on 18th of April. If you are paying on 18th of April, you will be allowed deduction in the next year, not in the current year. So in the second case, you will be allowed deduction in the current year. In the third case, you will be allowed deduction in the next year. I hope it is clear to all of you. Then you need to list down all the points that you have to keep it in mind while reporting clause 22. You need to ask the assessee. Because you are an auditor, you don't know any information about the assessee. You have to ask everything to the assessee. You have to ask the assessee about whether you are a micro or small enterprise. They will give you a management representation letter. You have to ask from the assessee the agreement between both the parties. You have to ask from the assessee the investment in plant and machinery. You have to ask from the assessee the turnover limit and identify and list down all the points over here. Next question. Discuss whether the general anti-avoidance rule will be applicable in this case or not. Whether GAR will apply or not. Very good questions of GAR. Be very careful. First, Red Limited is an Indian company. It incorporates Brown Limited as a wholly owned subsidiary in country Y. No tax jurisdiction. So, Red Limited, an Indian company, is opening one company in a no tax jurisdiction. Why? What is the objective? The objective is to buy cheaper raw material. That is the objective. The objective is not tax evasion. The objective is not tax benefit. Now, because the objective is not tax benefit, the main purpose of the transaction should be tax benefit. Then only GAR is applicable. Here, the main purpose is not tax benefit. The main purpose is to obtain cheaper raw material. Therefore, GAR cannot apply here. GAR cannot apply here. I hope it is clear to all of you. I hope it is clear to all of you. Next question is also a very good question on GAR. Yellow Limited is an Indian company. Pink Limited is in country H. Now, Pink is giving loan to Yellow. Yellow is paying interest. Okay. Now, there is something written between the DTAA between both the nations. For that, we need to read the information. Then we will come to the chart. Yellow Limited is an Indian company. And Pink Limited is a company which is incorporated in country H. Pink gave loan. Again, I am looking at this, reading the provision and then I am highlighting it. Pink gave loan to Yellow. Now the DTAA between India and country H gives exclusive right to tax interest in the resident state. Where is the resident state? Resident state is this country. Country H provides tax exemption of interest receivable by resident company from any equity in which the resident company holds not less than 10% of the equity shares. Pink Limited does not have a P in India. Yellow is able to claim interest deduction from its total income and thus enjoy tax benefit of 1.5 crore. Pink also earned a tax benefit equivalent to what? 2 crore in country H. Now, I understand that there is a tax benefit here and there is a deduction over here. This is leading to double tax benefit. Here, pink is getting tax exemption. Here, yellow is claiming tax deduction. So, on one hand, it is allowed as a deduction. On another hand, it is not considered as what? As income. It's a double non-taxation, I agree. Still GAR cannot apply because for application of GAR, the tax benefit has to be more than 3 crore rupees. Now, because the tax benefit is not more than 3 crore in India, what is the tax loss in India? Tax loss in India is of 1.5 crore because in India, the company is claiming deduction how much? The Indian company is claiming deduction of 1.5 crore. Now, because the tax benefit in India is less than what? 3 crore rupees, therefore GAR cannot apply in India. For the basic condition for application of GAR, the main purpose, it should be tax benefit and the tax benefit should be more than 3 crore rupees. I agree. In India, you are claiming deduction of 1.5 crore. In foreign country, you are claiming exemption of 2 crore rupees. But GAR cannot apply still. And now last but not least, you need to answer in the following cases whether advance ruling will be applicable or not. Let's see whether you can apply for advance ruling. TBF Limited is an Indian company, closely an Indian company, needs to pay 75 crores to BKINC foreign company. Now TBF wants to know whether such services falls within the definition of technical service and thus determine the amount of tax to be deducted on payment to be made to BKIC. So can the TBF apply for GAR? Yes. So apply for BFAR. Yes, they can apply because if a resident make an application, if a resident is entering into a transaction, be very careful. If a resident is entering into a transaction with non-resident, and if they want to know the tax liability of that transaction, they can make an application for what? BFAR. Second, Pedigree Limited is an Indian private sector company. It is considering entering into an export with Lamau INC of China. Pedigree Limited is expected to earn 500 crore and the expected liability would be 150 crore. Now, since the transaction value is greater than 100 crore, they can apply for BFAR. Third one, Indian public sector company. Indian public sector company can always apply. There is no monetary limit applicable for them. Fourth one, Indian public sector company whose matter is pending in front of ITAT, they can also apply. Indian public sector company, if their matter is pending in front of ITAT or income tax authority, they can apply. If their matter is pending in front of High Court and Supreme Court, then they cannot apply. I hope it is clear to all of you. So this is where we complete the compilation of 9 past paper. I hope you all have enjoyed it. If you have enjoyed it, just make sure that again and again I am saying, just make sure that you comment below whichever place the timestamp you found important. You found that this timestamp is important. So you just mark that down below. Suppose at 3 hours and 42 minutes, something important I have said. So you can write down 3 hours 42 minutes, sir has said an important question on transfer pricing. Mention that timestamp below. It will be very helpful for you all when you will revise the syllabus. Okay. Now today we are going to talk about 8 MTPs, including the mock test paper of May 2026. So we are going to total talk about 8 MTPs in today's paper. Now, few things I would like to say before we start with the session, and that is, because you have already done 9 RTPs and 9 past papers. Now, believe me, many questions in the MTP, around 70% of the questions in MTP is going to repeat. 70%. Because the MTP is the most hopeless paper that the ICI can remove for the practice of students. Yes, RTPs are very good. Past papers are obviously good. But MTPs are very hopeless. Don't expect that the questions like MTP will come in the examination. MTPs are very, very simple in general. Yes, 1 or 2 questions in every MTP are very, very, very good. But otherwise, most of the MTPs are very, very, very straightforward. So, what I am going to do over here is, I will cover 8 MTPs with you all in full English. But if any question is exactly similar, then I will not do that question. I will give you a reference also where we have done that question in the RTP or past paper or even in MTP. Yes, even if one or two adjustments are different or something which is new, that I will discuss. But if something which is exactly same, exactly no change in sentence, full stop, comma, nothing is changed, then doesn't make sense to do that particular question once again. It will waste your time first and then my time also. Our objective is to cover maximum content in minimum time. Optimum utilization of time we have to do. Our objective is not to repeat same questions again and again, especially when they are exactly same. Okay. So these are the few things that I had to say before I can start with the discussion. We are starting with MTP Series 1 May 2025. The very first question over here is on total income. We are supposed to compute total income and tax liability as per the normal provision. Not as per 115BAA, not as per 115BAB. Ignore math. The turnover of last year is 390 crore. Therefore, the tax rate will be 25%. Okay. Now let's start with the question. The associate is a company. It is a manufacturer. The net profit is 350 lakhs. The very first thing they have paid 1 lakh rupees to independent directors for attending board meeting, but they have not deducted TDS under 194J. They should have deducted. See, any payment made to director over and above salary is subject to TDS under 194J at the rate of 10% without threshold. Even threshold is not required for payment made to directors. See, payment made to directors can come under two sections. If a salary is paid to director, it will go under 192. But if other than salary, like board meeting, etc., fees is paid to independent directors, etc., then in that case, 194J TDS is applicable. No threshold is there. Generally, the threshold of 50,000 is there in 194J. But for director, there is no threshold. You have to deduct TDS. You have not deducted TDS, 30% expenditure will be disallowed. Next one, opening stock and closing stocks are overvalued. Okay. How much is opening stock? 200 lakhs. It is overvalued by how much percent? 10%. Therefore, it is 110 lakhs. Therefore, 10 is how much? Cross multiply. Whatever amount will come, that is overvalued. If opening stock is overvalued, means debit side of P&L is overvalued. It means you have claimed more expense. Therefore, add back. Similarly, if closing stock is overvalued, then reduce because you have increased the credit side. Therefore, the profit is increased. So, reduce. As simple as that. Next, depreciation as per the books of accounts, you will add back. Contribution to national laboratory allowed as deduction under the new regime, under the old regime. Under new regime, 35(2)AA is not allowed, but under old regime it is allowed. We are following as per the old regime, as per the normal regime. Then you have paid some GST of this year on 27 December. This is late. GST should have been paid on or before the due date of filing of return. Therefore, because it is paid after the due date of filing of return, therefore it will be disallowed under 43B. You have purchased some goods of 63 lakh rupees from a company in which your directors have substantial interest. Therefore, you are related party. So, from related party, you are purchasing goods for 63 lakhs. The market value of the goods is 58 lakh. Therefore, 5 lakh excess payment you are doing, that will be disallowed under 48(2). Excess payment made to related party, disallowed. Next, you are making some cash payment. To whom? To road transporter. Lorry, truck. So, can you make it a cash payment to a road transporter? Yes, up to 35,000 you can make. Generally, you cannot make cash payment of more than 10,000, but to lorry, truck transporter, you can make up to 35,000. Therefore, here, first payment you have made 40,000, disallowed. This will be disallowed. 35,000 will be allowed. If it exceeds 35,000, then it is disallowed. So, 35,000 will be allowed. 52,000 will be disallowed, not allowed. Next, you are incurring some legal expenses for bonus shares. So, if you incur some legal expenses for bonus shares, I have already told you it is allowed because issuing of bonus share does not increase the permanent capital of the company. Therefore, it is a revenue expense. But if you incur some legal expenses for right shares, then it is disallowed. That is not allowed because right shares lead to what? Permanent increase in the capital of the business. Therefore, it will not be allowed. Next is donation to political party paid by check, disallowed in PGBP and claim under 80 GGB later on. Because the payment is made by check, you can claim the deduction. If the payment is made by cash, you cannot claim. Next is depreciation, 62 lakhs you can claim as per income tax law. You can reduce it from your P&L. And last but not least, you have claimed a bad debts of 4 lakh rupees, out of which you have recovered 2 lakh rupees. So that is deemed income under section 41 subsection 4, recovery of bad debts, but you have not given the effect in the books of accounts. So add back to PGBP. So add back this to PGBP. I hope it is clear to all of you. After that, it's very simple question, nothing great as such. Just compute tax, 25% tax. If applicable, apply surcharge also and 4% cess. That's it. It's a very, very simple question. Question number 2. There is an LLP over here which is engaged in export. Therefore, it has a SEZ unit, unit 1 and unit 2 is a domestic tariff area unit. So, SEZ unit was set up 6th year back. Therefore, this is the 6th year of operation. Therefore, the assessee will be eligible for deduction of how much? 50%. After 5 years, you were eligible for 50% deduction. Now we are supposed to compute total income tax liability of Beta LLP. So if we are supposed to compute, so a lot of things we are supposed to compute. We are supposed to compute gross total income. Then from gross total income, we will compute 10AA deduction. After that, we will compute total income, then tax, then we will also compute AMT. We have to compute AMT now because LLP and they are claiming 10AA. So what is the profit of the assessee? Let's see. Net profit is 71 lakh for unit 1 SEZ unit and unit 2 840 lakhs. Add both of them. And now in that unit 1 41 lakh will be disallowed. So add 41 lakh to this. And in unit 2 48 55 lakhs will be disallowed. So add 55 lakhs to 840 lakhs. Therefore your total profit will be 751. How 751? 710 plus 41 and this unit 2 profit will be 895. How 895? 840 plus 55. So this will come to 895. Total profit is 1646. Now we will compute 10AA deduction. How we will get 10AA deduction? Profit from the export unit multiplied by export turnover of unit 1 divided by total turnover of unit 1. We will try to compute one by one all three parameters. Let's talk about the export turnover of unit 1 first. Sir, what is the export turnover of the unit 1? The export turnover of the unit 1 is as follows. Pay attention please all of you. The export sales is 1800 lakhs, but out of that only 1600 lakhs is received. Only what? The export turnover is 1800 lakhs, out of which 1600 lakh is received in India. So you can take only that much export turnover which is received in India within 6 months in convertible foreign currency. So you cannot take, you can only take 1600 rupees in the export turnover. In that also, in 1600 also, there are some expenses like insurance and freight. In export turnover, you cannot take insurance, freight and other communication, other telecommunication charges and other charges. The export turnover has to be FOB price, free on board price. It cannot be COB. Therefore, your export turnover first of all will only include realized amount, that is 1600. From that also reduce expenses. So expenses are 180. Therefore, export turnover is ultimately 1420. Okay. Now what is total turnover? Total turnover is a what? 1800 is my export turnover and domestic turnover is 300. So total turnover is 2100. Now in total turnover, you do not care about how much is received, how much is not received. Everything is part of total turnover. But yes, in total turnover, again you cannot take what? Certain expenses. Which expenses? You cannot take certain expenses like insurance and freight. So how much is insurance and freight in total turnover? In total turnover, the insurance and freight is 300 lakh. So therefore from 2100 I will reduce 300, that will come to 1800. So I got my export turnover also, I got my total turnover also. Now I will compute my profit. How much is the profit from unit 1? Profit from SEZ unit is 751, 710 plus 41. But in this 751 I cannot take two things. That is, I cannot take duty drawback, I cannot take profit on sale of license. Remember, export profit from the export does not include duty drawback, profit on sale of import license and cash assistance. Yes, all these things are not part of what? Profit from export. Therefore, I have to reduce all these things. If I reduce all these things, I will get 666 as my profit. Now I will multiply 666 into 1420 export turnover divided by 1800 total turnover, and therefore I will get my deduction. Of that, I will take 50% deduction. Therefore, my deduction comes to how much? 262.570. After that, I will compute tax. That's it. On that 1383, I will apply 30% tax, 12% surcharge because the income is more than 1 crore, 4% cess. This is my tax as per normal provision. Now I will compute tax as per AMT. For AMT, I have to compute adjusted total income. How will I compute adjusted total income? Total income 1383 plus 262 is my adjusted total income. On that, I will apply 18.5% tax. That is 18.5% AMT, 12% surcharge, 4% cess, and then I will compare whichever is higher and try to find out the AMT credit. I hope it is clear to all of you. So this is what this question is all about. Let's go ahead with the third question. The third question is also a very good question. Fashion Inc. is a notified foreign institutional investor. Always remember, whenever in the question FII will come, FII, there is only one section which is possible, that is 115 AD. Now we need to compute the total income and the tax liability of this particular FII, assuming they do not have any other income. Okay. Now let's compute the total income. First of all, dividend from the listed shares of Indian company. Dividend for FII as per 115 AD is taxable at 20% plus surcharge if applicable and cess. Okay. Next, interest on security for FII is again taxable at 20%, but you will not get the deduction of these expenses. Gross dividend, gross interest is taxable. Expense will not be allowed as deduction. Third one. Bonds you have purchased in 2019 and in 2026 you have sold. So you have purchased for 43 lakhs. You have sold for 58 lakhs. So there is a profit of how much? There is a gain of 15 lakh rupees. This is long-term capital gains. Is this covered under 112A? No. This is normal long-term capital gain. Therefore, normal long-term capital gain is taxable at 12.5% under 115AD. Next one, listed shares on which STT is paid. It is written below. Listed shares on which STT is paid. It is purchased on 2nd May and sold on 9th February. Sold within 12 months. Therefore, it is short-term capital gains and it is listed share. Therefore, it will be taxable at 20% as per 111A. Next, unlisted share. It is purchased in July and sold in March 26. Again, it is short-term capital gains. Now, on this 111A is not applicable. Remember, on normal STCG in 115AD, there is a 30% tax. 30% tax will be applied. Go and check 115AD. 115AD has 4 tax rates. Long-term capital gains normal 12.5%. Long-term capital gains 112A 12.5% with an exemption of 1.25 lakhs. STCG 111A 20%. STCG normal 30%. So this will be taxed at 30%. I hope it is clear to all of you. Let's go ahead with the next question. Next question is on TDS. Mr. Anuj is buying some property. First, he is buying a property in Chennai. He is buying 3 properties. First, he is buying a property in Chennai for 85 lakhs. So TDS will be deducted or not? Yes. 1% of 85 lakhs will be deducted as TDS. Stamp duty value is not given. If stamp duty value would have been given, I would have compared with stamp duty value, and whichever is higher on that amount, I would have deducted TDS. In this question, stamp duty value is not given. Now he has purchased again another urban plot of 49 lakhs. But the stamp duty value of the urban plot is 54 lakh. So whichever is higher. So on whichever is higher is what? Whichever is higher is 54 lakh. So on this, he will deduct TDS 54 lakhs into 1% under 194 IEA. So if either the consideration or the stamp duty value, if both are less than 50 lakhs, then no TDS. If one of them is more than 50 lakhs or equal to 50 lakhs, then TDS is applicable. Here, the consideration is 49 lakh, but the stamp duty value is 54 lakh. Therefore, deduct TDS at the rate of 1% on 54 lakh. Next one, he is purchasing some rural agriculture land. On rural agriculture land, TDS under 194 IEA is not applicable. It is exempted. Okay. Next one, there is an infrastructure debt fund in India who has taken some loan from a non-resident. So infrastructure debt fund has taken a loan from a foreign company, and in return they are paying an interest of 6 lakh rupees. How much TDS? 194 LB, 5% TDS plus 4% cess. It is 5.2%, not 5.4%. 5.2% TDS will be applicable. 194 LB. Interest deduction will not be allowed. So if the borrower is in infrastructure debt fund and the lender is non-resident or foreign company, then the borrower, when the infrastructure debt fund will pay the interest, at that time they will deduct TDS at the rate of 5.2%. Cess will not be applicable because the interest is only 6 lakh. Expense is not allowed as deduction. Will your answer change? If that foreign company is located in NJ. If that foreign company is located in NJ, then 5% is not applicable. Then 30% plus 4% cess, 31.2% tax will be deducted in that case. I hope it is clear to all of you. Next one, an airline company is paying landing and parking charges to the Airport Authority of India. So the landing and parking charges paid to the Airport Authority of India will be subject to deduction of TDS under 194C and not under 194I as held by Supreme Court in the case of Japan Airlines. Next one, an employee of government is receiving arrears of salary. So he is asking a question whether entire arrears of salary will be subject to tax deduction. The answer is no. If the employee gives Form 10E, Form 10EE for elephant, then in that case, the employer will give relief under Section 89 for arrears of salary, and after that, he will deduct the TDS. If the employee does not give Form 10E, then he will deduct TDS on the entire amount. I hope it is clear to all of you. Let's move on to the next question. Next question, question number 5, part 1. An income tax authority has lost a case against an assessee at CIT appeal. So at CIT appeal, the income tax department lost a case. The name of the assessee is Bela, and the income tax department did not appeal to ITAT because the tax effect was less than the monetary limit. Can they do so? Yes, they can do so. So Bela, in front of Bela, the income tax department lost the case. So the income tax department did not file the case. Did not file the case to ITAT because the tax effect was less than 60 lakh rupees. Because for ITAT, the limit is 60 lakhs under 268A. Now the question is, similar issue arise in case of Shweta and her sister Shefali. Can they give an example of Bela and say, in case of Bela, you have not appealed. Why are you appealing in my case? No, you cannot say. This section is assessee specific. This section is year specific. Even Bela cannot say next year. Even Bela cannot say next year. This is very specific to Bela only for this year. Now, Shweta and her sister cannot give a binding precedent of Bela and say that in case of Bela, you have not appealed. Why are you appealing in my case? 268A is specific to assessee. 268A is specific to year. I hope it is clear to all of you. Next one, an assessee who is a partnership firm did not file the return on time. So if you don't file the return on time, there can be a prosecution launched against you. That's what the officer has done. He has filed a complaint for prosecution under 276CC. Now there is some condition for filing prosecution. In case of other than company, a prosecution can be filed only if the tax payable after reducing the advance tax is more than 10,000 rupees. So initially the tax payable is more than 10,000, it is 70,000 rupees, but then assessee appeal to CIT appeal and CIT appeal reduce the tax to how much? 9,100. So now can the prosecution be launched? The answer is no. Because for prosecution there are some conditions. First of all, there should be a willful failure of filing of return. Second, if the assessee is other than company, then the prosecution is possible only if the tax payable after reducing advance tax is more than 10,000 rupees. Now after the appeal, the tax payable has been reduced below 10,000. Because it is reduced below 10,000, therefore prosecution cannot be launched. I hope it is clear to all of you. Next question, exactly copy paste of what we have done earlier in RTP May 2024. Question number 3, you can go and check. I have given reference of everything. I am not just talking just for the sake of talking. I have given a reference of each and everything what is repeated. Next question, this question repeated. I have given the reference file already shared on Telegram channel. You can go and download from there. Okay. This question also repeated. Go and check. Next question is a slightly new question. Again, very simple question. Nothing great. One more time it is going to repeat in the next paper also in MTP. There is a foreign hockey player who is a non-resident. So there is a non-resident foreign citizen. They are coming to India for the purpose of playing in hockey and they are earning 10,000 rupees. They are earning 45 lakh rupees from hockey. So that will be subject to 20.8% tax under 194E. It is taxable under 115BBA. If a non-resident who is not a citizen of India who comes to India and participates in any game or sport is liable to tax at 20% plus 4% cess. Further, if he is writing some article in a magazine, then that is also subject to 20% tax. If he does advertisement, that is also subject to 20% tax. Yes, if he earns some lottery, then that is subject to 30% tax under 194B. So the first two incomes will be subject to 20% tax under 194E and the third income will be subject to 30% tax under 194B. But the third income you have to gross up because this is net of TDS. So what are the questions? Question number 1. Examine whether the above incomes are subject to deduction of tax at source. Yes, the first income and the second income is subject to deduction of tax under 194E at 20.8% and the third income, that is the lottery income, is subject to deduction of tax under 194B at the rate of 30% plus cess. Whether it is necessary to file the return? Yes. If they would have only earned first two incomes and TDS would have been deducted, there is no need to file the return. Now because the player is also, the foreign national player is also earning horse race or lottery income, whatever it is, therefore he is liable to file the income tax return. If you would have only earned 194E income and TDS would have been deducted, there is no need to file the income tax return. But in this case, yes, he has to file because he is earning lottery also. Next, a non-resident has made an application to authority for advance ruling on 15th of June. Now they want to withdraw the application on 21st of July. Can they do so? No. By default, you cannot. Because once you make an application, you have to make a withdrawal application. You can withdraw the application of board for advance ruling within 30 days from the date of application. Now the 30 days have expired. But there are some rulings which says that if circumstances so justify, it can allow beyond 30 days also. So by default, the law does not say beyond 30 days, but there are some rulings and some court judgments which says that if the circumstances so justify, you can withdraw beyond 30 days also. I hope it is clear to all of you. You have to write this sentence in the examination. However, if the circumstances so justify, it can be withdrawn beyond 30 days also. I hope it is clear to all of you. So this is what this paper is all about. Let's go ahead with the MTP series 2, May 2025. The very first question is on amalgamation, carry forward of losses, carry forward of UAD and other aspects. There are two companies, ABC Limited is amalgamating company and XYZ Limited is amalgamated company. Both of them are getting amalgamated on 1st April 2025. Now the profit of XYZ, that is the amalgamated company, is 140 lakhs. Now they have done one mistake. What mistake? When they took the assets from ABC Limited, that is from amalgamating company, they depreciated the asset at market value. No, you cannot depreciate the asset at market value. If an amalgamated company take assets from amalgamating company, the cost in the hands of amalgamated company is WDV in the hands of amalgamating company. So the WDV in the hands of amalgamating company is 100 lakhs. But unfortunately, you have depreciated at 150 lakhs. So you have claimed depreciation on 50 lakh rupees extra. So 50 lakh rupees depreciation you have to add back in your profit. So you have claimed depreciation on 150 lakhs, which is wrong. You should have claimed on 100 lakhs. So the profit of your company is 140 lakhs. So 50 lakh depreciation you have to add back. So 50 lakhs into 15% add back first. And then you claim the losses whichever losses are allowed. Speculative losses not allowed. Unabsorbed depreciation allowed to carry forward by ABC Limited, by XYZ Limited. Unabsorbed scientific capital nature allowed to carry forward. Unabsorbed expenditure of capital nature on scientific research allowed to carry forward by what? The amalgamated company. Business loss, yes. Normal business loss allowed, speculative business loss not allowed. Normal business loss can be carried forward by the amalgamated company for balanced number of years from 1st April 2025. Earlier it was another 8 years, but now it is balanced number of years. So because the loss is just 4 years old, the amalgamated company can carry forward for another 4 years. So you can set off this 120 lakhs also. I hope it is clear to all of you. Is it clear? So what is the ultimate answer? 140 lakhs is your profit. Then add depreciation on 50 lakh rupees because that is excess claim and reduce the 3 items. These 3 items reduce, do not reduce speculative loss. You will get your profit. I hope it is clear to all of you. Next question is a very simple question on DTW. You can go through it. We have done much better questions on DTW. We have done similar question earlier multiple times. So I am not wasting time on this. I am going to the next paper. Next question, not paper, sorry. Question number 2. Question number 2A1, very simple question. There is an institution which is running educational institution as well as hospital. The gross receipts of both of them is 4.5 crore each. Whether they are liable to take approval? Yes, they cannot get exemption like this only. Because the aggregate receipt from both hospital and from education is exceeding 5 crores. You have to check aggregate receipt from both of them should not exceed 5 crore. If it is up to 5 crore, there is no need to take approval. If it crosses 5 crore, you have to take approval. Without approval, you cannot claim exemption. I hope it is clear to all of you. Second question, we need to compute the total income of the trust. A trust is earning the following income. First, a trust is earning 14 lakhs rupees from the property held. You will add this to income. Then trust is earning 6 lakhs from business which is incidental to main object. So if the business is incidental to your main object of trust, you can add that also to the income and claim 15% exemption. Then 9 lakh you are receiving voluntary contribution means normal donation, not corpus donation. You can add this also. Add all 3 of them. This is the part of your income to claim 15% exemption. Now from that, you have applied 12.8 lakh rupees towards charitable purpose. This is your application, but you need to be careful. This includes 4.8 lakhs repayment of loan for construction of orphanage. Now this entire expenditure of construction of orphanage was claimed as an application in previous year 2021. So now you cannot claim this 4.8 lakh as deduction in the current year because in 2021 you have already claimed that as an expenditure. For example, in 2021 you have taken a loan of 4.5 lakh, 4.8 lakhs for example. Listen carefully. In 2021, very important point. In 2021, you would have taken loan of, year is also important. Pay attention on the year also. In financial year 2021, you would have taken loan of 4.8 lakhs. After taking that loan, you would have incurred an expenditure on construction of orphanage. At that time, you have claimed deduction of construction of orphanage directly. Now in 25-26, if you are repaying that loan of 4.8 crore, you cannot get that deduction because that will lead to dual benefit because already you have claimed that as an expense in 2021 while constructing the orphanage. So now while repayment you cannot again claim. Therefore, you have to take deduction of 12.8 minus 4.8. You can claim 8 lakhs as application. You cannot claim 12.8 lakhs as application. But now you will raise question. Sir, you have explained us in class, sir. If you take a loan and incur an expenditure, then it is allowed only when the loan is repaid and not when the expenditure is incurred. That is correct. I agree. But that amendment came in Finance Act 2021. If you do that after 2021, then that is the scenario. If you have already taken a loan before 21, in this case, you have taken loan in 2021, before 2021. Correct? You have taken before 1/4/2021. Now, in this case, you have taken loan in 2021, before 1/4/2021. So that time the expenditure was directly allowed. You do not have to repay the loan. That repayment of loan condition came after 1/4/2021. That is the reason I have mentioned in our concept book also very clearly that this amendment of loan repayment has come in Finance Act 2021. So very simple. If you have taken a loan after 21, then it is allowed on repayment of loan. But if you have taken the loan before 21 and incurred the expenditure before 21, then when you repay the loan now, you cannot claim deduction of loan once again. I hope it is clear to all of you. So this is what this question is all about. Let's go ahead with the next question, which is on TDS 3A1. Bank is crediting 65 lakhs 50,000 in a separate account for macro monitoring purpose. Sir, what do you mean by this macro monitoring purpose? See, whenever you invest in bank, in fixed deposits and recurring deposits, the bank computes interest on a daily basis, but bank does not credit interest on a daily basis. They compute on a daily basis, but they don't credit on a daily basis. Computation is done on a daily basis. Every day they compute. So they compute and credit to a separate account, compute credit to a separate account, compute credit to a separate account for every customer. But at the year end or at the half year end or at the quarter end, they credit that to customer account. So the TDS is not deducted when it is computed for macro monitoring purpose. The TDS is deducted when it is actually credited to the customer's account. So here the TDS will not be applicable. Therefore, the assessing officer is not justified in disallowing the expense. Okay. Next, you are giving some profit commission by a reinsurance company to the insurance. Whether TDS is applicable? No. In 194D, it is very clearly written. 194D covers insurance commission, but it is very clearly written insurance commission will not include reinsurance. Therefore, on reinsurance, TDS will not be applicable. If it is a normal commission, then it is applicable. If an insurance company is paying to an agent, then TDS will be applicable under 194D. But if an insurance company is paying to another insurance company for reinsurance, then TDS is not applicable. I hope it is clear to all of you. Next one, we have just done that if you make some payment to director over and above salary, then you have to deduct TDS under 194J at the rate of 10%. I hope it is clear. And threshold is also not applicable. Do you remember in the previous MTP we have done? And last but not least, over here, the board for advance ruling has the power of issuing commission. Yes, board for advance ruling has 4 powers, which are similar to the powers covered under 131, which is given to the income tax authority under summon. Section 131 talks about the power to issue summon, and once the power to issue summon is given, this power can be given to the income tax authority, this power can be given to board for advance ruling, and this power can also be given to black money authority. And in this power, there are 4 powers which are given to the respective authority. First, power to discover an inspection. Second, power to enforce attendance. Third, power to compel production of books of accounts. And fourth, power to issue commissions. These are the 4 powers which are given to the income tax authority under section 131, which are given to the board for advance ruling also. I hope it is clear to all of you. Next question. Question number 4A, very simple question. There is an assessee who is having a business and the turnover of the business is 70 lakh. Is he liable to file the income tax return? Obviously, yes. Any person whose business turnover is more than 60 lakh rupees, then he is supposed to file the income tax return. What about exact 60 lakh? Exact 60 lakh, no need to file the return. If your business turnover is more than 60 lakh, file the return. So he has to file the return. Similarly, Mr. Vicky received a gift from his son, 50 lakh rupees. After that, he deposited that entire sum in his saving account. Is he liable to file the return? The answer is yes. If you deposit 50 lakh or more in a saving bank account, you are liable to file the income tax return. Remember, for that business limit, it is more than 60 lakh. But for saving bank limit, it is greater than equal to 50 lakhs. Exact 50 lakh if you deposit, then also it is liable for what? Filing the return. I hope it is clear to all of you. Next one. Can tribunal, while listening to the rectification application, reappreciate the entire evidence? No. First of all, does the tribunal has the power to rectify an apparent mistake? The answer is yes. Tribunal will not rectify its mistake under 154. For tribunal, the power is given under section 254 subsection 2 separately. Yes, tribunal can rectify an apparent mistake, but while rectifying the apparent mistake, they cannot reappreciate the entire matter once again. I have told you in the class many times, tribunal cannot review its own order. Tribunal cannot take a second view without any valid reason. They can only rectify an apparent mistake. They cannot change their decision. They cannot change their opinion. Therefore, this is not allowed. This is not allowed. Second, the High Court cannot interfere with the factual finding recorded by the lower authorities and tribunal without any valid reason. Correct? C. Till tribunal, it is a fact-finding authority, and High Court is subject to what? High Court is allowed to get into what? Get into only question of law, substantial question of law. Now, can High Court get into the facts which are determined by the lower authority without any valid reason? The answer is no. The High Court is doing what? The High Court is trying to poke his nose. Where? In the fact-finding. In the factual issues which is determined by tribunal or lower authorities. Can they do so without any valid reason? Without any valid reason, they cannot do so. They do not have this power. Next one, we are supposed to compute one simple penalty question is there. Does not result from misreporting. If it is not a misreporting, it is a simple normal underreporting. Therefore, 50% penalty will be imposed. It's a company. The turnover of the company of last year is 350 crore. Therefore, the tax rate is 25%. Now, we are supposed to compute penalty. First, underreported income. How will we find underreported income? Income assessed under 143.3 minus income processed. So, income assessed is minus 5 lakh. Income processed is 7.5 lakhs minus. Therefore, the underreported income is 2.5 lakhs. Now, how will I compute tax? In case of loss cases, directly compute tax. Directly. In loss cases, we have to directly compute tax. On 2.5 lakhs, 25% tax. 4% cess. That's it on that 50% penalty. Similarly, income reassessed 4,50,000 positive and income previously assessed 5 lakh negative. Therefore, under reported income 9.5 lakhs. Again, because it is a loss case, loss has converted to income, same logic. In case of loss, directly compute tax. On 9.5 lakhs, 25% tax, 4% cess. That's it on that 50% penalty. I hope it is clear to all of you. Very simple question, nothing great as such. Question number 5. Question number 5, A1. There is a search operation which is conducted on the assessee on 31st of October. The AO has seized 25 lakh rupees cash. Okay. Now on 27th November. Okay. On 27th November, the assessee has made an application explaining the source of that 25 lakhs. Now the question is, will department return you that particular 25 lakhs? So there is a proviso which is given under 132B, which says that if any asset is seized by the income tax department during the course of search, and if you go and explain the nature and source within 30 days from the end of the month in which the search is completed. When is the search completed? The search is completed in October 25. You have to go within 30 days from the end of the month. That is till 30th November. You have gone when? You have gone on 27th November, so you are going on time. So if you go and explain the nature and source of that particular income, of that 25 lakhs, if you go and explain the nature and source of this 25 lakhs, till 30th November 2025, the officer will return you the asset by reducing the existing liability. Existing liability will take. He is not going to completely give you back. He will take the existing liability and rest of the amount he will give you back. Existing liability, provided you should be able to satisfy the assessing officer. If the assessing officer is not satisfied with your explanation, then he will reject your application. It is not mandatory that he will always accept. If he accepts, he will return. If he rejects, then nothing can happen. Then wait for the assessment to complete. Sir, in how many days? If he accepts, sir, in how many days he will give? He will give within 120 days from the completion of search. When is the search completed? 31st October. So within 120 days from 31st October maximum, he will return you the assets by reducing the existing liability. This is what this provision is all about. I hope it is clear to all of you. Next question is whether GAR will be applicable or not. We need to answer that. See, there is one country, country X, and there is one country, India. Now, it is written in the DTAA between India and country X that if a country X company invests in Indian company more than 10%, then they will be liable to tax in India. So, if a country X company is investing in an Indian company more than 10%, then they will be liable to tax in India. So, they should not invest more than 10%. If it is below 10%, then it is not taxable in India. So, they want to invest in Indian company around 19-20%. So, what are they doing? If they invest 19-20%, which will be more than 10%, they will be liable to tax in India. So, they are not directly investing 19 or 20% in India. They are making two companies in country X. Lalit Limited, Mohan Limited formed in country X. So, now X Limited is holding company for Lalit, X Limited is holding company for Mohan, and they are telling Lalit and Mohan to individually invest 9.95% and in an Indian company, so that X country company is not investing more than 10% in Indian company and they can take the benefit of DTAA. So whether GAR can be applicable in this case, the answer is yes. There is no commercial substance of making Lalit Limited and Mohan Limited. The entire objective, the primary objective of making Lalit Limited and Mohan Limited is only to obtain tax benefit. There is no commercial substance. This entity lacks commercial substance. They do not do any other thing except investing in Indian company Red Chillies Limited. Therefore, the GAR will be applicable. The AO will disregard both the entity and will assume that X Limited has directly invested 19.9% and therefore tax will be charged in India. I hope it is clear to all of you. Next question is on whether the foreign company has a POEM in India or not. For that, we need to check the ABOI test. So, Mischief Limited is a company incorporated in Maldives. Now, they have given the data to us. So, what are the conditions to prove that the foreign company is passing the ABOI test? There are 5 conditions. First, the passive income should be less than equal to 50% of total income. Let's test the passive income. First of all, is the first income passive income? The answer is no. Why? Because in passive income, you should purchase and sell both from associate enterprise. Here you are selling to unrelated party. Therefore, this is not passive income. Second, also not passive income because here you are purchasing from a related party. You should purchase and sell both from related party. Third, you are purchasing both and selling both to associate enterprise. Therefore, this 5 lakhs and this 10 lakhs will come in passive income. Next, interest, dividend, capital gains, royalty and rent. These 5 incomes are always passive income. Therefore, this 20 and 15 is also passive. Therefore, how much is passive income? Total passive income, if I total, it is 50 lakhs, sorry, and divide by total income, if I do, it is 110 lakhs. How did I get total income? 25 plus 50 plus 20 plus 15, I will get 110 lakhs. Is it less than equal to 50%? The answer is yes, because it is less than equal to 50%. Condition number 1 fulfilled. What is condition number 2? The Indian assets should be less than 50% of total assets. The Indian assets are these assets: 120, 50, 40. Total assets are total of all of them. So the Indian assets are 210, total assets are 610. Therefore, Indian assets are also less than 50% of the total assets. Third, the Indian employees, which are 70, should be less than 50% of total employees. So the Indian employees are also less than 50% of total employees. Fourth condition, the payroll expense on the Indian employees should also be less than 50% of total expense. Yes, the payroll expense on Indian employees is 8 lakhs and the total employees is how much? 20 lakhs. Therefore, the payroll expense on Indian employees is also less than 50%. And last but not least, majority of the board meetings should be held outside India. So out of 8 board meetings, only 3 are held in India, 5 are held in Maldives. Therefore, this company will not be liable to tax in India, because this company will be called as what? Having active business outside India. The poem is outside India. Therefore, the status of this company is non-resident. I hope it is clear to all of you. They are fulfilling all the conditions of poem. Is this clear? Let's move on to the third paper, MTP Series 1, September 2025. Now, the very first question is exactly similar to what we have done earlier. Same. All adjustments are copy paste. You can go and check all of them. We have done all these adjustments multiple times, not one times, at least 4 to 5 times we have done all these adjustments. I'm not repeating this question once again. It doesn't make sense. You also ignore, completely ignore, please. Don't touch also this particular question. Yes, second question is a good question which is coming for the first time in our 26 paper compilation. What is this question? This question is on partnership form. We need to find out the book profit. We need to find out the remuneration. We need to find out the total income. AMT is not required. No AMT. We are supposed to compute only under the normal provision. Okay, just normal provision. No AMT is asked. AMT is not computed. So first we will compute the book profit as per the provisions of 40B. So what is the net profit of the partnership firm? It is 95 lakhs after debit and credit of following things. Interest on capital we are giving 13%, so add back 1%, only 12% allowed. Next, interest on loan from partner. Interest on loan from partner is also covered in 40B. It is also covered in 40B. You are giving 17% interest to partners. Partner is giving loan to the firm. Firm is giving interest. How much? 17%. Not allowed. Only 12% allowed. 5% interest add back. Now the next adjustment is very important. You are paying a royalty of 5 lakhs to a partner who is a professional script writer for use of his script. So you are using some script of the partner. The firm is using the script of the partner and paying a royalty. Whether this royalty can also come under 40B, the answer is yes. Take this also under 40. Because under 40B it is written that any remuneration, commission, bonus, salary, by whatever name called paid to partners can come over here. So by whatever name called can also include royalty. Therefore, this royalty will also come in 40B. Add back this and compute this under what? Under the total limit of 40B. Add back this also. Depreciation as per books of accounts, add back. Now next adjustment also very good. You have purchased the building in 2022 for 87 lakhs. I don't know for how much you have purchased. Today the WDV is 37.83 lakhs because it's a depreciable asset. You have purchased in 2022. Today the WDV is 37.83 lakhs. You are selling for 87 lakhs. The differential amount you have credited to P&L. First of all, reduce from PGBP. Reduce the PGBP and show under capital gains. It will be called as STCG. This was the only asset in the block. Therefore, the block ceased to exist. Therefore, short-term capital gains will be chargeable on you. So this is the amount, around 53, 52, whatever amount will come, 52 lakhs point something, that will be subject to tax under capital gains. But listen, when are you selling this? You are selling on 5th of November. And within 6 months from this date, you are investing what? You are investing in point number C, check, in National Highway Authority of India bonds, check, within 6 months. You are selling on 5th November, you are purchasing on 31st May, which is within 6 months, you are purchasing what? Your bonds. Therefore, you can claim exemption under what? 54EC. 54EC exemption can be claimed against long-term land and building. But sir, the gain is short-term, na? Gain is not relevant. The nature of asset is relevant. Remember, AS Builders case law. Is the asset long-term? Yes. The asset was purchased in 22, sold in 25. Therefore, the asset is long-term, it is sold after 24 months. Don't check the gain. Gain is not relevant. The nature of asset is relevant in 54EC. Therefore, you can claim exemption of 26 lakh rupees over here. Then there are 4 partners. Only 2 partners are working partners. Be careful while computing the remuneration. Okay. Partnership deed authorizes the payment of interest and remuneration. Remuneration is 35,000 rupees per month. This is the actual remuneration. Remuneration is not debited to P&L. Great. If it would have been debited, we would have added back. Now, because it is not debited, we do not add back. Okay. Next one. You are opening some unit in SEZ, but you are late. You are opening in 2022. After 2021, nobody is going to get deduction under 10AA. Maximum you have to open the unit by 31st March 2021. And the letter of approval should have been taken by 31st March 2020. Anybody who has taken letter of approval till 31st March 2020 and opened the unit till 31st March 21 can also claim deduction. But after 21, it is not possible. So this entire discussion is of no use to us. Okay. No use to. You cannot get deduction of this particular 10AA. Next, already done. 54 EC exemption you will claim. After that, depreciation as per income tax law 27,000 you can claim. Then WDV of the car 9,70,000 rupees. On that you can claim 15% depreciation. Then second hand machinery you are purchasing but put to use in November, therefore put to use for less than 180 days. Therefore you can claim what? 7.5% depreciation. Okay, not full 15%. After that, you will compute your book profit. After that, you compute remuneration, maximum remuneration, and compare with actual. Actual remuneration will include what? Two partners remuneration, 35,000 per partner into 12 into two partners plus in actual remuneration, you should also add 5 lakh rupees royalty because you are also considering royalty to be part of what? Remuneration only. You have to consider that also. Be very careful. And then you will compute your total income. I hope it is clear to all of you. Next question, similar. Just now we have done it. Check it, please. For a national coming to play in India and is earning from playing, for whatever he is earning from playing, that will be subject to 20.8% tax, and whatever is earning from horse race and lottery, that will be subject to 30% tax. Just now we have done this question. Check it, please. Nothing great. Question number 3. Let's start. Beautiful question. So there is a REIT, business trust. We need to compute the total income of business trust and also Mr. Arpan, which holds 70% in business trust. And there is also an SPV by the name called as H Limited. SPV does not, SPV has opted for 115BAA. So therefore this line is very, very critical for us. Be very careful. So there are 3 parties over here. One is REIT, which is known as Beta. Second is Arpan, which is the investor in the REIT. 70% is held by the Arpan only. He is a major shareholder. And H Limited is an SPV which opted for 115BAA. Now we need to compute the total income in the hands of REIT and Arpan. Let's see one by one. Interest from SPV exempt in the hands of REIT always and taxable in the hands of investor, but only how much taxable? 70% taxable, because 70% is what? The holding of Arpan. Dividend from H Limited, dividend from SPV always exempt in the hands of REIT. But what about in the hands of Arpan? In the hands of Arpan, it is taxable 70%. Why, sir? Because the SPV is opting for 115BAA. If SPV would have not opted for 115BAA, then this dividend income would have been exempted in the hands of Arpan. Now, because SPV is opting for 115BAA, SPV is taking concessional tax rate. Therefore, the Arpan has to bear the brunt of tax over there on that dividend income. Short-term capital gains on property, the business trust will pay tax at MMR, investor exempt. Interest on unlisted debenture, business trust will pay tax on MMR, investor exempt. Rent from direct property, business trust exempt, investor taxable 70%. Now you need to be very careful with this case now. Very, very intelligent part. Total how much money is distributed during the year by the business trust? Total 20 crore is distributed to all unit holders. All. Now you need to check. All these incomes are amounting to 20 crore or it is less than 20 crore. If it is less than 20 crore, it means 20 crore includes some repayment of debt also. You are paying over and above all these items, something repayment of debt, that will also be taxable under 56(2)(10) new amendment, FA 24 amendment. Remember or not? So if I total all of them, this 12 crore, this 2 crore, I want to total this. Total 12 crore, 2 crore, 1.2 crore, 12 lakhs, 2 crore. Total all of them, it comes to 17.32 crore. This is the total distribution of these 5 items, but actual distribution is 20 crore. Therefore, how much excess you are giving? You are giving 2.68 crore as a debt repayment to the investor. That will also be taxable in the hands of investor. How much? A plus B minus C, some formula was there. But out of that, Mr. Arpan is getting only 70%. So only 70% will be attributed to Arpan, minus the Arpan has purchased the units for how much? Arpan has purchased the units for 1.5 crore. So the differential amount will be called as what? The debt repayment in the hands of Arpan, which will be taxable under 56(2)(13). 37.2 lakhs will be taxable in the hands of Arpan. Go and check. I hope it is clear to all of you. Beautiful question it is. You always have to check whether the total distribution is more than these points. If it is less than this point, then it is okay. But if the total distribution is more than this point, then there can be debt repayment concept. Also, you can check if whenever they will give you the issue price of the units acquired in the REIT, when this line is also given, there can be a debt repayment concept in your question. I hope it is clear. Next question is a DTAA question. Varun is an Indian citizen. He is 44 years. He left India for the first time in 23. Now he came back to India for some personal reason. Permanently he came back to India. Therefore, he is a resident and ordinary resident. Why? Because he came in June. From June to March, obviously he is staying for 182 days. He is a resident. Now, in 2023 only, he went outside India for the first time. It means before that he was in India only. Therefore, he will easily fulfill the two additional conditions also. Therefore, Varun is a resident and ordinary resident. World income will be taxable in the hands of Varun. Now, Varun wants to pay tax as per new regime. So, accordingly, compute tax as per new regime. First, Varun is earning income from rental, $48,000 on 31st March. Municipal tax is not there. So you will convert this $48,000 minus 30% standard deduction. Okay. Whatever income will come, you will convert this into Indian rupees as per rule 115 TTBR on the last day. TTBR on the last day is 86. So therefore 48,000 minus 30%, 48,000 minus 30%, you will multiply this by 86 rupees. You will get your 28,89,600 as your rental income taxable in India. What is the second income which is taxable? If rest all incomes are Indian incomes only. Business in India 9,40,000 that you can take under PGBP. Dividend received 337,500. This is net of TDS. So you have to gross up this dividend. So gross up this dividend. Divide by 90%. On dividend 10% TDS is deducted under 194 by domestic company. Therefore gross up this by 90%. You will get your gross dividend. Then saving bank interest 19,800 you can take under IFRS. 80 TTA will not be available because 80 TTA is not available under new regime. So only 4 incomes are there in Varun's income. So take the total of all 4 incomes: rental income, business income, other source 2 income. One is dividend after grossing up, don't forget, and one is interest income. This is your gross total income, no chapter 6A. This is your total income, compute tax as per new regime. Your tax is 88E1. Divide this by 442. You will get your 20.86% as your tax in India, average rate in India. Now we will find out the average rate in country. There is only one income where you are doubly taxed. So average rate in country. Which country it is? Country B. What is the average rate in country B, sir? See, how much tax he is paying? 48,000 is the rental income he is earning over there. But he is getting a basic exemption of $15,000 over there. Therefore, he is paying 20% tax in country X only on $33,000. So on $33,000, he is paying 20% tax. That comes to 6,600. So 6,600 is the tax he is paying. And the income in the foreign country is 48,000. So 6,600 is the tax. 48,000 is the income, multiplied by 100, so 13.75 is the average rate in foreign country. Therefore, the relief will be 13.75%, not 20.86%. I hope it is clear to all of you. This 13.76% he will apply on doubly tax income. Doubly tax income is 28,89,000. I hope it is clear. Is it clear? Check it please. Question number 4, which is on TDS, and one question is on transfer pricing, which we have done earlier. TDS question I will say. Generally, if I pay some insurance commission to the insurance agent, insurance intermediary, I am supposed to deduct TDS under 194D at the rate of 2%. In excess of what? In excess of 20,000 rupees. But if the insurance intermediary is located in IFSC and he is giving me a declaration that he is eligible to claim deduction under ATLA, then I am not liable to deduct TDS. Remember or not? There are long notifications. Multiple people are covered to whom if you make payment and if they are located in IFSC and if they give a declaration, then no need to deduct TDS. So this is what is happening in the first question. The agent is an insurance intermediary which is located in IFSC and you are making a payment of commission of 1,50,000 rupees to him, but do not deduct TDS because he is giving a declaration that he is claiming deduction under ATLA. Therefore, do not deduct TDS. I hope it is clear to all of you. Next question we have exactly done in question number 4B of Jan 26 paper. Go and check. Next question. Question number 5A1. What is this, sir? The AO has passed an order for AY 2425, but the typist, while typing the order number, he has written 2324. So the order is of 2425, but while making the order, the typist has made a clerical error, making it 2324. Because of this mistake, can you tell that the entire order is invalid? And can you deny paying the tax liability? The answer is no. There is section which protects the income tax department, 292B, not BB, 292B. 292BB is different. 292B, which says that if there is any clerical error, typographical error in the order or in the any notice, in any summon, then you have to ignore that fact. If the overall impact of the order does not change, if the overall purpose of the income tax law is not defeated, here the income tax purpose is not defeated. Just because 2425 is wrongly written as 2324, the entire purpose is not defeated. You have to ignore that fact and consider that as a valid order and pay the tax on time. I hope it is clear to all of you. Next question we have done earlier. Again, I will say once again, Reliance Communication. Can ITAT under 254 subsection 2 re-hear the entire matter? No. When you go and make an application to ITAT under 254 subsection 2 for what? For rectification. ITAT does not have the power to re-hear the entire matter once again. ITAT does not have the power to review its own order. ITAT cannot review its own orders. The first view should be the last view. They cannot take multiple views. Once they pass an order, they cannot change the order in future. Yes, only one thing is possible. Once they pass the order, in future, if there is an apparent mistake, they have to rectify. That's it. That's the only power with the ITAT, which was said by the Supreme Court in the case of Reliance Communication. Multiple case laws are there on this issue. Next question. Again, a good question. Green Tech Innovation is a resident company. They are planning to enter into some collaboration with a German company. For that, they filed an application to advance ruling in April 26. So, an Indian company wants to enter into collaboration with a foreign German company. For that, they have made an application to board for advance ruling in April 26. But later it was revealed that this same Indian company, they have already submitted an application to AO for same matter in March also. In March also, 1 month before, you have already submitted a similar matter to the AO, same matter to the AO for determination of tax liability or tax implication. Now the question is whether the AAR will accept your ruling. The answer is no. It is very clearly written in the law that if your matter is already pending in front of Income Tax Authority or ITAT or any court, the AAR will reject your application. In this case, your matter is already pending since March 26. You should have not come in April 26 to AAR. Your application will be rejected. First part is this. Second part, what is the remedy available? If you are agreed by the ruling of the board for advance ruling, the only remedy is you can go to High Court, file an appeal in 60 days. Within 60 days from the date of receipt of BFAR order, you can file an appeal to High Court. If required, if circumstances so justify, if there is a genuine case, they will give you also an extension of another 30 days. Another 30 days extension can also be given by them. I hope it is clear to all of you. Next question is also a beautiful question on GAR. So pay attention. Very, very good question. There is country X here. There is India here. What is happening, sir? In country X, there is one company, Skyline company. In India, there is one company, Sunrise Limited. Now it is written between the DTAA between country X and India that if Skyline provides services to Indian company, they will be liable to tax in India. They will be liable to tax in India. But at the same time, it is written that if it is not company, instead it is a firm, then they will be liable to tax only if the firm has a fixed base in India, that is they have some P in India, or if the partners or employees stay in India for 180 days. Otherwise, it is not taxable. For company, it is directly taxable, but for firm, it is not directly taxable. For firm, they should have a branch in India, or their partners or employees should stay, or partners or employees, either of them should stay for more than 180 days. So the company did what? The company, instead of providing services through company, they made a firm. They made a firm and they provided the service through a firm to Sunrise Limited. They did not make any partner. They did not make any branch in India. Neither they have any partners or employees who are staying in India for more than 180 days. They are not violating these conditions. So therefore, whether GAR will be applicable, the answer is yes. GAR will be applicable because there is no commercial substance of making this partnership firm. The only objective of making this partnership firm is to take tax benefit. Therefore, the AO will disregard this particular partnership firm and will assume this partnership firm to be a company only, and therefore GAR will be applicable on the SSC. I hope it is clear to all of you. Next question. Mr. Pradeep is an interior decorator. Beautiful question this is also. His total receipts are 65 lakhs and the breakup of the receipts is also given here. Now he is contending that he will not get the books of accounts audited because his turnover is not exceeding 75 lakhs. He is ready to declare his income under presumptive income 4480A. Is he correct? The answer is yes, he is correct. How, sir? See, Pradeep's total receipts is how much? 65 lakhs. See, if your total receipts is up to 50 lakhs, you can definitely go for what? 4480A because Pradeep is an interior decorator. Interior decorator is covered in 4480A. But even if your total receipts is up to 75 lakhs, in that case also you can go for 4480A. If your receipts, cash receipts is up to 5% of total receipts. So if Pradeep's cash receipt is up to 5% of total receipts, then Pradeep can enjoy 4480A, up to 75 lakhs also. And if he enjoy 4480 up to 75 lakhs, then he does not have to get his books of accounts audited. So we need to check whether the Pradeep is coming in that 5% limit or not. See, the total receipts of Pradeep is 65 lakhs. That I will take in the denominator. Now I will check how much is cash receipt. I will get two cash receipt in this entire statement. One is this one. This bearer check is also considered as cash receipt, sir. Yes. And check which is not an account pay check will be considered as a cash receipt only. Okay. So this bearer check will be considered as cash receipt. And here also see 1,22,800 is received in bearer check. That is also cash receipt. Apart from that, everything is online. This is online, 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 this is online. Rest all is online. Only these two payments, these two receipts are what? Cash receipt. If I total it, divide by 65 lakhs, it comes to 3.61%. Therefore, because it is up to 5%, Pradeep can enjoy 44 ADA benefit up to 75 lakhs. Therefore, because he can enjoy 44 ADA benefits up to 75 lakhs and he wishes to claim presumptive income. He is not saying that he does not want presumptive income. He wishes to claim presumptive income. Therefore, there is no requirement of audit up to 75 lakhs. I hope it is clear to all of you. So, this is what this paper is all about. Let's go ahead with MTP Series 2 September 2025. The very first question is on total income. Let's see what they are asking. They are asking total income and tax payable as per the normal provision. No 115BAA, no 115BAB, no MAT, nothing. The turnover of last year is 450 crore. Therefore, the tax rate will be 30%. Okay, now let's start with the discussion. Assess is a manufacturing company. Net profit is 68,50,000. Depreciation as per the company's act is 59 lakhs that you will add back. Then routine adjustment. There is some old machinery which has caught fire, so it is destroyed. So there is a loss of 19 lakhs. This 19 lakh loss is a capital loss, so add back this loss and this scrap value will be reduced from the WDV of the block of asset. So reduce from PGBP and reduce from the WDV of block of asset, but WDV of the block of asset is not given to us. So ultimate treatment is what? Very simple. 19 lakh rupees add back to PGBP and 9 lakh 10,000 rupees reduce from PGBP. Next is tax demand 8 lakh 40,000 including cess. So income tax department, income tax demand including surcharge and cess is disallowed. Therefore disallow this entire amount. Next is this, you are receiving some power subsidy from central government of 17 lakh rupees which was not credited to income earlier. Therefore it is a part of income as per 22418. Any subsidy received from central government, state government body, agency, etc. It is income under 22418. Next one is an intelligent adjustment which is coming for the first time. Generally, interest income is where do we put interest income? Generally, we put interest income under IFRS, but in this case, interest income will not go in IFRS. In this case, interest income will go in PGBP. Why? Because it is interest earned on margin money deposited for securing bank guarantee. You want some bank guarantee which you want to give in business to your contractors, etc. So because you want some bank guarantee which you want to give to someone, and in place of that you have put some fixed deposit in the bank, and because of that fixed deposit you are getting some interest. This interest is not an independent investment activity. This interest is related to business. Therefore this interest will be PGBP income. Let it be part of PGBP. Don't do anything. Next one, raw material 14 lakhs you are purchasing for in-house research and development which is debited to P&L. It will be allowed as deduction. You are not claiming ITC on GST. Therefore you will be allowed the deduction on this 2,75,000 rupees also. Okay. Next one, you are making some payment of 18 lakh rupees for online advertisement to Yulong Materials Limited, which is a non-resident with a P in India. Now you are making some online payment to a non-resident. The non-resident also has a permanent establishment in India, and you are making payment to that non-resident. This income is accrued and taxable in India. Therefore, you should have deducted TDS. You have not deducted TDS. Therefore, 100% of this expenditure will be what? Disallowed under the income tax law. Next one is, you are receiving some dividend of 3,33,000 from foreign company. So reduce from here and show under IFOS. And there is an expense of 19,000 rupees which is other than interest. So other than interest expense are never allowed against dividend. Therefore add back this interest, add back this expense over here. So what is the ultimate treatment of this dividend adjustment? Reduce dividend income from here, show under IFOS. Add back expense, don't claim deduction under IFOS. Okay. Next is, you have taken some loan from PNB. On that there is an interest of 15 lakh rupees. Now you want to convert that interest into a new loan, or you want to convert that interest into a debenture. Therefore, conversion of outstanding interest into a debenture does not amount to actual payment. Therefore, this will not be allowed under the income tax law. This is also disallowed. Next, depreciation as per the income tax law will be allowed 43,20,000. Then you have purchased some printer of 92,50,000 rupees. On that printer, you will claim 15% normal depreciation, 20% additional depreciation. Then another printer you have purchased after 23rd October. So on this, you will claim half depreciation normal and half additional depreciation, 7.5% and 10%. And then some assets you have purchased after 30th October. On that, you will claim 50% depreciation. Lorry for transportation, you will claim 85 lakhs into 7.5%. Additional depreciation is not allowed on road transport vehicle. And one imported machinery for Hungary, which will not be subject to depreciation because it is installed in the next year. Okay, the turnover of the company is 450 crore. Therefore, the tax rate will be 30%. I hope it is clear to all of you. So this is what this question is all about. So let's go to the next question now. Question number 2. Question number 2 is a beautiful question of conversion of a private company into an LLP. If a private company is converted or an unlisted company is converted into LLP, then the provision of section 4713B is applicable. Now, what does 4713B says? First of all, first a private company was there, ABC Private Limited Company, and then that was converted into an LLP, ABC LLP on 30th of September 2025. Now, we need to tell the lot of tax implication. First, what will happen with the business loss? The business loss can be transferred to LLP for balance number of years from 1st April 2025. Earlier it was transferred for another 8 years, but now it can be transferred only for balance number of years. So the business trust can, so the business loss can be transferred to the LLP for balance number of years. Second, plant and machinery. Plant and machinery whose WDV was 14 lakh rupees. Ignore market value. Market value is not relevant. WDV is relevant. Take 15% depreciation on that and then bifurcate between both of them on the basis of number of days the assets are used by both of them. So from 1st April till 29 September, the company will claim depreciation, and from 30th September till 31st March, the LLP will claim depreciation. Next, plant and machinery, 75 lakh on which 3580 deduction is claimed. Therefore, now on this machinery, even the LLP cannot claim depreciation. In any asset on which 3580 deduction is claimed, that is not depreciable. That cannot be claimed as a depreciation even by LLP. Even LLP cannot claim depreciation on that. Next one, for building also same like machinery, claim 10% depreciation on the WDV, not on market value. The WDV of the predecessor, the WDV of the company becomes the WDV of the LLP, not the market value. Market value ignore. 40 lakhs into 10%, then bifurcate between both of them. Cost of land 80 lakhs. So this cost of land will become the cost in the hands of LLP. Whenever the LLP will sell the land, they will take 80 lakh as their cost of acquisition for the purpose of computation of capital gains. VRS. Total VRS incurred in 23, 24, 28 lakhs. Now VRS expenses are allowed over a period of 5 years. We all know that. Okay. Now in the current year entirely, it will be allowed to LLP. Entirely. In current year, don't bifurcate VRS. In the current year, entire VRS, that is 1/5 of 28 lakhs, that is whatever amount is coming, 5.6 lakhs will be allowed to LLP. Next years onwards, LLP will get, obviously, and past year, obviously, company was taking. Unadjusted MAT credit lapsed. Any unadjusted MAT credit will not be carried forward by the LLP, it is lapsed. Last but not least, depreciation. Depreciation can be carried forward by the LLP. UAD can be carried forward by the LLP. So these are the items, tax treatment, which we have to write for each and every item, and you will get the marks. 8 marks question, very great. Next question is a very simple question on transfer pricing. There is a company, Access Research Solution, which is providing scientific research services to various non-residents. One of the client is Emerald, which guarantees 12% of the total loan. So if one enterprise guarantees at least 10% of the total loans of another entity, then both of them are deemed to be a source enterprise. Therefore, transfer pricing provisions will be applicable in this case. Because both of them, because Access Research Solution and Emerald are deemed to be a source enterprise, the transaction between them will be deemed to be international transaction. This is part 1, very simple. Next, part 2. In part 2, you have to write the entire story of what secondary adjustment. Suppose the AO has done a primary adjustment of 440 lakhs, which is more than 1 crore rupees. And AO has passed an order on 31st of March. Assessee has accepted that. What are the subsequent compliances? Transaction is denominated in rupees. No repatriation of money till 31st March 2026. 1 year MCLR is 9% of SBI. So we have to write the entire provision of secondary adjustment. Because the AO has passed an order on 31st of March 2025, the assessee should bring back the money to India, repatriate the money to India within 90 days from the date of order. If the money is not repatriated to India within 90 days from date of order, then secondary adjustment will apply. Secondary adjustment, because the transaction is denominated in rupees, therefore the secondary adjustment will be also in rupees. 440 lakhs will be considered as deemed loan multiplied by 9% plus 3.25%. Because the transaction is denominated in rupees, 9 MCLR of SBI plus 3.25% will become your effective interest rate. On that, you will apply the interest rate, you will get your secondary adjustment interest. You have one more option, that you pay one-time additional tax of 20.9664 and get relieved. Once you pay one time additional tax of 20.9664, that's it. After that, there is no need to pay any tax. I hope it is clear to all of you. Both the options are there. Whichever is more feasible, the assessee can go for that. Next question, question number 3, which is on exit tax. There is a trust, Helping Hand Foundation, which was registered under 12AB. Now on 1st April 2025, it got merged with another trust, which is not approved under 1023C or 12AB. Therefore, exit tax will apply. Exit tax will apply. For that, you need to compute accredited income as per Rule 17CB. On that, you will apply 34.944% tax. Accredited income is aggregate value of all assets minus aggregate value of all liability. In assets, land will be valued at stamp duty value or market value, whichever is higher. Therefore, you will take stamp duty value. Equity shares will be equity shares which are listed in a stock exchange. You will take the average on 1st April 2025. That is whichever is 85 plus 95 average. That is you will take 90. For preference shares, you will take market value. For corpus fund, you will not take corpus fund. Outside liability, you will take taxation. You will not take, and other small outstanding expenses you will take. After that, you will get your accredited income. All assets minus all liabilities. The difference will be subject to tax at 34.944%. Very simple question. Bonus question it is. If it comes for 8 marks, it's a great win-win situation for you. Next is a very simple DTAA question. Very, we have done such questions earlier. You can check it once. If you want to do, you do it, or else I will recommend that you will ignore this. You ignore this, please. Don't waste your time. You have much better things to do in life. Next one is tedious question, in which part 1 we have not done earlier, part 2 we have done earlier. Now lot of questions will repeat. At least 70-80% questions will repeat from here. Now what is part 1? There is an agent, there is a distributor who is giving some commission to the lottery agents. So if the distributor is giving commission to lottery agent, are the distributor liable to deduct TDS? The answer is yes. Under which section? Under 194G, if the commission payment is more than 20,000 in the financial year, they are supposed to deduct TDS at the rate of 2%. Now here the commission amount is 1,20,000. You are making a payment of 1,20,000, which is more than 20,000. Therefore, deduct TDS at the rate of 2%. I hope it is clear to all of you. Next question we have done earlier. Check it, please. Very simple question. Next question is a very beautiful question. You should do this question. This is a must-do question from the MTP. Because this is the only question on Vodafone case law. This is the question on Vodafone case law. Very good question. Now there are 3 things which we need to understand. Eco-Pack Solutions Private Limited is an Indian company. It is in India. It is similar to HEL. Hindustan SR Limited. Do you remember that Vodafone case law HEL? Then there is Green Core Global, which is in country Zeta, which is similar to CGP, Mauritius company. And in this company, in this Green Core, there are 2 shareholders, Lucas Pereira and Daniel Zhang. Both of them are citizens of foreign country. They hold 50% each. So Lucas and Daniel are in what? Are in foreign country. They are holding shares of Green Core, which is also a foreign company. Now that Green Core is holding some shares in Eco-Pack Solutions Private Limited. So if Lucas and Daniel is selling the shares of a foreign company, whether the shares of the foreign company will be subject to tax in India? Yes, they will be subject to tax in India if they derive their value substantially from asset located in India. So if the shares of Green Core derive its value substantially from asset located in India, as per explanation 5 to section 9, then it will be deemed to accrue or rise in India. Then how do you find out whether it is deriving substantially its value from India or not? For that, first of all, we need to find out specified date. Specified date can be 2 dates. It can be either the date on which you sell these shares or the last balance sheet date of Green Core. What is the last balance sheet date of Green Core? It is 31st December. You can check it. So this 31st December 2025 is not relevant. The specified date can be either the last balance sheet date, that is the balance sheet date which comes prior to the year of sale. Year of sale is June 25. Last balance sheet date is December 24. The specified date can be December 24 or June 25. But between 2, which is the specified date? By default, you should take December 24 as specified date. But if the book value of the asset increase by more than 15%, the book value of the asset increase more than 15% of Green Core, then the specified date will become the date of transfer. So what is the book value of asset on 31st December? It is 2000. Check. This is the Green Core book value of asset. What is the book value of asset on the date of transfer? It is 2600. Is it increasing by more than 15%? Yes. Therefore, you will take the specified date as 1st June, not as what? 31st December. If the book value of asset would have been below 15%, then we would have taken 31st December as your date of what? Specified date. Now, so specified date is 1st June 2025 because the book value of asset as compared to the last balance sheet date is increasing by more than 15%. Therefore, this date is not relevant. Now on this date, I will check whether the shares of Greencore derive its value substantially from asset located in India or not. So how to determine that? For that, there are two conditions which Greencore has to fulfill. First, the investment in India should be more than 10 crore rupees. And the investment in India as compared to the total investment should be at least 50%. So how much investment they have made in India? They have made an investment in India of 1200 crore. Check please. Fair market value of assets in balance sheet of Eco Limited. At this time, you need to check the FMV. See, always remember, while computing this specified date, you have to take book value. But while finding out the substantial value, you have to take the FMV without reduction of liabilities. So how much is the FMV of the assets of Greencore in Eco Shares Private Limited? 1200 crore. How much percentage it is of total assets of Eco Solutions Private Limited, of Greencore Global? 1,200 is the investment in Indian company. 2,200 is the total assets market value of the Greencore. Therefore, this is greater than equal to 50%. Therefore, two conditions are fulfilled. Condition number one, investment in India is more than 10 crore. And investment in India as compared to total investment is greater than equal to 50%. Both the conditions are fulfilled. Therefore, the shares of Greencore Global derive its value substantially from asset located in India. Therefore, Lucas Pereira and Daniel Pereira, if they are selling the share, they will be liable to tax in India. I hope it is clear to all of you. Beautiful question it is. Beautiful question. Question number 5. Part A we have done earlier. You can go and check. Reference I have given over here. Part B we have not done earlier, but it is a Supreme Court judgment of SAP Labs India Private Limited. What does this say? Can High Court come in between and determine the arm's length price? See, determination of arm's length price is the pure question of fact. It's not a question of law. So the question is, can High Court come in between and determine the question of fact? The answer is no. But can High Court come in between and tell the department and tell the tribunal that you have not computed the arm's length price as per the income tax department, income tax rules and regulations? See, ultimately arm's length price is determined as per the provisions of 92C and its rules. Rule 10CA, Rule 10CA. All these rules are applied. So can High Court come in between and say that the income tax department or the SSC or the tribunal or any authority below that has not computed the arm's length price as per the Income Tax Act and its rules? Yes, that High Court can say. High Court will not come in, compute the arm's length price, but High Court definitely has the power to interfere in between and tell that the arm's length price are not computed as per the Act and the rules. I hope it is clear to all of you. Next question. The Indian branch of Slack Private Limited, they have done some transaction with a foreign company. The value of the transaction is 600 crore. Now they are asking for the fees. How much fee they are supposed to pay? See, if the transaction value is more than 300 crore, you have to pay advance ruling fee of 10 lakh rupees. If it is more than 300 crore, if it is up to 100 crore, then 2 lakh rupees. Above 100 crore, up to 300 crore, 5 lakh rupees. Above 300 crore, 10 lakh rupees fees you are supposed to pay. This is the first question. Second, same question repeated. If you are not happy with the order of BFAR, what is the remedy? Go to High Court within 60 days. 30 days extension will be given to you. Very simple question. Again and again they are asking the same question. Now next question is a good question on Bitcoin. You are purchasing 5,000 Bitcoin for 50,000. Now you are selling 2,500 Bitcoin for 25,500. So there is a profit of 500. How, sir? See, if 5,000 Bitcoins cost is 50,000. So what is the cost of 2,500 Bitcoin? 25,000. Cost is 25,000, you are selling for 25,500, therefore 500 rupees is gain. Multiply by 2,500 units. Similarly, another 2,500 you are selling for 28,750. So again there is a profit of 3,750 per Bitcoin. Why? Because the cost of 2,500 units is 25,000. Because the cost of 5,000 units is 50,000. So 25,000 is the cost. You are selling for 28,750. Therefore the gain is 3,750. Pay 30% tax. Expenses not allowed against the virtual digital asset. Expenses are not allowed. Expense on transfers are disallowed. Sorry. What about NFT? Same. 10,000 NFT you are purchasing for 1,50,000. Now you are selling 6,000 NFT means 60% for 89,000. So the cost of 60% comes to how much? 90,000. But you are selling for 89,000. There is a loss. This loss is lapse. You cannot set off this loss against Bitcoin. Not allowed. Not allowed. Not allowed. Get loss. Not allowed. Expenses also not allowed. Losses also not allowed. Another 4,000 you are selling for 56,000. What is the cost of 4,000? The cost of 4,000 is 40%. 4,000 is 40% of 10,000. So 40% of 1,50,000 is 60,000. The cost is 60,000. You are selling for 56,000. Therefore, 4,000 is loss. Again, this loss you cannot carry forward and set off. I hope it is clear to all of you. This is lapse. Not allowed. Next question we have done earlier. Go and check later on. Question number 6A1 of May 2024 paper. Okay. I hope it is clear to all of you. Lord, let's go ahead with the next one. That is MTP Series 1 Jan 2026. The very first question is exactly copy paste from question number 1 of RTP May 2025. I'm not going to repeat this again and again because most of the things are now copy pasted. This question is also copy pasted from same as question number 1 of November 2023 paper. You can go and check. This question is also repeated, same as DTAA question earlier. This question also repeated. This question also repeated. Most of the things now are going to be repeated now. This question also repeated. Now, this question is slightly new question which are not repeated in the 26 paper so far. So I will talk about it, and it's a very, very important question. Now, this C question will come once again in the next MTP. So from here they have copied in the next one. So what is this question? There is a total income. We need to compute total income and tax liability of Winter INC, which is a non-resident. Let's try to understand and compute the total income of this company, which is a foreign company, which is a non-resident. Dividend 1,25,000, 12,50,000, 20% tax plus cess will be applicable as per 115A. Second, this non-resident and foreign company is providing some technical know-how to an Indian company of 20 lakh rupees. So Indian company is receiving technical know-how, and instead of paying 20 lakh rupees, they are giving dividend of 20 lakh. They are giving debentures of 20 lakh rupees to foreign company. So the foreign company is providing me technical know-how, and I am giving them debentures. I am not giving them money. This will be taxable at what rate? This will be taxable at 35% tax. Sir, why sir? Why not 20% tax under 115A? 115A cannot be made applicable here because there is no agreement between both of them which is approved by central government. If there would have been agreement between both of them which would have been approved by central government, then I would have applied what? 115A. In this case, I will not apply 115A. Sorry. Here I have to apply normal tax rate 35%. But one more thing will come. Because I am also giving debentures, I am not giving money. I am not giving 20 lakhs money. I am giving debentures. So a debenture interest will also be taxable in India. That is for 6-month interest on 20 lakh rupees 8%. That will also be taxable at 35%. Sir, this interest also cannot come in 115A. No, this cannot come in 115A. You cannot tax this interest also at 20% because this loan is not given in foreign currency. This is given in Indian currency. Therefore, this debenture is in Indian currency. Therefore, this will not be subject to 115A. This will also be subject to 35% tax on interest. Next. Dividend from GDR. Dividend from GDR is taxable at 10% under 115AC. Next, normal business income at Mumbai will be taxable at 35%. And last but not least, royalty of 10 lakh rupees in pursuance of an agreement which is approved by central government. Yes, this can come under what? And it is other than 44DA. Yes, this can come under 115A. This will be subject to 20% tax or DTAA, whichever is lower. DTAA say 20%, income tax act say 20%, DTAA say 22%, income tax act say 20%. Therefore, now this can come under 115A. The reason is very simple, because there is an agreement which is approved by central government. In point number 2, there was no agreement which was approved by central government. Therefore, point number 2 cannot come in 115A, but point number 5 can come in 115A. I hope it is clear to all of you. Next question is a copy paste question. You can check it please if you want. The question after that is a new question, but it's a very simple question. Mr. Suhas is aged 43 years. He is working in a company with a salary of what? 85,000 rupees per month. Now he is also having a housing loan interest of 1,95,000 rupees self-occupied interest. Now he wants to follow old regime. Now you are supposed to compute the tax of Mr. Suhas. So you will compute the tax of Mr. Suhas under 192. How much tax? How will you compute the tax? You will take his salary 85,000 into 12 minus 50,000 standard deduction. From that you will deduct house property loss because he is following old regime. So you can claim house property loss under old regime. 1,95,000 rupees will be allowed as deduction. Once that is taken as deduction, after that compute total income, compute tax, and then find out how much tax can be deducted in case of Suhas. As simple as that. Nothing great as such. Next question we have done earlier in RTP 2025. This question we have done. I am giving reference. I am not just talking in air. I am not talking in air. I am giving reference of each and every question which we have done earlier. This question we have done. This question we have done. This question we have done. We have done all this question. This question we have done. This last question is pending. That I will do now. And this question is also not done earlier. So I will do that. Okay. What is this question? 292 BB. Question number 5A1. Assessee filed a return on 25th of October. That is in 24-25 Assessee has filed a return. The department has sent a scrutiny notice on 9th of July 2025. The assessee responded to the notice. Whether the service of notice is on time, if not, whether the assessment order can be challenged by the assessee. Now let's see what is happening. When is the assessee filed the return? 24-25. 25th October 2024, that is 24-25. When the notice was served on 9th of July. 100% is late because the time limit to serve notice under 143(2) is within 3 months from the end of the financial year in which the return is filed. So return is filed in 24-25. So within 3 months from the end of the financial year is 30th June 2025. By this date, the department should have served the notice, but the department has served the notice on 9th of July. So it's a late notice. Now, there are two possibilities. If assessee has cooperated, then it is deemed to be valid because 292BB will attract. And if the assessee has challenged before completion of assessment, then it is not deemed to be valid, then it is an invalid notice. Then you can challenge the assessment order also. Remember, if a notice comes late or if a notice comes improper, you should challenge that. You should challenge that. If you challenge that, nobody will raise any question. But if you don't challenge, if you cooperate in the assessment and if you let the assessment order get passed, after that if you raise any question, it is deemed to be valid notice. I hope it is clear to all of you. And one last question is on tax audit. What is happening in this question? Beautiful question on tax audit. On 28th of February 2025, there was a search conducted in a jewelry shop, Usha Jewelers, where it was found by the income tax department that huge payments are made in cash for purchasing golds, violating the provisions of 48(3). We all know that if you make a payment of more than 10,000 rupees to any person in a day, you should make by 4 modes. Assessee has made 18 crore rupees payment of gold purchase in cash. Some of the clients were asked, their response were recorded. Okay. Most of the golds they purchased is in cash and it is in excess of 10,000. When we asked the chartered accountant what the hell you have done, he has reported in the form 3CD that I have taken the management instruction. Management has given me a representation letter that they have not made payment in excess of 10,000 rupees. I have also done test check. I have not found anything. You have taken management representation that no payment are made for more than 10,000 rupees. You have taken an instruction from the management that we have given strict instruction to the employees, then don't make payment of more than 10,000 rupees in cash. You have also done test check. You have not found a single payment of more than 10,000. That is the reason I have not qualified. This is what the argument of the assessee of the chartered accountant is. No, it is wrong. First of all, the chartered accountant should understand that only taking a management representation letter does not fulfill his responsibility. Then everybody will do one thing, will go for the audit, will take management representation letter, will go home and say that audit is done. Management will always say that everything is correct. Management will never say that there is some problem in the industry. Therefore, it is your duty to check the transaction properly. Considering the nature of business, the assessee is engaged in the business of what? Gold. Cash is a very primary thing in this business. Therefore, because the cash is very primary thing in business, you should have checked each and everything very properly. Definitely giving the argument that management representation letter was taken, its standing instruction of the employees has been seen, I have done test check is not sufficient evidence. Therefore, a chartered accountant in this case is deemed to be guilty under the Chartered Accountant Act 1949. I hope it is clear to all of you. He will be held responsible. Nobody can escape you. Nobody can save you. Let's talk about MTP Series 2 Jan 2026. Question number 1, repeat. Check it please. Same question. Question number 1 of RTP 2025. Same. Question number 2, repeat. Repeat. Now question number 3 is slightly new. Let's see what is there. No, this is also repeat. Sorry. This is also repeat. This is also repeat. Go and check. I have given the reference. Yes, this question is slightly new. That is 3B. What is there in this question? Let's see. The trust claims that anonymous donation received by the firm by them are not liable to tax under 115 BBC. Part 1. A charitable trust applied the entire anonymous donation for the purpose of the trust. Wrong. If I am a charitable trust, then provisions of 115 BBC is applicable, and if 115 BBC is applicable, whatever anonymous donation I have received, even if I apply for the objects of the trust, I cannot claim exemption. Only one exemption is allowed from charitable trust from anonymous donation under 115 BBC, that is 5% of total donation or 1 lakh rupees, whichever is higher, that much you can claim as an exemption. Rest you have to, even if you apply, it doesn't matter, it will be subject to 30% tax. So the argument made by the trust that anonymous donation received, we have applied the entire amount for the objects of the trust is not correct. Even if you applied the entire amount for the objects of the trust, you have to follow the provisions of 115 BBC and pay 30% tax. Will your answer change if the assessee is a wholly religious trust? Yes, the answer will change now. Why, sir? Because if the assessee is a wholly religious trust, then the provisions of anonymous donation 115 BBC is not applicable to a trust which is wholly religious. It is only applicable to a trust which is wholly charitable or which is partly religious and partly charitable. If a trust is wholly religious, then the provision of anonymous donations are not applicable. So in that case, it will be treated like a normal donation. Add to the income statement, claim 15% exemption, and remaining amount you can apply and claim exemption. I hope it is clear to all of you. Next question is a simple question, very simple question of DTAA. Mr. Ashu is a resident, aged 25 years. The total, there are two important points which I am saying in this question. Rest of them are very similar to what we have done so far. Ashu is opting out of default regime, means Ashu is following old regime. Now, Ashu is earning royalty income of 18 lakh rupees. But you will not take 18 lakh rupees because Ashu is following cash system of accounting. Therefore, you will take only that much royalty which is received. First important point is this. You will only take 13.6 lakh royalty which is received. Second, Ashu cannot claim 80 QQB deduction. Why, sir? Ashu is following old regime, na? 80 QQB cannot be claimed. Why? Because Ashu is writing articles in journals and newspapers, and if you write articles in journals and newspapers, 80 QQB is not available. 80 QQB is available if you write some books which are artistic in nature, literary in nature, scientific in nature, not textbooks or notebooks or journals or newspapers. 80 QQB is not available. Be very careful. This is the second important thing. Apart from that, nothing great is there in this question. Rest is very simple. Ashu is earning. Therefore, in PGBP, what you will take? Only 13.6 lakhs. No 80 QQB deduction. Don't take 18 lakhs. Okay. Second, rental income 3.6 lakhs. You can reduce 12 lakhs, so 12,000 rupees standard municipal tax, 30% standard deduction. So rental is very normal. Dividend, you can take dividend which is 5.5 lakhs, which is received and gross amount it is given. So you take directly 5.5 lakhs, and then some repayment of education loan you are taken for your son for your MBA course. For that you can claim interest deduction under ATE. It's a very simple question. Compute tax rate in India, effective tax rate in India, and then find out the doubly tax income. Doubly tax income is only income. Doubly tax is your royalty income, and second income, which is doubly tax, is your rental income. Apply that 15% or average rate in India, whichever is lower on the doubly tax income. Okay, nothing great as such. Question number 2. 4A1 is something which we have done earlier. 4A2 we have not done earlier, so I will speak about 4A2. Sir, what is happening in 4A2? There are 4 people in 4A2. There is a patient who is going to hospital because he is not well. He is admitted in the hospital. Now, after he was released, so the hospital has given a bill. The patient is saying that don't give me the bill, give the bill to the insurance company. So the hospital has given the bill to the insurance company. Now the insurance company has given the bill to whom? To the third party administrator. And now the third party administrator is clearing the bill on behalf of hospital. So if a third party administrator is settling the claim on behalf of the hospital and making the payment to the on behalf of the insurance company and making the payment to the hospital, that will be subject to TDS under 194J. Remember or not? If the third party administrator is settling the claim and making the payment to hospital on behalf of insurance company, 194J TDS is applicable at 10%. I hope it is clear. This question we have done earlier. Go and check. Go and check. I am giving the reference. This question done earlier. This question done earlier. This question done earlier. Go and check. All these questions are done earlier. All of them. All of them. All of them. All of them are done earlier. Go and check. All of them. Now we will come to May 2026 MTP. Let's see what ICI has done in your attempt MTP. May 26. Have they done anything new? Let's move on to the MTP series 1, May 2026. Question 1, number 1, repeat. Check. Same question we have done earlier. All adjustment repeat. None of them are new. All of them are repeat. Question number 2, repeat. Same question. This. Same question we have done of slum sale. Do you remember? Chemical unit, textile unit. Same. They are not putting any efforts in making new MTPs. So always remember, most of the students get confused by looking at MTP. They go and solve ICI MTP in the center. They write the paper in the center and then they feel, yeah, I've got 70 marks in DT. I've got 80 marks. Such an easy DT paper. I can easily score 70 to 80 marks in DT. It's not that easy. It's not a cakewalk. The MTPs are always going to bluff you. They are not going to give you the real picture. The real picture will come from RTPs and past paper, not from MTPs. Always remember. So by solving ICI's MTP, don't be under an impression that you know everything. No. You might know everything. I'm not saying you don't know anything. I know that you know everything, but you are not going to get the same level of paper in the examination. Be very careful with that. Even the easiest of the easiest paper in the CA final exam is not like MTP. It is still tougher than MTP. In MTP, they just do one thing, that is a copy-paste activity from last papers. Only copy-paste they do. They don't have any time to make new paper also. Only copy-paste they are doing. Question number B is a new question. Let's see. Mr. Karan Verma is aged 32 years. Now we are supposed to compute Karan Verma's total income under the new regime. Let's see what all things will come in Karan Verma's total income. New regime, salary 23,70,000. From that you will take 75,000 standard deduction. Interest on self-occupied property not allowed in new regime. Dividend will go under IFOS. Fourth point, he is making some FD in the name of his wife, and she is earning some interest. So if I am making some FD in the name of my wife, that interest will be clubbed in my hands only, because that is my income, not wife's income. That will be clubbed in the hands of the husband. So you have to club that. So these are the domestic incomes. Now foreign incomes. He is earning some income from country R, 13,500. Business income multiplied by 90 rupees is the rate of euro. Then rental income is 8,000. So multiply by 90 minus 800 rupees municipal taxes minus 30% standard deduction. You can take that. Then short-term capital gains of 6,000. That's it. It's a very simple question. Nothing great as such. Then find out the average tax rate in India. And then apply that average tax rate. Compare that with foreign tax rate is 25%. Find out average tax rate in India and apply that on doubly tax income. Very simple question of DTAA. Nothing great as such. Next question, repeat. Now the next question is a good question. We have done a question earlier like this, but this is one step ahead of that. Let me tell you, Tide Limited is an Indian company and Limitless Limited is a company, foreign company, which is located in NJA. We are selling some goods to a company located in NJA for 9.5 crores. So if an Indian company is selling some goods to a person located in NJA, then both of them are first of all deemed to be a social enterprise. Second, the transaction between both of them are deemed to be international transaction. Therefore, we need to find out the arm's length price. So we need to find out comparable. Now in the market, we are getting two comparable. To others, we are selling for 10.5 crore to XYINC and 11 crore for RPINC. So we are getting two comparable. So 10.5 crore we are selling. See, to Limitless Limited, we are selling at what price? At 9.5 crore. To others, we are selling for 10.5 crore to one company and 11 crore to one company. But there is a difference in transaction between both of them. This 10.5 crore and this 11 crore includes two things which 9.5 crore does not include. So you have to remove those two things. Insurance freight is included in 10.5 crores and 11 crores. So remove insurance and freight. Then after sales service cost is also included in this. Remove that also. So now we are getting two arm's length price. Remember, if you are getting more than one arm's length price, then you have to follow range concept if the number of items are 6 or more. If the number of items are 6 or more, you are supposed to follow range concept. But here the number of items are not 6 and more. Here the number of items are less than 6, only 2 items. So you can take arithmetic mean of these 2 items. That will become your arm's length price. So 10.19 first arm's length price, 10.69 second arm's length price divided by 2 will be your average arm's length price. You will compare that with 9.5 crore, then difference amount you have to add back. And one more thing, generally whatever the difference you will get, if that is less than 3%, then you don't have to apply transfer pricing provision. But in case of NJ, you don't have to check 3% also. Remember, in case of NJ, you don't get the benefit of 3% margin. Here the difference is more than 3%, but I am just telling you for the sake of safety in future, they might test you this also. So here, if you take the average and if you compare with 9.5%, the difference is more than 3%. But even if it is less than 3%, still you will take the arm's length price. You will not take the actual price because the person located is in NJA. For NJA, 3% margin is not available. I hope it is clear to all of you. Next question. Serious question. Question number 1. Madhav is an individual whose business is turnover of last year is 3.2 crore. So Madhav, individual, last year business turnover is 3.2 crore. He is making a contract payment for repair of his house for 3 lakh rupees. So 194C will not apply for personal purpose. 194M will also not apply because the payment is not more than 50 lakhs. I hope it is clear. 75,000 rupees is paying commission for business. Yes, for because the commission is more than 20,000 rupees, therefore 194H will apply, and Madhav's last year turnover is more than 1 crore, therefore 194H is applicable to Madhav. Second question we have done earlier, you can check it. Okay. Third question. Question number B. You have taken on sublease building for 20,000 rupees per month and machinery for 18,000 rupees per month. Will you deduct TDS? The answer is no, because the aggregate payment does not exceed 50,000 rupees, therefore no TDS. Under 194I, new limit is set. Under 194I, earlier what was the limit? Till last year, the aggregate limit of the entire year was 2,40,000. Now, the monthly limit of aggregate monthly limit should be more than how much? Monthly limit should be more than 50,000. Here the monthly limit is only 38,000. Therefore, no TDS will be applicable over here. Here this point number C we have already done earlier. So ignore that. Okay. Now question number 5. There are two case law questions. Both of them we have not done. So we will talk about both of them. First is CIT versus AA Estate Private Limited. What is this case law, sir? There was an assessee who lost the case. Okay. Therefore, they filed an appeal to High Court. So, assessee lost the case at tribunal. Therefore, they filed an appeal to High Court. Now, when they filed an appeal to High Court, they obviously gave their substantial question of law. What is the question of law on which they want to appeal? So, assessee gave proposed the question of law. That this is the question of law on which we are supposed to appeal. Now, the High Court gave a judgment without framing the question of law at its end. High Court just relied on the assessee's question of law and gave the judgment. High Court itself, suo moto did not frame any question of law. So the question is the High Court liable to suo moto also frame a question of law? The answer is yes. The court said that there is a difference between the question proposed by the assessee and the question framed by the High Court. The assessee has to frame question under 260A3 and the 260A2, and the High Court has to frame a question under 260A3. Both the subsections are supposed to be fulfilled. A2 is to be fulfilled by assessee, A3 is supposed to be fulfilled by the court. Without High Court framing the substantial question of law at its end, it cannot give the judgment. Therefore, the judgment is invalid. Assessee has to propose the question, High Court has to frame the question, both the question has to be matched, and then the judgment has to be given. The High Court has not done the homework, therefore the judgment is incorrect. Next question which we have done it in our question bank also, if you remember. The assessee filed return of income, declaring income of 10 lakh rupees. His case was selected for scrutiny and the AO added 4 lakh rupees during the assessment. Now during the assessment, assessee came to know that he forgot to set off losses of 8 lakh rupees of last year. Now assessee also knew that the time limit for filing the revised return also expired. So some 8 lakh rupees loss he forgot to set off, and the time limit to file revised return also expired. Will the AO allow this loss? The answer is yes. There are two supporting things for the assessee. One is a Supreme Court judgment of 1985 and one is a CBDT circular of 1955, which says that the duty of every assessing officer is to compute correct total income. And if any assessee has failed to claim any losses, then it is the duty of the assessing officer to allow that loss and give that as a deduction. The objective of the assessing officer is to make correct assessment and is to help assessee, particularly in claiming deductions, claiming losses, claiming benefits. You have to assist the assessee. You should help the assessee in claiming the deductions and benefits and not disallow the losses just because the assessee forgot to claim the losses. Therefore, such losses will be allowed as deduction, don't worry. A CBDT circular of 1955 is there and Supreme Court judgment of 1985 is there. Next question we have done earlier, you can go and check. Next question we have done, done all these questions we have done earlier, you can go and check. This question just now we have done, if you remember. If you remember, just now we have done. Okay, same question only. Only one question is pending over here, whether GAR will be applicable in this case or not. The assessee has made an investment in a company on 1/4/2016. I am not interested in reading the question ahead, because if you have made an investment before 1/4/2017, do you remember in the chapter of GAR I have told you very first thing that GAR is applicable only if the transaction is entered on or after 1st April 2017. Now in this case, if the transaction is entered before 1/4/2017, then GAR will not be applicable. Therefore in this case, GAR will not be applicable. I hope it is clear to all of you. So this is what this paper is all about. So have you seen that most of the question in this paper are repeated by the ICAI from where? From their own RTPs, MTPs and past paper. They are not ready to put efforts to make new MTPs. That is the one of the reason they were irritated with 3 attempts. That in every 3 attempts we have to make MTPs, 2 MTPs, then RTPs we have to make every 2 months. Then we have to make question paper, then students pass, fail, etc. Again and again. Board of Studies was irritated. Making question paper of CA final is not an easy task. Yes, CA Inter, CA Foundation question paper making is slightly easier. I'm not saying that is very easy. Slightly easier compared to CA final question paper. Therefore, they have discontinued 3 attempts and again come back to 2 attempts. They don't have any brains. Whenever they feel like they make 3 attempts, whenever they feel like they make 2 attempts, whenever they will feel like they will make 4 attempts, whenever they will feel like they will remove IBS, whenever they will feel like they will put up one more subject like IBS. Anything can be done. There is no consistency. There is no certainty in the minds of the student. Hopeless people. Anyways, coming to one last MTP series 2, May 2026. What is happening in this question? Let's see. SS Limited is an listed company. And this is a beautiful question. We have not done this question earlier, so we will do it. They are engaged into 4 different kind of businesses. Now, what are we supposed to compute? We are supposed to compute lot of things. We are supposed to compute total income and optimum tax liability. Therefore, we need to follow 115BAA also. Book profit is also given. So, we will make 3 computation. First, total income and tax as per normal provision. Then, as per book profit. Then, we will compare that with 115BAA. Let's start with the first business. The first business is a chemical unit in Hisar. The net profit is 300 lakhs. They have made a total payment of 40 lakh for royalty, but out of that 40 lakhs, on 10 lakh royalty, they have failed to deduct TDS. So this 10 lakh rupees will be subject to 30% disallowance because TDS is not deducted. Now they are doing some emotional story over here. The pay has included this as an income and file is returned before the due date. So what should I do? Still, in the current year, I have to disallow 30% of 10 lakh. In the next year, I can claim the deduction. But in the current year, I have to disallow this 30% of 10 lakh. So 300 lakhs is the net profit, add 30% of 10 lakh, and then one more thing we are paying in case of Hisar unit, 1 crore 68 lakhs we are paying as a contribution to notified pension scheme, which is 15% of basic salary plus DA in terms, 15% not allowed, only 14% allowed under PGBP, therefore 1% add back 1%. So this will give you your chemical business profit. Second, Faridabad unit is a manufacturing unit, furniture manufacturing, net profit 90 lakhs. You are purchasing some trademark of 25 lakhs on 1st June. Wrong. Add back trademark and claim 25% depreciation on trademark. Trademark is an intangible asset. You cannot claim full trademark as reduction. Add back 25 lakhs and claim 25% as reduction. Then you have taken loan from non-resident, paid interest of 3 lakh rupees, deducted TDS in March and remitted in May. So everything is correct. You are deducting TDS in March, which is before the financial year, and paying in May, which is before the due date of filing of return. Therefore, this expenditure will be allowed. Next is you are paying some 7 lakh rupees tax on non-monetary perquisites of employees. So tax on non-monetary perquisites of employees are disallowed under section 40A5, not allowed, disallowed. Third one is fertilizer production unit in Surat. This will be subject to 35AD deduction. 35AD deduction will be allowed. Now how much profit is there? 220 lakh is the profit, which is after depreciation. So add back depreciation. In 35AD, depreciation is not allowed. Add back depreciation and claim the capital expenditure. Land not allowed, building fully claim and machinery also fully claim. So add back depreciation and claim fully building, fully machinery, land not allowed. Fertilizer unit done. Fourth one is warehousing facility for storage of edible oil. Storage of edible oil is not covered in 35AD because edible oil is not an agriculture product. Therefore, this is a normal business. Now, this is the net profit of 70 lakh, which is without depreciation. So, claim depreciation. On building, you will not get depreciation. On land, you will not get depreciation. On building, you can claim 10% depreciation. So, remove 10% depreciation from this. And on machinery, you can claim what? 15% depreciation. Additional depreciation not allowed because you are not doing manufacturing, you are doing warehousing. After doing all these things, they have given you one more information that company has raised some application money and they have put this application money in what? In bank. And from bank, they are earning interest of 3,20,000. What should I do with that interest? So the Supreme Court of India in the case of Rama Multitech Limited has held that the amount received from shareholder in the form of application money and put in the bank, and from there if you earn interest, you should set off that against your public issue expenses. Don't show that as an IFRS income. You should set off that as a share issue expense. Against share issue expense you can set off. Don't show that as an IFRS income. I hope it is clear. Next, you are receiving some dividend of 56 lakh rupees. You can show that as under IFRS, and you are distributing dividend of 40 lakh rupees 1 month prior to the due date of filing of return. So you can claim that 40 lakh rupees as a deduction under ATM. ATM you can claim as a deduction. Therefore, dividend received 56 lakh, dividend distributed 40 lakh. 40 lakhs you can claim as a deduction under ATM. The turnover of last to last year is 390 crore. Therefore, the tax rate will be 25%. On that, you apply surcharge and cess if applicable. Then you will compute the book profit. Book profit is directly given 520 lakhs. That is 5 crore 20 lakhs. 15% tax, 7% surcharge, and 4% cess. Because the income is more than 1 crore, 7% surcharge will apply. Then you will compute tax as per 115 BAA. As per 115 BAA, when you will compute tax, everything is same. Just add back the additional depreciation of this Surat unit. Additional depreciation will not be allowed. Rest all will be same. I hope it is clear to all of you. Even ATM is allowed under 115 BAA. And then you check which is more beneficial. Go for that. I hope it is clear. Next question we have done earlier. Go and check. Same question. I am putting the reference here. Done earlier this question just now. We have done 5 incomes non-resident is earning. Remember or not? Debentures received. Technical know-how given. Next question we have done earlier. Jan 26 trust. Beautiful question. Beautiful question of trust. Jan 26 if you remember. Remember? Yes, next question is a good question. Question number B1. There is a foreign company which is located in Mauritius. Now they have a branch in India. They have opened a branch in India. Now they are saying that because we are opening a branch in India, we should be liable for tax rate of 30% which is applicable to domestic company. Officer said that no. We will apply 35% tax rate on you. We will not apply domestic company tax rate. We will apply 35% tax rate on you. We will not give you the domestic company tax rate. We will give you the foreign company tax rate. Now the assessee is saying that how can you apply foreign company tax rate on me? There is a DTAA between India and foreign country which says that the permanent establishment of a foreign company located in India cannot be charged less favorable as compared to the Indian companies. How can you charge us less favorable? You are charging Indian companies at 30%. You are charging us at 35%. How can you charge us less favorable? So to protect this, the income tax department has put an explanation in section 90. What is an explanation in section 90? That a charge of a tax at a rate higher than the domestic company is not considered as less favorable. Do you remember or not? So if we charge foreign company at 35%, an Indian company or domestic company at 30%, we cannot consider that. We do not say that as a less favorable charge. We say that as an equal favorable. We do not say that as a less favorable. I hope it is clear to all of you. I hope it is clear. It cannot be considered as less favorable. Next question is a very simple question. That the Income Tax Act provides for taxation of certain incomes earned by Mr. Xavier, non-resident. So a non-resident, Xavier is there. He is earning some income from India. So the Income Tax Act is saying that you have to supposed to pay tax in India. But the DTAA which applies to Mr. X provides for taxation of such income in resident country. DTAA says that the tax will be charged in that country. Now Mr. Xavier liable to pay tax in India? Mr. Xavier is not liable to pay tax in India provided he has to fulfill lot of things. See, in section 90 subsection 2, it is very clearly written that you have to apply the domestic tax law or you have to apply the DTAA tax law, whichever is more beneficial to the assessee. But for that, the assessee has to prove that he is a resident of country X. He has to prove that he is a resident of country X. For that, he has to take what? He has to obtain TRC from country X as per the prescribed format, which shall contain all the informations which are required by the income tax department, like name of assessee, like resident country of the assessee, details of the assessee, email address, phone number, lot of information has to be there in the TRC. If Mr. Xavier is ready to give that to us, we will pass on the DTAA benefits to him. Otherwise, we are not going to pass on the DTAA benefits to him without the documents of TRC. Next question we have done. We have done. Check it please. We have done. Okay. Now this question we have not done. There is some mistake by ICI in this question. I'll tell you what. Mr. Arvind is running a business. His last year turnover is 202 lakhs. It is more than 1 crore. Now he's paying a monthly rent of 25,000 rupees for his office. So whether 194I will apply, 194I will not apply in this case. Why? Because the rent amount does not exceed 50,000 rupees per month. For 190 for I to apply, 190 for I. See, only 190 for I will apply. IB is not applicable in this case. Why? Because Mr. Arvind is an individual. He is doing a business. His last year turnover is more than 1 crore rupees. Therefore, 190 for I is only applicable. IB, the question of IB does not arise only here. But ICI has given the answer by giving reference of IB, not I, which is wrong. IB is not applicable here. Yes, answer is correct of ICI. That whether TDS will be applicable, ICI said that IB will not apply because the rent is not exceeding 50,000. IB is not applicable only here. You have to give a reference of I only and say that I is not applicable. IB is not possible only. I is not applicable because the rent does not exceed 50,000 rupees. I hope it is clear to all of you. Next question. ABC Limited is operating in India and Ben Limited is in Japan. Ben owns 55% shares of ABC. Both of them are deemed to be associated because it is more than 26%. Similarly, out of the 7 directors, 4 are appointed by Ben. Therefore, because of this reason also both of them are deemed to be associated. Therefore, transfer pricing is applicable. Now, the AO while verification of international transaction of 300 lakhs, notice that assessee has not maintained requisite records. All records are not maintained by assessee. So, which penalty will be imposed? 271 AA. For not maintaining proper records as per 92D, 271 AA will be applicable, 2% of the value of transaction. Second, assessee has also not obtained the accountant's report. If accountant's report is not obtained, that is form 3CB, then 271BA will be applicable on you. And 271BA penalty of 1 lakh rupees will be imposed on you. And along with that, 270A will also be applicable because if you are not obtaining accountant's report, it means you have not reported the transaction also. Not obtaining the report means not reporting the transaction, and for not reporting the transaction, there can be a penalty of 200% of tax payable on you, which can be called as misreporting of income. Misreporting penalty can also be imposed on you. I hope it is clear to all of you. Next question. RST INC, a US company having a poem in India. It has advanced a loan of 170 crore to Shiva Limited. How much loan they have given to Shiva? 170 crore. What is the total book value of Shiva? The total book value of Shiva is 300 crore. Out of that 30 crores is repaid, it doesn't matter. What is repaid, it doesn't matter. Ignore that. So out of 300 crore book value of asset, 170 crore I am financing. Therefore, it is more than 51% of the total asset. Therefore, both of them are deemed to be associated. Market value is not relevant to determine associate enterprise. Even what is repaid during the financial year is not relevant to determine what is associate enterprise. I hope it is clear to all of you. Next question we have done earlier. Go and check. I have given the reference. All these questions we have done earlier, done earlier, done earlier, done earlier, done earlier. Everything has been done till here now. Nothing has been left. You can go and check. Everything. After this, everything is done. Everything is done. Everything. Nothing is left. So here we complete the 8 MTPs. Here we complete the 9 RTPs and 9 past paper. Total 26 papers are done. Once again, I would like to tell you all of you, I have recorded this twice separately for all my dear student of English. It is not an easy task from my side. It is your duty to spread this to a maximum student as it is possible. Spread this to across the South India. Mainly I am talking to Guntur students, Andhra Pradesh Guntur students, where I have taken live batch this year. Spread it in all the hostels to the extent it is possible to give maximum benefits to maximum students across South India. I am putting extra efforts for you all. Please consider that much. Secondly, I would like to say, wherever you find anything important, please make sure that you put a timestamp below that in the comment box, so that when you refer for the second time, you make sure that you try to refer that directly by clicking on that particular timestamp. You don't have to waste your time. I hope it is clear to all of you. So that's it from my side. Very soon I will come up with some very important videos which might be relevant for you all. Till then, take care all of you. Bye. See you soon.